Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversations.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices.
And here's where you can watch us.
When others are warming up, I'm raring to go. The stories that matter, the stories that shape your life.
Hello and welcome to watching Prime 5 with Raisha. Just days after Israel launched a surprise deadly attack on Lebanon, killing over 300 people, both the countries will engage in talks in the United States next week. Iran's Supreme Leader Mojtaba Khamenei declares Iran is entering a new phase in its management of the Strait, vowing that those who attacked the country would not go unpunished. Meanwhile, US President Donald Trump admonishes Iran over Hormuz control. US stock futures dipped as investors tracked a fragile two-week ceasefire between the US and Iran. In regular trading on Thursday, the Dow, S&P 500 and Nasdaq extended this week's rally on optimism that the ceasefire will hold. All three major indexes are also on track to post a second straight week of gains. Indian stock market resumed its downtrend on Thursday, a day after rallying due to the US-Iran truce, as surging crude oil prices and cracks in the Middle East ceasefire agreement weighs. Nifty stares at another week which may close in the red. TCS kicks off the earnings season with a steady performance. However, as TCS sees its first ever dollar revenue decline since 2005, we'll have to wait and watch out for as to how the company reacts. The company also witnessed order momentum, whereas analyzed AI revenue surged past the $2 billion mark. A very good morning to our viewers. Hello and welcome. You're watching NDTV Profit. I'm Mahima Vachhajani and you are watching Markets Today. Over the next half an hour or so, we'll tell you everything that you need to know at the start of the day to start on the right note. With regards to the major headlines coming in with regards to where the global markets go, Donald Trump has announced through the post that all US ships, aircrafts and military personnel will remain in Iran with their ammunition and weapons until the real agreement is reached fully and is complied with. In his recent tweet, he also said that Iran is doing a very poor job, dishonorable, some would say, of allowing oil to go through the Strait of Hormuz. This is not the agreement that we had. Iran's new supreme leader vowed that Iran will not let US-Israel go unpunished for their aggression and demand, and this coming in for the compensation for the destruction and more control over the Strait of Hormuz during the negotiation talks in Islamabad. The Prime Minister Benjamin Netanyahu also said that in light of Lebanon's repeated requests to open direct negotiations with Israel, he said that he's instructed at the government meeting yesterday to open direct negotiation with Lebanon as soon as possible. The negotiations will focus on disarmament and establishing a peaceful relationship between Israel and Lebanon. Israel appreciates the call made today by the Prime Minister of Lebanon to kind of demilitarize Beirut. The White House has also, and this is in another news, that the White House has sent an internal staff-wide email that warned employees against using confidential information to place trades on financial markets and fast-growing event betting platforms as well. With regards to where the US markets go, benchmark futures are consolidating in the tight range amid growing caution ahead of the upcoming ceasefire talks with Iran, while the anticipation of key consumer inflation data has also kept investors on the sidelines. We saw the Dow futures seeing a downtick of around 0.02% and Nasdaq future an uptick of around 0.08%. With regards to where the Asian equity goes, the indices have opened on a positive note. Gains are there while expected to consolidate at higher levels is what the market sentiment is looking like before the important talks between the US and Iran on the recent geopolitical situations happen. Overall, if you take a look at the indexes right now, Nikkei is up 1.8%, Hang Seng up 1%, and Shanghai just seeing gains about 0.5 odd %. With regards to where the Indian markets go, Indian equity benchmarks resumed its declines, of course, on Thursday after one day of breather is what we saw, tracking weak global cues on uncertainty around the ceasefire and reports of renewed Israeli strikes on Lebanon. The Nifty 50 ended 0.9% lower to settle near 23,780, and the Sensex slumped over 1.2% and 900 points of a decline is what we saw. FIs have still remained sellers for 27 days straight, but the intensity is lower as compared to what it was in February. So that's with regards to where the Indian markets go. Right now, the implied open is suggesting an uptick of around 83 odd points. So that's with regards to where the Indian markets go. But let's take a look at how the derivatives space has shaped up. And Puneet is joining us to tell us as to what the cues are indicating. Puneet, what are the F&O cues looking like?
Well, at least a start in the green for now. Yesterday, we saw correction across the board after a very strong session on Wednesday, led by global factors, of course. So you saw seeing at least an 81-point uptake above the 23,900 odd levels for now is what the GIFT Nifty indicates. The long-term support continues to be at 23,800. We've largely maintained that while there has been limited historical evidence and hence we've breached that level. We seem to be recovering at least above that yet at time and again. So we'll continue to monitor that, as well as in terms of Bank Nifty, 55,500 continues to be a support, but you saw the index being under pressure yesterday. So yet again, we are finding support in the 54,000 odd levels, but seems to be a lack of it as of now. In terms of the cash markets, yet again, we saw foreign investors continue to sell almost 1,700 odd crores. There hasn't been selling to the rigor of almost $1 billion a day. And it has reduced as they await Q4 earnings. It's still a sell figure for yesterday's trading session. DIs continue to plow in money, and the index long also just a trim of almost 0.5 from roughly around 21.1 that it was yesterday. Index put call ratio also continues to be hovering around the 1 to 1.1 mark, largely a neutral position for now. In terms of open interest distribution, we have moved up the curve yet again to 23,500 now. So 24,000 is a key level for the calls, and 24,500 for the calls continues to be a couple of levels where open interest is materially high. Out of money call options is the way to go for now. But finally, in terms of open interest gainers and losers, we've seen individual stock movers dominating the news flow, and Godfrey Phillips yet again seeing a 24% open interest change for longs being built up. Motilal Oswal is the other one, while in terms of losers, very quickly, on Hitachi Energy, also saw long build up on the back of a brokerage node initiation, and short coverings continue to be one of the key factors in Force Motors as well, post hitting, breaching 20,000 yet again on stop. So continues to be in focus on April futures, but largely expecting a day, Mahima, to have decent news flow and hopefully continue to be in the green today.
Well, all right, and the hope continues. Let's hope that we open in the green and end in the green as well for this day and week as well. But that's with regards to where the F&O goes, and of course, with regards to where the overall resistance of that 24,000 stands, that's something that we'll be watching out for as well. But the major news, of course, coming in with earnings season kicking in, TCS has reported a steady fourth quarter with numbers coming in line with what the estimates are. But I think, Jasmeet, the concern is with regards to how, the overall revenue in terms of where the US stands. I think that's seen a decline since, first decline since 2005, if I'm not wrong. Give us the entire details of how the earnings have panned out this quarter.
Well, absolutely, Mahima. Very good morning and thank you for that. Let me quickly take you out to the Q4 earnings first and then give an overall perspective of FY26. In Q4, we do see a steady set of numbers where the revenue was beat in terms of what we were expecting and came in at an uptick of 5%. If you look at overall CC growth, came at 1.2%, the highest in last 4 quarters. While thirdly, talking about the overall deal wins, the deal wins also came in at roughly $12 billion, again $2 billion higher than what we were expecting in terms of the overall deal win for this particular quarter, given Q4 is generally soft for the company. While talking about the third aspect, that's the headcount. We see a healthy net count addition of 2,300 employees for the first time in last 3 quarters. So after the restructuring was announced in Q1, the company nearly cut 31,000 employees, and post that we see an add-on of 2,000 odd employees in the Q4 as well. So these are the key reasons why the Q4 seems to be a good up move in terms of the overall aspect. Now quickly help me run you all to the numbers as well. Now in terms of key revenue is up 5.8%, while EBIT is up by 5% as well. But the margins have been flattish in this quarter, though that's something that you were expecting already. The net profit saw uptick of 28%, while this up move of 28% comes on the back of the low base in the Q3 we saw due to the labor code impact. So all in all, we do see a good Q4 for the company. But now if you look at the annual figure, the FY26 figure, we all in all we see that the company reports its first ever dollar degrowth in terms of revenue since FY 2004. While this thing comes on the back of that overall AI fear, though we had rupee depreciation, still we saw overall degrowth for the first time in the company. That's why the street is being a little concerned. Now, if we look at the ADRs of the competitors as Inflows and Wipro in the US market, they did see a downtick, showing the overall AI fear being continued, and is this the first sign of AI actually deflating the overall revenue? That's something which will be a key concern to watch out for. Though the management remains positive on FY27 and they expect the overall AI revenue to grow faster in the coming quarters as well.
All right, Jasmeet, with regards to all the concerns that you flag, I think that is the reason, one of the reasons as to why some of these brokerages have also gone ahead and cut target prices for TCS. What is the overall consensus view coming in with regards to how Q4 has panned out for TCS?
Well, in terms of the brokerages, you rightly said the brokerages have remained bearish on TCS for a while, and post the result, we have 3 brokerages that have come out and given the ratings. First is Jefferies on TCS, while they maintain underperform and they cut the target price to 2,275 from 2,350 earlier. A cut of 75 rupees, but still a major one. They see a subdued growth outlook for the company going ahead. Further, they also make a note, though the Q4 was in line, but the margins have missed estimates as per their analysis. Further, they also see that the weak growth in BFSI segment is something to watch out for, given BFSI is the biggest segment for the company. While the next one is Citi, while they maintain sell on this particular counter with a target price of rupees 2,250. While they see the overall Q4 EBIT was in line, but they expect a low single-digit revenue growth to continue in the future as well, which will be a key concern for something like a TCS being at a large scale. While third one, we have Investec on TCS. Well, they maintain buy, but they cut the target price to rupees 3,020 from 3,700, a cut of roughly 600 odd rupees. While they cut due to the overall aspect of saying they cut the PE multiple by 20%, assuming that the long-term growth still remains subdued for the company. They expected a better commentary for FY27, which they could not get. So all in all, we do see brokers remain bearish on the particular counter and cut the target price as well.
Okay, Jasmeet, thank you so much for getting us those details. It's a wait and watch when it comes to TCS. While brokerages are cutting their target prices, we'll have to see as to how the market reacts to its earnings. But it's time to take a look at what stocks are in focus today. And Varsha is joining us with a whole list of stock which will be expected to be buzzing on the back of news flow coming in. Varsha, over to you.
Yeah, well, let me start with the stocks which will open positively or are expected to open positively. You have JSW Steel, wherein a company has come out with its business update, wherein total crude steel production is expected to go up 8%. Onto the Godrej Properties, booking value is up 16%. IRB Infrastructure has also come up with a business update, wherein their March toll collection is up 21%. Satwik Green has secured 109 crore order from EPC player. Wipro is considering a buyback of equity share and hence is expected to open positively. You have HDFC Life, which is expected to raise funds. Eicher Motor has launched the Flying Flea electric motorcycle, while BSE is expected to launch derivative contract. GHV Infra has won order of 105 crore. Ashiana Housing has acquired land in Pune, which will have a sales potential of around 1800 crore. Poonawalla FinCorp has launched QIP of to raise 2500 crore. But Couple of stocks which are expected to open negatively. Of course, you have TCS, wherein brokerages are bearish when it comes to TCS, and they've seen a drop in FY26 dollar revenue for first time since listing. You have KEC, wherein they get a tax demand of around 46 crore from IT department. So these are all the stocks which will be in focus on the back of news flows.
All right, Varsha, thank you so much for getting us those detailed whole host of stocks that you must keep on your radar today with regards to where news flow is concerned. But, other couple of stocks, counters, which are in focus on the back of their business updates are JSW Steel and Container Corp. And we have Puneet joining by to give us more details on how Q4 has panned out in terms of business updates for these.
Well, decent numbers for both of them. So let me start with JSW Steel first. Almost 7.49 million tons. While it's down 2% on a YOY basis, we have seen that pricing will be a key factor in Q4. So that's the combined crude steel production. We've also seen that for the Indian operations, down 2% at 7.28 million tons, while the capacity utilization continues to be hovering around 96%. So capacity addition will be a key factor to watch out for from the management. They have already announced some of the key measures, but when you look at the company's Salem plant, which has been the other aspects, now they saw its casters are being updated in January of 2026. Because of that, the capacity here has now gone from 1 million ton to 1.5 million ton. So that's something to watch out for. In terms of the FY26 production, also was up almost 8%. So this will be a key one for JSW Steel for today. In terms of Container Corp, also a very similar number where you've seen the total throughput up 6%, but the EXIM numbers are up almost 2% on a YOY basis, while domestic is up 18% in this particular quarter. For FY26 as a whole, you've seen throughput increase to 9.5%. So a couple of key stocks buzzing on the back of Q4 updates. A lot to, of course, watch out for from their results, quarterly results as well.
Absolutely. Thank you so much, Puneet, for getting us those details with regards to where Q4 business updates go. And in fact, Macquarie has also come out with a note on metals. Puneet was just talking about JSW Steel, where they've hiked prices for a lot of these metal counters. They're saying that in Q4, firm prices will boost EBITDA and ferrous segment may do better. Varsha is here with exactly that update. Varsha, what is Macquarie exactly bullish on when it comes to metals?
Yeah, well, they've rated outperform to Tata Steel, JSW Steel and Jindal Steel with upping their target price, and while they have maintained neutral for Hindalco, Coal India, and they've also hiked target price for both of these counters. Now what they're saying is on Q4 they're expecting firm prices which will boost EBITDA for these companies, and they prefer ferrous metals though. Domestic steel prices remains firm according to Macquarie, auguring well for FY27 earnings as well. They're saying that the Hindalco will benefit from firm aluminium price and gradual uptick in Novelis EBITDA, but valuation cap remains, or valuation cap's upside potential. Well, for Coal India, they are expecting neutral rating, which reflect modest downside following recent stock outperformance. So overall, they are bullish when it comes to metals, but they have upped target price, or they are maintaining outperform when it comes to Tata Steel, Jindal Steel and JSW Steel overall.
Varsha, thank you so much for getting us those details with regards to where metals go. But there's one more interesting note that has come in from Macquarie. What they're saying is that underperformed emerging markets have come down by 50% since 2025 on persistent foreign selling. The building blocks will support a near-term reversal, but overall the near-term reversal that they're looking at is somewhere missing. But from a negative view in 2025, they've turned mildly optimistic when it comes to 2026. What they're saying is that with a disrupted global energy market, we revert to a guarded stance. For sustained market outperformance, India's aggregate earnings profile needs to improve going forward. Typically, what they're saying is that 500 basis points EPS growth premium to emerging markets has to resume in order to achieve all of this. In fact, Nuvama today has also come out with an interesting note which says that this is where now they're seeing buying opportunity when it comes to the overall small cap space as well. So that's with regards to where the overall view on the Indian markets go coming in from these brokerages. But, shifting focus, the upcoming Noida International Airport is weeks away from starting commercial operations. Built with over rupees 11,000 crore worth of investment, the airport is expected to be one of the biggest airports in North India once all phases are completed by 2030. The airport, which missed 2 deadlines previously, is now expecting to get security clearance to soon commence operations. Our colleague Danish Anand brings us this ground report. Take a look.
After more than 7 decades, people of Delhi NCR are about to get an aviation boost as the upcoming Noida International Airport or the Jewar International Airport is all set to start its commercial operations in the weeks to come. And right now, NDTV Profit is present at the departure terminal of the Noida International Airport. First, talking about the design, the entire airport has been designed keeping the rich legacy and history of the state of Uttar Pradesh in mind. And that area that you see over there, this is depicting the ghats of Varanasi. And if you look at the ceiling of the terminal exterior, this is depicting the river flow, and hence as far as the design is concerned, all these basic things have been kept in mind, that how the rich legacy and history of Uttar Pradesh can be shown in this airport. Now, this is how the airport looks from the departure terminal side. Now, let's go inside and take a look at how the operations will be from the airport. As of now, if we talk about which all airlines have shown their interest to start operations, one is the Air India Group, and the other is Akasa, and third is Indigo, and you will find all these airline counters situated over here. And this is the runway 2028, which is 4,000 meters long, and this is the first of the 2 runways that the Noida International Airport will have. And the airport has also signed an agreement with Akasa Air to set up an MRO facility over here in order to attract more and more airlines.
Right, so that's the Jewar airport, and countdown has begun for this particular airport. But amidst the Middle East conflict, Mohit Bhatia, Director Commercial for IGL, expressed the need for India to leverage compressed biogas. Speaking to us at the All India Management Association event in Delhi, the director laid out all reasons why we should adopt more CBG. Listen to what he had to say exactly.
I would relate CBG particularly with 3 E's. The first E is the energy security, and if we want to have this mission of achieving Atmanirbhar Bharat or a Viksit Bharat, so CBG is one space where we can really leverage, and India has a great potential, almost 60 million tons potential of CBG. So that is one A part. The B part is the economic booster, I would say, because it generates circular economy, and it's a economic booster for the rural farmers and all. And the third is definitely the environmental gains. We can say that CBG is carbon neutral and a great step towards decarbonization.
In fact, at the same event, former RBI Governor Shaktikanta Das praised India's remarkable economic resilience. He said the country has achieved efficient gains, strong infrastructure expansion, and maintained growth over 7%. Listening to what he had to say.
In the face of global volatility, India has displayed remarkable resilience with its real GDP growing by 7.6% in the financial year we just concluded, that is financial year 25-26. I would like to stress that India's resilience does not alone explain the full story. In the last 5 years since COVID-19, India did not just endure the period of turbulence, it transformed through it.
All right, viewers, with that, it's a complete wrap on this edition of Markets Today. But do stay tuned. India Market Open up next.
Presenting the all-knowing, all-powerful Tech Guru.
Whoa. Guru? I'm no guru.
Okay.
I'm just a guy who loves his tech.
A show where the mysteries of megabytes and motherboards shall be unraveled.
Bro, nobody talks like that anymore. This is all about connected ecosystems, EVs and AI that you can use in your daily life. That's what we do on Tech 360. Real talk, real reviews, tech that you can actually use.
Tech has changed. So should your tech show. YouTube doesn't have a favorite news channel. It has 3. NDTV Profit, India's #1 English business news channel. NDTV 24/7, India's #1 English news channel. NDTV India, India's #1 Hindi news channel. 3 channels, 3 undisputed leaders, 1 unstoppable network. NDTV.
To understand the Tamil Nadu twist, join me in the midst of our people, language and politics. Vanakkam Tamil Nadu, here we come.
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversations.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
When others are warming up, I'm raring to go. The stories that matter, the stories that shape your life.
Hello, welcome to watching Prime 5 with me, Aisha Said. What's happening?
The show that sets the prime time agenda.
We'll be deep diving into this topic to tell you what's at stake.
Join me, Raisha Sehgal, on Prime 5, only on NDTV 24/7.
Will the rising sun win with a hand in hand? Will the two leaves and lotus bloom? Who will whistle to success in Tamil Nadu? To understand the Tamil Nadu twist, join me in the midst of our politics and people. Vanakkam Tamil Nadu, here we come.
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversations.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
New year. New power panel. India market open. Now in its boldest lineup. This is where the trends get tested and stocks get conviction.
I'll recommend a buy call on a stock only when I'm fully convinced on the stock. With a table-thumping buy.
And when the street wants the levels, he brings the chart.
Charts speak the truth, and I deliver the levels with no frills.
Parag Thakkar and Kush Bohra are now part of the morning crew with Tamanna, Neeraj and Alex. Same show, sharper voices. Every morning on India Market Open, your favorite market show just got better. On NDTV Profit, for your profit. presenting the all-knowing, all-powerful Tech Guru. You're watching live from the NDTV Profit headquarters in Mumbai. This is India Market Open with Tamanna, Alex and Neeraj.
Very good morning. You're watching India Market Open. Is the ceasefire lasting or not? If that's the big question, at least for now, it seems there's an uneasy calm. But I think attention is going to shift homewards today in the markets after a big result has been announced. TCS has kicked off the result season. Of course, I had the opportunity to speak with the management as well, but wondering what you guys made of the numbers, because on first gaze, everyone thought it was very positive, and then brokerages aren't so excited.
I know we'll talk about this in detail, right? But 3 quarters of consecutive quarter-on-quarter growth, fairly strong commentary for FY27. Multiples not too demanding. I think the street should be pleased with this. I'll be really surprised if the stock doesn't start off with a fair tick of green.
I am not entirely convinced. At first flush, the numbers look incredible. If you look at the revenue growth of well above the consensus estimates, you look at the constant currency growth, which is more or less in line, maybe at the lower end of what people were expecting, 1.2 to 1.5%. My concern is the BFSI, which is the biggest segment, which is up just 0.1% on a sequential basis. And if you have a stress point in the US, which is their largest market, if it's heading for a bit of a slowdown, it's not looking good in FY27.
What's your take?
So, because I had the opportunity to speak to the management and look at the numbers as well, I think they're doing much better than people have anticipated. And if you look beyond the noise of one quarter's numbers, the kind of announcements that they've made and tie-ups they've made. I mean, they've tied up with Anthropic, Nvidia, AMD. They've renewed their Marks and Spencer's account as well. So the deal pipelines are coming. I mean, the visible sign of stress for me would have been if the business is drying up. That's robust. So that is a positive. And one thing that they said, because I asked about the 30,000 odd headcount which was let go of, and how the whole revenue stream changes, they're very convinced it's not going to make a difference. Revenues are not going to be hit because of AI, is what they've said again and again. And the restructuring, so to speak, is over. It's done with.
They added to headcount actually 2,000.
2,500, but then it looks like a small amount if you compare to 30,000. But that phase is done. I thought that was quite heartening.
Should be awesome to see. Okay. And by the way, guys, so that is TCS, but that's the other thing, and I'm going to be anal about this all through the next 1 year. This whole feeder nuclear reactor piece that we've gotten into, right? Phase 2. There's a very interesting thing that happened, and from a nation perspective, I think it's really good. One of Kazakhstan's largest companies, the shareholders of that firm, voted 92.9% in favor of concluding this long-term uranium supply with India. So about 50% of their total uranium supply will be given to India over the course of the next number of years.
Excellent.
So India is really tying up those ends when it comes to that whole piece. I know we've done a fabulous piece already, but that's something that we should definitely keep an eye out for.
Definitely a big story simmering on, and the 1 year timeline is about right before the street sort of catches up to what's happening. So much to unpack this morning. So let's get to it. And on the geopolitical front, I think it's noteworthy the statement that has come in from the Ayatollah. Iran's supreme leader has issued a statement. Mujtaba Khamenei has declared victory in that conflict. Now, this is a written statement which someone else read out, attributing it to Mujtaba Khamenei. In this, he says that compensation will be demanded. I thought that was important. I've just picked the important bits. And has also said that management of the Strait of Hormuz will be advanced to a new stage. This is important to see how this works out and whether there's going to be more friction on how the Strait of Hormuz is handled, managed, manned, and tolls collected here on. As far as global markets are concerned, at least US markets continue their winning streak on the announcement of a ceasefire between US and Iran. You saw all indices up in the green, and the US markets are set to end the week in the positive as well. The Nasdaq about nearly 1% up. futures have been a little more tepid, but pretty much flat. Nothing astonishing one way or the other. Bond yields have stayed steady as personal consumption expenditure index, that's PCE, important inflation gauge that the Fed watches, that's come in line. The 10-year is at 4.28%. Oil prices, meanwhile, are staying volatile as Iran continues to limit the number of tankers in the Strait of Hormuz, which is why you saw Brent touch close to 100 in the last few hours, but then cool off after Israel has announced talks with Lebanon. So you have 96.46 on this. Just the latest in that, Lebanon has responded saying, we'll talk to you only when you stop bombing us. So this is a wait and watch kind of a situation. In other news, Russia has announced a ceasefire for Easter, Orthodox Easter, I believe, with Ukraine. So all of that is happening on the backdrop as well. Let's pull up Asian markets, and largely the consensus seems to be that the ceasefire has kind of held, and which is why they implied in India also showing you a green uptick and possibly a positive start after the 200-point drawdown on the Nifty yesterday. Santosh Rao, Head of Research Partner, Manhattan Venture Partners, joining us this morning. Santosh, very good morning to you from where we are. Always a pleasure to speak with you. Do you think this ceasefire, along with a few skirmishes here and there, looks like it's holding for now? It's not collapsed immediately, at least, and that's something that the street will look at positively.
Yes, I think if you listen to the rhetoric from both sides, they just don't seem to be talking to each other. Everyone has, it doesn't seem like a ceasefire. They're talking different languages. I mean, Trump has rejected their demands, Iran's demands, but they think it's it's very unreasonable what they're saying. But then it's going forward. The market believes there is a Trump put out there. In the end, things will work out, and everything will be okay. I think that's what's happening. So there's a lot of back and forth going on, positioning going on. So I think it will prevail in the end because it's in the best interest of both. But both will really put all the posture in front of them because both want to say that they won. So I think all that is going on. That the big thing, trading on geopolitical event at this point is probably the toughest thing at this point because there is there doesn't seem to be any consensus, just in the broad outline that, okay, there is a ceasefire, but they're talking different languages. The terms are totally different. So I don't know at what point they're going to say we're going to call it off, or they're going to go ahead and then call it off. So we don't know. It's still till the end. It's not good. It's not done till it's done because they're talking totally different things. So let's see. Let's wait and see. But at this point, the market thinks it'll go ahead and there will be a ceasefire.
We hope that that's the case as well, Santosh. And good morning to you from where we're at. The question is, in the interim, there are signs that there is a slowdown, at least a tad bit, relatively speaking, in the US economy. The latest high-frequency indicators, the question marks about private jobs, and various other factors. And if inflation does pick up, then what happens to growth in that kind of a scenario? What happens in a scenario when monetary policy has to react to inflation? So relatively near term, I'm not even talking that far out, I'm talking about the next couple of quarters. How do risk assets react to that?
Yeah, I think you nailed it correctly, because I think there's a whiff of stagflation, because you have inflation on one hand, oil prices staying above 100 is still a very risky bet. Inflation will kick up, and then jobs are coming down. The labor participation rate is coming down. So the labor market is weak. So you have both sides. The labor is weak, growth is slowing down, inflation is picking up. So very stagflationary in that sense. So we have to wait and see. At least the first half of this year, which is it's not too far away, end of June, it's not going to be good. The hope is that the market is betting that the second half will be much better. We might get one rate cut there with the hope that things will settle down on the geopolitical things. On the domestic front, earnings are expected to be very good. The earnings season just kicks off. They're still expecting 14% earnings growth for this year so far. So in that sense, the earnings are good. P multiples have come down. So I think there is, it's kind of coiled to go up. The market is pretty much spring-loaded to go up in that sense because the Ps have come down and earnings are good. So in that sense, the fundamentals there in terms of the stock market are pointing good towards the second half. But for the next 3 or 4 months, it's going to be very, very, not very rosy because you have inflationary pressures and also job market is still very weak.
Santosh, good evening to you, of course.
Hi. Hi,
Neeraj. The slew of global brokerages, right, who talk to and advise foreign institutional investors are almost unequivocally turning bullish or have turned bullish. You look at CLSA, you look at Jefferies, you look at JP Morgan, all of them have turned constructive on India. Does this valuation reset help attract foreign institutional investors back to India with the presumption, of course, that we've seen the last days of the conflict as well? Or do you think it's still some time away?
I think India is now very well positioned because the multiples are very attractive. They have come down quite a bit. So I think India is a great market for money to come back in. I don't know the exact timing, but definitely the wind is blowing definitely in your favor in that sense. But we'll wait and see where. I think everybody is waiting and watching at this point. But the market looks ahead. The smart money looks way ahead. And down the road, 6 months to 12 months ahead, I think India is definitely a good place to invest because of the fundamentals that there are. So I would say even US is expected to kind of pick up also towards the later half, like I said. So things are global growth, I think, will be much more stable and up on pointing up towards the later part of the year. We might get we won't get a rate increase for sure. They'll hold or maybe cut one by the end. So the US will give you some incentive there. The dollar is kind of pulling back a little bit, which is good for the emerging markets. So I think all that will point to a good setup for India and other emerging markets.
Right. On that note, Santosh, thanks so much for taking the time. Pleasure speaking with you as always.
Thank you. Take care.
All right, well, let's talk about what happened in trade yesterday. You had the benchmark Nifty 50 that shaved off about a quarter of Wednesday's gains, and the Sensex expiry apparently added an element of volatility in that trading session. In fact, the Nifty 50 trading in a 200-point range and quite a bit of seesawing in that time frame. It ended nearly 100 points off the intraday low, in fact. Private banks, Larsen & Toubro, Reliance Industries, purely on the basis of weightage, led the declines on the downside, right? The Nifty Bank underperformed the benchmark with cuts of 1.6%, and Nifty IT was in focus ahead of the TCS results. In fact, the Nifty IT made a pretty roaring comeback from the low point of the day. That gain was as much as 1.7% from that low point. It ended in the green with gains of just about 0.2%. Metals and defense shone in that lackluster session, and financials were the worst performers. In fact, the Nifty Bank was the worst sectoral performer. Broader markets outperformed with both of those indices ending in the green, and market breadth actually improved but ended with declines still ahead of the advances. Foreign institutions are still selling, but they are selling less than they were earlier on in this conflict. They sold on a net basis about 1,700 crore rupees, and that was more than matched by domestic institutions, Neeraj.
Yeah, so that was, you could argue that yesterday's price action, if not entirely countering day before's yesterday's price move, but in some sense countered the move. But, the stage is set for maybe if IT delivers, then some positivity. Yeah. Because yesterday what we saw was the lingering uncertainty capping the upside. But can we say the same for it today? Now, there is, how do we say, a small precedence. You would expect that because there are the US-Iran conversations or dialogues going to take place over the weekend, you would expect that profit booking is possible today because the street may want to go into this light, if you will. But we thought of the same before the Good Friday long weekend, and Thursday we actually had a rally from the lows, right? So don't rule out a surprise move like Thursday. As of now, it may not be showing, but I somehow feel that IT may help the Nifty and people should keep an eye out for defense stocks. Now, I'll tell you why there is a, just a bit of a conflict from a trade perspective. I know we'll talk about the fundamentals, and Tamanna, of course, will be best placed today to talk about it. But positioning into these results for TCS, there was a note which I read post the results that majority of the shorts built in TCS were YTD were still in the system. OI is still 10% higher than the 3-month average, while price is down. So keep in mind. So that is maybe a positive. The antidote to this, and maybe positive from TCS commentary, and I'd love to know what they said to Tamanna, is that yesterday all global IT stocks were down. Accenture hit lows as well. So the global piece on IT isn't quite supportive. So there's a bit of a tug of war out here. Remains to be seen how it shapes up. And just one more point of, from a market-wide perspective, one more point of data, if you will. Nuvama Institutional Equities note says that the small cap index has also entered a long-term buy zone, reinforcing the bottom-up accumulation opportunity across the broader market. And a note from Ikigai, guys, said this very interesting data. I know we spoke about this Sunil Singhania note ke 17 mahine ke baad hamesha rally hoti hai. Ikigai says that since 2009, 4 months of negative streaks on the Nifty, like the one recorded in March 2026, have been followed by an average 1-year return of 40%. I don't know if we do 40%, but
we'll take half of that.
It's an average. So yeah, you're right. We'll take half of that. So let's see. The decks are set maybe.
The only thing on TCS is if you look at the brokerages this morning, a lot of them have reduced their target price. Not all of them, no one has downgraded, but target prices have been cut and EPS outlook has been cut. So we'll have to wait and see.
So like I said, I want to hear what Tamanna has to say about it because she spoke to the guys, spoke to the management. But could it be like what happened at 22,200 on the Nifty, that all brokerages cut the targets from 29 to 26 and we've had a bit of a rally? I mean, I hope that happens.
Maybe things work in lag. I don't know. We'll have to wait and see. See, you have to look at the picture altogether because any management of any company you speak to will always sound bullish on their company. The only difference here is because of the pedigree, the credibility of what they say or the believability factor of what they say is much higher because we speak to so many companies all of the time and no one comes and says my company is in trouble one way or the other. But it's about the credibility, the track record of one management versus the other, I suppose. All right, in terms of factors to watch, I thought this Macquarie note on the India strategy was interesting from Aditya Suresh. India has underperformed emerging markets by 50% since 2025 on persistent foreign selling. Still, the building blocks to support a near-term reversal are missing. From a negative view in 2025, we had turned mildly optimistic for 26. But with a disrupted global energy market, we revert to a guarded stance. For sustained market outperformance, India's aggregate earnings profile needs to improve. The typical 500 bips EPS growth premium to emerging markets has to resume. So it's all coming down, I suppose, to earnings. For today's setup, the big question really is FII selling waning off, and that's the point that Alex made as well. FII sell figure yesterday was at 1,711 crores, lowest since the war has begun. Now, it's a very different way to see the FII numbers. We used to, because the buy number is now a sight for sore eyes. We haven't seen one in a while. But the fact is that the selling momentum is beginning to come down. After a 5-day winning streak, the Nifty paused for profit booking yesterday. I look at it more as profit booking than any big question mark on the ceasefire. The Nifty has managed to hold above short-term averages though. US, Iran, Israel triad continues to dictate the broader trend. Markets are entering a consolidative range-bound phase as the world watches the ceasefire. Major resistance at 24,000, that's the big hurdle. Sustaining above this opens the path to 24,300. Immediate support 23,500 to 23,450. Strong demand zone coincides with short-term moving averages. But the Bank Nifty remains above the short-term EMAs, suggesting the broader structure is still intact. Despite the pullback, resistance at 55,375 and 55,860, supports at 55,645 and 55,055. So those are some of the levels you need to look at. But let me go across to Puneet for the F&O setup this morning.
Well, thank you so much for that. We've largely seen, a start in the green being indicated for now, but essentially a time-wise, not a correction per se, but introspection seems to be a key thing that we are watching out for, because while 23,800 has been a long-term support, we reached that level a couple of days ago and then back again above that. But for now, continuing to hold that number about 23,800. Hopefully, some more time spent essentially at this level can give some confidence to investors for it to be a long-term support as well. For the Bank Nifty though, it's a slightly more tricky area because 55,500 was a key level. We breached that on Wednesday, but have now retreated almost 700 points from there. So there's essentially a lack of support in this 54,400 mark, a very near-term one, but hasn't been tested thoroughly enough to have a long-term support like 23,800 for the Nifty before we saw that slit again. So the banking names will be, the next trigger could well be earnings in the next week, but largely continues to be in a very, very sensitive zone for now. For investors, as you rightly said, 1,700 crores, it's much down from the $1 billion selling number, which we were seeing every day in the last week, but continue to monitor this. And in terms of the index longs too, it was 21.1 yesterday, seen a slight 50 basis point reduction by the foreign investors in the longs that they built, but 20% is still very healthy compared to what we saw at the end of February. So going into earnings season, it's a decent number, the highest it has been over the last 6 weeks, of course, and monitor that. And in terms of open interest distribution, also very similar to yesterday, 24,000 for the calls, 24,500 out of money open interest being increased. And for the puts, we've seen 23,500 as a level now, starting to see action there, and that's good for the long term, which we are seeing as a level where put investors buying an out of money or slightly out of money put option there. And finally, in terms of stocks, yesterday was one where you continue to monitor a bunch of them. So Godfrey Phillips yet again saw a long being built up. So did Motilal Oswal and Nippon Life. But in terms of the open interest losers, there's only a couple of them, and then the open interest thins out very quickly. So only Force Motors was the one where you saw short covering, but largely a day, watch out for the auto pack, did well yesterday, and metals continue to be in favor. But barring that, it's here and there for now for almost all the indices going into Q4 earnings.
Absolutely. Thank you for that, Puneet. All right, stocks on our radar. I'm talking about TCS first. It's on my watch list. I'm giving it a thumbs up. This is not to preempt how the stock will react today. This is how we're looking at the numbers. So the numbers have beaten estimates. Margins are in line. Revenue grew in constant currency terms at 1.2% versus 0.8% in Q3. The fact is that in dollar terms, revenue did dip for the first time in several quarters. So that is one point that could see a negative impact. But for FY26 is down 2.4%. Headcount was up 2,356 after a downtick of 31,000 in the last 3 quarters. The annualized AI revenue is at $2.3 billion versus $1.8 billion in Q3, so big jump there. And the management says that this will continue to grow at a strong trajectory. The deal win size at $12 billion for the quarter was versus an estimate of $10 billion, and 400 million plus clients were added in the quarter. The key numbers also on your screens, where revenues were up 5.38% at 70,698 crores. EBIT was up 5.8% as well. Margins were up 10 basis points at 25.27 crores. This is all Q on Q. Net profit was 28.72% as well. Here's what Jefferies says. They've maintained and underperformed and cut the target price to 2,275 from 2,350. I mean, both are actually below where the stock price is right now. They've said there's a subdued growth outlook. Q4 revenue was in line, though margins missed estimates as per Jefferies. Weak growth in BFSI, flat year-on-year deal bookings, AI-led revenue deflation due to higher exposure to application management services should keep growth in check, is what they say. Margins are expected to remain range-bound in absence of strong revenue growth. They expect a subdued 5.5% earnings per share CAGR over FY26 to 29. Wipro is the other stock on my radar. Thumbs up for it. The company's board will meet on April 16 to consider a proposal for the buyback of equity shares. This always excites the market. You could see some stock movement as well because of it. Here's what Morgan Stanley says. They've maintained an underweight with a target price of 242 rupees. They're saying a potential buyback has been a move anticipated by the market. They see potential for a $2 billion buyback. That's approximately 8.5% of the current market price. During the past 5 buybacks, Wipro has outperformed versus the Sensex post a formal buyback. An announcement in 4 out of 5 times and 3 out of 5 times has been positive. They expect a likely positive reaction on the share price in the short term. Believe investors would quickly shift their focus back to fundamentals. But for today, it could be a positive story. JSW Steel's business update is the other one on my radar. A decent set of numbers. There was some pinch, but that was anticipated. So the total crude steel production was up 8%. In Q4, it was pretty much flat, 0.1% year on year. Morgan Stanley says that the India operations have been down 1% year on year and up 1% quarter on quarter. So flat either way. The Ohio volumes were 0.15 MNT versus 0.2 in the last quarter. Consolidated production volumes were at 7.49 MNT in Q4 and flat for the quarter. Their view is that the company had earlier highlighted that one of the blast furnaces in Vijayanagar has been under shutdown for capacity expansion and would impact Q4 production as well as Q3. However, they also note that with the help of inventory destocking, sales volumes should be relatively better. So those are the first 3 on my radar.
You know, I think that a lot of attention is going to be demanded, rightfully so, by the IT pack. So I don't know how much the other stocks are going to react. But let's see. Ashiana Housing is on top of my list. They've acquired land parcel 28.5. It's a pretty large parcel of land. This is in Vadgaon in Pune. Or I think it's on the outskirts of Pune. This is land that is intended to be used as a senior living project, and I think this is a bit of a trend for a few real estate companies that are now entering that senior living space. The way that it works is that they launch these projects and they sell properties, and then there are services that are offered to the residents of those projects. The saleable area is estimated at 20 lakh square feet and sales value potential seen at 1,800 crore rupees. I find it fascinating that the conversation has shifted now to a certain extent from that demographic dividend to the number of people that are now heading towards retirement as a natural course takes or natural progression takes its course in India. Poonawalla FinCorp is the second on my list, and purely on the back of price action, they've announced the opening of a qualified institutional placement of equity shares on the 9th of April. That was yesterday. Floor price of the issue has been set at 390.26 rupees per share, and that floor price is less than 3% discount to yesterday's market close. But bear in mind that the market value dropped by as much as 3% in trade yesterday, and the stock is down as much as 12% over the course of the last month, in fact from the 2nd of March. Eicher Motors, the third stock on my list, purely on the back of the expansion of its EV portfolio. It's launched the much awaited Flying Flea. That's the name of the electric motorcycle, and that's been priced at 2.79 lakh rupees. Not cheap, but it's a cool looking motorcycle, and people have bought Royal Enfield without really blinking too much at the price.
Yeah, almost all the times in the past. Let's see if this one is yet another episode of the same. I have 2 sets of stocks, if you will. The first one is life insurance. Now, HDFC Life, there is a board meet scheduled on April 16 to consider raising funds through issuance of shares. Now, you know why it might be interesting to see how this shapes up, because the price is at 591. Now guys, do you know that the stock first hit a price of 590 on 11th October 2019? So for the last 6.5 years, if you will, after going everywhere, it has given 0 returns. 6.5 years. So it'll be interesting to see whether this gets lapped up or no. Just to be fair, I was looking at the life insurance space at large. ICICI Pru Life was 522 rupees in November 2019. It's at about 540. Again, virtually zero returns for about 6 years. LIC listed at 820 in May 2022, it is at 793. Since listing, virtually zero returns. The only life insurance company which has actually given returns, if you will, meaningfully is SBI Life, listed at 700 in 2017, currently is at 1904. So in some sense, that one has beaten the gradients, but otherwise, all the others haven't quite really created shareholder wealth. So it's interesting timing for HDFC Life to do their fundraise. Let's see how successful it is. Godrej Properties is the other one. The Q4 collections are up about 14% YOY, 86% quarter on quarter. Booking value, you could argue that you can look at booking value as a number, though people can go and cancel as well, but it is up 21% quarter on quarter. They have achieved 95% of its annual guidance for collections for FY26, and they have achieved about 105% of the annual guidance for booking value for FY26 as well. FY26 booking value is up about 16%. So not bad. I mean, and maybe real estate, which was also beaten down unabashedly. The numbers thus far haven't been that bad. A lot of companies have done some very interesting things. We spoke about Ashiana today. I think one of us spoke about Prestige yesterday or day before.
And there's another project today.
Another project today for Prestige? Oh yeah, perfect. And we had a lovely conversation with a mid-sized developer yesterday. We just signed 10 new projects in Mumbai, Sri Lotus Developers. So let's see how things shape up here.
Yeah. And if that overhang of the Middle East war was what was really dampening down real estate, was the biggest hit, because all input prices were going up, and then fears about whether buying would come down, etc. If that is easing, then maybe real estate is one of the beneficiaries as it reverses. All right, TCS, big story this morning, and you're going to hear from the management in a short while from now. They've reported a steady fourth quarter. It seems to be a divided house on whether this was a good set of numbers or not. Isn't it, Jasmeet? Jasmeet joining in for more.
Well, Tamanna, very good morning and thank you for that. The Q4 was absolutely a beat in terms of what you were expecting. The revenue growth expected was at 2% but came at 5%. So we see revenue seeing a beat, margins coming in line what you were expecting, and even net profit was a beat, but expectation was 25%, came in at 28%. And there are a few key takeaways from this quarter which really proved why the company did well in terms of the overall Q4 performance only. We do see that the overall CC growth came at 1.2%, the highest in last 3 quarters for the company. We see recovery coming in here as well. While secondly, the headcount addition. After cutting headcounts for nearly 3 quarters, down by 31,000 employees, in this quarter we see a healthy addition of 2,300 employees, showing up move of the demand commentary going ahead. Further, if you look at the overall analyzed deal win, even in a weak quarter like Q4, the softer quarter, we saw a deal win at $12 billion versus the expectation was $10 billion. So we see up move in deal wins as well. While lastly, in terms of the overall AI revenue, saw an uptick of 27% on QOQ basis that announced in the previous December on terms of overall annualized revenue at 1.5, it has come in at 2.2. So we see addition in that as well. So all in all, we do see a good Q4 number, but dollar term annualized revenue, we see a downtick of 0.5%.
Okay, Manav Medewala joining us. He's research analyst at Mirai Asset Share Khan. Manav, just a few minutes to go to when we hear from the management, but your take overall on TCS, was it better than what you expected?
So the real focus this earnings season was not the numbers, but on the management commentary around AI-led demand, pricing dynamics, and deal pipeline visibility as the market seeks clarity on whether the sector is AI disrupted or advantaged. In terms of TCS result, yes, the deal pipeline showcased their ability to back large deals, but the bridge between a record order book and a credible revenue acceleration story for FY27 is what I feel was missing. And when it comes to EPS growth, not much of a lever is left at the margin front. So margins are going to be more or less stable in the coming few quarters. So everything is now dependent on revenue growth, how well the company is able to capitalize its current order book. So not much of a positives coming out from the TCS results.
So you're seeing it as a negative, Manav? You think the stock will open down?
So I expect the stock to open flat to slightly negative, yes.
Okay. Would you see that as an opportunity of piling up? My basic question is, are you feeling, after you've heard the management commentary on the con call, confident that they will come up ahead of this AI disruption or not?
See, so as we spoke to the management and on the con call that happened yesterday, yes, they will come across as a winner, but it's not going to happen in 1 or 2 quarters. There's going to be a more of a gradual story. Probably it might pan out in 1 or 2 years. as deal pipelines convert into more of a AI-led deals with revenues, kicking faster than what AI would cannibalize, right? But it's going to be a long story. It's not going to be something that's going to happen in 1 year.
Quick question on the AI revenue as they've reported it, right? $2.3 billion. And so there is substantial growth, at least on the face of it. Double-digit growth heading towards that 20% mark. Are you not at all enthused by that? It's still a very small percentage of the whole.
So if you look at the AI revenue that the company disclosed, it contributes 7 to 8% of the total revenue, right? But what fears most is the traditional service lines. Will it be able to offset the cannibalization that's going to happen in the traditional service lines? Will it be faster than what we are expecting, or will it be much slower than what we are expecting, right? So this is something that the street was watching out for, but no positive commentary was there as such from the TCS management, and the same was replicated by the Accenture results as well. No such positives were there in the Accenture results as well.
Have the management in just a minute, but quick question, that 25.3% EBIT margin, how much of the contribution came from rupee depreciation in your calculation?
So I would have to do the math, but probably around 2 to 3%.
Okay.
Another point that they made also in their revenues, and because I did ask how much of it has come from your acquisitions, because they had a slew of acquisitions. So they've said about 40 basis points have come in. So that is something that they're saying very, very clearly.
Yeah.
I feel they're in a rebuild stage right now. So I agree with Manav that you might see its impact positively in a few quarters, but they're definitely right there. We should, take a look at that interview in a few seconds from now. I had the opportunity to sit down with K. Krithivasan and Aarthi Subramaniam and ask them a host of questions, especially on how AI is impacting the business model and revenue streams of the country's largest IT company. We also spoke a bit about the quarter gone by and how they see headcount improving over the time to come. Listen in to that interview. The numbers, of course, are looking robust. What is the sense you're getting in terms of demand at a time when it was first tariffs, now there is a Middle East crisis, there's war? Is that impacting appetite or continuing to impact appetite?
See, while the macro or geopolitical overhang could be there, but you also see we had one of the best order books this quarter.
Yeah.
With this 12 billion, and for the year we closed 40 billion order book. We signed 3 mega deals. Okay. And our number of $100 million clients, it went up by 4 this quarter. If you look all these lead indicators, it gives us a lot of optimism about the year to come by. So we are quite positive. While there could be some macroeconomic overhang over a short period of time, we are very positive about the future.
The revenues are also looking robust.
Yes, 3 consecutive quarters of growth.
Correct. Some of it powered by the newer acquisitions?
There is in this quarter, about 40 bips of revenue came through the acquisition.
Okay. And do you see more acquisitions on the anvil? Because a lot, and what you put out...
We continue to look for the right opportunities, right assets, where if you're based on the acquisition, if there is a synergy, where we can grow faster, definitely we look at it. We always said we will be doing it for getting competency at the scale and speed. So it will be for the capabilities, right? If we find it's the right capability and it will help us grow faster, we will look at that.
One last point I will touch upon, and this is also because, when we spoke last, you talked about how you aim to be the world's largest AI tech services company. How close are you to that goal?
Oh, we are progressing very well. We have laid out, I think last time also, we said we have got a very well defined 5-pillar strategy. And we are executing on the pillars. We are very happy with the way we are progressing, like be it training our own associates, adopting AI within TCS, and Aarthi and her team have come up with a model where how do we reimagine the services we deliver to our customers? How do you mature them? She calls it autonomy scale 0, 1 to 5. So we have defined it for almost all service lines. and how we are making AI real for our customers. Again, we have come up with number of rapid builds, and we've got making our contextual knowledge come to play alive for our customers. And last is what we did in terms of acquisitions and what we did in terms of Hypervault. We're quite happy with the progress we are making.
And if I may just add, I think if you see our AI revenues from last quarter to this quarter annualized has increased from 1.8 billion to 2.3 billion, which is a huge positive.
You see that trajectory continuing?
Yes, yes. And the other thing I would say is the kind of progress we have made on the Hypervault initiative, which is a key component of our end-to-end play, which we call it infrastructure to intelligence. I think excellent progress made by our teams, and you have heard some of the announcements that we made with OpenAI and AMD, and we see that going very well. So the whole AI ecosystem thinking that we are bringing into this is starting to play out extremely well.
Truly, it's front and center. If I just may ask about the 1 gigawatt data center, that's the other huge one. And one of the reactions to that, at least from analysts, was, is this going to be margin accretive? Is this where TCS should be really spending the money? Will revenues come in? If you could just address that bit.
She just said, right, after the announcement, the number of partnerships that we've been able to sign and the number of other players in the industry, be it hyperscalers or be it model providers or power gear makers or cooling, so many other people are interested in talking to us, and we are in very interesting discussions with many of them. So I believe overall it could drive our revenue. We maybe start seeing the revenue from sometime in CY28, because when it becomes operational. But the discussions are very robust, and we are very happy with the way things are progressing.
And this adds a very unique dimension to building strategic partnerships with our customers and also with our partners.
That conversation, we will be playing out that entire conversation at 9:30 a.m. in a little more details, about 16 minutes of that conversation for you going ahead. But let me welcome Parag Thakkar and Kush Bora into the studios this morning, this Friday. I don't know why this 1 week is feeling like 2-3 weeks packed into one.
Lot of action.
Lot of action coming in. Parag bhai, since we were talking about TCS, your take on TCS, and the IT is something that you were bullish on before everyone else. TCS is something that you were bullish on in terms of the management, the pedigree, the company. What do you make of the numbers and their commentary?
So decent numbers, I would say 1.2% CC growth. Margins were also within the guided range. Deal wins were absolutely good, $12 billion. Last 4 quarters average was $10 billion. There were some negatives also, like BFSI growth was very muted. Plus, I think overnight, unfortunately, what has happened is there's some Mython model which has come. Mythos, and that has brought down stocks like Accenture, Cognizant, Infosys ADR also, and IBM globally. So I would not say that in near term it will do very well. So that is one thing. Of course, this companies offer 6% free cash flow yield. Dividend yield is very good, but I think nothing to get excited too much in near term.
So, is it more? One thing is the numbers in the fourth quarter, but the other thing is the outlook for FY27, and the question marks about the fact that BFSI accounts for such a lion's share of their overall pie, and the fact that it is not growing, is that what is leading to your concern about FY27?
Correct. So basically, near term there is nothing which takes us higher. Because of this Mythos model is also going to affect their BFSI thing only.
No, but I asked Kriti about the Mythos model specifically. I don't know if you managed to run that clip, but we'll run it, the full thing at 9:30. And I said, so now they've come out with this Mythos. Every day there is some new kind of model. So how is it impacting you? Is giving you steepest nights? Well, he's saying no, it's not, because we will adopt all of those. We will be using those. as well. So it's not going to make that kind of difference.
So I would
us.
also agree with the other participants. This thing that in medium to long run, you cannot go wrong if you buy at today's price, which is 6% free cash flow yield, 4.5% dividend yield, and all these large cap IT companies will also adapt to it. Whatever new models, Anthropic or this Mythos, they will adapt. So in medium to long run, of course, and that's why I am not going to sell today. But the point is that
how are you defining that, Parag bhai, medium to long term?
So 6 months to 1 year.
Okay.
Kind of
Okay.
Yeah, you were completing your point.
Sorry.
No issue. No. So point is that in absolute near term, definitely there will be headwinds, because see, whatever is happening is so fast that everybody, human mind also takes time to adjust to it, right? On the technology front.
That is true. Kush, what are you making of the markets today? Time for a bit of a rebound after sell-off yesterday. Thoda breather mil gaya and time for markets to come back.
Agreed. Absolutely spot on. I think that what we saw yesterday was more of breather only. Absolutely. Agar aap dekho to Nifty and large cap stocks mein there was overheating on shorter term time frames, right? So some profit booking, some cooling off was par for the course. Also, if you see the FII index positioning, that's come down from 21% on the long side, from 21% to 20%. The stock future segment saw selling, but only to the tune of 124 crores only. And that's the operative word, right? Which is the volumes per se, because the volumes yesterday were very, very thin, which means the market participants aren't really, willing to let go of the positions that they've made from lower levels, in a meaningful way. Yesterday also, by the way, if you remember, we spoke that the derivatives data is indicating that there might not be a big and an immediate follow through of the Wednesday's move. So yes, all in all, the bias for the market still remains positive. But from an actionable standpoint, what do? The medium term positions or the positional long bets on the index, you can continue to hold. If you are an aggressive trader, you go out and take a long position on the Nifty, because derivatives data still indicating, PCR is still indicating that there is heavy call writing at near-term strikes. Technically 24,000 is a resistance, and geopolitically there is still some discussions around the ceasefire. But if you want to have a peaceful weekend, it's a good idea to maybe trade intraday and not take any positions home.
Okay, and what about individual stocks that you're looking at this morning?
Yeah, still going with a mix of long and short. So 2 long calls, 1 short call, Nalco and GPIL. Incidentally, these are calls that we've discussed in the recent past, either consolidating with the positive bias or target 1 hit. So in case of Nalco, target 1 was hit. So you could continue holding on to this now with targets of 418 and 424. Stop loss bumped up to 406. GPIL also consolidating. It took a breather day before. Yesterday it gained some ground. So 290, 297, these are your targets. 279 is where you keep that stop loss. And on the short side, I've got Hyundai. Not doing well, while some of the other names from the auto pack are starting to see some kind of recovery, some kind of meaningful buying interest. This one's not, and the primary trend remains negative for Hyundai. So 1725, 1705, these are your targets on the downside. 1765 is where you keep that stop loss on April futures short call.
Okay, all right. So those are the stocks on Kush's watch list. So we'll talk about some more beyond that. We have to slip in a very quick break. We'll get you all of the top trading strategies on the other side. So do stay tuned.
Presenting the all-knowing, all-powerful Tech Guru.
Whoa. Guru? I'm no guru.
Okay.
I'm just a guy who loves his tech.
A show where the mysteries of megabytes and motherboards shall be unraveled.
Bro, nobody talks like that anymore.
Okay, welcome back after that super short break. We are going into the opening session, the pre-open session, just in about 15 minutes. I want to pull up the implied for you very quickly. 61 points up in the green, and so much to unpack this morning. Okay, let's talk about some ideas over here. Parag bhai, I want to talk to you about what you are finding exciting right now as opportunities in the middle of all of this uncertainty.
So basically, as I told, I'm very optimistic on, and of course, I have a very large weight in my portfolio, PMS portfolios. So I would take, disclaimer is that there is a vested interest. So in this current fall, I have loaded onto something like Grasim, Ultratex of the world. So cement kind of place. But in Grasim, I find a deep value. Because the market cap is around 1,85,000 crores. And if you see, they hold 56% stake in Ultratech. Ultratech's market cap is 3,40,000 crores. So if you just see the maths, actually Grasim is exactly valued as with only 56% stake in Ultratech. And Ultratech is growing, doing very well, industry leading EBITDA per ton, highest market share in cement, and growing steadily. So I would say that so the entire other things, Birla Opus, what they are building, which is a 5,000 crore revenue business with 11% market share, potential to become a 50,000 crore market cap company in next 3 to 4 years, which is 800 rupees per share for Grasim. That is not only discounted in the price. They hold 52% stake in AB Capital, which is also doing very well, by the way. And it has a market cap of 88,000 crores. So again, 44,000 crore worth of value, which is again 700 rupees per share for Grasim, is not discounted in the Grasim's price. Now, Grasim's standalone business, which is an industry leading player in VSF and caustic soda. And VSF, they are the 90% market share in India they have. And that is making 3,200 to 3,500 crore EBITDA. So that is valued at 25,000 crore, which is around 400 rupees per share for Grasim. So I am saying that this is a company where you are actually playing a proxy to India's entire theme, right? Cement, NBFC, paints, VSF, caustic soda, everything you are playing. Plus they are building a B2B business for construction materials, which is touching a $1 billion revenue now. So I would say that there's so much of option value here.
What is the dividend yield on this?
So dividend will be less, because it's a growth company.
They're investing a lot into growth.
And so I'm saying that here is a proxy where all the underlying businesses are doing well, and you are getting a business which is at minimum 35-40% discount to its intrinsic value.
Okay. So, of course, the disclaimer there from Parag Thakkar that he does hold this.
We have a very large holding,
Yeah, so keep that in mind as well.
And investors should please take advice of their financial advisors, because one caveat which I would like to put is, people say that there should be a holding company discount, right, to their Ultratech holdings or AB Capital holdings, where they hold 56 and 52% respectively. But the point is that even after you do that, the margin of safety is so high that you cannot ignore it. And the quality of the businesses which you are exposed to, which is Ultratech, Aditya Birla Capital, Birla Opus, is phenomenal if you have a long-term view.
Okay, absolutely. So we give you ideas here every morning. Kush, what are your ideas for the morning?
Like we've already discussed, Nalco and Godavari Power, but let me also add a couple of auto anch names so that, CIE Automotive is something that we discussed yesterday, did rather well in a market that was consolidating to sideways. One other favorite stock from this space that I usually discuss is Lumax Autotech. This is also now starting to gain ground. 4 weeks of positive moves in a market like this, a positive sign. 1750, 1765 thereabouts is the resistance zone. I think once that is cleared, it could have further upside. But if you want to buy it in a consolidative phase, that's not a bad idea either. So to add to the stocks that already have been discussed, Lumax Auto and CIE Automotive, still good buys.
Okay, well, let's go across to my colleague Soumit Sarkar, who joins in with all the chatter from the dealing room. Remember, yesterday, the Poonawalla FinCorp QIP, which has been launched, was a khabar confirmed. It may not happen every day, but Soumit, I'd love to know if there are any khabar confirms, part one, and what is the new thing that people should keep in mind as we head into the weekend?
In fact, Poonawalla FinCorp was the only thing that got confirmed yesterday, would indicate that the QIP size was reduced. And yes, the QIP that the company has launched right now is 2,500 with an option for an upsize. But right now, there's no indication on that front. Apart from that, few stocks that one should keep an eye out for is Angel One and Motilal, both broking firms where there are some institutional flows, as what dealers have indicated. Delivery volumes are as well on the higher side. For Varun Beverages, multiple dealing rooms are recommending positional buy calls to their clients, so keep an eye out for this counter. And lastly, when it comes to Maruti Suzuki, there are a few buy flows on the PMS desk. Dealers expect that the fourth quarter numbers could be much better compared to what the street has been anticipating, so keep an eye out for Maruti Suzuki as well.
Keep an eye on Maruti Suzuki. All right, so the entire automotive pack. Kush, you pointed out Hyundai, and I'm just wondering what you make of the spurt that we saw in the commercial vehicle players on Wednesday. There would have been a bit of a breather yesterday, But do you build into that something like an Ashok Leyland, double-digit gains? I would also ask you about Tata Motors CV. Maybe throw in a passenger vehicle player in the way of Maruti Suzuki. Eicher Motors has an update today on the Flying Flea electric vehicle.
Yeah, so Ashok Leyland, is a stock that I missed big time. The last time around it moved, and it's not something that generally pops on at least my radars, and I missed it big time. I think this correction that came about, in the last month or so, very healthy. The spurt is big, backed on very heavy volumes. I think this is still ready for, that next leg of up move after this correction. So amongst the names that you've mentioned, the one clear standout is actually Ashok Leyland, the stock that we started with. So I wouldn't really mind a positional bet on this one. 150, 155 thereabouts should be your stop loss. On the way up, you're looking at 185 and perhaps 200, because that will also act as a derivative-led resistance. But these levels very much on the card. So this is something that you can buy and hold positionally.
I'm wondering if you have a call on Wipro on charts?
As infrequently as we discuss about this, right? वैसा ही setup है. Even when you discuss the IT names, ये आते ही नहीं list में. मतलब हम सीधा Infosys.
It's infrequent. We talk about IT infrequently.
No, Wipro.
हाँ.
तो हम TCS, Infosys, HCL जाते हैं और फिर सीधा Persistent और Coforge जा जाते हैं.
There's a buyback announcement. I'm going to ask Parag Bhai also about it. There'll be some excitement today.
Perfectly fine. बेच दो. मतलब नीचे से लिया है तो sell कर दो. You're better off buying into the
मतलब you're saying that participate in the buyback and give your shares back.
Yeah, I mean, I don't see this having that big spurt that some of the other IT names might still have. So not really very constructive.
Parag Bhai?
So same here. Generally, I love buybacks. Generally, but here in the case of Wipro, what happens is, see, promoter holds 72.5% stake. So in all probability, promoters are also going to participate in the buyback. And wherever promoter participates in the buyback, I am not very excited, because that is like a dividend. He is also taking dividend, we are also taking dividend as a shareholder. If promoter is not participating in the buyback, then it is like he feels that the stock is undervalued.
But poor promoter, I mean, even they have a right to participate.
No, that's okay. I'm saying you can give dividend, and I'm not against that they do buyback. It is just my thinking that if promoter participates in the buyback and he also tenders shares, you should treat it as dividend.
No, also in case of Wipro, somehow I've seen over the years their buyback news, except for once, really haven't gone ahead and given a big spurt to the stock, unlike a lot of other companies.
So actually it boils down to fundamentals.
Yeah, but in Wipro's case, there is also historical precedent. Buyback announcements haven't necessarily, except for once, haven't really resulted in a big spurt for the stock.
Unfortunately, the results don't show up. For example, I was also excited, in fact, 6 months, 9 months ago, when they got large deal wins. But unfortunately, those deal wins are not getting executed right now, and then they are getting delayed, and that's why the revenue pickup or traction is not coming up.
They're not. Okay, there's a stock that could be interesting today, and that's BSE. I don't think that necessarily the launch of an IT index on the derivative side really brings about big earnings. But just the fact that the capital markets are seeing a bit of a revival, they have this permission from the powers as well, or SEBI as well, that they can launch this index. I wonder if it is showing any kind of a trading possibility today on open. Now, Kush Bora, come in with the possibilities. If it opens flat, would you buy? If it opens maybe 1% or 2% higher, would you buy BSE, or would you avoid it completely?
Yeah, so okay, let's start with the top view. Very constructive on BSE. I have been for a very long time. Every dip that comes about, I suggest कि इसको buy करो. More of a positional bet than a trading bet. And to answer your question, very well put. Flat खुलेगा तो पक्का buy करो. If it opens about 1 or 2% higher or maybe slightly higher, तो immediate risk reward ratio जो है आपका वो खराब हो जाता है. But I think from a long term perspective, there is a beautiful rising trend line support. Every time it dips, at that level, or even to some of the meaningful support zones, there's a buying coming in. So for me, this is a buy on dips and hold positionally kind of a stock. अगर आज 2%, 3% or maybe higher खुलता है, you're better off booking some profits partially and then re-entering at lower levels. But broadly, very constructive. I'll also throw in MCX in the mix. It's very close to a resistance level, 2650, 2700 about, that's the resistance. Once that breaks out, that could also spurt. So constructive on BSE and MCX.
Okay, more companies that are in focus because of their business updates. Let's go through them quickly. Puneet joining in with more details.
Well, thank you for that. JSW Steel is the first one. The whole metal pack has been focused on the back of pricing, but volumes just 2% in terms of down 2% at 7.49 million tons crude steel production for Q4. They've also mentioned that the India operation also down with a similar percentage. What's interesting is a 96% capacity utilization for the India business. So you will look at capacity addition in the near term. The Salem unit, which has been in focus for JSW Steel, also has increased capacity from 1 to 1.15 million tons in this quarter itself. So continue to monitor JSW Steel on the back of quarterly updates. So is Container Corp, yet again, where majority of its capacity and throughput for the 1.4 million ton TEU is up 6% on a YY basis, and the EXIM number is up 2%, but the domestic number is up almost 16%. So continue to monitor Container Corp on the back of this news as well. Overall for the year, they're up 9.5% in terms of throughput. So these two stocks on the back of Q4 quarterly updates.
Thank you for that. Let's quickly look at some of the brokerage notes which have come this morning. There's a Goldman Sachs view on Honasa. They've maintained a neutral but hiked the target price to 365 rupees from 330 rupees. They're saying the trading update in Q4 was a strong quarter. Mama Earth and younger brands continued their growth momentum. I thought the view on delivery was also interesting from HSBC. They maintained a hold and hiked their target price to 500 rupees. They're saying they're keeping the wheels turning despite fuel risks. Stock stays resilient despite Middle East concerns. India's pump prices are yet to rise. Company showed in 2020 to 22 it can mitigate spikes. Near-term demand remains robust. Raise FY28 estimate EBITDA by 2% on higher Q4 volumes. Is delivery something that you're looking at on the charts?
Very constructively.
Yeah.
Delivery, even in the midst of the war and everything that's going on, had made a base lot earlier. There were volume accumulations on the healthy side. Last week, you had a dip in this, but the volumes are practically negligible, right? So very constructive on delivery. Just that it's come up to a resistance. But I think with the kind of momentum that you're seeing and the volume accumulation, I think 500, 525 levels, positionally very much on the cards. Stop loss around the 445 zone.
Okay. The other one, it always becomes the high beta stock whether the markets fall up and down. Shriram Finance, right? Every single point of time. So Morgan Stanley is a note there, and just want to read it out. They've maintained an overweight with a target price of 1325. They say the upgrade of long-term rating to AAA from AA plus by ICRA has come in quick succession, and Shriram's funding costs on average 135 basis points lower than some of the highly rated peers, and the intrinsic ROA should rise structurally as this gap narrows. Meaningful fall over the past 4 months should now, I don't know if should now accelerate the adoption, maybe, if you will, and it's a preferred pick amongst the non-bank lenders. I don't think Morgan Stanley tried to say that the meaningful fall will accelerate, so keep that in mind. Parag Thakkar, I would like to come to you, Parag bhai. Leave out that acceleration of the downside, but because it's come off quite a bit and the valuations are good, is it a good stock despite it being high beta?
So the point is that, see, I'll tell you, first of all, one thing is clearly there. So with so much of liquidity coming in, 40,000 crore into the company has become much more stronger. The ratings will improve, the cost of funds will go down, ROAs will definitely improve, right? So all things are positive. The only thing is that they are lenders to a very risky segment, which is second-hand trucks and all that, right? So if economy does well, this company does well disproportionately. Monsoon has to be good for this company to do well. So keep that things in mind, that it's a real proxy to ground level economy. So when there is and why it is so much volatile is that when oil goes up, when there's a geopolitical worry, when there's a worry of slowdown, recession, this stock will not perform. This stock will do well when your outlook on economy is very clear that it is headed up above 7% GDP growth. Monsoon should be decent. That's why.
Okay. Just want to look at some of the first few rates coming in before we get to more stocks that we're watching. I want to pull up Wipro. And remember, this is literally the first minute, so all of this will settle. But Wipro in focus because of that buyback. Markets are looking okay, pretty decent. Wipro about 4% up. Let's look at TCS. What's the first view on TCS, at least from the screen? 2.5% up right now. Will it sustain? What happens? All of that will be seen. But that's the first tick, at least coming up on your screen. Godrej Properties. Let's look at Godrej Industries. Let's look at some of your FMCGs also. FMCG pack also buzzing around. Imami, Godrej Industries are two that I can spot this morning, specifically showing some action over there. So, I mean, we'll wait and see how all of these sort of settle, but more stocks that you should have in focus. We want to pack all this information for you before we hit the opening bell. Varsha joining us with more.
Let me start with IRB infrastructure, which will be in focus considering their March toll collections are up 21% year on year, and FY26 toll collections stand at around 8,323 crore. Then you have Satvik Green Energy, wherein they've received 109 crore order. This is from one of the EPC players, and this is for solar PV modules. Then you have Sandur Manganese, wherein they've executed a forest lease agreement with the Karnataka government to establish the iron ore mine. Then you have BSE, wherein they've received SEBI's note to launch derivative contracts on the BSE Focus IT Index. Goldium International will be in focus as they have opened its 24th retail store in Faridabad. You have NHPC, wherein the board will meet on April 14th. This is for monetization of future cash flow from its power stations. And lastly, you have GHV Infra, wherein they've won 105 crore order from GHV India for construction of various projects located in Kalwa. So these are few stocks which will be in focus as of today.
Much, Varsha, for getting us those details. By the way, we're just about settling 3 minutes in, about 0.4% higher for the benchmark Nifty 50. Amardev Singh, Senior Vice President Research at Angel One, joining us right now. Amar, thanks so much for taking the time. It seems like just over the past few sessions, the tone has switched to a buy on dip kind of a situation. Do you see that panning out, and what are the levels that you're looking at for the benchmark? You're on mute.
Very good morning, and thank you for having me on the show. So see, what we are seeing, definitely we've seen some very strong up move from almost 22,000 levels to 24,000 odd levels. So on the back of the ceasefire which has been announced, but I would say that we need to take it slightly with a pinch of salt, because why I'm saying that, because there could definitely be volatile sessions, and what I'm seeing technically, as I've been saying for quite some time, is that higher levels would be sold into. There's no doubt about it. So what, as far as Nifty is concerned, I would say that level would be somewhere on the 24,200, 300. So roughly around still 400-500 points higher, where we would meet with very strong selling resistance and a lot of profit booking happening around those levels, those who've gone long. And that is being, I would say, replicated in most of the stocks, be the frontline stocks. So I would say one shouldn't really get carried away by this move. But yes, it could be a time wherein if one is long, maybe look at some booking profit, or at least the partially booking profits. Because till the time we really don't see Nifty sustaining above the 24,400, 500 zone consistently, and the crude oil coming below the, I would say, 80s to too big a level to expect, but at least 85 or so it starts trading, then we could say that more or less we are settled in and things would fall in place. So as far as on the downside support is concerned, Nifty's got extremely strong support coming on the 23,200 to 400 zone. So it's a 1,000 point which Nifty is actually looking at. Structurally, I would say there is still a lot of weakness which is evident, no doubt.
Individual stocks that you're looking at, Amar, slightly quickly because we're running out of time.
Yeah, sure. So the first one is Bharat Dynamics from the defense space. So this is one stock one can look at. The stock has corrected significantly. So this is one can look at a buying opportunity in the stock around the current level. So 1321 can look at a buying opportunity for an upside target of 1397 and a target of 1267. And the second stock is, again, I would say one stock which I like, that is Cochin Shipyard. The stock has corrected, is around crucial support zones, and there's a pullback that is being witnessed. So buying at the current levels for an upside target of 1525 and a stop loss of 1347. So these are two stocks one can look at.
Okay, all right. Thanks so much, Amar, for that. Let's go across now for the big brokerage call of the day. For a check on metals, Macquarie has come out with a note on it, and they're talking about the fact that they're staying positive on it in Q4. Let's go across to Mahima to find out what exactly they're saying. Mahima?
Right, so Alex, even on Wednesday, HSBC did come out with a note on metals and was very constructive when it comes to these metal names. Macquarie today has also gone ahead and upgraded a lot of these names. Tata Steel, they've maintained outperform, hiked the target price to 241. JSW, they've hiked the price target to 1353. For Jindal Steel, they've hiked the target price to 1321. Hindalco, also they've hiked the target price to 1080 but maintained the neutral stance on this one. For Coal India, they've maintained neutral and maintained the target price at 445. Now what they're saying is that Q4 overall firm prices are going to boost EBITDA and they prefer ferrous names. Right now what they're saying is that domestic steel prices remain firm and this augurs well going forward in FY27 earnings. Hindalco benefits from firm aluminium prices and gradual uptick in Novelis is what they're expecting. Novelis EBITDA is what they're expecting. But in terms of valuations, they're saying valuations cap upside potential is something that that they'll be watching out for when it comes to Hindalco. For Coal India, neutral rating reflects modest downside following recent stock outperformance is what they're saying. So this is the overall view coming in on metals from Macquarie, hiking target price for a lot of these names.
Okay. Thanks, Mahima, for that. And we have a Metallica fan in the studio as well, because he's been chiming on that since yesterday. Parag bhai, there has been a bit of an up move, yes. Are the metal names, both ferrous and non-ferrous, still good to buy? Where would you find favor?
So basically, I am with steel. So I have been overweight on steel companies, JSW Steel, Tata Steel, because I feel.
So no Vedanta, no Nalco, no Hindalco.
Vedanta is a huge value, no doubt about it. But I don't own it. That's what I'm saying.
Okay, but you are bullish on steel.
Yeah. Steel, I'm very positive because the steel prices have gone up too much. So I think the margins which will come for Tata Steel, JSW Steel kind of companies will be very, or Jindal Steel and Power for that matter, will be very good.
Okay, pre-open rates have settled, and we should just take a look at what's happening there. I want to pull up the Nifty IT and some of the IT pack. Infosys down 1% at the end of that pre-open session. We'll see how it opens in another 7 odd minutes or so. TCS down close to 1% as we have closed out that pre-open session. Like we've been seeing this morning, there's no consensus call on what this company is being looked at or the mood on this company from the street, and that's showing in the pre-open session as well. Could go one way or the other. Wipro, there's a clear mood of positivity on that buyback, at least for now, in the pre-open session. Realty stocks, look at a Godrej Properties. Realty stocks are looking good today. Lodha, etc. All of them actually doing fairly well. Banks are doing decently, which is good. There's some recovery coming in there, and that is one theme that could continue to move through the day. Anything interesting that you're spotting, Kush, after the pre-open session that you'd like to highlight, or stocks that should be on your radar?
I think I'll talk about the index. Bank Nifty is something that we've not spoken about. The private banks actually had quite a sharp gash yesterday, again on the back of very low volume. So I don't think that was a meaningful pullback. It was more of profit booking. Also, the PCR on Bank Nifty went from 0.9 to about 0.77, which means there was support at lower levels. So I remain constructive. I think a breakout will come above Wednesday's high, which is 55,800 thereabouts. Once you have that, I think a move towards 57, 200, 300, the 200-day moving average could well get underway. So remain constructive on banks.
But individual private sector, large private sector banks, like you said yesterday, they dropped quite precipitously.
Again, the volumes are the key factor for me here. I mean, there could be profit booking, but if the volume just doesn't support, it doesn't really make sense, right? And like I said, there has been overheating. If you see the hourly charts, some of these RSIs had crossed 80. So, which means that from a very near-term perspective, there was very clear overheating. So, thoda bahut profit booking banta hai.
But are they buyers at these levels?
Absolutely.
Which, in what order?
ICICI, HDFC, by the way, is not a momentum trade. HDFC is something that you buy positionally. ICICI also hitting resistances. I would actually go towards the towards the PSU pack.
Okay.
So the SBIs of the world, the Canara Bank and Bank of Baroda of the world, these make more of momentum bets.
Okay, just a few minutes to go for the opening session, and one thing which seems fairly clear is that the take on the ceasefire fear is now that it's lasting. at least as we speak? Because that's what you're seeing on the screen, right? Not so much concern and worry. And maybe what we saw yesterday was just a bit of a dip more than anything else.
The US markets certainly showed that yesterday, right? Even if Europe was a bit quiet. So yeah, completely agree. And maybe that helps the market still go into the weekend. Okay. Otherwise, you would feel that low base
weekend fear. Yeah.
Exactly.
You think, Parag bhai, that's one thing which is missing, that Friday fear?
Actually, yesterday, nowadays, what I am observing, it might be wrong. I am not a very big expert on this. On a BSE Sensex expiry day, there is a very aggressive selling. So that is over yesterday. So I think that Friday fear is sold yesterday. So it is done.
Oh, yeah.
In my view. And now let's see how during the day it pans out and the news flows on the Strait of Hormuz plays out.
So Friday fear happened on Thursday itself in this case.
That is my view, at least for now.
Okay. Amar, IRB Infra, Godrej Properties, Shriram Finance, these three. How are you looking at it? Just 2 minutes to go before we open.
Yeah, so if I look at IRB Infra, IRB Infra is more or less trading somewhat, I would say it's sideways. I wouldn't read much into it. Shriram Finance is one stock which I definitely like. It is consolidating, but again on the upside, Shriram Finance is likely to run into resistance of the recent highs. But the overall trend for Shriram Finance remains strong and positive. On the upside, I would say 1080. 1100, that's a zone of resistance. On the downside, strongly supported around the 950, 960 zone. But it's a buy on decline stock as of now. And the third one you mentioned was?
Godrej Properties.
Yeah. So see, most of the properties stocks, we've seen a significant erosion and then there's a pullback. Godrej Properties has formed a double bottom, I would say, somewhere on the 1440, 1450 level. So there is a possibility that the stock could rally towards the 1800, 1850 zone. That's it, because that's a very strong zone of resistance for Godrej Properties.
Okay, so positive on them. AstraZeneca showing interesting moves as well, about 3.5% up. I wonder if you're going to see a reversal in some of the fertilizer pack, because that was such a big pain point. Parag, would you look at fertilizers, some of the companies which were getting pressed down, glass, ceramics, etc.?
So that depends on how the Strait of Hormuz opens and how the LPG tankers move, right?
हमारे लिए तो वैसे भी खुला था.
No, but very few ships are coming. On an average, if you see the pre-war traffic or pre-war, the number of ships are very less. So I would say that and some of the stocks like Chambal Fertilizer, of course I don't own it. They are good in fertilizer space.
Okay.
I would say.
Half a minute, so you can give us a slightly detailed view. One stock that stands out post pre-open.
Yeah, GPIL, Godavari Power. Again, this is a call that we had in the morning about 290, 297 targets. 279 is where you keep that stop loss. Mild breather, but now again the stock is back in its on its winning ways. Medium-term trend, near-term trend has been positive. So I think even if it dips a little, nothing to worry. I would continue to hold it with the stop loss given 279.
Okay, Godavari Power. Amar, 10 seconds, one top stock, just 10 seconds.
Yeah, I would say that Bharat Dynamics is a stock one can look at.
Okay, so Bharat Dynamics is from Amar and Godavari Power is from Kush Bora. Grasim is from Parag Bhai, but that's not a trade, keep that in mind. Okay, here's how we are likely to start off. In the green for sure, even despite the fact that IT may not start off necessarily well. Let's see what happens during the course of the day to that index. But for now, we're starting in the green, which is good. Strong market breadth. Mid caps doing okay. Small Nifty Bank giving that support. Small cap index 0.67%. No complaints. Something that Tamanna was saying. Maybe the market believes that despite the to and fro's here, maybe there is a belief that this is probably for real this time. Let's wait and watch. Nifty IT though 1.4% lower. Let's get the heat map up on the screen. Alex would have a smile on his face. He believed TCS will start off lower, and it is 1.6% lower. Tech Mahindra Infy giving it company as well. Wipro is not in that list. Wipro is actually on the upside because of a technical reason that they've announced a buyback. Sun Pharma is 3% lower. Now I wonder if this is because Sun Pharma is preparing a war chest for a very large acquisition. I wonder if that could be one reason why the street doesn't like it at these times. To prepare a war chest, maybe take on debt is not something that people usually like. Titan, HUL are amongst the losers. The gainers, Shriram Finance, likely because of the market or maybe because of the Morgan Stanley note, but the top gainer today. Axis Bank doing okay, Wipro doing okay. There is strength in Eicher Motors. There's a new launch there. Interglobe bounces back 1.5% after the 3% drubbing yesterday. Tata Steel 1.5%. BEL, everybody's defense favorite, doing okay. M&M, Bajaj Finance, etc. Yeah, a lot of green, which is actually really pleasing to the eyes. Let's see if we hold on to that, and let's see if IT were to reverse a little bit of the losses, then does it help the index scale further? Close to 24,000. Not a bad start, Tamanna.
Not a bad start at all, and 24,000, if we do cross, and you're looking at 24,200, 24,300 maybe as the next level. Let's look at the broader markets very quickly and look at what's happening there. The mid cap and small cap holding up. I think that's really an important part of how you should see the markets today, because this is getting portfolios a healing touch bit by bit. Even the small cap 250, about 1% up. The sectoral heat map is something that we should pull. I suspect you'll see IT in the red and everything else looking relatively okay. There you have it. Nifty IT about 1.5%. Nifty Pharma largely pulled down by Sun Pharma, healthcare as well, but everything else is doing pretty good. Defense stocks up and about, energy stocks up and about, PSU banks recovering. So you're seeing some of the profit booking candidates from yesterday's trade, including a Shriram Finance, for example, getting a leg up this morning. Pretty decent breadth, market breadth coming in. Definitely more buys than sells in the market and on the screens right now. But let me get to specific stocks and what the story there is that we're tracking this morning. This Friday morning is turning out to be, after a long time, a Friday that is not too frightening, at least at the start of trade. JSW Steel business updates have come in, which are pretty decent, and the stock is about 1% up. Godrej Properties, their booking values are up 16%. That stock is showing a 2% uptick at start. IRB Infra, also these are again business updates. So the focus is shifting more domestically as geopolitical clouds of war seem to be receding in the backdrop for now. IRB Infra has good toll collections there. Sathvik Green has 109 crore order, and that stock is 4% up, looking decent this morning. Wipro, we looked at Wipro as well. Wipro with the buyback story is why it's a positive. HDFC Life will be raising funds. That will be in focus, and it's being seen as a positive as well, 1.5% there. New launch from Eicher Motors, new motorcycle has been launched by that company. That's 2% up. BSE will launch a derivatives contract, also in focus from our technical analyst, 1.5% up there. GHV Infra has 105 crore order. That's a 2% uptick. Ashiana Housing has land acquisition news coming in, and Poonawalla FinCorp has launched a QIP. They're raising more funds. Usually the street doesn't like it, and 1.5% down, but nothing extreme on either side, I would say, Alex. No extreme reactions coming in, even for a TCS for that matter, which is showing a downtick, but it's not a massive drubbing from the street with all those WhatsApp messages doing the round saying that in US terms there has been a drop for the first time, etc. You're not seeing that on the screen.
Yeah, fair enough. And actually you're seeing a few stocks from the broader markets that are doing particularly well. Cohance is one of them, up as much as 9%. New India Assurance is up 5.4%. Ola Electric continues its recent uptrend and is moving up as much as 5% at this point. You know what is standing out to me though is the power equipment manufacturers. After that JP Morgan initiate note with overweight rating on GVTND as well as Hitachi Energy, which incidentally is trading at all-time highs. It is still trading considerably higher today as well, 3.2% higher at this juncture. So I very quickly want to get a check from Kush on both of these counters and whether there is considerable upside still in GVTND and Hitachi Energy.
So there is. GVTND incidentally was our weekly pick on 30th March, and that's already doing well. 4100 was the second target, by the way, so very close to that. There is momentum and there is upside still left on this one. Breakouts have come about. I would continue to hold. Even if 4100 was my second target, I would suggest you could book partially and hold the rest of the quantity with 3875, 3900 as your trailing stop losses. So that's the view on GVTND. Hitachi Energy, the breakout came about 3 sessions ago, about the 26,000 mark. The move has been swift. can't say you should initiate a fresh buy because the risk reward ratio will not be favorable, but very much continue to hold. There is a fair bit of upside left in these names. 26,800, that is your stop loss on Hitachi.
Okay, and New India, by the way, is going from strength to strength. On that note, gentlemen, in the studio, and Amarjit Singh joining us remotely, thank you so much for taking the time. Pleasure speaking with you as always. Have a great Friday. Joining us now is Manish Sonthalia, Director and Chief Investment Officer at MK Investment Managers. Manish, always a pleasure speaking with you, and thanks so much for taking the time. Happy Friday to you. It's looking like a happy Friday after a while, I must say, and at the start as well, because some of those fears seem to have dissipated even as this truce seems to be a little bit fragile, but the fear seems to have dissipated somewhat. Do you agree? And the focus is now going back to earnings.
Yeah, I think 2 weeks, the deadline, market will be rather range bound. I mean, plus minus 5%, unless and until we hear something decisive. I think 22,000 on the downside should hold and 25,000 on the upside. Is unlikely to be broken till about the final verdict on the ceasefire is out. Of course, we are moving in the right direction, and that is why markets basically from a rapid short selling squeeze that we saw the day before yesterday is likely to be continuing as we progress into the earnings season, because earnings season is not likely to be that bad, at least for this fourth quarter. Numbers should be in line with, or maybe, certain sectors will do much better than estimates.
Manish, did the nerves of titanium get tested in the last 1 month? And do you believe now that the valuation reset, and arguably we are about 8-9% or 6-7% higher than the lows, but is this the valuation reset that you might have been looking for, and would make you be fully invested?
So I think geopolitical situation, if the ceasefire truce does not hold good, then it's going to be problematic for India. In line with many parts of Southeast Asia, because we are very heavily dependent on energy imports and fertilizer, subsidies on gas and all of that. So, the good scenario is that we should settle this. If that be not the case, then earnings damage for FY27 is likely to be there, because we are in for an inflation shock, supply chain shock, and, growth reset. Consumption is going to take a hit. Government might stick to FRBM, and, your capex spends, etc., could also be cut. So, all of that would mean that FY27 numbers will be reset, and FY28 would be the new normalized year if this whole thing gets lingered on. If not, if we are in for a diplomatic settlement, talks are in tomorrow, and let's assume for the best that things don't escalate further from here, then obviously, we have seen a February 28th till first week of April, the damage is not going to be that bad. I think earning estimates are likely to hold at around 12-13%, and that's not too much of damage before we entered into the crisis. And it's back to normal. And, this 17-18P has been tested time and again. 22,000 also got tested now. 4 months of relentless selling, but we didn't break 22,000. And hopefully, this would set the new low for the markets as we move higher into the normalized scenario.
Okay. Manish, what did you make of IT result that has come, or IT overall? Are you worried about Mythos?
So unexciting, to say the least, except for the fact. Yeah, I mean, see, these stocks are all trading at 6%, 5%, 4% free cash flow yields.
Yeah.
So they are not going to fall, because 4 to 6% free cash flow yields signify zero growth. And we are still talking about, like, TCS actually commented about low single digit growth still to come in FY27. It's only that, except for even after rupee depreciation, we didn't see too much of a margin expansion. And in YOY terms, constant currency dollar terms, revenue didn't grow. So which means that, yes, they have alluded to the fact that AI is an enabler, and you have $2.7 billion of annualized run rate on revenue from the AI portion of the turnover. All of that is fine, and adoption will take time. So I would believe that reset of valuations is not going to happen on the upside. Whatever is the earnings growth, that bit of an upside we should build into the market cap as we progress into FY27 numbers.
Okay, Manish, there are a lot of new things that have emerged, right? And because the central thought seems to be that energy transition and power generation will become the constant theme for the next 4 or 5 years, no matter what else happens. Would you believe so? And if so, how do you play that?
So, the Middle East crisis has exposed energy security for India, for sure.
Yeah.
We are so dependent on fossil fuels, and one closure of Strait of Hormuz, and we have seen Brent go up, and, no LPG, and fertilizer subsidy has, and, gas rationing is happening for sectors. Morbi has been shut down. So there is a need for alternate sources of energy, and obviously renewables is one area where we can do a lot. And generations that have been taken care of. Transmission losses is the need of the hour. New Electricity Act is around the corner, and HVDC, low leakage on losses on transmission, is where the focus is. So transformers, etc., are seeing order books closer to 4 to 5 years, particularly in the higher kV segment. So yes, it is a given now that energy security is required. Our vulnerability on fossil fuels remain exposed, particularly after closure of Strait of Hormuz. And maybe this is the tactic that might be used even in the future, the closure, the leverage on the closure of the Strait of Hormuz. So I would agree that metals, power, energy, renewables, they are going to be in the limelight for next many years. You've got to find stocks which have valuation comfort, not that stocks are still discounting FY30 numbers. Great stocks, great earnings bought at insane prices also won't make money.
Manish, speaking of energy, and I don't know if you've identified pockets of opportunity with this entire nuclear conversation coming through, right? The potential exists, but I wonder in the listed space, how will you play it? There are a few names. NTPC is doing a few MOUs, but these seem to be very nascent and very early days. So do you see this panning out in the very near future? Because it seems like the government wants to accelerate this program very, very quickly. So will that present opportunities heading into FY28 perhaps?
100%. So, the vision document says 8 gigawatts going to 100 gigawatts by 2047.
Yeah.
And 20,000 crores has been allocated. So, government focus is there on the nuclear side. And we don't have a direct play, but indirect plays are there. The pump companies, the cooling, the reactor cooling agents, the guys who actually manufacture the reactors. They are trading at pittance in terms of growth and valuation currently, but they can be very big companies. So ancillaries, tier 2 players supporting the nuclear infrastructure, a lot of them are still there as a play.
Manish Sonthalia, the usually very bullish Manish Sonthalia is sounding a bit, how do I say?
No, I'm not bearish, Neeraj. I'm saying...
I didn't say you're bearish. I'm saying you're not sounding bullish. There's a difference. But no,
I think the time will come to be hyper bullish. Let's get this 15 days out of the window. It's back to normal. Once that is visualized, I think it's going to be rapidly moving higher from here.
Manish, you have our numbers. You turn hyper bullish. Please give us a ping. Even if it's 7 days hence, we'll get you back on air if you have the time. Would love to chat then again, as we did love chatting to you today. Thank you so much for taking the time out.
Thank you.
We're talking to the top team at TCS at a time when the biggest question about this entire space and India's largest IT company is what the future holds. And we have the opportunity in a quarter where their numbers have looked I think, better than most expected to ask some of those questions. K. Krithivasan and Aarti Subramaniam with us. Thank you so much to the two of you to give us time on NDTV Profit.
Thank you.
Let me begin. Of course, the numbers have been, I think, better than most estimates of the street. But let me start with the elephant in the room and the conversation which has gone on through this quarter, apart from the numbers, which is what is going to be the revenue model, the survival, the outlook for IT services companies with AI in the picture. Let me begin by directing that first at you, Krithi.
I find the revenue model in the future is very bright. Okay, I say this for a few reasons. One, the system integrators have, what is the main role of system integrators? We make the technology work, deliver the outcome for the business. And we do it because we know the context in which the technology has to be implemented. So the fundamental nature of what we do doesn't change with AI. And now coming into moving from philosophy into the specifics. We'll take the first concern some of you would have on will AI remove the jobs? What currently what we are seeing, it probably brings in maybe 20, 25, 30% productivity. Now, based on the discussions we have with most of our customers, what we find is just the productivity gain comes in, but that productivity gain is flowed back into other transformation engagements or other backlog they have. This is point number one. In my view, point number two is for any enterprise to even leverage AI, there is so much of groundwork needs to be done. Like you have to get your data estate right. You need to get your model architecture right. You need to get your agent architecture right. You may have to train your SLMs. Okay, you may have to fine tune them. So there's so much of work that has to happen. Third is even if you have all these things, you still need someone to work with you in reimagining your business process so that AI delivers a true value for you. AI's value is not in reducing 15-10% on the IT budget. AI's value comes when you are able to improve your customer's experience, bring new product, new service, and that's where we've been helping our customers. So if you look all these things together, I believe actually our opportunity space is increasing and not under threat.
I will come to the bit on employees in just a couple of questions, if that's okay, because I think 30,000 employees have been, the headcount has been reduced over the last 3 quarters, 2,500 odd increased. So how does that math work up? But the question is not so much as of the opportunity for AI or the number of employees.
It's opportunity for system integrators is what I said.
How will you bill clients? How will you charge clients? Will you have to charge them differently with AI in the picture now that you need less people to actually provide those services?
No, that's
very simply
put. I said, the first thing I said, we may need less people for doing what you are doing today, but you are going to be much more than what you are doing today. So when you are going to be the whole space is expanding significantly. I said, what you are doing today, you may get 20% productivity, you may probably do 20% less. But there is so much of additional work that needs to happen. Who is going to do it? So I am not expecting that we will need much less people than what we have today.
So the revenue model does not change significantly.
Revenue model in terms of how you price your services can change. Right. But I am not expecting a shrinkage in the overall revenue on the trajectory of revenue as well.
Okay, so there's no AI discount or AI deflation that can come into place? Overall.
Yes.
Okay. How you charge your services or bill your services, how do you think that changes?
It can proceed, like eventually AI has to deliver the business outcome or and because of that, we will be signing up to programs where there's an outcome is also guaranteed. But like we have seen always, this needle will move slowly. Currently, we do programs more in a fixed output model.
Yes.
Where you deliver, that probably will continue. Or where you commit, if you are doing a migration program or where I say technology modernization. The technology modernization you will deliver based on if I am moving from technology A to technology B, I can charge a fixed price. These are all models that exist even today. Okay, where we move to outcome-based model, the needle will move slowly, but it will happen. I don't expect that to happen dramatically overnight.
What is the timeline you expect that outcome-based model to come in?
It can be 2-3 years. I don't want to put a timeline to it, and it doesn't really matter as much as whether the model is T&M based or outcome based. I don't think it matters as much.
I think the big takeaway that you don't expect revenues to get impacted in any significant fashion
Absolutely.
in the foreseeable future. If I may come to you, ma'am, on the employee bit of it, and you've had a plus on the headcount point, at least this quarter. Do you expect the quality and nature of people that you add on to now change in line with new outcomes that are expected or new demands from clients vis-a-vis AI?
See, if you really look at demand, right, I think first it's important to understand where customers are spending money, right? Like Kriti said earlier, there is, run optimization which is happening, which is where it's all about productivity and efficiency. Then there is, transformation. There are 3 types of transformations our customers are embarking on. One is, transformations which are enterprise transformations, things that we have been doing for a decade, whether it's the cloud modernization, data modernization, implementation of enterprise systems like SAP, Salesforce, right? So those things are continuing and there is demand for those services, right? So we continue to build those niche skills. The next one is modernization that Kriti touched upon. That's again a huge opportunity because with AI, you can actually solve for tech debt faster, better, and also cheaper. So those programs are coming up, and again there is a lot of AI. You need the knowledge of the legacy technologies, plus you need the AI talent. That's coming together. The third type of transformation are what we call the pure play AI transformation programs, which are the business impacting programs that Kriti alluded to earlier, where again there are different skills. So with the rapid change in technology, there are new skills coming into play, but a large part of the new services, whether it's cyber, cloud, and everything that I talked about, we're continuing to build skills in-house and also hire for niche skills. The other color to this is that we are also investing in more advisory talent, right? More consulting and advisory type of skills, because you want to shift more to the right in terms of how you engage, because with AI, you need to really help them reimagine what they do, their workflows, the process. So we're bringing the higher, experts with consulting and advisory skills as well. So that's how we are approaching.
In terms of net numbers of headcount, and I think I laid out a few of them before. If I look at the last 4 quarters, the cuts that have come in versus the increments, what direction are you heading in? What is the kind of headcount outlook you're seeing?
See, we are continuing to, 2 cadres of talent intake. One is on the fresh campus hires. We hired more than 44,000 last year, and we already have 25,000 offers which are already given out for this year. That's on the entry level, campus hires. On the experienced professionals, again, we hired a significant number last year, and on the based on client demands, we'll continue to onboard experienced professionals.
Has the right sizing process now ended, which you needed to do a few quarters ago?
Yes.
That restructuring is done?
Yes, that's restructuring is done.
Only point I want to add, we never called it right sizing.
Okay, fair enough. That's a
we said
term
we wanted to be a future ready organization. Our talent model has to be future ready. We only said there are certain people who are in a senior management or middle management who will not be able to adapt to the new future ready or the new ways of working, who will be respectfully outplacing or later releasing from the organization. So it is nothing, we didn't have a size. When I say smart, we didn't have a size in mind saying that I need to cut down my organization by this much. And to correct, it was not AI induced. It was essentially getting ready for a future ready model. It's not because of the productivity we gain. We did not let go anybody.
That process is now done.
Yes.
Yes. Okay, I think that's just important to note. The other point that I wanted to talk to you about, and I know we have limited time, so I'm just putting in, I would say, the major FAQs into this interview. All of these new models that get released every few weeks by a company that you are partnering with, and latest is Mythos. You have all of these new models come in, and every time the comment is, will you need traditional IT service companies less and less if there's a new cloud model which does the work of, say, a legal team more easily or an HR team more easily? Mythos is the latest. How do you look at all of these updates?
You want to take it, Ashley?
Sure. See, if you really look at it, all
answering this question since morning. So
see, I think if you look
maybe you should then both of you swap.
No, I think if you really look at the model capabilities, ever since the Gen AI moment in November, December 2022, model capabilities are rapidly developing. And every time a new, if you look at, let me give you an example, right? You take software engineering, coding, right? Coding assistance, and if you look at last year, compared to FY25, we were looking at 10 to 15% productivity with the coding assistants, which were of that generation. Last year, that number moved to 20 to 30. So I think the improvements are definitely coming, and with the newer versions, we are the first ones. As soon, for example,
it's not a threat to you. It's not a threat.
It is an opportunity to be more productive, more efficient. And if you look at coding assistants as an example, using coding assistants for doing the engineering work we do is mainstream in FY26. And the adoption will continue to increase. And like I said, there's so much of latent demand in enterprises. So the optimization that you bring, you want to do more work. So it's an opportunity.
it helps in productivity, it doesn't eliminate.
Okay. I must ask some questions about what your quarter has been like, so let me do that as well. The numbers, of course, are looking robust. What is the sense you're getting in terms of demand at a time when it was first tariffs, now there is a Middle East crisis, there's war? Is that impacting appetite or continuing to impact appetite?
See, while the macro or geopolitical overhang could be there, but you also see we had one of the best order books this quarter.
Yeah.
With this 12 billion, and for the year we closed 40 billion order book. We signed 3 mega deals. Okay. And our number of $100 million clients, it went up by 4 this quarter. If you look all these lead indicators, it gives us a lot of optimism about the year to come by. So we are quite positive. While there could be some macroeconomic overhang for a short period of time, we are very positive about the future.
The revenues are also looking robust.
Yes, 3 consecutive quarters of growth.
Correct. Some of it powered by the newer acquisitions?
There is about, in this quarter, about 40 bips of revenue came through the acquisition.
Okay. And do you see more acquisitions on the anvil? Because a lot, and what you put out...
We continue to look
yeah.
for the right opportunities, right assets, where if you're based on the acquisition, if there is a synergy where we can grow faster, definitely we look at it. We always said we will be doing it for getting competency at the scale and speed. So it will be for the capabilities, right? If we find it's the right capability and it will help us grow faster, we will look at that.
One last point I will touch upon, and this is also because, you know, when we spoke last, you talked about how you aim to be the world's largest AI tech services company. How close are you to that goal?
Oh, we see we are progressing very well. We have laid out, I think last time also, we said we have got a very well defined 5-pillar strategy. And we are executing on the pillars. We are very happy with the way we are progressing, like be it training our own associates, being adopting AI within TCS, and Aarti and her team have come up with a model where they go, how do we reimagine the services we deliver to our customers? How do you mature them? She calls it autonomy scale 0, 1 to 5. So we have defined it for almost all service lines, and how we are making AI real for our customers. Again, we have come up with number of rapid builds, and we're making our contextual knowledge come to play life for our customers. And last is what we did in terms of acquisitions and what we did in terms of hypervault. We're quite happy with the progress you're making.
And if I may just add, I think if you see our AI revenues from last quarter to this quarter annualized has increased from 1.8 billion to 2.3 billion, which is a huge positive.
You see that trajectory continuing?
Yes, yes. And the other thing I would say is the kind of progress we have made on the Hypervault initiative, which is a key component of our end-to-end play, which we call it infrastructure to intelligence. I think excellent progress made by our teams, and you have heard some of the announcements that we made with OpenAI and AMD, and we see that going very well. So the whole AI ecosystem thinking that we are bringing into this is starting to play out extremely well.
Truly, it's front and center. If I just may ask about the 1 gigawatt data center, that's the other huge one. And one of the reactions to that, at least from analysts, was, is this going to be margin accretive? Is this where TCS should be really spending the money? Will revenues come in? If you could just address that bit.
She just said, right? After the announcement, the number of partnerships that we've been able to sign and the number of other players in the industry, be it hyperscalers or be it model providers or power gear makers or cooling, so many other people are interested in talking to us, and we are in very interesting discussions with many of them. So I believe that overall it could drive our revenue. We maybe start seeing the revenue from sometime in CY28, because when it becomes operational. But the discussions are very robust, and we are very happy with the way things are progressing.
And this adds a very unique dimension to building strategic partnerships with our customers and also with our partners.
All right, so that was a conversation with the management of Tata Consultancy Services. And let's take a look at the markets. And we're not too far away from the high point of the day, if not at the high point of the day, up as much as 0.8% and heading towards, believe it or not, 24,000. You might not have thought about that just last week. But it's 41 stocks in the Nifty 50 that are gaining, and the worst performers are actually the IT pack. Infosys now seeing cuts of about 3.3%. Tata Consultancy Services also lower by about 3%. HCL Tech and Tech Mahindra not too far behind. It seems like this global fear about Mythos and various other disruptions to IT are playing out here as well in the Indian equity markets. Sun Pharmaceuticals is another stock that trades a tad bit under pressure. It's trading with cut of 3% right now, and this is after reports of a proposed mega acquisition. Varsha joining you to talk about what is being spoken about here and why the street might be a little worried about this acquisition. Varsha?
Yes, so the stock is down because of course on the large acquisition deal, this is as per media reports. So Sun Pharma plans $12 billion bid to acquire Organon and Company. This would be largest global M&A by Indian Pharma, and the binding offer is expected in coming weeks. Now there's a no single bidder situation. Sun Pharma will be competing with Global P Consortium. Now the important point over here is why market is worried and why the stock is down almost 3%. This is a largest deal versus Sun's size, and the Organon's, the company which Sun Pharma is expected to acquire, they have a huge debt on their balance sheet, and also there are some weak, they have a weak growth in some of their segments. Also they do have competitive pressure when it comes to their generics and biosimilar portfolio, and Organon's CEO, if you see, resigned in October 25 following an internal investigation related to sales malpractices. Also, acquisition does not bring a strong pipeline of products for Sun, neither does it enhance Sun's R&D portfolio. But why Sun is buying? According to them, this will move beyond generics, will cater to innovative pharma, will build global scale and branded portfolio for them. If I were to talk about the financial position of Sun Pharma, they have $3.2 billion of cash on their balance sheet, but Organon has a high debt of almost $8 billion and also is facing competitive pressure. Organon, they are into women's health, biosimilar, established drugs, but their sales were impacted by lower US government funding and pricing and competition. So a lot of issues are actually there for the target company, and hence market is not liking the proposed deal for Sun.
All right. So keep an eye on that stock. And from pharmaceuticals, let's move to healthcare, because Yatharth Hospitals has been in focus recently. The stock is very close to the high point of the day, but I'd be curious to look at the 1 month and the 3 month charts just to see how the stock is done, because it is trading higher than its longer term multiples. The stock is up as much as 11% over the last 3 months and considerably off the high, off the low rather, that it showcased in that time frame. But what are the factors that are aiding the stock's performance even as the markets are underperforming just a tad bit compared with everything else? Varsha is still with us. Varsha, what's standing out here?
Well, the important highlight or interesting point for this Yatharth Hospital versus peer is, one is the company's RPOP is lower versus peer. However, the growth is very strong, and also there's a huge potential to catch up to the RPOP basis the expansion plans. The RPOP is nothing but average revenue per occupied bed. Now, if I were to compare it with peers, if you see, you do have a table in front of you. If you see, the RPOP for Yatharth is low with an occupancy of 67%. So there's a huge growth left for RPOP, and they're expecting almost 10% year-on-year growth when it comes to the RPOP. Talking about expansion roadmap for Yatharth, they have a current bed capacity, if you stand at around 2,550, and Agra is expected to scale from 150 to 250 beds, and RPOP is expected to rise eventually. Medium-term ambition, if I were to talk about, they want to take this bed addition to 5,000 bed via 3,000 bed additions, and the capex plan is expected at 1,500 crore in next 3 years. While on the specialty mix, there is a clear push towards super specialty to sustain RPOP growth. Oncology share now stand at around 10%. They want to take it to 15%, and the RPOP growth guidance is 10% year-on-year. Onto the profitability look, growth phase consolidated EBITDA margin is expected at 24 to 25%, and break-even is expected in Faridabad and Model Town within next 15 months. Lastly, onto the payer mix strategy and receivable, the current mix, if you see, stand around 35% when it comes to government.
Varsha, thanks so much for that pretty comprehensive view on Yatharth. In fact, we're joined by the management of the company. Amit Singh, Group Chief Executive Officer of Yatharth Hospital and Trauma Care Services, joining us this morning. Amit, good morning, and thanks so much for taking the time. I wonder, in that wrap that my colleague Varsha just gave us of Yatharth, what stood out to you? Because to me, what stood out is the kind of capex and the build-out that you have lined up over the course of the next 5 years, which is to dramatically increase capacity. And this seems to be a bit of a trend in the hospital and healthcare space in India among the listed players.
Yes, you're absolutely right. As we have stated earlier, we see the northern India as a huge potential. There is a huge gap between the demand and supply, and that is what, as we have a very strong brand presence in northern India, we want to capitalize it. Still, we believe that there are areas within the Delhi NCR, and if you go to the capital, state's capital, there's a huge opportunity, and that is what our next 5 years, I think roadmaps are very clear that we're going to add additional around 2,500 to 3,000 beds. Largely going to be the brownfield, but also will be some asset-light, partnership and a few strategic greenfield projects.
So, but the concern, Amit, is while this build-out takes place, there's going to be a period of not necessarily instability, but maybe some of the metrics will look a little bit anemic. Is that something that will take place? Because ultimately you will have a relatively lower occupancy in the initial days as you build these hospitals out. Is that a fair assessment?
Not exactly. If you see, as Yatharth group wise, our occupancy is close to 62-63%. But in last 6 to 8 months, we have added 3 hospitals with around close to 900 beds. And I'll tell you, my acquisition with the Delhi and then the Faridabad is a very, very strong acquisition and a very, very fruitful acquisition, I would say. In the first full quarter of quarter 3 for these 2 hospitals, adding up probably close to early 2-digit revenue in terms of the group total revenue. So I believe we are very much confident about the market where we have entered into it, and when we go in next probably 3 to 5 years, doubling our bed capacity. Till the time we believe that these 2 or 3 hospitals we have recently added will be a slightly on a maturity side, which will give us a very good occupancy and ARPOB as well. So we see the growth potentials very much has. So that's I mean, we are very bullish about it.
Okay, Mr. Singh, the belief is that this revenue growth projections that you or any of your peers are giving on the back of capacity additions that come on stream this year and over the course of the next couple of years lead to a strong number in FY27 and arguably a continuation of a compounded annual growth rate over the next 5 years at the very least. Would that be a fair assessment, part one? And what could the numbers on those look like? For example, FY27 revenue growth and a compounded annual growth rate estimate, let's say for the next 5 years.
So, as I said earlier, I think we are very confident.
If you said it earlier, but yeah, please continue.
Yeah, so companies' growth, let's see, if you look at it, last 1.5, 2 years back, if you see, when we had around close to 1,300 beds, and we have added another 1,300 beds in the next 1.5, 2 years, kind of still maintaining the growth trajectory in terms of the revenue, right? So these indicators are very much, giving us a boost. That's we believe that's where the market where we'll be entering into it, and the kind of acquisition which we'll be doing it, right, in the future. I believe that these numbers going to be sustained.
Sir, sorry.
And whatever they're going to be any drag with some new acquisition or something, I believe that's existing units will definitely will catching up on that.
Fair call, Mr. Singh. But yeah, which is what I was saying. I was looking for the number there. You said it earlier, but I didn't get the number, so I'm trying to get the number from you. FY27 number and a compounded annual growth rate number for the next 5 years. It's a hypothesis.
No, I think it's still, I mean, I believe that results are not out. So, but I would say you can have a fair assumption about last quarter number. And typically in healthcare, if you see, largely quarter 2 and quarter 4 is the strongest quarters.
Got it. Yeah, sorry. No, I appreciate. I did not want you to commit to what the FY26 number or Q4 number would be. Just a broad estimate of what the 5-year CAGR number could be.
I think these numbers are going to sustain. I believe a couple of percentage here and there, but I think these numbers going to be sustained.
Yeah, fine. I don't want to put you. And sorry, but just before my colleague comes in, you do not want to. Would you need to? How do I say, need to raise some equity capital in the next 12 months in order to fund any of the future expansion plans, or would internal accruals help you fund all of those activities?
As of now, our books are very, very strong, and then we believe that whatever the next 3 to 4 years the spend going to be largely will be from internal accruals, and if need arises, I think we would like to leverage the market. I mean that's fine with us, but we are pretty confident that I think internal accrual would be sufficient for us to fuel those growth or any acquisitions.
Okay, Mr. Singh, appreciate that, and yeah, sorry, I didn't want to probe you to say a number which you cannot say because you're in a silent period. Maybe we'll talk to you once again once your quarterly numbers are out for us to have a better sense around the numbers. But all the best for the expansions and the growth. Thank you so much for taking the time out and being with us today.
Thank you very much for having me. Thank you very much.
Appreciate that. The pleasure is ours. Well, Yatharth obviously can't talk numbers, but sounded confident. He did.
Okay. The other big story that we need to track is what is happening in the Strait of Hormuz. Now, a lot of reports that Iran is going to continue to charge a toll through the Strait of Hormuz, one of the world's busiest energy choke points, perhaps in crypto or yuan. Now, as some of those layers come about, it's a good idea to get a sense of what the industry is facing. Sunil Vaswani, ED at CSLA, the Container Shipping Lines Association, joining us now on the show. Mr. Vaswani, very good morning to you. Let's just get a sense of your perspective. I mean, we keep seeing the marine traffic live satellite visuals to see how many ships are passing through the strait, and obviously the traffic has not come back anywhere close as it was, say, 6 weeks ago. But what has been your end of the experience right now?
So, morning, and thanks for having me here. Well, it's still early days, so really nothing has changed on the ground per se. Under normal circumstances where you had about 100 to 140 ships sailing the strait every day, you just have about a few, 4 or 5 ships, maybe max 10 ships sailing out of the strait. To make matters worse, there have been reports that about Iran saying that they might have laid some sea mines in the Strait of Hormuz. So that makes things even more difficult for any of the shipping lines to consider reverting to their old service patterns of entering the Strait of Hormuz. Besides, we have still some of our ships that are stranded inside, and earlier a couple of our ships even got hit. So for that confidence level to come in, then we need some assurances, because as of now, the container lines are continuing with the revised strategy and the resumption of services that they announced a few weeks ago, whereby our ships call outside the Strait of Hormuz, that is on the east of Strait of Hormuz, onto the ports like Corfacan, Salalah, Jeddah, Sohar, and that service pattern will continue for now.
No, so just to clarify, are the stranded ships pushing through? And is there a charge for them to come through, or any ships to come through?
So for the stranded ships, let me put it officially, there has been no intimation about this charge. But we keep hearing about it, from different sources. And figures also that come in are quite significant, because they say about either $1 a barrel, or more. It's even worse, $2 million a ship. And $2 million a ship is quite significant.
Mr. Vaswani, again, this is seemingly conjecture at this point, and there's no, as you pointed, there's no official statement by Iran. But a couple of things are coming through, and maybe we can get your view, because you're probably better informed than we are, which is that there is a requirement for ships passing through the strait, those that are allowed to go through, to hug the coast and to take a certain route through the strait. There is supposedly a conversation about checking of cargo. And third, there is a conversation about not just energy and crude, but any consignments that go through the strait will be charged a toll. Are you hearing any of these?
We keep hearing about, like, news reports, like you keep hearing, but there's nothing official, as I said. And number two is that confidence is just not there to cross the strait at this point in time.
Okay, so there's obviously a concern because of what is happening on the ground and the fragility of this truce. But I do want to also ask about the insurance rates and whether anything has changed on that front. And is this primarily the reason, of course, apart from the danger to lives and the people on board those ships, which is of primary importance, has anything changed on the insurance front?
Nothing on the insurance front as well, because even the route that we are taking currently also comes under a risk, as far as insurance is concerned. So, while we may be, sailing through the east of Hormuz, that also is a risky area. So the insurance costs still remain the same.
Got it. Mr. Vaswani, in general, if a ship were to pass under the terms as they stand right now, which is that there is no complete clarity, but Iran is allowing flagged vessels to pass, what would the average increase in cost be? Insurance, the fees or the toll that has to be paid, what have you, versus what it used to be. What is that average increase in cost per a large vessel passing?
So the cost as far as insurance and bunkers, etc., have already been factored in. That comes to about $1,500 to $2,000 per 20-foot container. But if you add on the toll charges, which is all hypothetical, so I don't want to set panic out here because there's nothing officially confirmed on this. So I'm just answering a hypothetical question. But if that were to happen, let's say $2 million a ship, depending on the size of the ship, it could work out to, $300, $400 per container. But again, as I said, it's all hypothetical. So
But
Please
Mr.
don't.
Asani, if we leave the hypothetical aside, which is the number that you said, in percentage terms, what is that uptick versus what was the scenario before a month and a half?
So as I said, it would be exactly about, not exactly, it would be roughly about $300 to $400 per container, roughly estimated.
And it was what, sir, before?
Well, nothing. There was no toll earlier.
Okay.
No, I think Mr. Vaswani just misunderstood. Perhaps we're talking about, we're not talking about the toll because we don't know about the toll. We're talking about the other costs that have gone up, and compared with prior to the conflict, what percentage increase in the cost of transit through the Strait?
So I would say that there has been hardly any increase as far as the freight charges are concerned. There has been some increase on the freight charges, but it is essentially the bunker, the war risk surcharge that we were charging about $1,500 to $2,000. That was not there. That is the additional cost. The freight is about, say, maybe, I don't have the exact figures, would be $700,000. But the additional cost that has come in is as far as the war risk surcharge. That's about $1,500 to $2,000 per 20-foot container.
Okay, so Mr. Vaswani, I'm going to ask a couple of very simple questions, and they might be sort of yes or no questions. Before the ceasefire was announced, was there any kind of charge that had to be paid to pass through the Strait of Hormuz? We can call it a toll, we cannot call it a toll. But was there any charge to be paid for protection to pass through the Strait of Hormuz that had to be paid by container lines?
Officially, we are not aware of that.
Okay. If there is going to be a charge, and there's a possibility that there may be, how will that be accounted for? Will that be passed on directly to your customers? Is that how it will go?
See, any cost anywhere that comes in is shared by everybody, So certainly the customers also would have to bear the cost.
And to what extent are there ships going through or waiting to go through? Is it at a standstill right now? Are other options being looked at? Are other routes being looked at? What's happening there? Because it's not as if there is zero transportation happening in that area, right?
Yes. So as things stand, passing through the Strait of Hormuz is practically at a standstill, at least as far as the foreign container shipping lines are concerned. And we know that transportation has to move on. And that's why, as I said, that we have revised our service pattern to call on the east of Hormuz, which means we call at ports like Fujairah, Korfakan, Sohar, Salalah, and even Jeddah, for that matter, to move on.
Okay,
and then cargo is transported inland by road.
Okay, and Mr. Vaswani, purely from a layperson's perspective and with basic understanding of geography, the possibility of trade with alternative sources for energy, it's been over a month now, and I'm pretty sure that these alternatives are being looked at very carefully. These are longer maritime routes, but have we started seeing traffic, say for example, around the Cape, or even on the other side from the east, or rather, from the east of India?
So let me put it this way, I can answer questions more straightforward as far as the container shipping lines are concerned, because that's what we deal with. Now, for the container shipping lines, as I said, that as far as the Middle East is concerned, I explained how we have taken alternative routes. You asked also a question about the Cape of Good Hope. We had shifted to the Cape of Good Hope for cargoes to Europe and the US East Coast 2.5 years ago when the Houthis had struck. So instead of crossing the Red Sea or the Suez Canal, we started going over the Cape of Good Hope, and that stands. So the rest of it is all as I just explained as far as the Middle East is concerned.
Got it. All right. On that note, Mr. Vaswani, thanks so much for taking the time. Pleasure speaking with you. And I appreciate the amount of information that you've been able to share with us.
Thank you. And I always appreciate being here with you. So thank you so much.
Thank you, sir.
I think it's very, very important to understand what he could talk about and what he could not talk about, because the situation is very unclear. And this is the confusion, right? A lot of the information is coming from posts, getting translated from Persian, media reports, tweets, one doesn't really know what's going on.
Yeah, this 2 million number per ship.
Yeah.
We haven't got an official confirmation today.
No, you haven't.
I don't think we're going to, because it depends. It's going to depend. What we do know is, I saw a report which I found very interesting, is that the South Korean envoy has gone to Tehran to negotiate the transport of the passage of South Korean ships through the Strait of Hormuz.
Okay, so
there is going to be bilateral conversations now. Everyone's figured out, okay, these are the guys we need to speak to. I mean, the world moves in a very transactional fashion at the end of the day. Everything else is fine, as it should. So people are now going to figure out, this is the guy we need to speak to. Let's figure out our scene and sort it out. That's all up in the air right now. So we need to see what happens there. Very short break. A lot of news coming up on the other side. We're going to be speaking to Jignanshu Gaur, talking about the quick commerce space. It's getting increasingly crowded. Who can nudge ahead? Jignanshu Gaur speaking about it after this very short break. Stay tuned.
केसरिया से मन जोगी हुआ रे दिल झूमे देखो मतवारा हुआ रे केसरिया से मन जोगी हुआ
हर पल मनाओ केसरी त्योहार विमल बोलो जुबान केसरी
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversations.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
All right, welcome back. Market's doing well. We've crossed the 24,000 mark once. Let's see where we are on the Nifty before we get to our first conversation. It'll slide off from there. But definitely a recovery coming in. Most of the profit booking from yesterday seems to have been covered up. Let's focus on India's quick commerce space. It's getting increasingly crowded with rapid dark store expansion intensifying competitive pressure. To speak on this, we're joined now by Jignanshu Gaur. He's Director and Senior Analyst at Bernstein, looks at this space very closely. Jignanshu, always a pleasure to have you on, and thank you so much for your time. Take us through your report and the outcomes that you have seen there versus the quick commerce space. Are we seeing a situation where the room to grow is now getting capped?
Thank you so much, Tunna, for having me here. Always a pleasure. What we look at is that broadly the number of dark stores that most quick commerce players have in India. And I think two big takeaways in my view. One is at the aggregate level, the total number of dark stores in India has already crossed 6,000 across multiple players, which is significantly fast shift in the retail landscape in India. Second, a majority of these are focused in the top 6 or 7 cities. And those collectively are almost 60 to 70% of the total dark store. So that's point number 2. In these cities, the players seem to be focusing on the same geographies at a pin code level, and hence sort of the same customer profile. And lastly, outside of these cities, except for Blinkit and Instamart, we see a limited number of players who are trying to prove the model, whether it works outside metro cities or not. So yes, for the same customers in the same geographies, intense competition. The other way of looking at it is, we think competition is at its peak today. No new incremental player will come, and Flipkart, Amazon have already accelerated their dark store expansion in the last 6 to 9 months.
Okay, so Jignanshu, the question therefore stems is that in food delivery, for example, some of these companies maybe hit a bit of a growth plateau, but then eventually turn the metrics which the market likes, which is some bit of EBITDA, some bit of profitability, as the case may be, right? Do you sense that happening
en masse at some point of time if indeed the expansion slows and therefore the capex slows, so on and so forth? And is that actually a net positive?
Yes, eventually, right? But I think things might get a little worse before they get better.
Okay. Wow.
And yeah, it becomes, I think all industries, especially e-commerce industries, which have scale effects or network effects, go through the cycle where you are anchored on customer acquisition as your primary objective for the first few years of your life cycle, and then you shift focus away towards profitability. Like you mentioned, food delivery is in that space with both Swiggy and Zomato focusing on margins, where the growth has now stabilized. We don't think the growth is at that stage yet in the quick commerce space. There is still room for growth. However, there is not a very high amount of strategic differentiation between the players. The positioning is very similar in terms of products, etc.
So therefore, Jignanshu, the operative question to anybody listening to this conversation is, what is the call? And how do you then differentiate between the two? What is your call on the two players? Which one do you like more?
See, sitting where we are today, we believe Blinkit is has proven far better execution chops than Instamart has. In this industry right now, with one of the highest amount of competitive intensity, it seems to be growing faster than the industry. Both because it has expanded network where others don't have, and it has the largest network in the industry, but also because its first mover advantage gives it a loyal set of customers whose default first app is Blinkit. And unless something fails, you generally don't move away. Whether there is a clear differentiation of what Blinkit stands for versus Instamart stands for or other stands for, I don't think there is a very big differentiation. But Blinkit has proven financial metrics and operational metrics better than Instamart. So we think at this stage, we would suggest buying Blinkit over buying Eternal over buying Swiggy.
Okay, Eternal over Swiggy is the core outcome of that conversation as well, apart from the other points. I think even Jignanshu saying that things might get worse before they get better, very, very crucial. Thank you so much, Jignanshu Gaur, for speaking with us. Remember, new entrants also making a beeline, including Zepto, for that quick commerce space. Let's move on to the large conversation this morning. Shreyas Devalkar, Head Equity Access AMC, with us this morning. Mr. Devalkar, always a pleasure to have you on. Thank you so much for speaking with us today as the markets are showing a bit of a bounce back. I think it's a day when one can say that the faithful have been proven correct. Those who actually saw opportunities and bought through the dips over the last 5 weeks. Were you in that camp?
Yeah, so actually market opened up opportunity across the board. So it was this correction happened especially in the stocks which are linked to the crude and overall financial space. So definitely it has given opportunity to buy.
Shreyas, good morning, Neeraj here. Almost all sell-side notes are now replete with examples or other reasons of valuation comfort and why they turn constructive, even if they reduce the target on the Nifty, so on and so forth. With the presumption that the worst of the conflict is behind, the worst of the oil price increase is behind, etc. Do you believe here is where you would want to put all the capital that you have to work? I mean, assuming you keep 2-3% cash normally, so 97%, whatever it is, but the maximum permissible that you usually do, would you put all of that to work at the current valuations, or would you still be careful because what if there is some bit of a slip over the course of the next 15, 20, 30 days?
Sure. So it is, if we are talking about only about the conflict, then obviously the crude oil prices is what we watch out very closely because the news flow has been on both sides at multiple points in time. So if you look at the crude oil prices, we are taking a base assumption that it would settle somewhere around 80s, 90s because maybe it may not get resolved so soon as far as crude prices especially is concerned. So with that kind of view, in my opinion, there is a merit to shift some positions from here and there. So point is that yes, at that kind of crude, it has some element of inflation, and that's where what are you buying is more important than taking a cash call in that sense. As far as the investor level, definitely this overall valuation level of the large cap space is definitely attractive. There is no doubt on that. Many sectors and many companies are actually gone back to their pre-COVID level valuations. While in the mid and small cap, I would call out that at an index level, it may not be that lucrative. Individual stocks may come out to be more lucrative when it comes to the valuation. But at the index level, I don't think mid and small is really lucrative at the index level valuation.
Okay. Shreyas, morning. Alex here. And so therefore, from a strategy perspective, I'm going to ask a slightly broader question, which is that in this kind of a scenario, because you operate on almost always a completely deployed kind of a situation, right? Will you use opportunities and stay a little bit nimble where in a day or 2 or 3 sessions, you have a recovery of 7, 8, 10% in certain stocks that you might have taken a position in? So in more liquid names, you will utilize and book those profits to keep the powder available for you to deploy in certain other opportunities. Will you be more nimble than before?
But generally, the way we would operate is not based on this event per se, and especially the way of operation of nimbleness. From that point of view, I'm talking about. What I would look at is, as I said, that this event, what it has led to when it comes to the shift in opportunities, or something probably. Before the war, you would have been positive on very high growth, especially in some of the cycles which were turning up. Now you have to question that, especially within the auto space, and accordingly, we would like to turn and shift rather than trying to use that cash calls as a proxy to nimbleness per se.
What is the positioning in your hybrid fund right now? Let's talk about the balanced advantage fund.
So in the balanced advantage fund, as of last month end, it has been closer to, generally we have been in that 55 to 60 range.
55 to 60. Do you foresee a situation in the near term where you will go above 60%?
Yes, if the crude settles down at current level and it shows a sign of moving down towards 80s, 90s, broadly in that range, then definitely it would offer opportunity.
Okay, and very quick follow-up question. Since you've said that at the index level, not too many opportunities in the broader markets, but individually there might be, will your incremental allocation likely be in the frontline stocks where there's probably more valuation comfort?
See, this valuation argument has been very tight for last 2-3 years per se. What is happening out here is the companies which are growing slow, and most of them are in the large cap space. There the valuations are lucrative. Where there is a question on ROE or they are growing slow. There is a question on AI disrupting them, and there the valuations are lucrative. While the companies, especially in the manufacturing space, especially where there is a tailwind and there is no direct impact of all these disruptions happening around. And if there is tailwind, then all the more better. But then such companies are not exactly at a lucrative valuation. And that's where that dichotomy has been in the market for quite some time. And that's where you are seeing the market is getting broadly consolidated at a broader indices level because of this primary reason that wherever there is less growth or question around a sustainable ROE, in that case, the valuations are really lucrative, maybe closer to their pre-COVID levels, while the spaces where there is a tailwind and especially the manufacturing, etc. spaces, the valuations are high as such. So it's not about mid versus large, it is about these two categories of stocks.
What sectors are you liking, Shreyas?
Sure. So we are broadly positive on overall financial space because there is both positive in terms of valuation and also in terms of its growth revival, what we have seen at least till pre-COVID. So that growth revival, if you see from earlier pre-COVID, the growth there was higher. Somehow post-COVID, the financial services after that initial pickup the growth came down, especially on the credit growth front. While from that level, since last November, October, November, December time period, the growth has started reviving. So that is one. The other one is manufacturing sector, which where we are positive across the board in most of our funds. Apart from that, selectively we are positive in stocks in the pharmaceutical. When it comes to consumption, as I said earlier, the auto part of it one need to evaluate after this war situation. While the other part of consumption, there as always, in last 4 or 5 years, the growth in the retail has been better than the growth in FMCG, and that's how we are pursuing out there.
Okay. So manufacturing, financials, auto, among the things that Shreyas Devalkar likes right now. Thank you so much for speaking with us. Always a pleasure having you on. That's pretty much all the time we have on the show, and it's great to see that markets are holding out quite positively. But one story that caught my eye, guys, is because there's been so much buzz about all of these trades being placed before Trump's statements and longs on equity, shorts on crude, and then he comes and says ceasefire, someone's become very, very rich. There's actually a directive that's gone out from the White House as per the Wall Street Journal, which has told White House staffers, please don't place bets before a statement. And I was just thinking,
that's it.
This is the short version. I'm telling you the whole very long story in 5 words. This is super cliff notes, stamp notes on it. But just think about it, that there are people who would have access to the speech and what the president will say.
This is basic stuff.
Who are trying to make money off it.
Yeah, this is basic stuff. I mean, the SEBI would have been hunting you by this point.
Yeah, I'm surprised that such big leaks are happening. It's insane.
And I'm surprised that all that the White House is doing is saying, please don't trade.
Please don't.
Yeah, and huge bets on poly market as well. It's not just trading in the markets, right? These are these betting agencies in the US where people are making money, and they're privy to information of what Trump is going to say. It's insane levels of corruption.
Scary.
From top to bottom, if this is what's happening. We'll wrap up over here, and we're just leaving you with what's been happening in the markets. It's been positive. It's been a good session on India Market Open, but that's all the time we have on this table, and everyone who helps put this show together. Stay tuned though. Ask Profit up next.
केसरिया से मन जोगी हुआ रे दिल झूमे देखो मतवारा हुआ रे केसरिया से मन जोगी हुआ
हर पल मनाओ केसरी त्योहार विमल बोलो जुबान केसरी
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversations.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
To understand the Tamil Nadu twist, join me in the midst of our people, language and politics. Vanakkam Tamil Nadu, here we come.
केसरिया से मन जोगी हुआ रे दिल झूमे देखो मतवारा हुआ रे केसरिया से मन जोगी हुआ
हर पल मनाओ केसरी त्योहार विमल बोलो जुबान केसरी
Presenting the all-knowing, all-powerful
Hello and welcome back to NDTV Profit. You're watching Ask Profit, a show that solves all your stock-related queries. My name is Puneet Zaveri. With me is Mahima Vachhajani. And over the next hour or so, we'll try and solve those queries. So if you haven't already, do start sending them on the numbers that are flashing on the top of your screen. You can call us also on the landline number. Speak to us as well as our guest today. The number for that is also flashing on your screen up there. But before we do that and a lot more, very quick check of how the markets are doing. Indication was of a start in the green while only in roughly around 40 to 50 points, but we materially built on that today. So we're now trading above 24,000 mark yet again. The Nifty is up 1%. When you look at the heat map for the Nifty 50 also, IT pack continues to be in focus. TCS, the first company to report results majorly, of course, in the benchmark, has been a disappointing quarter and hence dragging the major IT names with it. Tech Mahindra, Infosys, all down today. Apart from that, also you're seeing pressure on ONGC, but very minusculely, while Sun Pharma continues to be one of the biggest losers for the Nifty 50 today. In terms of the gainers, Asian Paints is surprising on the upside, now up 4%, and the top gainer for the Nifty 50. ICICI Bank, Axis Bank continue to be in favor too. So is Eicher Motors. Today is the launch of the Flying Flea, which is its first electric vehicle motorcycle, and a lot of expectation. Reviews have started to come in a little bit and seems to be very strong in terms of the launch, but a lot more updates post Q4 results for the company on the same. When you also look at the sectoral heat map, IT definitely will be one of the bigger losers today, and that is the case, down 2.5%. So largely the biggest loser and material one itself. The others, Realty, continue to show gains. So does private banks. Autos up yet again. So is India Defence and the Financial Services Index as well. Nifty Bank hovers around the 1.8% mark, but the advance decline ratio, Mahima, that's been something that we've been tracking consistently. Also in favor today of the advances as well, because and materially to add to, because it has been consistently positive over the last couple of days, and almost a 1:10, 1:11 ratio for the gains. So we're both happy in that aspect.
Yeah, absolutely. And it's widening as we speak as well. So that is completely in the favors of the bulls for the day. The mid cap 150 and the small cap 250 both trading above that 1% mark. In fact, the small cap 250 is now trading above that 1.5% mark, almost at its day's high point as we speak. Let's quickly pull up the BSE 500 to take a look at what are the stocks buzzing in the broader end of spectrum. You have Sun Pharma, which is of course taking a knock. Coforge, Emphasis, all of these IT names taking a knock on the red side, but you have Sapphire Foods today back in the green after a really long time, up 7%. Cohen's Life, New India, Life Assurance, Orient Electric are some of the names that are doing fairly well in trade today. But with that, let's welcome in our guest for the day and start answering all your stock related questions. We are joined by Sameer Dalal of Natulal and Sons Stockbrokers. Today I think I'm taking Sameer's introduction and pronouncing it correctly. And Saumil Mehta, Head Alternate Research at Mid Asset, Sheikh Khan joining us now. Welcome to both of you, gentlemen, and a very good morning to the both of you. I'll start taking the first question, which is coming in from Sanjay, who's writing us from Bangalore and asking about TCS. Wants to know whether this is a good buy from a one-year perspective or not. Sameer, I'll come to you on this one. Your view and the entire way Q4 has panned out, and overall, if this is the right time to make an entry.
Yeah, so Q4 numbers were actually a mixed bag. People keep saying they've done well, but they've done well because of the currency decline, right? If you look at the constant currency revenue, it's actually degrown which is sending the picture that growth is questionable. Yes, the management is saying we won good orders and they have $12 billion, but we need to see translation into actual growth. But what is happy to see in the results was the fact that, the AI part of the business is scaling up decently. And hopefully that continues, because the integration of AI into corporate enterprises is something I think where TCS, Infosys, and all of these companies will start playing an important role. If that keeps scaling up, things will start looking better on the profitability front, not on the revenue front. Having said that, look, my stand has been on IT and including TCS is that these are good stocks to put against an FD. So in an FD, you get 7% return. If you're in the highest tax bracket, you pay 40% tax. Against that, this is a sector which is generating 5% div yield. And if the growth rates and profitability remain at around, say, 7-8%, the PE can maintain at these levels. So you can get a 7-8% increase in the stock price per year. So you get anywhere between 10 to 12% return, including the dividend. So from that perspective, yes, it's a decent investment. Downside looks limited from here. But is it a screaming buy at this point, even after these results and the guidance? I mean, not guidance, but the order wins and all of that given? No, I don't think it's a screaming buy. It's a defensive kind of bet at this point of time for me.
View, Samir from Natwalal and Sons. So we'll got that view on the IT pack, but let's quickly pull up the stock of Anand Rathi Wealth, and we'll quickly go to that conversation as well. The management came out with its earnings yesterday. My colleague Sharath caught up with the management. Let's listen into what they had to say.
The overall sentiment in that HNI category which you are catering to, has that actually, the growth rates which we are expecting maybe 2 years ago when the IPO had come of the company, and now seeing the market conditions, is the asset allocation playing a bit differently? And if yes, is it hitting the equity segment, at least for the segment which you are catering to?
Yes, sure. But I think this is my 18th quarter as a company result. So we got listed in December 2021. This is our 18th quarter. We've always been telling our shareholders what to expect out of us. And because we understand our client segment and we filter our clients on certain basis. So to answer your first question, whether the asset allocation has changed, the answer is no. When markets are down is when we get our clients to buy more. Are they inherently very positive at these times? The answer is not at all. That's when me and my colleagues, 393, 400 of us, go into the market and tell them that market always goes up. That's the reality. There have been 12 wars. Market has gone back up once the war has finished. But that data is too difficult for one to notice by himself or herself. So we as advisors handhold them, is why you would see a large portion of equity allocations happened in this quarter when the market sentiment was bad. Left to themselves, I as an HNI will also be very depressed. There has to be some Sathi who comes and brings in rationality rather than the heart aspect of wealth management. That's why you see net mobilizations have been good for the quarter. Asset allocation has not changed though.
Okay, so the asset allocation hasn't changed, but the growth rates which was there, I think you have given a growth rate of that 20 to 25% growth rate. Will that continue? Will you stick with that guidance going ahead also in the long term, or is there something there for the medium term which is different?
No, it's not very different because we've created a very uncomplicated business. Our pitch to the client is also uncomplicated. To the shareholder also, we have very uncomplicated business. We don't sell agile things. We sell to our clients what is actually needed, not something so innovative that money becomes experimental. So coming back to your question of what's the growth guidance, we have guided 1,415 crores of revenue on a base of 1,198, which is what we finished last year. We had again projected 1,175. We did 23 crores more of revenue than projected, owing to the principles which our elders in the company have laid down. Don't overcommit, always undercommit and over-deliver. With the same principle, we are committing a revenue of 1,415, a profit or a PAT guidance of 460 crores, and an assets under management guidance of 1,20,000 crores. We ended at 93,000 crores. These again have to be seen with a conservative bent of mind when we guide, and that's where you see last 4 years we've always given a guidance and have met it, and there has been not any quarter less than 20% growth, and we are one of the few companies which have been able to do that for 18 consecutive quarters.
Right, definitely the guidance everything takes in. I just wanted to understand a little bit more, especially on your operational parameters. The active clients, that's how much current levels is there. The growth was around 14% which I checked on a year-on-year basis. And how does this client addition is panning out? Is there any change happening in the constituent of the client, or is it going towards a larger client bases, or the smaller ones are also getting included? How's the change happening in the client setup right now, if any?
Sharath sir, your question has 2-3 questions intertwined. Let me first break it down. How do we acquire clients, and what is the segment of the clients we acquire? When we acquire client families, we are very selective of whom we want to bring in. We don't bring short-term clients. We don't want to add assets from people who are not investing for a lifetime. We want intergenerational wealth. Largely, that's how it works. That's why our client attrition numbers are point in decimals, if not in second decimals. On a quarterly basis, they are in second decimal. So coming back, we have a very, very tight, clear mandate of what is our target segment. Having said which, we acquire using references, cold calls, website leads, people coming to us, or maybe LinkedIn and all these social media platforms where you reach out to people.
Well, that was the management of Anand Rathi Wealth talking about the quarterly results as well, and since we are in that season, of course. But Somil, good morning, welcome to the show. Just a quick view on Anand Rathi Wealth because it's been a very rank outperformer in the last 1 year. Stocks almost doubled in that sense. Is there still legs to this rally now on the charts?
Good morning to everyone. Yes, absolutely. It's positive. In the last, let's say, from end of 2025 to last month, it has been in a range. It has been consolidating around the averages, around the 200 daily exponential moving average. It was always in the uptrend. However, this entire consolidation was around 3000 levels, but it has broken this entire range on the upside. So I'm bullish on this stock, and I'll be expecting this stock to continue the uptrend. The supports would be around 3,300, 3,180, very specifically. So I think on the upside, there's a lot of room here. I'll be extremely bullish here, but I would not suggest to buy fresh when there will be a little bit of more correction or a halt. Probably that would be again an opportunity to buy into the stock.
Okay, all right. So that's the view coming in on Anand Rathi. The next caller, I think Suryash is calling us from Hyderabad. I hope I'm pronouncing your name correctly. What's your question about?
Hi, this is Suresh from Hyderabad.
Okay, Suresh. Tell me, what's your query about?
Yeah. My query is, I am holding Pharma. Around the average price is 960, and I'm holding 100 shares.
Okay.
So I wanted to I want both the technical and fundamental view.
So when you bought this, was it the technicals that you saw, or was it the fundamentals that you studied?
I was looking into both the technical and fundamental, so I bought it at a lower level. I felt it is on recovery path. I was purchased these things, and look, I'm okay to hold these things for long term.
Okay, got it. Then I'll take this up with Samir. Samir, your view on Natco Pharma?
Yeah, so pharma space continues to look attractive. I mean, this is one of the counters that has actually done a lot of hard work in getting medicines into India, which are patented in the international markets into India at very, very attractive rates, capturing market share. Apart from that, they've also got some good exports going, the ANDAs that they filed. Valuations are also relatively reasonable when you look at it compared to the rest of the peers. So for me, Natco Pharma at this point is actually a buy. So I advise you to stay holding on to it. And whenever you get any dips, please add on to this. This is one of the strong counters in the pharma space, according to me.
Got the view, Samir. But the next question coming in on Tata Motors CV, it's been, been under pressure, broke the 400 mark, and since then, from 389, has seen a stellar run. Was up almost 12%, 10% along with Ashok Leyland on Wednesday. Now a viewer is holding 10,000 shares of the company, bought at 400. This is Anita from Vijayawada. And her question largely is, Samir, what she should do with her position now. It's quite a meaningful position that she's added, almost 40 lakhs in that sense. But what should she do now? Should she continue to hold?
So given such a large position has been taken, I would kind of hope that she's diversified and not just stuck in one stock. So if she is diversified, and this is just one of the multiple investments, I think stay invested. This commercial vehicle cycle is going to remain healthy. We think Tata Motors, the largest player, yes, they've lost a little bit of market share, but they'll be able to do extremely well with the new launches that they have. So stay put, hold on to it. But if you're not diversified, please do that. Then don't stay put in only one stock, because that always increases the risk of something or the other going wrong with an individual company. So that is the only advice I'd like to give the person who's asked the question.
Okay, all right. Moving on to the next question, which is from Ahmed, who's writing us from Delhi. He says that he wants to invest 1 lakh in the healthcare space, wants to know as to what counters are looking attractive right now. So, anything that you're liking on the charts in the space?
There are 3 stocks which I'm liking. The first one is Fortis. Fortis definitely looks good to me. Fortis has broken out of an ending diagonal pattern on the daily charts, started moving up again. The long-term structure still holds, and I'll be expecting much higher levels above 1,000, probably 1,050 as well in the medium-term outlook. But looks great to me for an investor. Lupin looks great to me. Lupin has been forming higher tops, higher bottom formation since last 6-7 months, broken out of a big range. I'll be expecting higher targets above 2,500 in the medium term outlook. Supports would be around 2,250, 2,200. But yes, these 2 stocks definitely look good to me.
Okay, all right. Moving on to the next caller. I think Chandu is calling us from Hyderabad. Chandu, a very good morning to you. What's your query about?
Hi, very good morning.
Good morning.
Good morning
Go
to
ahead.
all.
Yeah.
Yeah, my query related to Sapphire Food. So I bought it around 600 quantity at price of 257. So I'm a long-term investor. Shall I go ahead and average right now, or is it good stock to hold for long term? I want to know the short-term and long-term view.
Okay. So I'm just trying to understand, Chandu, when you bought this, was it the fundamentals that you saw?
Yeah, that time both are merging related opportunity will be there, right? That time I bought it actually. Sapphire Foods and some other one is going to merging, right? So
Devyani, correct. Okay.
I'm looking into the entity only, I bought it actually.
Okay.
But yeah.
Okay, Chandu, got it. Samir, so basically what he's saying is that when he heard the news of Devyani and Sapphire merger, that's when he bought Sapphire. Since then, we've seen the stock falling, but it's now playing catch up since the past 2 days. What's your recommendation? What should Chandu do right now with regards to his holding in Sapphire?
Okay, so first of all, very, very positive on the QSR space from a long-term perspective, okay? Because if you look at it, a lot of these branded retail outlets have barely made a dent in the Indian market when it comes to its reach. Now, when the merger between Devyani and Sapphire happens, there'll be 2 advantages. One, there are a lot of stores in similar locations for some of their brands, so they will be able to rationalize that and reduce some of, increase their store presence in some different places, which will allow them to reduce their, the overlap in the area and move to new areas, capturing more market share. Secondly, if you look at QSR and Sapphire and Devyani included, they've all gone through a period where SSSG has been negative for 2 years. Now, if SSSG, that is the same store sales growth, just moves back to what it was 2 years ago, I think what you will see is a massive increase in profitability because of the constant addition of stores. So for me, this entire space is a buy. Devyani and Sapphire merged entity is also a buy. Very, very attractive at this point of time. I would advise, if you have a little more liquidity and a well-diversified portfolio, add on to this and average your cost down. If you hold it for 3 years, this stock can actually be a multi-bagger for you.
Okay, multi-bagger on Devyani is what Samir feels, but let's go across, take the next question. This one's coming on Aether Energy, and our viewer holds, he's actually bought the shares today itself. This is Suman at 844. He wants a very short-term perspective. Somil, 1 to 3 months is his view, but stocks kind of run up quite materially, right? Somil, what would your view be on the charts now? Is there more legs to this rally?
Absolutely. I mean, looks great to me. It's already in the uptrend. Breakout just happened 2 trading sessions back. A triangle pattern has broken on the upside, taking support at 20-40 daily moving average. Everything going well for the stock. But I would have waited for a little bit of correction or probably a pause and entered the stock. But nevertheless, I think the stock could go till 870, 880 levels. These are my targets in the short term.
Got that view, Somil. But very quickly, let's look at the BSE F&O setup for today as well. Firstly, on the Sensex, you are seeing that move. Yesterday was, of course, the expiry. But today, it's been a decent day. So you're seeing all movements almost in the green today. Asian Paints definitely leading the chart as we spoke to you. And the Nifty IT continuing to be under pressure. Sun Pharma actually has been in the news, potentially bidding for a company worth $12 billion, and the market's not having two bits of it at this point of time. In terms of longs being unwinded, now let's look at stock specific action now. You are seeing in terms of longs actually in terms of being built up is Lodha as well as Asian Paints. So you're seeing up 4% there. Lodha also recovering from that level of almost where it was trading around 670, and since then seen buying over the last 2 to 3 days. In terms of short covering, you've seen Ashok Leyland being one of the big winners there in terms of shorts being covered. So is ICICI Bank. Just a week to go for the results for ICICI Bank, of course. In terms of what we've seen in longs being unwinded, DMart is one. Now, had a very stellar run because of a very strong update. Mahima has been covering that as well. So, you saw DMart also being in focus post quarterly results, and once those come in, will be back in focus. So has Vedanta been at focus on investors longs for being unwinded. And shorts finally where they are being built up. Sun Pharma, of course, so is Infosys, very interestingly, post the reaction that we've seen on TCS today. Those are some of the stocks to keep on your radar. But let me go across, take the next query on Indigo. Now, this is Akash who sent us this question now. He's holding shares at 5,387, holding 30 shares. He wants an 18 to 24 month perspective, Samir, on this one. And largely the question that while we've seen a ceasefire, it's as fragile as ever, right? So is it a good time to buy into it right now? And if for someone who's already holding like Akash, what would be your view?
Okay, so I'll just give you my thought first, which is I do not like the aviation space. I've said this multiple times, and it's something I don't invest in. What people like about this business model is that you're kind of working on customer money rather than your own, because you sell your tickets 3 months ahead and you pay for your petrol 2 months down, and the plane leases are also you pay at the end of the month. So you're kind of working on customer money, which is what people love about this business because it's so light on working capital. But there's always a risk. Now, for whatever reason, if there's a slowdown in the economy, travel is one of the places that gets hit first because that's a very big discretionary spend, right? And when that starts happening and seats start going empty, the operating leverage works in the negative direction because your cost of running that plane is there irrespective of whether you sell 60% of the seats, 40% of the seats, or 100% of the seats. From that aspect, we always think there's a very high risk when it comes to the aviation sector. If you look at the history of aviation, there have been very few companies that have been successful in the world. Most of them have defaulted and failed. Now, Indigo is one of the ones that stands out. But the fact that the industry has a lot of risk and you're buying it at very elevated levels. Well, you bought it at a very elevated level at 5,300. For you to make money is not going to be the easiest thing. For me, I would avoid it, but any rally, I would sell out. But I mean, net, I'm not negative on Indigo from the simple reason that one airline in India will have to survive, and the most likely of that is Indigo.
Right, so that's the view coming in on the aviation space. But it's time for our rapid fire round now. Samir as well as Somil, you both know the drill. Try to keep your answers as short as possible. The first one is coming in on BHEL. This is from Arun, who's writing us from Hyderabad. Wants to know if we can hold or exit from a slightly long-term perspective. Somil, your view on the charts?
I would hold on to the stock. My target should be above 310, 320.
Mohit actually from Ludhiana holds the IOC at 77. So he bought it way back in 2022. Asking what he should do for the next couple of years. Samir?
So, again, right now, because the crude prices have gone up, the companies are losing money, right? So it's very interlinked to what happens with crude. Secondly, this is a very sensitive kind of thing when it comes when government increases prices. IOC and all, of course, benefit, but then it hurts inflation and everything. So for me, these HP, BP, IOC have always been an avoid. So I would not touch it, and I would sell out actually.
Okay. Okay, NTPC Green is the next one. 1,000 shares bought at the levels of 98. Good time to add 500 more shares, Somil?
NTPC Green, I'll add definitely a buy. Support at 90, 92 levels. My targets would be above 115.
SG Mart bought at 330 by Hari. Samir, by any chance, do you track this counter? He wants a 3-year view.
So which stock?
SG Mart.
No, I don't track this one. Sorry.
Somil on the chart. Stock's up 6% today. Any view?
I'll hold on to the stock. Bullish on the stock.
ITC Hotels is the next one. Our viewer wants to hold it for the next 12 months. Continue to hold, viewing the chart, Somil?
I would hold on to it. Keep a strict stop loss around 140.
Okay.
Is it the right time to buy KSB Pump, Somit, is what Chandrasekhar is asking.
KSB Pump, hold on to the stock. I'll be bullish. My target should be above 1,000.
Is it a good time to invest in Keynes Tech? Gopika from Chennai is asking this. Samir, your view?
Oh, valuations are a bit expensive. I like the space and I think the opportunity is great. But I find valuations, even after this sharp correction, if you look at the 1 year, 1.5 year period, valuations still look a little bit expensive. But yeah, accumulated over the next year, slowly, any corrections maybe buy.
Right.
Quadrant Future Tech bought at 385. Is the right time to add more, Somil?
Which stock you said? Sorry?
Quadrant Future Tech.
Quadrant Future, yes. Okay, so I'll be bullish in the short term, not in the medium term. My targets would be above 340, 350 levels.
Okay, Newgen Tech, hold, accumulate or sell. Our viewer is holding 20 shares at the levels of 250. Somil, your view?
Sorry, I didn't catch the
Newgen
name.
Technologies.
Newgen, yes. I would exit the stock, but in the very short term, probably a spike till 500.
IRFC bought at 200 by Siva from Amravati. Somil, should he sell now or continue to hold his 2,000 shares?
What level did he buy? Sorry?
200.
200. See, I'm expecting a bounce in the very short term till 110. Probably that will be a time to exit.
Anant Raj, is this the right time to buy more shares? Our viewer is holding 100 shares at the levels of 472. Samir, your view?
So unfortunately, Anand Raj is one we don't track. But yes, from they're doing the data center. So from that perspective, I do want to track it, but I haven't done yet.
Tejas Networks, Somil bought at 458, a very volatile counter. What would be your view for an investor?
I think the short-term trend is already done. My targets are around 500, so probably could hold on till 500.
TD Power is the next one. Usha from Hyderabad wants to know the short-term target for this one. Is this the right time to make an entry, Somil?
No, I would not enter, but you can hold.
Anil Singh wants to buy into the banking sector. He's asking between J&K and Federal. Samir, what would be your choice?
Between those two, Federal.
Alright, that's the end of the first round of rapid fire in this edition of Fast Profit. Samir, we'll let you go on that note. Thanks so much for joining in. And Samir, stay with us. A lot more stock related queries on the other side after this very short break.
केसरिया से मन जोगी हुआ रे दिल झूमे देखो मतवारा हुआ रे केसरिया
सफल बनाओ केसरी त्योहार विमल बोलो जुबान केसरी
Presenting the all-knowing, all-powerful tech guru.
Whoa. Guru? I'm no guru.
Okay.
I'm just a guy who loves his tech.
A show where the mysteries of megabytes and motherboards shall be unraveled.
Bro, nobody talks like that anymore. This is all about connected ecosystems, EVs and AI that you can use in your daily life. That's what we do on Tech 360. Real talk, real reviews, tech that you can actually use.
Tech has changed. So should your tech show.
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversations.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal.
Welcome back. You're watching Ask Profit right here on NDTV Profit. We still have Samir with us. Also joining in now on the technical side is Sachin Janardhan. He's AVP Derivative Research Analyst at IDBI Capital. Sachin, good morning. Welcome to the show. Throwing the first query on you is RBL Bank. Actually, what a viewer wants to know. Sunil from Pune holds share at 326, Sachin, and he holds 111 shares. Now he's asking what he should do with this counter. If you can suggest a short-term target.
So currently you can hold, basically the trend is up only for the stock on all the major time frames. So you can hold with a stop loss of around 300 basically, and the target might be around 340 and 366 on the upside.
Okay, we've got our next caller. I think Ravi is calling us from Hyderabad. Ravi, a very good morning to you. What's your query about?
Yeah, very good morning. I want to know, I have a query on L&T Finance. My time horizon is next 1 year.
Okay.
So just want to know at what price it's a good time to buy.
Okay, Ravi, got your question. I'll take this up with Samir then. Samir, on L&T Finance, do you think these are the right levels to make an entry or should he wait?
I think you can wait for L&T Finance. You see, the stock has had a massive run-up over the last year and a half. Valuations have moved up quite significantly in the NBFCs. Now, I understand the book has become fully retailized, 97% or 98% retail loans. The microfinance arm has started to grow again. That two-wheelers is doing well. Tractors are getting more market share. So all of those are positive, but all of that is captured in the price. So for me, if you want to make a CAGR of 15 to 18% return, now you're going to have to play the growth. So they're growing at about 15%, but the valuation re-rating is not going to happen. So around 240 or 230 would be the right buying price. Actually, in this fall, the price did go down to that level. So if you get it again in the fall, then look at adding on.
Got that view, Samir. But the next question coming in is on Vikram Solar. Now, a viewer actually wants to know. He is holding, this is Sharath from Tirupati. Now he is holding Vikram Solar shares almost, he's not mentioned the quantity here, but he wants a long-term view on the stock, and he's bought at 291, holding 98 shares. Now, Samir, stocks corrected since then. The IPO price was also 332 odd. What's your view on Vikram Solar now?
Puneet, you're saying the IPO price was 332, but before it listed for IPO in the grey market, Vikram Solar was selling for 400 and 420 rupees a share, right? So all of these people are sitting on quite heavy losses in this space. Now, my view on the renewable energy and the solar space. It is very positive. And if you ask me, this war that has happened should be a wake-up call and put fire under the rear end of the government to say that we need to reduce our dependence on international energy. And the easiest and best way to do it is solar and wind. So for me, if the government gives the right steps and the right incentives for solar and wind, which they are doing a little bit, but it needs to be a lot more. If they give it, you're going to see a massive run up in all of these stocks. So Vikram Solar included. The stock valuations have come off. They're reasonably priced. I think the stock can go up. My initial target on Vikram Solar is 300, 320. Longer term, of course, is a little higher. But which is my top pick in the space. I don't want to name it at this point of time unless a question later comes on. But Vikram Solar also positive.
Okay, so that's the view coming in from Samir on renewable space. And by the way, the counter that he's talking
we don't want
about.
to take the name because I was very tempted to in the question itself, but we want to keep a little bit of drama in if it does pop up.
Let's see if we get a question on that one. But moving on to our next caller, I think Vijay is calling us from Punjab. Vijay, very good morning to you. I believe you have a question on IEX.
Yeah, good morning, ma'am. I want to know about the IEX. I bought 2,000 shares at 145. I have 6 to 1 year time. What will be the future of IEX?
Okay, I'll take this up with Sachin then. Sachin, IEX, what are the charts indicating right now?
So overall, the trend for the stock on a daily and weekly charts are down only. So the recommendation will be because today the stock is actually hovering around the 100-day EMA, which is I feel it is taking a resistance. So exit will be the call.
Okay, exit will be the call. Got it. The next question actually coming in now is it's from our viewer on Yes Bank. Now, Samir, a very interesting one. He is actually holding 20,000 shares of the company bought at 20. With a very simple question of when could it be, if it could be the next multi-bagger, what is the expectation in the next few years? So it's a very long-term view that he's taking on. But, we've seen a new MD come in. How are you viewing the stock now, given that the other banking peers also have done well in terms of deposits and advances, at least in Q4? What's your view on Yes Bank?
Okay, so disclaimer first, I'm very bullish and I have a good decent size holding in Yes Bank. Okay. Now, I'll give you, people may call it anchoring bias or whatever, but since they asked when will it be a multi-bagger, I say in 3 years, it'll probably double. If you have maybe a 5-year to 6-year view, it could probably be 3 to 4 times its current price. So we're talking about 60 to 88, 5 years. Okay. Anywhere in between that. Now, why am I so positive? Look at the branch reach that they have. Given the new promoters that have come in, the confidence will come in, the ratings will get upgraded, so cost of funds will start coming down. We believe as India continues to develop over a period of time, the loans demanded by corporate India will start going up, which will allow all of these banks to start being more aggressive on their lending front. We believe NIM compression, which happened because of interest rate cuts that were happening, are now behind for the time being. So NIMs will start expanding in the short term. Profitability will rise. And if you look at the bank's OPEX cost as a percentage of its total cost, it has been higher. But as the loan books keep growing, the OPEX cost keeps coming down, the profitability will grow. Credit costs are coming under control. And we think over a period of the time, the stock's profitability will increase. It's gone through a lot of pain, consolidation, correction. And now I think over the next 3 years, you'll see a good up move happening.
Got your view, Samir. So very interesting one, Samir has given today, a couple of them actually. And we know about Kalyan, we know about the renewable energy play that Samir feels, Yes Bank, Devyani. So it's very interesting that, if a stock falls dramatically, Samir might be licking his chops on those ones and analyzing them to the brunt, because very interesting ones. Indigo he doesn't like, he mentioned the show as well. So viewers, hopefully that gives you a perspective also of these individual names that do correct. Some of them Samir likes, some of them he doesn't. But yes, Samir, so you were saying something.
No, I was saying I do like it when stocks do correct because it does about buying opportunities.
Right.
But then it keeps correcting, like the one that I don't want to mention.
Yeah.
The questions keep coming, it kind of hurts also.
The mystery continues.
The mystery continues for now, at least for the next few minutes until we get a query on it. But let's go across, take our next call now from Pune. Swapnil has a stock query for us. Swapnil, good morning. Welcome to Ask Profit. What's your query?
Hey, very good morning, Puneet, Mahima, Samir, Sachin. So I brought M&M in recent lows, 3003 from 500 stocks. So I want to know for because I brought it in recent lows, I want to know whether I should book the profit and go to any other counter in the same sector. And my question goes to Samir, particularly for the long term. And by the way, I'm very fan of Samir's candid reviews. He is very candid on his reviews. So thank you for that.
Got it, Swapna. So see, if you're going to Samir, he has a long-term view here. So I don't know, Samir, if you would recommend selling now, because he has gains of almost a lakh right now, given he's bought it at 3,003 rupees per share. But your view on M&M for Swapnil?
Okay, so first of all, thank you for the kind words that he gave. Yes, you're right, Puneet. I only give long-term views. I'm not someone who can. I mean, I can give short-term views, but I prefer not to. And on Mahindra and Mahindra, we remain very constructive, very bullish. We've told you over a period of time the way Anish has, tightened the ship at Mahindra. The return on equity has been moving up. He's not making unnecessary investments. He's selling assets of businesses which are not part of the core or which, he doesn't feel he can scale up. So these are all great moves which are being done. And the stock shareholders have been rewarded because of that, capital allocation. We think the tractor space, they're the leader, will continue to grow. The electric vehicle space, they're early movers, and I think they're going to be able to capture more market share. The subsidiary companies, the realty arm, the hospitality arm, the finance arm, all are scaling up very nicely. So as those stock prices move up and you do a sum of the parts, the overall valuation of M&M should go up. So long term, very bullish. But if you're asking for a very short term, I think you're better off asking the technical analyst on where the resistances are for the short term.
Okay, so that's the view coming in on M&M. Why am I laughing is because Puneet has managed to find a query.
See, I didn't manage anything. I don't have any reference. It just propped up on our screens, and we've just taken this query, pinned it up, and hopefully taking this query. But which one is it?
Basically, it is on SW Solar. This is coming in from Shankar, who's writing us from Bengaluru. He says that he's planning to invest into around 200 shares of this particular counter. And Samir, he wants your view on this one. So the bag is out. The cat is out of the bag, and the mystery is resolved. We're talking about SW Solar. Samir, what's the view?
Yeah, so my view remains a buy. The Reliance order is taking a lot longer than we would have hoped for. But I'm just waiting for, the Reliance order to flow through to Sterling and Wilson, which eventually has to come, given Reliance is the parent, owns 36% of the company. And if you're going to put in 10 gigawatts, even if you give 3 gigawatts to one of your subsidiaries, that changes the dynamics of your own subsidiary, right? So that will come through. Of course, they've got a lot of orders from other players. Your parent company has also given a nice big order, which is an open-ended order saying that we will continue to work on these parameters. It's a cost-plus basis. And if all of these things continue, leverage plays through. Sterling and Wilson, like I said, for me, it's a 3-year multi-bagger story. I'm very heavily invested. Again, anchoring bias, but very positive and have a buy recommendation.
Got that view, Samir. And I think the last time we spoke to Samir, stock was hovering around the 176 odd mark. It's still there. It hit a low of almost 148 on Monday, the 30th of March, and then of course seen the buying. So it would have been great to get Samir on that day itself. But of course, that view stays positive, at least on Sterling and Wilson for now, and definitely the impending order to. Sorry, Samir.
260.
Sorry, Samir, you were saying something. Can you repeat that?
I said I've been bullish on this stock since 240. So I've seen 240 going down to 140 also, right? So it doesn't matter on the day. The point is I have a long-term bullish view. I cannot predict where the bottom of the market is. But if you have patience, this is a stock. Remember, it's been 800 about 2 years ago. I'm not even talking of 800 right now. I'm saying let it go to 500 over the next year and a half. I'll be very, very happy. And like I told you, I have a 4-digit target, but that will take 3 to 4 years.
Most certainly, but definitely no one likes the stocks going down, and at least at a level that the volatility that we see in Sterling and Wilson. Got the view, Samir. The next question coming in on Tata Tech, Sachin. Our viewer Venkatraman actually holds shares at 700. He's bought 200 stocks. What should he do, Sachin, with this counter now?
Overall, since actually inception of the stock is making lower high and lower low pattern. So on all the time frames, basically daily, weekly and monthly, the stock is in a series of a downtrend basically. So such a stock, whenever there is a bounce, and I have seen a bounce of more than 33% in this stock in a period of 1 to 2 months, but still it makes new low. So any rise in this stock is a bull trap basically. So I feel one should exit this stock.
Okay, all right. So that's the view coming in on Tata Tech. I think we've got our next caller. Sharad is calling us from Chennai. Sharad, very good morning to you. I believe you have a question on Fino Payments.
Yeah, good morning. I am a senior citizen. I am holding 10,000 Fino Payment Bank shares. 10,000 Fino Payment Bank.
Yeah.
My cost is more than 300 rupees. So what should I do? Whether I should hold it, exit or average? I am a long-time investor, maybe for 2-3 years.
Got it. Sharad, just trying to understand here, because you're sitting on a huge loss, 6.5 lakhs is what I'm seeing. What was the thinking behind buying Fino Payments at that 300 mark?
I was expecting they will get the SFB license and all. I bought it when they got that in-principle approval for SFB.
Okay. Okay, got your question. And since you're a long-term investor, I'll go to Samir for this particular counter. A lot of developments have happened, right, post that for this particular counter, and that's we've seen a downhill since then when we talk about Fino Payments Bank. But considering that he's sitting on a huge loss right now, Samir, what would you recommend him to do?
So, this is a huge amount he's invested, and unfortunately, I don't have a view on Fino Payments. So I don't want to even tell him to sell and buy something else, because somebody who knows Fino Payment should discuss it, because I don't have any view on that.
Fair. Sachin, from a longer term view, longer term charts perspective, would you be able to give a perspective on Fino Payments?
Currently, what happened actually, it is actually a replica of Tata Tech. Basically, it has started from lower high, lower low segment. In all the time frames, the stock is in a downtrend. It has actually broken a major support of 180 basically. And last month, it has made a low of 110. So what I can right now suggest is the last hope is 110. If that is also broken, I see the stock around 60 to 50 levels in the near term basically. So now the 180, which was earlier acting as a support, now will act as a resistance. So in case if you are getting this price action near the 180 levels, you can exit basically, or 110.
Because, Mahima, this has been a very interesting counter in that sense. What could go wrong has gone wrong. And I think the latest news that was that the CEO was arrested as well. But post that, we've seen the quarterly update come in, a very strong growth in disbursement. But the asset quality has been a very big concern for investors. And hence, you're seeing that stock correction of almost 48% from the highs as well.
But just if Sharad is already watching this, still watching this, we would want you to come back probably on Monday to get a fundamental view again on this one, since he's a long-term investor. I think it's better for him, because 16.5 lakhs is what he's sitting at a loss on. So I think it's important to get that perspective from fundamental analysts. So Sharad, I think we'll request you to do that on Monday as well. But moving on to the next question, it's coming in on HDFC AMC. Our viewer Venkat from Hyderabad has bought it at the levels of 2320. He's holding 44 stocks, says wants to hold it for the next 2 to 3 years. What should be the next course of action for him? Samir, is it a good hold for the next 3 years?
Absolutely. Continue to hold. Whenever you get a correction, so we have an accumulate rating. We have a target price of about 3,600 1 year, 4,200 2 years. But whenever it comes closer to 2,200, 300, keep buying this stock. This is something that's going to be a long-term compounder. If you have 10 years horizon, don't be surprised if it's like maybe 5 or 10x, because the operating leverage is incredible. There will be volatility. It can go down whenever markets fall because AUMs will shrink. But long-term, the mutual fund, PMS, SIF, the entire business of mutual funds, which will be equity, debt, multi-asset, will all keep growing. And HDFC is a leader in the private space and will do extremely well.
Got that view, Samir. Bank of Maharashtra is the next one. Surya Prakash holds shares at 60. Sachin, he's holding 950 shares. Should he continue to hold or exit now?
He can hold basically, as we have also recommended this stock on our company's time frame. Basically, we are seeing right now it can touch 80 levels as well. Overall, on a weekly time frame, it has broken out from the cup and handle pattern. It retested and then now it is again going up. I love this stock because the trend of the stock on all the time frame, basically on a daily, weekly and monthly time frames are up.
Okay, all right. So that's the view coming in on Bank of Maharashtra. The next one is coming in on Pidilite. Our viewer Madhukar from Hyderabad wants to know if this is the right time to make an entry into this counter from the next 2 years perspective. Samir, your view on Pidilite?
Leke chipke raho. Pidilite is a good investment to make at this point. The correction has been good. Yes, valuations are expensive, but given the kind of dominance of the space, it's not going to be easy for new entrants to come and compete and be able to, call the shots. Fevicol has kind of become like a brand. Apart, we only discussed Fevicol, but they have so many other businesses. They've gotten into this business where tiles can be stuck with a particular kind of material that they give. Of course, Asian Paints is also doing it, and a couple other cement companies also doing it. But what is happening is their basket is expanding. They have the reach, the brand value, and all of it. So for me, Pidilite long term, great investment. Valuation a little expensive, but expect them to remain so. Expect the company to generate a 15% CAGR, not more than that, compounded over the next 5 years.
So Samir says chipke raho, of course, on this. ये जोड़ पानी में नहीं टूटेगा of the other. It's such a good company in terms of these legendary campaigns that they did as well. So it's just etched in memory in that sense. But the next question.
Yeah, I think we've got Amit calling us from Bengaluru. Amit, very good morning to you. I believe you have a question on Eternal.
Yes, happy morning to all the experts. I wanted to ask about Eternal. I do not hold any stock right now.
Okay.
I wanted to know if it's right time to enter for the next, I'm looking for an outlook for the next 1 to 2 months.
1 to 2 months. Okay, then I'll take this up with Sachin. Sachin, 2 months outlook on the charts for this one. 238 is what it's trading at right now.
So overall, on daily and weekly time frame, the stock is not that good. But what happened actually last month, the high was 244.50. Current month it has broken that high. So on a monthly time frame, I can see from 1 to 2 months perspective, I think the stock can go up.
Got that view, Sachin. But the next question coming in, it's a very interesting one on Genus Power. Now, Murli Mohan from Kerala has taken the time to type a very detailed question, and thanks so much for that, Murli Mohan, because he's holding shares at 250. And he wants a long-term view, Samir. Now, he's mentioning that for the last 10 quarters, company has given decent results, very strong growth, essentially both on revenue and profit. But the PE is at 15 versus the industrial PE at 25 for the industry. So how are you viewing Genus Power? I hope you have coverage on this one, but what should we do with his 1,500 shares?
So I don't have a view on this one, but I can tell you about the power space. We've discussed this multiple times. For me, the next 3 to 5 years, you're going to see acceleration in demand for power, setting up of capacities. We just discussed it earlier, why I'm saying we need energy independence. And any company that is, I don't know what this company does, but any vertical, be it the generators, be it the people who set up the power plants, the people who make the transmitters, the capacitors, the inverters, who set up the power lines, all are going to see huge demand and huge growth. So this is a space one should stay focused. Just focus on where valuations, if you're saying this is a stock trading at 15 times, figure out, is it trading at 15 because the ROE is poor or because the growth is slower than the competitors? If either of these two is there, then that is the reason it'll keep trading. Unless they can move up on the ROE chart or increase their growth, and growth comes because if you're more competitive. So see where the weakness for this counter lies, and if they can overcome that. If they can, then what stops the PE from going from 215 from 25? Nothing. So just focus on those factors. I don't cover this one, but this is what you should focus on when you study the counter.
Right, time for our second rapid fire round. Samir and Sachin, try to keep your answers as short as possible to buy, sell and hold. The first one is from Sunil, who's writing us from Bengaluru, asking about Patel Engineering. 500 shares bought at the levels of 103. What should he do, Sachin, on the charts?
Patel Engineering, overall, I see the stock is in a downtrend, so exit will be the call.
Okay. Vijay from Chennai wants to know about SBI, Sachin, for a short-term view. Is it a good time to buy?
Yes, I like this stock. Basically, all the PSU banks are in a uptrend, so he can buy, yes.
Nuvama Wealth, 25 shares bought at the levels of 1230. Any outlook on this one, Samir, from a long-term perspective?
Yes, very positive on this space of capital markets, which is more fee-based, but
Ranjit wants to know about metal names. Sachin, if it's a good time to buy into JSW, Steel, Tata or SAIL, what would be your recommendation?
So comparatively, in all the three, Tata Steel will be good.
Ircon is the next one. Pooja wants to know if this is the right time to buy this counter. Sachin, your view on the charts?
Stock is in a series of a downtrend. Today only it has taken resistance at 50 DEMA. I won't buy right now.
Physics Wala is the next one. Our viewer wants a view. This is Harsha from Andhra Pradesh. Sachin, on the charts, what would you recommend?
Physics Wala, right?
Physics Wala, yes. Stock's trading at 101, of course, below, very close to its IPO price, but has been very volatile in this time.
So overall, the stock has actually moved up above the 50-day EMA with a stop loss of around 85. One can buy.
Okay, PFC is the next one. Lakshya is asking a question on this one. He's got 400 share. Can he continue to hold it for a year? Samir, your view?
Yes, absolutely. Hold on.
Embassy Developers, Jitesh Sankaran actually wants to buy into this counter now. Samir, you're smiling. What's your view?
It's a buy. The only thing is, I think it's moved to PCA, so you won't get it traded every day. But once the court case ends, probably, buy.
Kim's Hospital is the next one. From a 1 year perspective, is this a good time to buy? Gautam from Bengaluru is asking this. Sachin, your view on the charts?
So the stock he can buy. Basically, there's no problem.
Okay.
Fujiyama Power bought at 228 by Pravesh, holding 65 shares. Samir, any coverage on the counter?
This one, sorry.
Sachin, on the charts, any view?
He can buy, no problem.
Shelly Engineering bought at the levels of 1980. 3 to 6 months perspective on the charts. Sachin, your view? Murli from Bengaluru is asking.
Avoid.
Netware bought at 3354, Sachin, by our viewers Sri Kumar. What should he do with the 100 shares?
He can buy and hold.
Okay, the next one is on NMDC. Balwant Modi is asking this question from Rajkot. From a long-term perspective, can he continue to hold this counter? Sachin, your view?
He can buy.
Anantraj bought at 730, Sachin, by a viewer, almost 6,000 shares. Is it a good time to average now?
No.
Ola Electric bought at the levels of 122. 200 shares is what Pavitra has been holding. Good time to average, Samir?
Well, averaging should have been done some time back, but hold on to it.
The next question coming in is on HCC, bought at 49. Now, stock's trading very close to 17 to 18% rupees levels. What should we do now, Samir, any view?
So they must have got a rights issue form also, and they must have, their cost wouldn't have been as high unless they just let it lapse. But having said that, company's reduced its debt quite significantly. Order books are quite good. They do very complex projects. I say this is to hold on and buy some more, average it out.
Okay, Tata Power bought at an average price of 376. Long-term perspective on this one, Samir?
Hold on to it. I think it has more room on the upside. Like I said, Pava, I'm very bullish, so hold on.
Ravi from Mumbai actually is asking a question on Sun Pharma. We covered that it's looking at a very big acquisition, hence stock is down. But Samir, is it a good time to enter now or wait for some clarification?
Yeah, I think you can enter now. Look, markets may not like an acquisition a company chooses to make, but at the end of the day, the company knows what it's doing. And many a times, they get it right later, and then the market rewards them later. So buy even now. If it happens, it doesn't happen, that's a secondary issue, but business is strong.
Right. Well, that is the end of the rapid fire as well as this edition of Ask Profit. Sachin as well as Samir, thanks so much for helping us solve all these 55 queries that we have in this last hour. But viewers, stay tuned. That's all the time we have on this edition of Ask Profit. KYC comes up next, and a very interesting one nonetheless. So do stay tuned.
केसरिया से मन जोगी हुआ रे दिल झूमे देखो मतवारा हुआ रे केसरिया से मन जोगी हुआ
हर पल मनाओ केसरी त्योहार विमल बोलो जुबान केसरी
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversations.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
Presenting the all-knowing, all-powerful Tech Guru.
Whoa. Guru? I'm no guru.
Okay.
I'm just a guy who loves his tech.
A show where the mysteries of megabytes and motherboards shall be unraveled.
Bro, nobody talks like that anymore. This is all about connected ecosystems, EVs and AI that you can use in your daily life. That's what we do on Tech 360. Real talk, real reviews, tech that you can actually use.
Tech has changed. So should your tech show.
To understand the Tamil Nadu twist, join me in the midst of our people, language and politics. Vanakkam Tamil Nadu, here we come.
Hello and welcome back to NDTV Profit. You're watching KYC or Know Your Company. My name is Puneet Zaveri, and over the next half an hour or so, we'll try and put that focus on that one company that should be on your focus today. Today, we are focusing on a smaller name. Paka Limited is what the company is. Into the packaging space, operates into a niche business, but there is a lot to look out for this company. Now, of course, they are building a very complete as well as compostable packaging portfolio, and it's very important for the company to do it in a sustainable way, and you will get to hear from the management very soon on why that is the case as well. Now, when you look at the three segments, wrap and carry, food services as well as flexible packaging are the three categories. Roughly wrap and carry, which is effectively that if you go to a store like Subway, you can get a sub, wrap it, carry it and take it home. So all of that packaging is what Paka Limited does. That's almost majority of its revenue, and it is entering into flexible packaging. More of that in just a bit. But the other aspect has been that sugarcane bagasse, which is the company's raw material, puts into focus the sustainability part that I just spoke about. So that is about the company, what they do, and where is the raw material also. Now, since largely it is a B2B company, because wrap and carry is a B2B business, the food business, which for example they might go to a restaurant or one mom and pop store, they are a B2C client, so a business to a consumer client, but that is just 13% of the company's revenue. So hence a B2C portfolio, while being there, it's limited to that extent as of now. They are of course getting into new launches, also looking to double their product portfolio in the second half, which is already underway. So we'll talk to the management about that as well. But overall, we have seen that the clientele includes the likes of Haldiram, Baskin-Robbins, Borosil, Cafe Coffee Day, and amongst others also. You will see the packaging part of it is all taken care of by Paka Limited at this point of time. When you look at the three key things that you will have to watch out from the management's conversation as well, that they are investing roughly between 100 to 140 crores via convertible warrants. Now what this will do is increase promoter holding, of course, but this is also used for the second key thing to watch, which is the new plant of almost 750 odd crores. Now that is for an expansion in Ayodhya for the new vertical which we spoke about, that's flexible packaging, and hence there is skin in the game, of course, and some of the capex has been taken care of from there. There's also 100 crore investment done by SBI Mutual Fund for this venture too. So you are seeing diversity come in funding apart from internal accruals. Apart from that, the big talking point has been the inventory days. Now sugar season, which is one of the sugar gas which I told you was the raw material, has a season between somewhere around October to November till April. So effectively H2 is where this company takes the inventory for the full year. But they haven't been very quickly been able to manage this, and hence you see the inventory days at over 450 days and a lot of capital being locked in because of that, and that puts pressure on ROCE. So that's the three key things to watch about. But let's look at the parameters now. Now there are 8 key parameters that we are focusing on. Income statement, of course, balance sheet and cash flow take the 3 key verticals. You also look at return ratios, where I just told you could see an impact because of a higher inventory. Apart from that, shareholding, street cred, return ratios, as well as outlook is something that we focus on for this company. In terms of income statement though, let's go across and put that into perspective first. You see a 3-year CAGR of about 12% isn't the greatest for a company growing at 300 to 400 crores in terms of revenue. So hence in terms of the EBITDA, it's been flat for the last 3 years. So have the profits been, and hence we've given this a thumbs down for now. A lot to watch out for the company's new vertical flexible packaging, which will come into FY27, and of course for FY26 also numbers seem to be on a similar flattish trajectory for now, what we've seen in the first 3 quarters. When you look at the balance sheet, and of course the margin trajectory has been on a downward trend for FY25, and hence a thumbs down for now for the company. Looking at the balance sheet though, it tells you a perspective that it has been, while it has been a tough performance over the last 3 years, we've seen the other equity also inch up materially because the company's 140 crore tranche of convertible warrants, half of that has already come. So you can see an increase there. From 240 crores to 445 crores, you've also seen the money come in from SBI Mutual Fund for the investment already. So you're seeing the equity largely being stable. Apart from that, the borrowing number has increased from 100 crores to 200 crores going into FY25. So this does have an impact on the interest cost too, which we saw in the previous slide. And hence, we've given this for now a thumbs down as well, because there has to be some improvement done in all of these key aspects. Cash flow also has been very, very weak in terms of the company. Actually, for balance sheet, we had given the company a neutral rating because there has been improvement in the equity portion of the company. So hence, we've given it a neutral. We'll come back to that in just a bit. Cash flow from operations, this is a thumbs down because the cash flow from operations has been constrained over the last 3 years. So from 51 crore, it's down to 11 crore, and hence the cash flow from operations to PAT ratio is also very depressed, down from 64 to 18%. So hence, we've given this thumbs down as well, as we continue to monitor this as well. In terms of the 4th parameter, which is return ratios, we continue to look at how the company has been able to withstand the capital advances, because the new capacity is almost 400 to 500 crores. So return ratios trends has been on a downward trajectory because a lot of capital gets stuck in the inventory, as I spoke to you about. Hence, we've given this a neutral rating because there is a change that is expected from FY27. FY26 might be the same, but the new plant will come in H2 of FY27. So somewhere around October of this year, and hence from Q3 start to see capacity utilization go up as well. In terms of shareholding, that's the 5th key parameter. We look at the promoter holding, has been down to 42% because of the investment coming in from SBI amongst others, but the company plans to increase this back to the 48 to 49%. Now there's a limit of increasing the shareholding by 5% in every year. So you will see this in Q1 of FY27 getting increased as well, which will be almost in the next 2 quarters. In terms of ownership, public do own roughly a majority of almost 52% of the company, which is a diversified shareholder base, and hence you've seen the individual shareholder number also increase materially as the company has underperformed in the last 2 years, something that retail investors keep a keen eye on. Street cred is the other one. Has been a tough period for the company. Stocks down in the 1 month performance, 6 months, 1 year, as well as the 5-year period. Given that we've seen that the last 3-year performance has been subdued in terms of the financial, that is visible in both the year-to-date performance as well as what you've seen in the 1 and 5 year period. So hence, this one is also a thumbs down from that aspect. A lot to improve for the company post FY27. When you look at the last couple of key parameters, let's pull those up very quickly as well, because we've seen consistently that valuations come into perspective yet again as well. But let's pull those up as well as the outlook for what the company expects. First, in terms of valuations, now very interestingly, now when you look at all of these players, Paka, of course, trading at around 62 times because the earnings and the profitability has just waned away. So you've seen the price to earnings ratio, the denominator has squeezed, and hence the price largely remaining stable to a downward momentum, hence the PE has increased. But in terms of a direct sustainable player, there's not a direct competitor there as of now. So when we've included the paper names now, a lot of them are into packaging, a lot of them are not. So you have to look at it from both perspectives, that while the stock is expensive on this metric, there won't be a direct comparison with West Coast, but we have to put in some peers to compare it with the paper players also, because they are also into packaging at this point of time. So this is also a very interesting one, a neutral rating here, because yet again you will see that come in from FY27. But in terms of outlook, and let's give you that perspective very quickly as well, because we've seen the new paper machine to double capacity from to almost 9,000 tons by 2026. This is largely going to be something to watch. Strategic decisions will be to slow down into US as well as Guatemala will help company conserve cash, so ROC will improve going forward. B2C is an important vertical because it has better gross margins. We spoke to you about the food business being 13% of revenue, and they are looking to launch compostable solutions as well with the new flexible packaging vertical. So when you look at all of these key aspects, there is of course quite a bit to talk about with the company to cover the challenges that we've highlighted as well as what is the outlook for FY27. Before we do that, a quick look at the final ratings, because a lot of the parameters we look at are historical. Hence, you will see that income statement and cash flow are negative. Neutral rating or return ratios as well as balance sheet, which has been maintained because of the equity infusion. Shareholding continues to be a positive, so is the outlook. But there is a lot to look at the street cred, and this should be valuations, but we've spoken to you already about it. Finally, the ratings for the company out of the 8 parameters, we've given it a 3.5 because there is a lot to talk about and a lot to be visible, not in FY26, but in FY27. But let me welcome in Mr. Ved Krishna. At this point of time, I had a chance to speak to him about what are some of the key aspects that are the challenges part, what the company actually does to give you a perspective as well, and also on the return ratios and growth outlook. Let's listen in to what Mr. Ved Krishna had to say. Largely, there has been a lot to talk about, especially in the packaging business, with the growth that we've seen across verticals, across foods, across restaurants, across what we've seen also in e-commerce. So this is a very key aspect and a key conversation, because the listed peer gives investors a lot of access to Paka Limited now. Just when how we start now, so you have 2 main verticals in revenue. You are investing for a third one as well. But and wrap and carry is one, foods is one, but just within packaging, if you can start us off with what are some of the key segments that you cater to and who would you be competing with, both in the listed and the unlisted space. If we can start off with that.
Absolutely. Thank you so much for having me. So like you mentioned, 2 and the third coming up, we have 3 broad segments. We are totally focused on how do we make packaging regenerative. So for first and foremost, wrap and carry. So wrap and carry is everything we use for food, where you wrap a burger or you wrap a sandwich and then you carry it. So broadly, that's the focus. And how do you create value there? By creating products that are stronger, better printability, etc., so that people stay with a compostable substrate. The second one that you mentioned is food services. There again, it's all about how do you create value for the customer by having a very different eating experience. So if you go to a Haldiram or to an airport today, you'll get these brown colored plates and bowls, which have a very different experience from a styrofoam or a poly-based product. So So those are typically manufactured by us. The third one where we've been kind of focusing on and building on is the flexible packaging domain, which is multi-layered substrates. All of us consume potato chips and chocolates and crackers. So they come in this structure where, no air goes in and no water goes in. And if you taste a bag of chips after 6 months of manufacturing, you still feel it's fresh, mainly because of that. So it's very difficult to crack in a natural substrate, but that's what we've been working on for a few years. And the base substrate is a very dense paper. It's something like a release paper, which is what comes out of the sticker. So when you see it, you'll find that it's a very dense paper. So that's what we are trying to create. So the new investment is all about flexible packaging. How do you transform that segment and create, we were talking just before you hit record was that, how do you reduce that garbage pile that we are creating as human beings?
Got it. And in terms of, and thanks so much for the comprehensive view on the company. How are you, selling to its clients? Is this largely a business that's B2B? Or have you also started a B2C vertical where you're seeing these mom and pop stores, these individual one-store outlets, which are of course expanding as well? Because we've seen an advent of those as well, especially in the foods businesses, especially when you see coffee verticals come up. If you can give us some perspective of how do you actually sell the products that you manufacture? Is it B2B, B2C? What's the strategy?
Yeah, so the wrap and carry and flexible segments are typically B2B because they are not a finished product. They typically go into another round of conversion. So in a wrap and carry, it'll convert into a bag or a wrapper and have some printing on it. In a flexible, it'll be similar. It'll go to a converter who will print on it, pouch it, etc., etc. And we want to do things at scale. So doing the conversion is not really something that we are focusing on. On the food services, you're absolutely right. It has been actually surprising how it's grown in the B2C segment. We thought, the B2C segment would remain like a 5 to 8% kind of revenue for us. But it's gone over 20% now, which is mainly because of quick commerce, which we never expected. And that's been a welcome change for us. And we did work closely with restaurants, like you mentioned. But in the end, they're also B2B. So it's a B2B2C. So, but in this case, now it's a direct to customer where the customers order directly from a Blinkit or a Zepto or a Flipkart or an Amazon and get their disposables at home. So we are actually learning, how do you do a D2C business? Because we've typically been in B2B segments traditionally.
Got it, sir. And we've largely seen that, before I come to the financials of each vertical and the growth and the expectation, the one key aspect has been that you've invested almost 100 crores to convertible warrants and almost 100 to 140 crores of convertible warrants. Just wanted to understand how much has already been deployed in the company and how much of it is remaining in terms of timeline, and what will your stake be after the full 140 crores is invested?
Absolutely. So this is all part of a large project we are betting on. And like I mentioned, flexible packaging. So it's a 750 odd crore project where there's a state-of-the-art line that is being created, specially designed to build these products. We are very excited because it should start in the next 3 to 4 months. So of course, these are long capital kind of outlay projects. So it's taken us a couple of years to build this. So the capital structure is such where there is about 240 odd crores that came as equity or warrants, and the remainder came as internal accruals and loans. What we have done is that 100 crore was taken by one entity, 140 crores was taken by another entity, and part of that was convertible warrants, which falls due in April now. The remainder is being deployed. The total spent now is already over 500 crores because again, it's on the verge of startup now. So we are hopefully going to see this project see the sunlight of the day later this year.
So your project in Ayodhya, which required an investment of 750 crores, almost 140 from these convertible warrants, as well as another 100 crores have been deployed by the promoter for this project. Is that a correct understanding?
Oh, no, sorry. I'm glad you repeated that question. So there were two external parties, the board in front of you. SBI Mutual came in with 100. Carnelian Capital took partially warrants, partially equity. We diluted ourselves down to about 38%. But we are also buying in now. So we are buying in about around 100 crores. So my equity will go to about 48, 49% again by next year, because I can only buy in 5%. So 5% comes in now, and 5% will come in by April next year.
So I think as per the filing, I can see that promoters hold roughly around 41.6% stake as of the end of December. And you are saying that that will go to 49 probably when both of these 5% comes in. So around 40 to 49% maybe by FY27 end. Would that be a safe assessment?
Yeah, FY27 beginning, because FY26, 27, we buy in 5%, which is in the next month or so.
Right.
And then, of course, I can only creep another 5%. I can creep 5% more next year. So the money will probably come in before, but it'll be converted to equity by next year, April.
Perfect. I got that clarification. So, and also a project in Ayodhya of 750 crores. When is the likely timeline? Is it at the end of the year, probably by Q4 is when you start production, at least in phase 1 for that? Is that, and then of course the capacity utilization will include gradually through FY27. Would that be correct?
So we are working towards Q3. We start production in Q3, and then yes, we stabilize Q4, and hopefully by FY27-28 we are up to about 70 to 80% capacity.
And in terms of the potential of revenue basically from this plant, what is the expectation on a full scale basis, if I can add without any timelines, once your capacity utilization is over 75 to 80%, what could be the revenue potential from this plant? And then any specifics that you can highlight for maybe for FY28, because you're saying that you will start only in Q3. So a couple of quarters to understand the nuances of that plan. So maybe in FY28, what's the expectation of revenue?
So yeah, starting from your first part of your question. So once we come to a steady state, if we just look at the base paper itself, which is the base for creating flexibles, the revenue potential is about a little over 500 crores alone from this plant. We're not talking about the revenue that will increase from our current operations. And then, of course, if we go into flexibles, that over doubles the revenue because you get into more barriers, and the quality and the value also rises. So we're talking upwards of 1,000 crores from the new plant once the coating also comes in, but that's planned a little bit later once the base paper is stabilized. In terms of the current year, yes, we will get some revenue from the operations of the new machine, but the real kicker will come in by next year to kind of add to our current revenue and the increase in revenue that we make from the current operations.
And Mr. Krishna, what we've seen actually in the last 3 years is that the revenue has largely been actually kind of flat, kind of stable at almost 400 odd crores. Now, for this year as well, it seems to be that you're on trajectory to do that. But the margins, so firstly on revenue growth, before I come to margins, what is the expectation that, is it largely built on this new plant in Ayodhya that will drive the revenue growth while the current business motors on? Is that the assessment? And what has been the reason why the revenue has been largely in this 400 crore range for the last, since FY23, 24 and 25?
Yeah, so of course, we've been on the drawing board for these couple of years, but that doesn't take away the possibilities that we should have capitalized on. Mainly, we are a very innovation-led organization. Everything we kind of do is to do with how do you make the earth more regenerative, and that basically for us it's packaging. How do you make packaging more regenerative? So there are a couple of things we were betting very heavily on. One is how do you build more in the delivery space? And the other is how do you build more in the flexible space? So nothing stops us from going asset light, outsourcing, building partnerships for manufacturing, etc. But we have not been able to capitalize those. Those were expected in the last couple of years. But the great thing is that we have started getting into gear for those as well. So it will not be steady state from the current operations either. We will build on the current operations. We are trying to transform our food services division, where we are trying to to bring in more revenue through outsourcing. We are also trying to bring in new ranges of products. Like I mentioned, the delivery range is something we've been again on the drawing board for a couple of years, and that's seeing the light of the day now. And again, it's a transformational product, and we will hope that that will take the fancy of the market and people will shift from petroleum substrates to renewable substrates. So that's the effort that will be there. And hence, so the steady state is because of, I would say a mix of working on the new project and not being able to deliver on the targets that we had set. But those are delays and not defaults. So the idea is that those will start kicking in as well, and the company will show a very different performance going forward.
Mr. Krishna, in terms of what you mentioned, right, that these are just delays and not revenue loss. So any particular reason why the revenue has been delayed? Is it largely because of capacity being increased? Is that the reason, or how do you see the traditional business growth? Because your new plant will of course address a new vertical, but for the other two, your wrap and carry as well as your food business, the growth has been a key contentious point, right? So how are you viewing this? What has been the reason for those delays essentially?
Yeah, so like I said before, we are a deeply innovations-led business. So everything we do has to be focused on how do you create materials that are regenerative, that don't harm any other species in terms of animals, fishes, as well as the ecology. So when you do that, you're kind of always in a learning trajectory. So when we look at, say, the delivery space, we want to transform the entire experience of the customer and not just make it regenerative. So that sometimes takes longer than our kind of optimistic thinking. But that said, those are kicking into gear, and we will get both. We'll get the new capacity and revenue from those. We'll get revenue from new products. We'll also get revenue from outsource side. So we have now got a couple of tie-ups in both food services and wrap and carry, where we are doing ancillary products to what we do through outsource means. So those will be more asset-light models.
The other question, because of paucity of time, has been the key aspect on cash flows, right? Because a lot has been invested, especially in the inventory. So inventory days are over 400 days now. Is there any plan? What is the and that was for FY25. What has been the number for FY26 and the eventual reduction of the same? Is it something that because of raw material insourcing that you are doing, it will largely be something that you have to continue to maintain? And what is the reason for the inventory days specific to be so high? What can be a steady state from here?
Yeah, you identified it absolutely right. It's the raw materials. So we are based totally on sugarcane residue. The fiber that is left from sugarcane, it's called bagasse.
Yeah.
And that's what because again, we want to use materials that are regenerative. So that's a waste for the sugar industry. The sugar season typically runs between November and April. We have to stock that inventory for the entire year. So what you see is basically a heavy inventory when we end on March 31st, because that's almost the end of the season. So that's our peak inventory. So that's just because it's a seasonal kind of business that we are in. So every year you'll see a higher inventory when we close. That said, this year it's even higher because we are stocking for the new plant. So the new plant gets into gear, which means there'll be a higher capacity, which means higher pulping will be needed, and hence there is an overstocking on purpose. So it's still for the new plant, and again, inventory for us. And again, the second part of that inventory is fuel. We make our own energy. We are totally based on biomass. We are usually off grid. Only temporarily are we a little bit off on the grid right now. So we use biomass, which is mainly rice husk. And interestingly, the rice season is also the same. It's from November to April. So the inventory for that also is very high. So typically when we end on March 31st, the inventories are at a peak level, and hence you see a higher inventory days.
केसरिया से मन जोगी हुआ रे दिल झूमे देखो मतवारा हुआ रे केसरिया से मन जोगी हुआ
हर पल मनाओ केसरी त्योहार विमल बोलो जुबान केसरी
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversations.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
Presenting the all-knowing, all-powerful Tech Guru.
Whoa. Guru? I'm no guru.
Okay.
I'm just a guy who loves his tech.
A show where the mysteries of megabytes and motherboards shall be unraveled.
Bro, nobody talks like that anymore. This is all about connected ecosystems, EVs and AI that you can use in your daily life. That's what we do on Tech 360. Real talk, real reviews, tech that you can actually use.
Positive global cues and strong buying in the financials aid Nifty rebound in trade today. Broader markets mirror the benchmarks, all key sectors in green territory except IT and Pharma. Sun Pharma trades under pressure after reports of a proposed mega acquisition. The company is said to be planning a $12 billion bid for Organon and Company, which would mark the largest overseas acquisition by an Indian pharma firm. Most of the IT companies fall in trade, with TCS shares decline in response to their fourth quarter results. The only outlier in IT pack, Wipro, surges after announcing that the company is mulling a buyback decision. Amid the fragile ceasefire in the Middle East, all eyes will be on Islamabad, which will host talks between the US and Iran from tomorrow. Hello and welcome. You've tuned into Markets at 12. I'm Nisha Podar. Let's take a look at the markets. And yes, there is a fair bit of gains that the market is seeing. Nifty 50 is inching closer towards 1% gain. But remember, it is struggling to hold on to the 24,000 levels, which it has breached a few times. But every time it breaches that, there is a fair bit of resistance coming in. So just at the kissing distance of 24,000 levels, Nifty 50 is shining with green tinge today. Let's take a look at overall markets. Most of the sectors are in the green except IT after the TCS results, and especially the concerns over the US revenue. And on the other hand, Pharma, which is also largely dragged by the big acquisition that Sun Pharma could really do. Barring these, the rest of the market is really showing a gain in the momentum. The biggest lead is really coming in from the banking and financial space, which is gaining the most, and also in terms of contribution to Nifty 50, the big banking names are really taking the charge and contributing the most. Remember that banking sector was a weak link in yesterday's trade and is coming back with force in trade today. The broader market showing slight outperformance to the key indices. So overall, the market is looking buoyant today, and some bit of really clarity on ceasefire and the talks in Pakistan is really helping the overall market momentum and also keeping the crude prices at bay. Let's focus on some mutual fund data. And March AMFI data shows a strong momentum that is coming in the equity funds led by flexi cap and mid cap as well as the small cap categories of mutual fund. Now the large cap inflows also improved even as flows into gold as well as multi-asset funds softened. Let's bring in my colleague Alex, who's been really focusing on these numbers and gets us the entire gist and analysis in this. Tell us, Alex.
Well, it's actually a pretty picture, and I will take you through the overarching numbers. But first, let me focus on the big story here, because you look at active equity mutual fund schemes, and this is one of the largest category, very important to focus on. Inflows of 40,450 crore rupees on a net basis into this particular category. It is, in fact, if you remove new fund offers, that is inflows that come through when a mutual fund issues a new scheme, and you compare it with all of the months of FY26, that's the previous financial year, it is the highest inflow into active equity if you remove the inflows into NFOs. It is, in fact, if you account for NFOs, the highest level since July of 2025, when you had inflows of about 42,700 crore rupees. But in that month, you had inflows of about 9,000 crore rupees that came through in new fund offers. In this month, you had inflows of only about 1,947 crore rupees. So very strong, and that's strength across the board. You have significant inflows in flexi cap funds over 10,000 crore rupees. In both mid-cap as well as small-cap funds, you've seen inflows of over 6,000 crore rupees each. In multi-cap as a category, you've seen inflows of close to 3,000 crore rupees as well. And in the large-cap category, close to 3,000 crore rupees. Interestingly, large and mid-cap is emerging as a favorite for a lot of investors. And you're seeing inflows of over 5,300 crore rupees into this category as well. On a consolidated basis, for the mutual fund industry as a whole, you've seen outflows, and considerable outflows at that, to the extent of about 2.4 lakh crore rupees. But this is normal because it was the end of not just the quarter, but also the financial year. And as a result of which, you will generally see outflows from fixed income mutual fund schemes, which during the month of March stood at 2.95 lakh crore rupees. Now, in the run-up to March, you've actually seen a fair degree of interest in gold, but it actually died down quite considerably in February, and that has continued in the month of March as well. You've still seen inflows in gold ETFs to the extent of 2,266 crore rupees. But what is more interesting to me is actually, in all likelihood, the inflows that you've seen into index funds, equity, as well as equity ETFs. In those two categories, in index funds, for example, you've seen inflows of about 8,200 crore rupees and as much as 19,800 crore rupees into other ETFs. If it was any month in the preceding 3 or 4 months apart from March, I would have said that this is likely flowing into silver. But in the month of March, because of the way that inflows have come through in equity, I would hazard a guess to say that they've actually gone into equities. We're still waiting for the SIP figure that will come through in just a bit. Don't be surprised if there's a bit of a slip. It seems like there's a lot of flows that have come through in the way of lump sums. Now, let me go across to Anthony Heredia, who is Managing Director and Chief Executive Officer of Mahindra Manulife Mutual Fund, joining us to make sense of the numbers. Anthony, I'm not sure how much of what I said you were able to hear, but what I was essentially observing is that this is the highest inflow into active equity mutual fund schemes in FY26. If you remove the inflows from new fund offers, it's the highest level since July of 2025. But in July 2025, you had 9,000 crore rupees of inflows through NFOs. Is this heartening from your perspective?
Yeah, Alex, I didn't pick a lot of what you said because the connection dropped, but I completely agree with these comments. Actually, these numbers are not surprising because through March, we saw on the ground a pretty significant appetite picking up from investors. It's almost like it's taken an event, a very high-risk event, to put investors into a risk-on mode. And I think what's even more heartening, Alex, is I think this is continuing through the first 10 days of April as well. So clearly investors are making choices because of the correction to add to equity. And like you said, it's extremely positive and heartening.
Let me ask you this. We're still waiting for the SIP numbers to come through, but the word that I got in the run-up today is that you might actually see a slip in that number. So it had fallen to what, around 29,000 crore rupees in the previous month, and there were cancellations that came through as well and stoppages. It seems like a lot of money, Anthony, has come through in the way of lump sum investment. So if you look across the cohort of people that invests in mutual funds, what is the kind of behavior that you saw, as you pointed out, on the ground?
So, Alex, on the ground, what you're saying is playing out in the sense that people, I guess, at mass retail.
Let me hold off just a bit, because we've just got that SIP number, and we've actually got a record. Yeah, it's actually very close to, if not a record number. 32,087 crore rupees is the number that has come through. So it's positive across the board, Anthony.
No, it is, Alex. Like I said, I was about to say that on the ground, you started to pick up sense that SIPs was fraying at the margin. But when we saw our numbers, it didn't show it. And to just give you some color, right? I mean, at the end of the day, it's about bank mandates getting banked. I think that 29,000 crores probably people overreacted to, but they didn't think about the fact that February had only 28 days. And March goes back to the typical 31 days, right? So I'd like to think of it in a period of Jan to March. We were about 31,000 odd crores in Jan. We are now 32 in March. But I believe that I think lump sum will grow faster than SIP, because people have seen this correction as an opportunity to go in. And obviously SIP takes time, right? So I think for the first time in about a year, I've seen investors being a lot more committed to putting money at one go than trying to think about SIPs because they're worried about markets.
And last point, because I think the numbers speak for themselves, but I'm just curious about what your thinking is here, is that you've seen a sizable inflow into both mid-cap and small-cap as categories. Each one has gotten inflows of over 6,000 crore rupees. And flexi-cap as a category in the recent past has consistently gotten very close to 10,000 crore rupees on a monthly basis, on a net basis. People are seemingly gravitating towards the more diversified funds. Is that something of a trend that you're seeing?
It is, but Alex, I'll probably fall flat on my face in a couple of months when we speak. But my gut tells me that the move to flexi cap was in a range-bound market. I can't really decide. Large caps have been outperforming, so flexi cap's the best option to bet on the future, which is smaller and mid-cap companies in some sense. I would actually expect flexi cap again will stay the course, but I think multi-cap will make a big comeback, because multi-cap historically has obviously more than 50% in small and mid as a construct, right? So I think what you'll find is if this number into small and mid holds, then eventually people are going to think about multi-cap far more deeply than flexi-cap is my view.
Yep.
Flexi-cap has been the story of the last 6 to 9 months. I don't know what's going to happen. This is the best way to be diversified.
Yeah.
But I think people are now becoming a lot more confident about small and mids, and then multi-cap becomes an automatic choice as a consequence as well.
Okay, and we'll talk in a few months to see whether you were right. Thank you so much, Anthony, for taking the time.
Thank you, Alex, as always.
Yeah.
Thank you.
All right,
Bye-bye.
with that, it's back to you, Nisha.
All right. Thank you so much, Alex, for getting us all the insights on the mutual fund flows for the last month. Now, let's shift focus on pharma space. Remember that pharma and IT are the only spaces with a red tick today in trade, while the rest of the market is looking much better and gaining. So, pharma pack is under pressure on also account of a big drag coming in from the heavyweight Sun Pharma, which is down over 4% in trade at the moment, inching towards 5% loss on that heavyweight counter, which is sulking after, remember, reports of a proposed mega acquisition. But even US tariff news is weighing on the stocks as well as the entire sector. Vishal Manchanda, who's the Senior VP Institutional Research at Systematics Shares and Stocks, is here to talk to us about his views on the pharma sectors. Vishal, good to have you on NDTV Profit. My first question to you on the overall pharma decline today. How do you read into it? Of course, with the US tariff overhang, we are getting into the earnings season and with Sun Pharma as a big drag today.
So yeah, Sun correction today is largely to do with the news release we have seen around speculation that Sun is going to acquire Organon for $12 billion. So there are two things here. One, earlier there was speculation they're going to acquire for $10 billion, and now the number is $12 billion. While Sun has neither accepted or denied the speculation. So we really don't know whether this deal will pan out or not. But largely the concerns with the street is the size of the acquisition will significantly leverage Sun Pharma. Probably the debt to EBITDA ratio will exceed 2 times, and that is a concern for the street. And again, the target company is not a high growth asset. It's probably a zero growth asset.
All right, so those are the two key concerns. Of course, debt is something that the markets don't like. There's another aspect, Vishal, in any large transaction. It takes a lot of time of the management and energy to focus on the overall acquisition, and that also moves away from the growth. Now, the other aspect that I wanted to ask you is that the strategic intent for Sun Pharma for this acquisition could also be to move beyond the generics into the innovative pharma. Now, market has also not liked the time-consuming patient capital required for innovation. Is the strategic intent and also the rationale of the deal that could be a concern if this deal were to happen?
So largely, I think this deal is more a value deal that Sun is looking at, but the size of the deal and probably the strategic implications can be meaningful for Sun Pharma because Organon is about a $6 billion top line company. So essentially, Sun, if you look at Sun existing innovator product sales, that's about $1.3 billion annually. And so with this acquisition, their total innovative portfolio sales would move from $1.3 billion to almost $7 billion. So not all the $6 billion that Organon does is innovative portfolio, but a significant part of that are patented drugs or branded drugs, basically.
All right. So Vishal, looking at the overall tariff concerns also from the US and also looking at the earnings that we are getting into, what's your quick view on the overall pharma sector there?
So I think tariffs, we have seen this tariff concerns for the last 1.5 years. But I think overall, if at all, I think the most immediate concern is tariff on patented drugs, and where again Sun Pharma is exposed there. In my view, if at all those tariffs come in place, it's not going to be a very meaningful adverse impact. It might be a 3% adverse impact on Sun EBITDA if at all those tariffs come in play.
All right, and will Sun be a buy at these levels, Vishal? What will be your quick view on the stock price?
So my overall view on Sun is, so I think even if this acquisition goes through, if you look at Sun's track record in kind of delivering on acquisition, that has been phenomenal and probably best in the market. So I would kind of trust the management for this deal, Organon deal, at whatever value they would be doing this.
Yes.
And I have a buy rating there.
All right, Vishal Manchanda, thank you so much for your quick take on the pharma sector. And of course, you bet on Sun Pharma. Of course, it's a bellwether of the pharma sector today on a drag because of a large acquisition that they're trying. Thanks, Vishal. All right, moving on, Iran is eyeing a new revenue stream by proposing a transit toll through the Strait of Hormuz, one of the world's busiest energy choke points. Now, the key uncertainty is who bears the cost if sellers absorb it. Major exporters like Saudi Arabia, Iraq, and the UAE face a sharp hit. If buyers pay up, well, the Asian importers led by China and India take the strain either way, and the move risks pushing up the freight costs and also the energy prices, adding another layer of pressure to the global trade and shipping. To discuss more of this, we are joined by Peter Maguire, who's the CEO of Australia Trading.com. Peter, always a pleasure to welcome you on NDTV Profit. How do you see the crude movement from here on with ceasefire, Hormuz Strait toll that is really developing, and the mode of payment and the overall uncertainties around the supply?
Absolutely, Nisha. I think you've summarised it beautifully. I'll tell you what, it's very dynamic, and as you've highlighted, you've got the talk in the town as far as that toll, how that's going to be impacted, who's going to bear the cost. Naturally, it'll end up coming to the consumer, I'm sure. But the other side, of course, is it's going to be in Chinese yuan. Is President Trump, I saw him saying that he wants to actually charge a toll. So it's going to be, again, fascinating how this all unpacks. The other side, of course, US races to keep Israel, its fight with Lebanon, that needs to be understood and the impact that that's having. So I feel as though the crude's very range bound at the moment after that big washout on Wednesday. Let's just see where we are over the next couple of days. But there are talks over the weekend, and it's very dynamic.
Right, Peter, it's a very dynamic space that we are dealing with for 5 weeks now, and we have been actually done well with the Indian markets, with it reaching the 24,000 levels on Nifty 50 back again. Now, the big concern here, Peter, is that the day the crude is above $100 per barrel, that day the market sees weakness. So it is showing a huge amount of correlation to one particular level. It's more sentimental. So the days on which it is really trading below $100, those are good days. How are you seeing the outlook on crude, and is everything, the supply constraint, really baked into the prices, the futures prices at the current moment, and will it be contained below $100 per barrel? What's your outlook here?
Well, I think first off, you're exactly it. You know, you've nailed it as far as that $100. And there is a psychological barrier, and it does have an impact naturally to market sentiment with equities. And we've seen it under 100 now, and we saw a nice move across Asia today. It was well bid up. And where it's running, I would say that if this ceasefire is going to materialise and there are no breaks in that, Nisha, then I'm very confident that oil will be sub 100 and probably even very close to 90 or less. But as we know, there's a lot of water to pass under the bridge between now and when that expires. And there's talk in the town as far as whether there's going to be breaks in it, how it all structures. So one would be hopeful that crude prices can stay at these levels or lower, but there's a lot of uncertainty when you come to warfare and geopolitical risk.
That's right. So, Peter, how is this toll math really adding to the pricing? And what are the traders now saying? In fact, what is the reaction and the future trends that you're picking which could impact the overall supply and crude prices going forward?
Well, I think traders naturally and consumers, they want to see, and countries want to see the Strait of Hormuz to be opened. And they want to see petroleum and all of those energy products actually going through there without any issues. Now, there is talk that Iran's going to, as we know, charge a toll. Is it going to be absorbed? How effective is it going to be? And are they going to get away with it? Because there may be, you hear the likes of Singapore, you hear the likes of the Saudis. No one wants to actually pay this. So it's very confusing. It's only early days, but we can understand how this works as far as choke points. And is this going to be the new normal for other choke points to adopt a similar strategy, Nisha, in time?
Right. So, Peter, now the question arises. You said that it can be below 90 or below if the ceasefire and the uncertainties are at bay at the current moment. It is finding sanity at those levels is what you said. But if the ceasefire and the negotiations really fructify and all goes well as well, after that also, do you account for it to go down to 65 odd levels, or do you think the constraints that have been caused by the last 5 weeks are going to spill over and it will take some time for the crude supply to recover? So what are the levels that we are penciling in if the war were to end and everything to normalize also?
Well, I think you could use a 65 handle as an achievable target, but it's not going to happen instantly, Nisha. And you know as well as I that there are time frames as far as the opportunity for that price to get to that. There's a lot of things that have got to go right, not wrong. And yes, oil will come down in value, and there's no doubting that. So it's very much a wait-and-see approach. Let's see where we are over the next matter of weeks. I think $80 has got to be a key target, and then we'll readjust our outlook as far as downside, because, again, there can be hiccups across the whole platform, and one needs to be very mindful. Volatility is a key word when you're talking about oil, and certainly the Strait of Hormuz.
That's right. So $80 is where we could see some sanity coming in if all goes well. Are there any important factors besides the war negotiations that are also at play currently, which would be baking into the crude prices? First, Peter, and second, your view on the metal prices as well, precious metal prices. How is the outlook looking from the volatility that even that market is seeing because of the ceasefire and the war situation?
Well, I think first off, the uncertainty as far as southern Lebanon and where that's going to be impacted and the Hezbollah. So that is a wild card that we're throwing again into the mix of all of this, Nisha. So we've got to be conscious where how that unpacks or whether it actually escalates from here. So there's that part of it. The second part, as you said, as far as gold, one needs to be really across the central bank buying. January was six tons, and we had 19 tons purchased by central banks in February. We haven't got the numbers for March yet, but that was a very strong start to the year. So the overall momentum is central banks are buying, and they're buying up big. So I'm sure that retail consumers, and certainly people in the population of India, are rubbing their hands with glee in the sense where there's more upside for gold over the foreseeable future.
All right, Peter, thanks so much for giving us all your insights on the commodities. It's always a pleasure to speak to you. So 60 is not something that we are going to reach even if war gets over. 80 is the level that we can really look at. And very well, the ceasefire can take the crude prices to below 90 as well. It's looking pretty for the Indian markets. Take a look at Nifty 50. It has crossed the 24,000 levels, over 1% gain. So keep an eye out on the market. With that, it's a wrap on markets at 12, but keep it with NDTV Profit. Thank you so much.
केसरिया से मन जोगी हुआ रे दिल झूमे देखो मतवारा हुआ रे केसरिया से मन जोगी हुआ
हर पल मनाओ केसरी त्योहार विमल बोलो जुबान केसरी
Presenting the all-knowing, all-powerful Tech Guru.
Whoa. Guru? I'm no guru.
Okay.
I'm just a guy who loves his tech.
A show where the mysteries of megabytes and motherboards shall be unraveled.
Bro, nobody talks like that anymore. This is all about connected ecosystems, EVs and AI that you can use in your daily life. That's what we do on Tech 360. Real talk, real reviews, tech that you can actually use.
Tech has changed. So should your tech show.
To understand the Tamil Nadu twist, join me in the midst of people, language and politics. Vanakkam Tamil Nadu, here we come.
When others are warming up, I'm raring to go. The stories that matter, the stories that shape your life.
Hello and welcome to watching Prime 5 with me, Raisha Sehgal. What's happening? How
The show that sets the prime time agenda.
We'll be deep diving into this topic to tell you what's at stake.
Join me, Raisha Sehgal, on Prime 5 only on NDTV 24/7.
Sun win with a hand in hand? Will the two leaves and lotus bloom?
Hello and welcome to NDTV Profit. You're watching Trending Stocks with me, Yatharth and Alex Matthew, standing at the NDTV Profit market pit with all the action in the markets today. Alex, over to you.
Well, Hiral, good afternoon to you and good afternoon to everybody tuning in. It's a funky Friday. Freaky Friday. No matter what you call it, it's actually a good Friday. We've got gains of about 1% for the Nifty 50 and we're trading very close to the high point of the day. In fact, it's not just for the Nifty 50 and we're above the 24,000 mark at this juncture, but pull up the broader markets as well. The mid-cap index also trading very close to the high point of the day. If anything, it's eclipsing the move by the benchmark Nifty 50, up about 1.25%. The small cap index also gaining well over 1%. In fact, 1.5% for this particular index. Pull up the banking index because this is where the action is. A lot of those private sector banks doing particularly well in trade. And I'll bring up ICICI Bank and a few of the other banks in just a bit. But gains of close to 2% for this particular index. In fact, let's pull up the heat map for the Nifty 50 and you will see what I'm talking about. There's a large amount of green on the screen, but you will see some of the top gainers in the form of the banking pack. There you go, ICICI Bank right here, Axis Bank right here, but the top gainer is Asian Paints. Eicher Motors not too far behind. There is news, of course, of a new electric vehicle having been launched. Bajaj Auto not doing too badly as well. But what is not working today is Sun Pharmaceuticals, and this is worry about the expansion plans that they have. Infosys, or the acquisition rather, that they have planned. Infosys, TCS, HCL Tech, Tech Mahindra and Wipro in the bottom list. This is not just Tata Consultancy Services results that have come through, but also the underperformance that is likely in IT that people are expecting because of the launch of Mythos and everything in the way of the artificial intelligence picture here. So it's a pretty picture broadly, but there are a few niggles.
Absolutely, there are a few niggles in the way, and how the weekend is going to be interesting because we've already seen a 1500 points kind of a range in terms of Nifty 50 over this week. But moving on in terms of the watch list, Asian Paints 10% in 5 days, but today's move is exceptional. The top gainer on Nifty 50, and Sun Pharma bleeding on the back of the acquisition news, which has been an overhang since quite some time. Eicher Motors, they've launched a new bike on the back of which strong moves coming in there. And the IT sector has been under pressure now, because of which you're seeing a TCS, as well as a Wipro, which are bearing the brunt. Wipro is in focus on the buyback news, as well as you have
TCS on the way Q4 numbers have panned out. Poonawalla FinCorp, Street not really enthused with the 2,500 crore QIP launch. That stock is down in trade. And the strong premium data that has come in is keeping New India Assurance afloat. Cohance, strong volumes. Blue Jet also pretty strong in trade today. Sapphire Foods has seen a smart move this week, 14% in the last 5 trading sessions. You have Ola Electric, which has actually bounced to an 11-month high, and this is only on the back of the kind of numbers that they've reported in terms of registrations in the month of March. That rally that we are seeing on this counter is spectacular. Inox India as well has jumped most in 2 years, along with Aegis Logistics. So that's what the watch list is looking like. But Alex, over to you to take the rapid fire with Akshay Bhagwat of JM Financial.
Well, absolutely, Hiral. We've got Akshay joining in. Akshay, good afternoon to you, and it's a good Friday so far. I hope that it continues to the end of trade. But let's talk about the rapid fire, and do give us your answers as quickly as possible. First up is a company that's reacting positively to the latest premium data in the insurance space, New India Assurance. Would you trade this? You're on mute, Akshay.
Good afternoon, Alex. So New India Assurance is reacting to the numbers. Momentum is strong, 158 to 160. The target's opening up with a support of 145. Positive view.
Positive. All right. Cohance, one of the volume buzzers, and I've got a few to talk about. But would you buy into Cohance?
Highly oversold stock, momentum catching after a very long time. The recovery move can go up till 400. Yes, you can buy it for momentum with a support of 350.
Another volume buzzer in the form of Blue Jet Healthcare. The volume currently over 3 times the 20-day average. How would you trade it?
Blue Jet Healthcare, strong volumes, and this might see a positional target till 450. Continue to hold. 375 is your support.
If you thought 3 times the 20-day average was high, take a look at this Sapphire Foods. It's 6 times the 20-day average volume. Would you trade this one?
I would give this a miss. There is a resistance around 175 to 180.
Ola Electric, it's been on a bit of a tear, bouncing back from those lows. It's up and about today as well, but would you ride that high?
44, 45 is a resistance zone. Yes, still more upside is in the making. 35 is the support.
Inox India is seeing its biggest jump in 2 years. Would you continue to hold this if you manage to get it?
I would book out my profits at current market.
And finally, Aegis Logistics, it's rallied the most in 6 months. What would you do if you haven't managed to get it, and if you have?
For Aegis Logistics, at this point, if you have, I would book out my profits if it's for trading. Support is 575. Medium-term targets 3 month plus, work out till 725.
Okay.
Short-term, it's an exit.
All right. So if volumes might have been a little thin yesterday, that isn't the case in individual counters today, Hiral. But what are the trends telling you?
You know, it's very interesting to see what usually trends on Google, because the names usually crop up which are actually in focus over the last couple of trading sessions. Yesterday, interestingly, we had a Bharat Forge. Today, Ola Electric, that's been on the list since quite some time. Ashok Leyland has also been there, Intellect Design, Sun Pharma. In fact, Akshay, quick one. If you have to look at Ola Electric with the kind of surge that has come in over the last trading sessions, would you advise investors to book profits? Your view on that one? And secondly, the pressure on Sun Pharma, what are charts indicating?
So first of all, good afternoon, Hiral. And with the momentum kicking off in Ola Electric, 4 days of one-way rally, this rally can see some bit of profit booking around levels of 44 to 45, which is the swing high on the technical chart. So that is the point where you can consider taking your profits off the table. And as far as Sun Pharma goes, there has been a good sell-off, and I think the stock is all again setting itself up to see levels of 1600 on the downside. It's only a short-term selling which I see. Longer-term charts are still neutral. So look for buying opportunities again on dips around 1600.
So interesting on Sun Pharmaceuticals in particular, right? Because it's an underperformer, the worst performer, in fact, on the Nifty 50 and down over 4%. The problem is to do with an acquisition that might be on the cards, and that is not in this case, what the doctor ordered. Let's find out from Varsha why this is a problem. Wrong prescription, yeah?
Yeah, we might say that, Alex, but the Sun Pharma is actually under pressure because Sun Pharma is planning $12 billion acquisition, and the name of the target company is Organo Company, and this would be a largest, M&A deal by Indian pharma company, and bidding offer is expected in the next few weeks. Now, the point here is why the market is worried about this, because this is a large deal versus Sun's size, and the Organo, that is the target company, has a lot of debt on its balance sheet, and even there are some weak growth in some of their segments, and also the competitive pressure in generics and biosimilar, some of the problems that this company has. Onto the or business snapshot, when it comes to Organo, they have women health, biosimilar, established drugs, and the sales were impacted by lower US government funding and pricing and competition. So overall, because of the weak balance sheet that the Organo has, and the Sun do not have that much of cash to fund this acquisition, are some of the key problems which market finds, and this is the reason why Sun Pharma is down in trade today.
Okay, all right, so well put. Let's find out from Sunny Agarwal whether he thinks that these are major headwinds and whether it's a better idea to avoid an acquisition like this. Sunny, good afternoon to you. What's the view on Sun?
Yeah, good afternoon, Alex. I think we should wait for more details on the acquisition. No doubt, pretty large size of acquisition. $12 billion is a huge number. And I believe that usually such kind of large acquisition take 1 or 2 years for total synergies to play out. So as of now, would like to stay away, would like to hear more details on the acquisition front and how post-acquisition pro forma number look forward.
Okay, so that's with regards to where Sun Pharma goes, the stock at the day's lowest levels. But moving on, Shriram Finance is seeming to have a good run in today's session. One of the top gainers has cooled off slightly from the day's highs. Let's just pull up a 5-day chart and see what this NBFC has done, because Morgan Stanley has maintained an overweight and they have a target price of 1,325. There's an upgrade of long-term ratings as well to a AAA from a AA positive by ICRA, and that has come in quick succession over here. Now, what they've said is that Shriram's funding costs were on an average 135 basis points lower than those of highly rated peers. And the intrinsic return on assets should rise structurally as this gap is now narrowing. In fact, they've also added that the meaningful fall over the past 4 months should now accelerate. If you just pull up a 1-year chart of Shriram Finance, that will tell you the kind of crash that we've seen in the past 4 months and then the recovery that has come in on a Shriram Finance afterwards. In fact, it is the preferred pick amongst non-bank lenders as well. Your view when it comes to Shriram Finance, Sunny?
So we continue to remain constructive on Shriram Finance post MUFG deal. Cost of fund is likely to reduce by 200 basis points over the next 8 quarters, and that should aid the earning growth. And on the top of that, valuation continue to remain comfortable as compared to peers like Chola, which is trading north of 4 times price to book, as compared to Shriram, which is trading closer to 2.3, 2.4 price to book multiple. So again, a good opportunity to add in a portfolio from a medium to long term perspective.
Bear in mind that it's heightened volatility for this particular counter. If there's one stock in the Nifty 50 that defined high beta, it is Shriram Finance. But let's talk about the IT space, because that arguably is the story of the day today. Two different tales though, and let's start with the positive first, and that is Wipro. The announcement that the board will be contemplating a buyback is usually seen as a positive for the stock because it's a way of rewarding shareholders. What are the details though? I mean, you were saying that it's $2 billion of a buyback?
Right, the broker is estimating a buyback of $2 billion roughly from Wipro, while Wipro is back with its buyback where you're anticipating since quite some time. Now if you look at the overall buyback, this is the first buyback in last 3 years, and Wipro is planning to do it, announce it in the during its Q4 earnings. That's during the April 16th. When we look at the overall cash balance at Wipro currently is at 41,000 crores, and we are anticipating Wipro to spend nearly 18,000 odd crores to do this buyback. If we look at the past data, we have seen that Wipro generally gives a premium of 15 to 18 odd %, and based on the current market price, we can expect the buyback rate to be anywhere between 240 to 245 odd rupees. The stock did see an up move today in trade, move up to 3 odd %, but right now it's settled. So it's a wait and watch. What does the buyback come at, and what price does it come at altogether?
You know, the entire pack has been under pressure today, and Wipro, of course, on account of the buyback, is still trading in the green, just about 0.1% or so. But broadly, you have frontline IT companies that are taking a bit of a whack. It's some part to do with TCS results and the other part to do with Mythos, but specifically on TCS. The jury was out this morning whether it was positive or negative. The numbers broadly in line. Why is the stock taking a beating?
Well, if you look at overall TCS, we did see that the Q4 was an outbeat for the company. It did really well in terms of the AI revenue, the overall guidance of the management expecting FY27. But the main beat comes when you look at the overall annual performance of Wipro, of TCS. We have seen company report for the first time a degrowth in dollar revenue since 2004. So while this comes on the back of that AI fear and the tariff impact that we saw initially where the deals got delayed. So this is the reason why we saw in the overall FY26 a slight upbeat. In terms of overall AI revenue also, we were expecting a good uptick in AI revenue, which did come at 2.3 billion, but Street's still not happy. They still expect the overall AI deflation will be much more higher than the revenue growth. That's the reason why TCS has been dying in trade today.
Speaking of AI, in fact, part of a conversation that Managing Editor Tamanna Inamdar had with the management of TCS, and what they've said, and this is specifically what Kriti Kritivasan has said, is that AI integrated models are likely to expand job opportunities and not cut the tech company's budget. In fact, listen in to what he had to say about AI as well as the revenue opportunities going forward.
AI's value is not in reducing 15-10% on the IT budget. AI's value comes when you are able to improve your customer's experience, bring new product, new service, and that's where we've been helping our customers. So if you look all these things together, I believe actually our opportunity space is increasing and not under threat. We may need less people for doing what you are doing today, but you are going to be much more than what you are doing today. So when you are going to be the whole space is expanding significantly. I said, what you are doing today, you may get 20% productivity, you may probably do 20% less. But there is so much of additional work that needs to happen. Who is going to do it? So I am not expecting that we will need much less people than what we have today. Revenue model in terms of how you price your services can change, but I am not expecting a shrinkage in the overall revenue.
All right, the street yet to buy into that argument, at least based on what the street is seeing today with regard to the IT space. Let me go across to you first, Sunny, on what you made of those arguments and, in fact, the TCS numbers, because ultimately it is the bellwether for the sector. Does this mean that the IT sector is likely going to face headwinds heading into FY27 as well? And what's your call on the sector?
I think coming to TCS, we feel the numbers are mixed bag, although the margins were at a record high, last 4-year high, and I think continue to be an industry leading margin. On the other hand, FY27 is a year where we may see a kind of mid-single digit kind of growth, factoring in all the AI related deflation. However, having said that, I think the scenario is slightly better than what was there in FY26, and to that extent we have seen a very sharp correction on the valuation front. So as we speak, TCS is trading closer to 15 to 16 times 1 year forward price to earning multiple. So that gives a lot of comfort, at least from a valuation perspective. But at the same time, the growth is likely to be very moderate, kind of 5 to 6% growth one can expect in FY27. And we continue to believe that if somebody is looking for a value buy and is happy with a kind of 10 to 12% kind of CAGR story, then in that case, TCS is a stock which can be added gradually in the portfolio. But having said that, what we feel is that other players like Coforge and SCL Tech, they have got a slightly better growth visibility going forward, and those are the two stocks which we feel are relatively well placed as compared to TCS as we speak.
Okay, so that's with regards to where the IT majors go. But moving on, another sector which has been in focus over the last couple of weeks is metals. Today, it has cooled off and now it's almost going back into the negative terrain. But let's just pull up a 1-week chart of the metal index and see what's happened there and compare that to the 1-month chart as well. And that'll tell you the metal story. There you go. A 9% up move coming in the last 1 week. So there is brewing. There is a lot of interest there. We have Macquarie also, which has come up with their report, and they have outperformed on Tata Steel. They've actually hiked the target price there. JSW Steel, they've maintained their rating and hiked the target price as well. Jindal Steel, again, maintained the rating, increased the target price, and likewise for a Hindalco and a Coal India. What they're saying is that Q4 firm prices is something that will boost the EBITDA of all of these companies, and they prefer the ferrous metal pack versus the non-ferrous. And the domestic steel prices are expected to remain firm, and this is what will augur well for FY27 earnings. Hindalco is going to benefit from the firm aluminium price and the gradual uptick that we'll see in terms of Novelis's EBITDA, but the valuations cap an upside potential for this one. For Coal India, the neutral rating actually reflects modest downside following the recent stock outperformance, because that stock has outperformed in the last couple of months. Sunny, your view specifically when it comes to the metal pack, and within that, I would want to talk to you about Hindalco and Coal India. Do you think it's now time to book profits in terms of Coal India?
I think coming to metal space, I think aluminum prices continue to hover closer to $3,400, $3,500 per ton, led by disruption on account of supply from Middle East, and that is closer to its lifetime high. So I think aluminum players are well placed to deliver a healthy earning growth going forward. Similarly on steel, as you rightly pointed out, because post imposition of a trade barrier, we have seen a close to 10 to 15% kind of a rise as far as the flat as well as the long steel prices are concerned in India. So both these packs should report a healthy earning growth for Q4 as well as 1Q FY27. Coming to Hindalco, what we feel is that again, because of these very buoyant kind of aluminum prices, Hindalco is relatively well placed as compared to the Coal India, where we feel that the value play which was going on since last 4-5 months is likely to be over, and FY27 is likely to be a muted year in terms of earning growth. So maybe Coal India one can book profit and shift money to Hindalco or likes of Nalco to ride on the aluminum growth story, and Tata Steel to ride on the steel prices, domestic robust steel prices as we are seeing in India.
Speaking of riding, let's talk about Eicher Motors, and it is one of the top gainers on the Nifty 50 today. I've got an important question actually two important questions for Puneet, who's joining me to talk about what is leading to this. The Flying Flea has been launched. So the question is, will the Flying Flea fly flaming circles around its internal combustion counterparts? And does the Flying Flea actually sound like a Royal Enfield?
Well, the second question is easy to answer. It's a no for now because of the whole electric vehicle landscape. But the key aspect is a very important launch. The first electric motorcycle by a mainstream brand. You have some players, and we'll get to that in just a bit. But at 2.79 lakhs, it's the pricing that's a key important one to watch out for. How is the acceptability of a brand? Because it has a 3.9 kilowatt hour battery, so it is higher than what you would see in an electric scooter. Gives you that range of almost 150 odd kilometers, but it's a city riding experience in that sense. So you will have to watch out for a brand new consumer that Eicher is going after, similar to what they did with the Hunter at the lower end of the spectrum. So you got a lot of younger audiences there. This would be to appeal that audience that there is not present in Eicher Motors right now. What's also important is the fact that the bookings are already open from today, April 10th, and the test deliveries will be available from the 12th. But also Ultraviolet, Revolt, as well as the Ola Roadster are some of the other competitors. You will see one coming in from Yatharth next year. But the first mainstream brand to come in, it's coming on the Flying Flea by Royal Enfield, but a lot of focus on the first two words there.
Yeah, the Flying Flea. It's a very different design take as well for this motorcycle, in case you haven't seen it. The question though is, Akshay Bhagwat, will the Flying Flea take... okay, I'll go to Sunny. Sunny, on the fundamentals, do you think that the Flying Flea will make that much of a difference to the volume numbers?
Not in the overall scheme of things, but definitely, again, a new product launch definitely tends to give a boost to an volume. Having said that, the portfolio below 350cc continue to do well as we speak because of the rationalization of GST. On the other hand, we are seeing a recovery above 350cc where we have seen an increase in GST rate in the month of September. So even that portfolio should do well. Emerging markets volume continue to remain robust. gross margin expansion we have seen in Q3. So I think our view is constructive on Eicher Motor, and again is a second topic. So first continue to remain TVS and then followed by Eicher.
Okay, so that's with regards to the two-wheeler space. But moving on, two other names which are in focus is Ashiana Housing. And this is on the back of the land parcel that they've acquired in Pune, 3.5% up move coming in there because the sales value potential is seen at 1,800 crores. And Godrej Properties as well on their back of the business update. Collections have gone up on a year-on-year basis, strong move there. The booking value has seen a growth as well, and they've achieved 95% of their annual guidance of collections for FY26 and 105% of their annual guidance for the booking value for FY26. On the back of that, if you talk about the stock, 2% up move coming in there. Sunny, your view when it comes to the real estate pack, because a lot of acquisitions that are happening from a land parcel perspective, if you talk about their guidance in FY26, not all of them have met their guidance as well. How would you look at real estate as a sector at this point in time after the recent run-up that we've seen?
I think we would like to remain selective on the real estate side. So there are a few companies which are outperforming and have been able to meet their guidance. So for that matter, we believe that Aditya Birla Real Estate or Prestige, or for that matter Phoenix Mill, Lodha, these are the few players which we feel which have penetrated into a new territory, and that is something which is aiding the pre-sales growth number. And at the same time, on valuation front, few companies like Suntec Realty or for that matter Raymond Realty, which are trading at a very reasonable valuation. So these are the few names which we feel can be a part of your portfolio over the period of next 6 to 12 months.
Okay, so Raymond Realty, that stock at the day's highs as well. But completely out of time. Thank you, Sunny, so much for joining in. Always a pleasure to speak to you. Thank you from Alex, the team that put the show together, and myself. Lots more lined up on the other side. Please stay tuned to NDTV Profit.
केसरिया से मन जोगी हुआ रे दिल झूमे देखो मतवारा हुआ रे केसरिया से मन जोगी हुआ
हर पल मनाओ केसरी त्योहार विमल बोलो जुबान केसरी
If you really want to see environmental action in India, we will have to revive community action.
How convenient you make it for somebody to choose a greener option, or how inconvenient you make it for them to choose a browner option makes a difference.
So we have eradicated road transport. Where we cannot replace it with the slurry pipeline, we are using this LNG or electric trucks.
कुछ खास होने वाला है।
Presenting the all-knowing, all-powerful Tech Guru.
Whoa. Guru? I'm no guru.
Okay.
I'm just a guy who loves his tech.
A show where the mysteries of megabytes and motherboards shall be unraveled.
Bro, nobody talks like that anymore. This is all about connected ecosystems, EVs and AI that you can use in your daily life. That's what we do on Tech 360. Real talk, real reviews, tech that you can actually use.
Tech has changed. So should your tech show.
I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversations.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
To understand the Tamil Nadu twist, join me in the midst of our people, language and politics. Vanakkam Tamil Nadu, here we come.
When others are warming up, I'm raring to go. The stories that matter, the stories that shape your life.
Hello and welcome to watching Prime 5 with me, Aisha Sehgal. What's happening? How to
The show that sets the prime time agenda.
We'll be deep diving into this topic to tell you what's at stake.
Join me, Aisha Sehgal, on Prime 5, only on NDTV 24/7.
Will the rising sun win with a hand in hand? Will the two leaves and lotus bloom? Who will whistle to success in Tamil Nadu? To understand the Tamil Nadu twist, join me in the midst of our politics and people. Vanakkam Tamil Nadu, here we come.
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most
Positive global cues and strong buying in financials aid Nifty rebound in trade. Broader markets mirror benchmarks. All key sectors in green territory except IT and Pharma. Sun Pharmaceutical trades under pressure after reports of a proposed mega acquisition. The company is said to be planning a $12 billion bid for Organon and Company, which would mark the largest overseas acquisition by an Indian pharmaceutical firm. Most of the IT companies fall in trade, with TCS shares declining, and in response to their fourth quarter earnings, that's where TCS is declining. The only outlier in the IT pack is Wipro, with surges after announcing the company mulling a buyback decision. Amid the fragile ceasefire in the Middle East, all eyes will be on Islamabad, which will host talks between US and Iran from tomorrow. Hello and welcome. You're watching Lunchtime Trades with me, Mahima Vachrajani, and this is a show where we get you a roundup of everything that's been happening in the world of commodities, news and updates on the top buzzers at this hour. And all this while you grab your lunch plates. But let's take a quick look on the markets as to how they're faring at the hour. You have your Nifty 50, which is right now trading 1% higher, almost trading at its day's high point. 240 points of an uptick is what we are seeing. With regards to where the heat map goes, let's try to pull up the Nifty 50 heat map and see what is the top gainer. Asian Paints seeing that uptick of 4% and continues that a rally in trade today. Eicher Motors is the other one which is trading 4% higher as well. Bajaj Auto, M&M, so Auto Pack as a whole doing fairly well. You have your ICICI Bank, Trent, Axis Bank, Shriram Finance also gaining in that range of 2% each. But on the flip side, you have Sun Pharma taking a downtick of around almost 4% on the back of the talks of it acquiring a company. Infosys, TCS, Coal India are some of the counters that are also taking a knock. So IT names is the other set of stocks that is not doing fairly well. The Bank Nifty also doing fairly well, up 1.7%, trading in that 55,700 levels. Let's try to pull up the sectoral heat map to see as to how sectors are looking like right now. And only the Nifty IT in the red right now, trading with cuts of about 2%, but auto trading with 2.6% higher. Nifty Realty continuing its gain up 2.4%, followed by media, private bank, as well as banks and consumption and defense as a whole, seeing an uptick of around 1% each. But let's try to pull up the advanced decline ratio, because that will give us a picture as to how the broad end of spectrum is looking like, and that's continued. Almost 11:1 ratio is what we're seeing on the advances versus decline, purely in the favors of the bulls is what we're seeing. Let's quickly pull up the mid cap 150 and the small cap 250. Doing slightly better when the benchmarks go. The mid cap 150 is up 1.4% and the small cap 250 up 1.6%. Quickly, the BSE 500, before I go on to our next piece, I think New India still continues to be higher, up 17%. Last we saw was high by about 14%, so probably trading at its day's high point. Cohen's Life, Avanti, Orient Electric are some of the counters that are doing fairly well, but on the flip side, you have IT names and pharma names and some defense names also seeing a downtick. Something like a Data Patterns is down by about 2%. So that's in regards to where the markets go. But speaking of one space that a lot of brokerages have been bullish on is metals. Today, Macquarie, in fact, has come out with a note on metals wherein they say that overall Q4 is going to be a strong one because of steady prices, and that will boost EBITDA and ferrous segment as a whole, and it's going to do better as compared to what they were expecting. With Varsha joining by to give us a perspective on why and what makes Macquarie bullish on a lot of these names, because Varsha, they've gone ahead and hiked the target price for a lot of these metal counters.
Yes, absolutely. They've maintained outperform for Tata Steel, JSW Steel and Jindal Steel, and also they've hiked target price for these three counters, while they've maintained neutral rating for Coal India, Hindalco, and they've also raised target price for both of these counters. Now what they're saying is for Q4 they're expecting prices to be firm, which will boost EBITDA, and they're preferring ferrous segment over here. And they say that the domestic steel prices remains firm and auguring well for FY27 earnings. And according to Macquarie, Hindalco will benefit from firm aluminium price and gradual uptick in Novelis EBITDA, but valuation cap will upside potential for that. But for Coal India, the neutral rating reflects modest downside following recent stock outperformance as per Macquarie. So overall, if you see, they are bullish when it comes to all the six counters of metals. But they have, of course, maintained outperform for Tata Steel, JSW Steel and Jindal Steel overall.
Right. Varsha, thank you so much for getting us those details with regards to where the metal counter is concerned. But with that, let's kick in and try to understand as to what the commodity market is looking like and what can you expect going ahead. To understand exactly this, we're right now joined by Biren Vakil, commodity consultant at Padium Commodity Advisors, joining us now. Biren, thank you so much for taking out the time. My first question to you with regards to where crude stands. Not much of a movement is what we're seeing today, but overall, your perspective on crude prices now that we've seen a ceasefire of 2 weeks at least, and plus we're going to see talks happening in Islamabad going forward as well. What are you predicting when it comes to crude right now, if this settles, if this does not settle?
For a while, market has found a peak, tentative peak. So we may see tentative peak around 110, 115 for the Brent. And at the same time, floor could be around 80, 85. So we may see a range-bound trading of 85 to 110 because ceasefire is still seems fragile, or there are a lot of uncertainties persist. If it holds beyond 2 weeks, we may see tightness in forward curve in Brent as well as in WTI. We may see crude towards 80, but it depends on how ceasefire lasts, how long it lasts.
All right, so that's the view coming in on crude. Meaning the other aspect is gold. Since the past couple of days, we're seeing an uptick on this counter once the ceasefire was announced. Before that, we saw 1 month of volatility coming in for gold. It was falling on the back of dollar prices rising, bond yields going up, etc. Overall, your perspective on how gold can fare by the end of 2026, because a lot of these global brokerages have gone out and maintained their stance when it comes to gold, with UBS having target price of as high as $6,200 and Goldman Sachs around $5,000 dollars overall per ounce. What is your outlook when it comes to gold by the end of 2026?
It is difficult to make such a long forecast, but temporary it seems risk on trade is back for a while. So gold may rediscover its inner bull and may hit towards 5,000, 5,200. For a while, 48 current price seems to be a floor. If ceasefire holds for 2 weeks or more, we may further downside. As of now, we can say path of least resistance is toward upside.
So Biren, then for somebody who is looking at investing a lump sum amount in gold right now, should they wait or this is a buying opportunity?
It's a good for deep pocket buyers. What I would prefer is to accumulate in the form of ETF or gold bond traded in secondary market. That could be a good idea based on scale down buying.
Mutual funds and ETFs is the best way to kind of go ahead and accumulate gold if you want to at the start. Biren, the other aspect is silver. Now, for everybody who is watching this, silver is always seen as a commodity and not as an investment like gold is, right? Silver is something that has seen a significant downtick since the start of this war, corrected quite a bit. Of course, it rallied also significantly. And the gold-silver ratio is right now, slightly looking to be more attractive as compared to where it was a month ago, right? Your outlook on silver and what would you as a commodity person do right now when it comes to silver?
If risk on theme prevails, silver may outperform gold. Ratio is bottom out around 48 and it currently stands around 63, 64. Silver is a high beta commodity. So if metals and big tech, other counters, AI, etc. remains outperformer, then silver may outperform gold.
Just to give viewers a perspective, gold is seeing a downtick for around 0.8 odd % today, and silver is seeing a downtick of around 0.96 odd %. But Biren, the other aspect is, and I've been, Varsha was just talking about how Macquarie has come out with a note on metals. There are a lot of brokerages that are talking about these metals like steel, aluminium, etc. I'll start with aluminium first because LME prices have been going up globally, and that is something which is beneficial for a lot of companies that are kind of exporting aluminium. But overall, your view on prices when it comes to aluminium going forward?
Significant damages in aluminium smelting capacity in Middle East may disturb broader S&D equilibrium. So I'm sensing there is still a room for upside in aluminium, and other metal could be zinc, which may outperform if risk on sentiment prevails. But regardless of this ceasefire or other things, it remains static. Aluminium still has a chance to outperform.
In fact, the JP Morgan note that came in a few days ago did say that despite of the ceasefire, the plants that have been impacted in the Middle East that produce aluminium will take time to kind of revive themselves. At least 9 to 10 months is what they'll take. And till then, aluminium prices are expected to be elevated globally, and that kind of benefits a lot of counters that export aluminium from India. So JP Morgan kind of is bullish on counters like Hindalco as well as counters like Vedanta. But just one last quick view, Biren, you did shortly talk about steel as well, but overall any specific view on steel also going forward, because that is also having the same nature as how aluminium moves?
I think steel is a long-term bull market, structural market, I would say.
Okay, all right. So that is the perspective coming in on steel. Biren, thank you so much for giving us those perspective on all the commodities that we talked about. Thank you so much for taking out the time and speaking with us at NDTV Profit. All right, so that's that's the way and way forward for commodities going ahead. There is silver, there is gold. Of course, gold. Every other analyst is anticipating that the rally will continue once there is some relief coming in for this entire war, and aluminium and steel is also expected to rise going ahead. But shifting focus and talking about Shriram Finance, now this is one stock that has kind of moved in the way how markets have moved, but in a much better way. And Morgan Stanley today in fact has come out with a note on it, maintaining overweight stance, giving a target price of 13.25 for this particular counter. What they've said is that they like this counter and upgraded it from a long-term. The company has also gotten an upgrade of long-term rating to AAA from AA plus by ICRA, and that has come in as a quick succession. And what they're saying is that Shriram's funding costs were on an average at 135 basis points lower than those of highly rated peers, and that is something that they've been liking. What they're saying is that Shriram's intrinsic ROA should rise structurally as this gap narrows. Meaningful fall over the past 4 months should now accelerate, and Shriram Finance is a preferred pick among the non-banking lenders, is what makes Morgan Stanley bullish on Shriram Finance. But shifting focus to this entire space, which is the only counter that's in the red when it comes to the sectoral picture, IT services is the major sector which is right now trading in the red, and you have a lot of counters which are under pressure, but Wipro is the only one which is kind of seeing an uptick of around 0.3%, and L&T Tech as well. But Wipro has announced that it will consider a buyback of shares along with its fourth quarter results on April 16th, and this to understand as to what this buyback means and what's made the tide turn in the stocks today, we have Jasmeet joining by to give us more perspective on this one. Jasmeet, over to you.
Well, Mahima, thank you for that. As rightly said, this being the only sector that's seeing a lot of pressure at this point in time. But given that Nifty IT had already rallied 10% in the month of April, and we see some bit of correction in the overall stocks. Now, we talk about Wipro per se trading in green currently, while the stock remains on focus as the board to consider buyback from the Q4 earnings that's on 16th of April. Now, what board expects is this will be the third buyback first buyback they're doing in the last 3 years, and altogether fifth buyback for the company in the history. Now, currently the cash balances with the company are roughly at 41,000 crore, and analysts are expecting company to deploy nearly 18,000 odd crore for this particular buyback. If we look at the past data, the premium which generally the board gives for the overall buyback is between 18 to 20%. Keeping the same premium, we can expect the buyback to be anywhere between 240 to 245 rupees based on the current price. So all in all, we do expect positive up move in the stock going ahead, but currently the stock rallied 3% odd, but right now has cooled off the trade.
Okay, so that's the perspective coming in on Wipro, but Jasmeet, stay on, because the street is kind of not happy with the way TCS numbers have come in when it comes to the Q4 numbers, and the stock continues to be under pressure. Give us more perspective on what are the reasons as to why the stock is seeing a downtick of almost 3% as we speak, almost at its day's low point, and what our brokerage is saying about it.
Well, I was rightly said, the stock in the pre-open did see a bit of gain, but then eventually just settled down and currently trading in red. So here are the top key reasons why TCS is facing all that pressure in terms of the price movement. The first one, the company reported overall CC growth for FY26 in negative format. It's down 2.6%. And company also reports its first ever negative dollar up move since the end of listing. Since 2004, this is the first year where the company reports a degrowth of 0.5% in terms of the revenue earned in dollar terms. Now, if you look at overall other performances of Q4 we did see active and good healthy growth, and the company remains positive in terms of overall AI. They did see a healthy growth of 28% of AI revenue, and management expects this to continue going ahead as well. But on the other hand, Street fears that the overall AI revenue might not be as large as what the deflation might come to the AI. And overall brokerage also remain bearish on this particular counter. If you look at the brokerages, I have 3 brokerages that have reduced their stance in this particular counter and also cut their rating. I have something like Jefferies, which maintained underperforms and cut the target price to 2275 from earlier 2350. Now what they say is they see the entire quarter was as per the expectation, but the growth for FY27 remains subdued, and they were not very keen with the comment that came from the man for FY27. While secondly, I have TCS on City on TCS. Now they have maintained sell on this particular counter with target price of rupees 2250. Again, they said a similar pressure on this particular counter. All in all, we do see brokerage being bearish, but the Q4 was a good quarter for the company in terms of the deal wins.
Okay, Jasmeet, thank you so much for getting us those details. In fact, when we spoke to the management, what they said is that AI integrated model are likely to expand job opportunities and not cut tech companies' budget. This was said by Kirthivasan, CEO and MD of TCS, while speaking to NDTV Profit. Let's listen in to what he had to say exactly on AI and revenue trends.
AI's value is not in reducing 15-10% on the IT budget. AI's value comes when you are able to improve your customer's experience, bring new product, new service, and that's where we've been helping our customers. So if you look all these things together, I believe actually our opportunity space is increasing and not under threat. We may need less people for doing what you are doing today, but you are going to be much more than what you are doing today. So when you are going to be the whole space is expanding significantly. I said, what you are doing today, you may get 20% productivity, you may probably do 20% less. But there is so much of additional work that needs to happen. Who is going to do it? So I am not expecting that we will need much less people than what we have today. Revenue model in terms of how you price your services can change, but I am not expecting a shrinkage in the overall revenue.
Okay, now, so that was, of course, the management of TCS talking about AI and revenue trends. But, India has capped refinery margins to manage losses on domestic fuel sales. Now, this follows a windfall tax on fuel exports. How will this impact refiners, marketers, and customers? Somit is here to explain exactly that. Somit, over to you.
Well, as per the PTI report, India is looking to cap the gains that we are looking on the refinery side. Now, they are looking to cap this refinery margins at around $15 per barrel. Now, what does this mean? For refiners or for companies who have more refining than marketing, for them the margins, that is the gains, will be capped, and this will be negative for pure play refiners or companies with higher refining business, that is Reliance Industries, MRPL and Chennai Petroleum. For them what it means is that refiners cannot earn more profit despite the fact that the prices of the refined products are on the higher side. And for marketing companies, like for oil marketing companies like IOCL, BPCL and HPCL, for them it is quite of positive, given the fact that it gives them some relief on sourcing the refined products from these refining companies. Now, what it means is that the cost of sourcing refined products like petrol and diesel, that goes down, and among all the 3 oil marketing companies, HPL stands to benefit the most, given the fact that they have a low refining to marketing ratio, which means that they have more marketing business rather than refining business. They refine less products and they sell more than that. Hence, HPCL stands to benefit here the most. Just to give a simple example, the Singapore gross refining margin, which is the Asian benchmark for refining margin, that is currently trading at around $46.7 per barrel. Now, this is because the availability of final products or refined products is less in the market. But what government has done here is that they have capped these gains at $15 per barrel, which means that despite the fact that GRMs are at a higher level, a refining company cannot earn more than $15 per barrel on an average on all products that they sell from the refining unit.
Okay, Soumit, thank you so much for giving us, that detailed outlook on what this means. But staying with the Middle East conflict itself, amid the heavy rocket fire, Pradeep Datta of NDTV, who's an NDTV consulting editor, covers an incoming projectile explodes nearby. Now, this is a zone with no ceasefire in sight, only the sound of blasts, relentless gunfire, and military movement around the place. Let's see the report.
अभी आप देख सकते हैं कि रॉकेट की आवाज आपको सुनाई दी होगी, क्योंकि रॉकेट चलता रहता है। यहाँ कभी भी किसी भी वक्त यहाँ पे रॉकेट फायर हो जाता है। और वो देख सकते हैं आप, ये देख सकते हैं, ये आप देख सकते हैं कि किस तरीके से लगातार रॉकेट फायर किए जा रहे हैं। आसमान में आपको धुआं उड़ता हुआ नजर आएगा। ये लॉन्चिंग साइट है जहाँ से रॉकेट फायर किए जा रहे हैं। और अब देखिए, मालूम नहीं जाके ये रॉकेट कहाँ गिरेंगे, किसका आशना गिरा देंगे, क्योंकि उम्र लगती है आशना बनाने में। लेकिन एक पल में एक धमाके की आवाज आप देख सकते हैं कि धमाके की आवाज की वजह से ये आपको आवाजें जो सुनाई दे रही है, धमाके की आवाज सुनाई दे रही है। ये रॉकेट फायर किए जा रहे हैं, ये मिसाइल फायर किए जा रहे हैं। मुझे लगता है कि हमें किसी सेफ शेल्टर की ओर जाना होगा, क्योंकि यही एक बेस्ट ऑप्शन रहता है। या तो जमीन पे लेट जाइए, या तो आप किसी सेफ शेल्टर में चले जाइए, क्योंकि यही एक ऑप्शन जो है आपके पास बेहतर ऑप्शन रहता है ऐसी सिचुएशन में, जब कभी भी। क्योंकि हम जिस एरिया में है वो बहुत ही मुश्किल एरिया है, ये सरहद का एरिया है। ये इस समय आप बताऊंगा, ये मैं आपको बताना चाहता हूँ, ये इजराइल और लेबनान का बॉर्डर है। और ये जो जमीन का टुकड़ा है, ये डिसाइड करेगा कि सीज फायर का फेट क्या होने वाला है। आप देख सकते हैं वहां पे, यहाँ पे या तो आपको टैंक की मूवमेंट सुनाई देगी, यहाँ ऐसे धमाके सुनाई देंगे, या तो रॉकेट चलते हुए आसमान में नजर आएंगे, या वो इमारतें जो पूरी तरह से ढह चुकी है। आप देख सकते हैं खंडर वहां जो बने हुए हैं, वो खंडर डिसाइड करते हैं, भी बताते दर्शाते हैं कि इस इलाके में क्या हुआ है। लगातार यहाँ पे आईडीएफ टारगेट कर रहा है। और ये जो खूबसूरत मकान है बिल्कुल खाली है, यहाँ रहने वाला कोई नहीं है, क्योंकि लगातार हिजबुल्लाह की तरफ से फायरिंग हो रही है और हिजबुल्लाह लगातार टारगेट करता जा रहा है। और यहाँ पे परेशानी का सबब है, बहुत सारे परिवार यहाँ से घर बार छोड़ के चले गए। अब ये देखना है कि जो बातचीत इस्लामाबाद में हुई, उसके बाद क्या रिजल्ट आते हैं। क्या लेबनान को लेकर कोई समझौता हो पाएगा, जबकि ईरान ने साफ कर दिया, वाज़ेह कर दिया कि लेबनान अगर सीज फायर नहीं होता है, वहां पे धमाके बंद नहीं होते, वहां पे आईडीएफ का अटैक बंद नहीं होता है, तो वो इस समझौते में शामिल नहीं होंगे।
Okay, so that was a ground report coming in from the border of Israel and Lebanon, the conditions that we're seeing there. But, with that, we're completely out of time on this edition of Lunchtime Trades. Do stay tuned. Small Cap Buzzers on the other side.
केसरिया से मन जोगी हुआ रे, दिल झूमे देखो मतवारा हुआ रे। केसरिया से मन जोगी हुआ।
हर पल मनाओ केसरी त्योहार। विमल, बोलो जुबान केसरी।
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversations.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
कुछ बड़ा होने वाला है।
If you really want to see environmental action in India, we will have to revive community action.
How convenient you make it for somebody to choose a greener option, or how inconvenient you make it for them to choose a browner option, makes a difference.
So we have eradicated road transport. Where we cannot replace it with the slurry pipeline, we are using this LNG or electric trucks.
Presenting the all-knowing, all-powerful Tech Guru.
Whoa. Guru? I'm no guru.
Okay.
I'm just a guy who loves his tech.
A show where the mysteries of megabytes and motherboards shall be unraveled.
Bro, nobody talks like that anymore. This is all about connected ecosystems, EVs and AI that you can use in your daily life. That's what we do on Tech 360. Real talk, real reviews, tech that you can actually use.
Tech has changed. So should your tech show.
To understand the Tamil Nadu twist, join me in the midst of our people, language and politics. Vanakkam Tamil Nadu, here we come.
When others are warming up, I'm raring to go. The stories that matter, the stories that shape your life. Hello and welcome to watching Prime 5 with me, Raisha Sehgal. What's happening? How to? The show that sets the prime time agenda. We'll be deep diving into this topic to tell you what's at stake. Join me, Raisha Sehgal, on Prime 5 only on NDTV 24/7.
Sun win with a hand in hand? Will the two leaves and lotus bloom? Who will whistle to success in Tamil Nadu? To understand the Tamil Nadu twist, join me in the midst of our politics and people. Vanakkam Tamil Nadu, here we come.
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive.
Good afternoon. You're watching Small Cap Buzzers on NDTV Profit with me, Somit Sarkar, and my co-anchor Varsha. In the next half an hour, we'll take you through the most important small cap stocks that have been buzzing in trade, either on the back of price or volume action. So first, let's see what's on the show today. Firstly, we'll be speaking with the management of Dhanuka Agritech. Now, despite the weakness that we have seen in the market, that stock is up nearly 4% in the last 1 month. So the key question to ask the management is, what will be the impact of the Middle East crisis? Will there be any impact, or are they seeing any kind of positive impact that is leading to such kind of gains for the share prices? Is the key question to ask that management. Apart from that, we'll be also covering stocks like AGI Infra. Now, that counter is up for the 7th consecutive session in trade, and in the last 7 trading sessions, the stock has gained nearly 33%. Coming up with that, we'll also be speaking about Hind Rectifiers. That stock is flying up in trade. It's up more than 15% in trade today, and in the last 5 trading sessions, it has gained nearly 24%. And if you look at the volumes today, they are nearly 9 times its 20-day average. Apart from that, we'll be also talking about ITDC. Now, again, this counter is also up for 7 straight sessions and it has gained nearly 55%. Now, this is largely on the back of an exclusive story that we had done. So, what was that story and how will this help the company is something that you'll get to know on the show today when it comes to ITDC. And lastly, on Infobins Tech, strong volumes. The stock is up nearly 32% in the last 5 trading session. It was up nearly 15% in today's trade. What could be the potential reason? Let's try and decode that on the Small Cap Buzzers show today. Now, if you look at the markets, the Nifty, it has opened in green and it has managed to sustain those gains. We have been above the 24,000 level in trade today. And if you look at the sectoral indices, on that front, Nifty IT is the top sectoral loser, down around 2% in trade after TCS numbers. While on the gaining side, we have Nifty Auto and Nifty Real Estate, which have been buzzing in trade. Even the small and mid cap indices are in green today. But Varsha, which are the key stocks that have been buzzing when it comes to the small cap sector?
Well, let me start with India Bulls. The stock is buzzing, of course, on the back of volumes. There you go. This India Bulls is up almost, if I'm not wrong, 15 to 16% in trade today. But even Rosel Tech System is one of the stocks which is actually buzzing. DCM Shriram is up 11%. This is, of course, on the back of volumes, I would say. Even there you go, Rosel Tech is actually up almost 15%, DCM is up almost 4% in trade. Aztec Life is up almost 9% in trade, of course, on the back of volumes of its 30-day average. There you go, the stock is actually up 15% as of we speak. Som Distilleries is also one such stock which is actually buzzing in trade, is up almost 9%. You have Unimec Aerospace also buzzing in trade today. The stock is up almost 8%. It has come off a little bit. The stock is up almost 4.5%. But one stock which is in focus is, of course, Dhanuka Agritech. Now, a lot of things are actually happening in this company. This company is moving towards value-added products. Even they bought some of the portfolio of buyers also, which is expected to contribute to the revenue in FY27 and going forward. But to speak more about the growth outlook for next 2 to 3 years and how Middle East crisis will be impacting the company, we are here joined by Mr. M.K. Dhanuka, who is chairman at Dhanuka Agritech. Mr. Dhanuka, welcome at NDTV Profit and always pleasure to have you. Let me start with the ongoing impact on Dhanuka Agritech of Middle East crisis that we are seeing, because considering the increase in the raw material prices, will this have an impact on margins? And overall, if you could update the impact of Middle East crisis on Dhanuka.
You see, all the agrochemicals are derivatives from specialty chemicals, and specialty chemicals are dependent on crude. So since crude prices has gone very high, so all the specialty chemicals prices have increased. For example, ammonia from $450 it has gone to $700. For example, sulfur from $250 it has gone to $750. All the other specialty chemicals, benzene, xylene, toluene, etc., which are used for manufacturing of technical grade pesticides, they have gone very high. So in some of the molecules, the increase is up to the level of 40 to 50% level. So when there is huge increase in the prices of raw material, ultimately the technical grade pesticide has increased and the brine prices have also increased. So we are passing on the price increase to the customer. Usually we are passing the price increase once in a month, but this in April, we are passing in second time. From 1st April, we increase the prices, and from 16th April, again, we are increasing the prices.
All right. And also, sir, last quarter you had given a guidance cut, but you were expecting FY26 to end on a flattish note. Considering the Middle East crisis, and you have seen the Q4, should investor expect a flattish FY26, or you're seeing some kind of degrowth considering the war situation that we are in?
We are expecting more or less flattish year. There can be 0.5% here and there. Otherwise, it is a flattish year for Dhanuka Agritech.
And sir, what about margins for FY26 and beyond? If you could just give us the ballpark range.
We had 20.47% EBITDA margin in FY25, and we have given 125th reduction in the EBITDA margin this year. So we hope that we will be able to maintain around 19.25% margin for FY26.
And sir, since we are talking about the financials, what about FY27? Over FY26, would we see the double-digit growth, or what are the targets for FY27 considering the revenue growth and of course margins?
Yeah, definitely the price increase is going to happen, so that itself will give increase in the revenue. So definitely we are expecting double-digit growth in FY27, and we hope that the margin should remain in the range of around 19% EBITDA margins.
Okay. Also, if you could just take us through what the number of product launches that you're eyeing for FY27, and what could be the revenue contribution from these new products?
We are going to introduce two new 9(3) molecules, which will be first time introduced in India. They will be the fungicide. One is for grapes and another is for horticulture crops. So these two 9(3) molecules. Apart from that, Me Too products, 2 or 3 Me Too products, which are 9(4) products, that will be also launched in this financial year.
Right. And sir, also, what is that you are also venturing, or rather I would say you ventured into the value-added products as well. What's the current contribution of value-added products, and where do you want to take this number to?
You see, value-added product means specialty molecules basically, and specialty molecules we have a share of around 50% in our top line, and we hope that we will maintain this share of 1% here and there. Otherwise, we will maintain the share of around 50% specialty molecules.
Okay, got that view. Also, sir, talking about your facility in Dahej, so with Japanese and Europe companies visiting Dahej, how material could contract manufacturing be, relative to your captive consumption? Just wanted to understand the revenue contribution from contract manufacturing that you want to take to for next 2 years.
Frankly, till now, no contract has been signed with any of the Japanese or European companies. Presently, we are manufacturing for mainly domestic market. We have applied for registration in various countries for export for bifenthrin technical and difenoconazole technical, which we are manufacturing at Dahej. And once we get the export registration, then we will be able to export these two technical grade pesticides from Dahej unit. But presently, we are marketing in domestic market. And thirdly, Ipro Valley Carb Technical, which we are right now importing from Bayer, Germany, that we will start manufacturing at the Dahej unit in the current financial year.
On that Bayer portfolio, just wanted to understand, in this year, that portfolio will contribute almost 30 crore revenue in FY26. What's the, when it can contribute meaningfully, if you could, give us the timelines?
You see, we have arrangement with Bayer Crop Science to market on behalf of Dhanuka in various countries till 30th June 2026. From 1st July 26 onwards, the revenue will start coming in the Dhanuka's books. So we hope that Bayer products will start significantly contributing in Dhanuka's top line and bottom line from 1st July onwards, and we hope that we will be able to do around 175 crore business for Bayer products in the current financial year in Dhanuka books.
Right. And sir, for FY27, you mentioned that the EBITDA margin that you're expecting hovers around 19%, but considering the Bayer's manufacturing shift from Germany to India, wouldn't your margins should inch up at least in FY27, or you're expecting that inch up in FY28?
it will happen in 28 because it will take time to basically make the modification in the existing plant to manufacture the Ipro Valley carb. So it will happen at the end of the financial year. So major benefit will start coming from next financial year only.
And sir, you also mentioned about international revenue contributing to your top line. When can you see the meaningful revenue from exports?
Once we get the registration in various countries, only then it will start happen. But from buyers' product, we will start getting a significant contribution in the current financial year only.
Got that view. Well, thank you so much, sir, for joining in and having a conversation with us, and all the best for the business.
Thank you, Vaishali. Thank you.
Thank you so much. This was Dhanuka Agritech expecting a flattish kind of revenue growth when it comes to FY26. But with that, let's also invite the guest for our show today, who is Girish Sodhani, co-founder of Ensure Capital. Girish, you heard the management of Dhanuka Agritech. What's your view on the same?
So, yes, the overall fundamentals was very strong in the term means. The valuations, the PE ratios are a little bit more cheaper in the term means of sector overall valuations. But in the shorter period of times, obviously the companies come into the pressures because of the margin reductions, because of the geopolitical situations currently going on. But we don't forget about that the overall scenario is very bullish in the longer period of time. For the next 2 to 3 years time frame, I think the companies are strong into the bullishness of EBITDA margins, approximately 17 to 20%. That would be very attractive in the longer period. And come into the revenue targets of the 2300 in the financial year 27 and just go beyond that approximately a growth size of around 19 to 20% on a year-on-year basis. And the Bayer integrations, the companies contributed 60 to 70% on the Bayer product lines. So this is also gives a strong good size. And the stocks currently what the company already holds in the cheaper rate and going to be expanded in the next 2 to 3 months down the line once the ceasefire is going to be expandable. So I think the whole scenario is very positive for the Dhanuka Agritech. But for the completely a longer period, at least go beyond for the next 2 to 3 quarters itself.
Okay. Right. Before we move on to our next talk, let's get in Puneet to understand how things are shaping up when it comes to the F&O side. 24,000 and up, Puneet?
Well, most certainly. And you're seeing, of course, the Sensex leading a lot of those stocks in the gains. Asian Paints was one of them in the morning, continuing to do that as well. But ICICI Bank, M&M also showing you the trend today. So barring the IT players, as well as on Sun Pharma, where the big acquisition is having an impact, potentially big acquisition is having an impact on the stock today. You are seeing a larger screen which is green in color, of course, and leading that gains is, of course, Trent, Axis Bank, Bajaj Finserv, amongst others. Now, when you look at the longs in terms of which are being built up in the system now, Adani Energy as well as Sona BLW are a couple of counters which are seeing strong buying today in the BSE F&O setup. You're also looking at short coverings of stocks, again in the auto pack, where yesterday was a day where you saw some selling. Today, buying yet again coming in. Shorts which are built in the system for all these players are now being covered as well as we speak. In terms of longs being unwinded, you're seeing stocks like SAIL as well as NMDC where gains have been built over the last few weeks and now profit being taken off the table. And finally, in terms of shorts which are being built up, fresh shorts being built up on stocks like Sun Pharma as well as on Coal India, and we'll put more focus on Coal India and India Market Close, are also some of the key stocks which are in focus today as part of the BSE F&O setup.
Thank you, Puneet, for that. But let's go across to Varsha to understand what's been buzzing when it comes to AGI Infra.
Well, considering the AGI Infra, the stock is up almost 3% in trade, though it has come off a little bit. But if you see, the stock is up for 7 consecutive sessions, up 33% in the last 7 sessions. And on the recent news, they recently got approval for development of group housing colony, and the project land parcel measures 10.26 acres, and which marks company's maiden project in New Chandigarh. But talking about their ongoing projects, they have total units under development of around 5,854 Even mature projects are nearing completion. Onto the upcoming projects, they're expecting major launches, which include the Utopia, that the new Chandigarh project. Also, all upcoming projects are 100% owned, and the completion horizon extends to FY31 to 32. Onto the project mix, premium and luxury housing, dominates across completed and upcoming. Even affordable housing is meaningful when it comes to their legacy pipeline. Onto the sales visibility, the ongoing projects already has 52% sold by area, and the significant unsold inventory provides medium-term revenue runway for the company. And lastly, on the long-term vision for this company, they are expecting PAT margins to be around 20%, and they are also focusing on execution-led growth over land aggregation. Girish, what's your view on the AGI Infra? And considering the upcoming projects that the company has, and also what's your view considering on the overall sector when it comes to the infrastructure?
So currently the infrastructure is now into the focus because major of the projects are going to be completed. Come to the AGI now. They have recently released a Mohali agricultural housing project. Acquisitions are currently working on the reality projects of the 30 crores acquisitions. Successfully completed, there are almost 3 to 4 project lines down the line in the next 2 quarters itself. So overall, the infrastructure companies are strongly believed of in the next at least 1.5 year time frame. Come to the AGIs right now. The AGIs looks very attractive, not in the technical propositions because the stocks are already running from the last 3 to 4 sessions very strongly, but completely based on the fundamental terms, the growth numbers are very attractive. Exceptional margins are coming out, so almost 43% above the margins in the year-on-year basis. Reportedly, profitability was a net profit approximately 30% plus. So the overall infrastructure was very attractive, but the AGI is looking more attractive because recently there's so many news for the new infrastructure products.
Right, the next stock that is in focus is Hind Rectifiers. The counter is up nearly 16% in trade, and this is largely on the back of very strong volumes. And overall, YTD basis or even in the last 1 month, that stock has been managing to report gains despite the weakness that we are seeing in the market. In fact, in the last 1 month, the stock is up nearly 14%, and on a YTD basis, the stock is up nearly 9% in trade, and today it's up nearly 16%. Let's get in part to understand what could be the potential reason behind this move that we're looking at in Rectifiers.
Thanks a lot, Somit. So, Hind Rectifiers manufactures power electronics and railway traction equipment. They are a big beneficiary of electrification and modernization push for Indian railways. The company's order book stands at over 1,000 crores as of December 2025, and the management is expecting strong inflows from transformers in the upcoming quarters. Moving on to the share stock performance, the stock has rallied and is up more than 15% today. In fact, in the last 1 year, the stock has gained over 70%, which is really interesting given how underperforming nature of the Indian markets. Recently, the company also issued a 1:1 bonus issue, which has improved liquidity of shares in the Indian market as well. In their recent press release, the company announced that their advanced copper conductors like CTC, PICC and EPICC are now commercially available. The company aims to sell these specialized conductors externally starting with the first quarter of FY27, and the in-house manufacturing of these specialized copper conductors are expected to not only boost cost efficiency but also improve the supply of those metals for the company. The management expects margin expansion from this move from the second quarter of FY27. Regarding their growth outlook, around 40 new products are currently in the pipeline, and the management is expecting the 30% growth to continue from the next year forward.
Right. Girish, have you looked at this counter Hind Rectifiers at the current valuations? Would you recommend this counter to your clients?
Exactly, the management commentary was very excellent. If we talk about the holistic growth in the next 2 to 3 quarters, looks very attractive. But again, there's a very strong concern about the debt and the leverage. Currently, the interest cost is much higher. In VK says that almost quarter 3 financial year 26 was 4.71 crores. So again, the debt equity is also going to be increased into it. So working capital required and due to the inventories as well as the receivables from the Indian railway project lines. So many concerns about that. So I'm not looking out very favorable as of now. But my suggestion is to just wait and watch for at least next 2 to 3 quarters how the management is going to be revised as well as the restructure on the debt propositions. Then I can share any particular point of view.
Right. Well, moving on, let's pull up ITDC. The stock is, if you see, the stock is up 55% in the last 7 days. Today, it's up almost 16% in trade. What's the reason of this buzz? Let's invite Mahima for all the details.
Right, so Varsha, overall the stock has been up in the past 7 session and has gained around 55% in the last 7 days. Basically, the company is into running of hotels, restaurants, etc., and is basically a company owned by Government of India. But the recent update that NDTV Profit reported via government sources was that ITDC's prime asset, that is the Ashok Hotel, is set to be taken up under the National Monetization Pipeline. This will be done by the private player route, and overall the plan is being discussed at the upcoming interministerial group meeting early next week. The government has also cleared the transfer of ITDC hotel subsidiaries to state governments as well. And total 4 subsidiaries slash hotel units will be divested as the part of this monetization strategy. Ranchi Ashok will be transferred to the Jharkhand government for 300 odd crore. Punjab Ashok to the Punjab Tourism Department for around 79 lakhs. Just 51% will be transferred here. And Jammu Ashok will be transferred over to J&K government at a valuation of around 11 crore. The 3 subsidiaries transfer is already in talks and is at an advanced stage. And the 4th unit, Odisha, is also at an advanced stage as well. So this is the overall view as to what's causing this rally coming into this counter.
Thank you so much, Mahima, for all the details. Well, Girish, 55% of gain in last 7 days. What would you advise to investors? Should they sell the stock, or the fundamentals are strong enough to be in the stock?
The fundamentals was very strong as of now. The tourism sectors is basically into the revelings because of the government positive initiatives by the Swadesh Darshan 2.0. I think this gives a strong build-ups to all the tourism sectors, especially the government one. So the ITDC is basically belongs to the government, but fresh allocation is not advisable. If you hold this particular stock, just wait and watch for the next good upside, but fresh allocation is not advisable.
Yet another interesting counter in trade, today's Infobeans. The stock is up nearly 16%. In the last 5 trading sessions, it has gained nearly 31%. In the last 6 months, it's up 45%. Despite the stock has come down from its 52-week high of 250 rupees, I believe. In the last 1 year, the stock has still managed to give a good return of nearly 150%. What does the company do, and what could be leading such gains in the counter? Let's get in Jasmeet to understand the same.
Well, Samir, thank you for that. It's quite interesting stock, to be honest. Mid-cap IT firm. Let's quickly understand what does the company do. Well, company operates into digital transformation service where they provide the AI-led and IT services to clients across BFSI and other segments. While company operates basically in US, UAE and India as well. Now, with this counter, why is it interesting is because where we see overall IT is tanking on the back of the AI fear, this counter has managed to stay up in last 6 months and over 1 year as well. Let's quickly understand the stock performance for something like an Infobean. Now, the overall stock is up 31% in the last 5 days, while the volumes currently are about 6 times. That's why the stock is buzzing in trade today. In terms of the 6-month performance, the stock is nearly 45%, but on Y20 basis, it's slightly 11%, but still better than the rest of the IT players in the market. Over a year, the stock has really rallied 140% on the back of that positive up move coming in terms of the revenue. Let's quickly understand the recent news in the stock counter, what the company has posted. Well, they do flag that the overall Iran and Israel war has slight impact on them. At this point, they don't see any impact, but they see if the war continues, they might see the impact on the overall performance. Given roughly 7 to 8% of the revenue comes from this market, but they also restate that the core market, that's the US, that remains intact and the revenue from there continues to grow. Lastly, they also said the prolonged conflict may delay the overall deal wins that they have in that area as well. Now, let's quickly understand the key financials particular counter. The company has had a good financial record in the back where they have gained consecutively in the last 7 quarters in terms of the overall revenue expansion. Further, the revenue and PAT both have been growing sharply on YY basis as well, watch for Q3. Now, in terms of the overall line performance, stock has really reported a revenue of 392 odd crores and PAT at 65 odd crores. While we did see a margin pressure going into Q3 on the back of that overall new hiring, the AI investments, and also on the back of the overall wage hike that the company has been doing. While last year, in the geographical split, we do see that nearly 55% of the revenue comes from the US. So all in all, we do see a good performance from this particular counter. It's very much how the Q4 plans are going ahead.
Right. Girish, any view on this counter? Despite the weakness that we are seeing in IT stocks, this stock has been on an uptrend.
So there's so many reasons behind this. The companies are almost at zero debt basically. So I think that this is a very strong push for these type of IT companies, mid-sized IT companies, we can say that. And again, the strong sentiments from the AI-driven product launch. They are recently launched at the Insanse SDD accelerator programs. Basically, it's a completely AI-based program. So there's so many strong build-ups for the overall geographical locations. Currently, they are working into the US and the Europe of approximately 85% plus of the market share. But in the last 2 quarters itself, they have diversified their portfolios from the West Asia's countries of approximately 7 to 8%. And the retention of their clientele was very much high. So overall, the strong fundamentals looks very strongly. But currently, the stocks are already performs heavily from last few sessions. So I think this is not a fresh entry propositions currently at this levels. But if you get the chance of around 150 or 155, that would be very attractive levels for the next 1.5 year time frame.
Well, thank you so much, Girish, for all the details and having a conversation with us. It was a pleasure to have you. Well, viewers, this is all the time that we have on this edition of Small Cap Buzzers. Stay tuned to NDTV Profit.
केसरिया से मन जोगी हुआ रे दिल झूमे देखो पतवारा हुआ रे केसरिया से मन जोगी हुआ
हर पल मनाओ केसरी त्योहार विमल बोलो जुबान केसरी
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversations.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
कुछ खास होने वाला है।
The government has a very focused, very intelligent, very smartly devised policy for renewable energy. We combine that with the Indian talent for innovation. With these faculties that we have, I believe that anybody can follow to success.
As we say in the climate word, we need all hands on the deck for any sustainability solution. And NDTV joining this robust voice makes all the more difference to India.
Presenting the all-knowing, all-powerful Tech Guru.
Whoa. Guru? I'm no guru.
Okay.
I'm just a guy who loves his tech.
A show where the mysteries of megabytes and motherboards shall be unraveled.
Bro, nobody talks like that anymore. This is all about connected ecosystems, EVs and AI that you can use in your daily life. That's what we do on Tech 360. Real talk, real reviews, tech that you can actually use.
Tech.
Hello and and welcome. You're watching Ask Profit, the afternoon edition. I'm Mahima Vacharan, and with me, as always, is Puneet Zaveri. Before we start taking your stock-related questions, let's take a quick look as to how the markets are doing. The Nifty is still trading with 270 odd points gain, trading at its day's high point as we speak, up by about 1.1 odd %. On the Nifty 50, the top gainer still continues to be Asian Paints, followed by Eicher Motors, Bajaj Auto, ICICI Bank, Shriram Finance, M&M, Trent, SBI, and Tata Motors. But something that's really taken a knock today is Coal India, which is seeing a downtick of around 4.2%, followed by Sun Pharma, which continues to be down by about 3.7 odd %. Infosys, TCS, HCL Tech, Tech Mahindra, all IT names continue to be under pressure. Let's try to quickly pull up the sectoral heat map to see as to how sectors are faring at this hour. IT continues to be under pressure, down now by about 2 odd %. Pharma has now, slipped on the green side, up by about 2.2 odd %. But the Nifty Auto continues to be the top gainer, up 2.8%, followed by Realty, Media, as well as PSU Bank. So we're banking names doing fairly well. The Bank Nifty also, in fact, is right now trading at the 55,900 levels. Another 100 points of an uptick is what we've seen in the last half an hour or so. 11,000 points of a gain is what we're seeing on the Bank Nifty. Let's quickly pull up the advanced decline ratio to see as to how the broad end of spectrum is doing. The last couple of hours, we've seen some widening when it comes to the advanced decline ratio, but throughout the day, that almost 11:1 ratio has been maintained, Puneet, because the broader end of spectrum is doing slightly better as compared to where the benchmarks go.
And that seems to be the picture that's developing, right? Because already the small cap index is outperforming the benchmarks post the recovery. So maybe just before the results season starts, I think we could see some expectations being built in for the small cap names. Very beaten down, of course, much more than the large cap and the benchmarks, but continue to monitor all of that. The BSE 500 also very quickly, if you can pull that, because you're seeing a 1.5 to a 1.8% up move, both on the mid cap and the small cap index. And New India Assurance up almost 20%. Cohance Life, actually, after a really long time, seeing an 18% up move today. So is Avanti Feeds up 14%. Orient Electric up 7%. So Adani Energy, Sona, BAW, some of the key stocks which were much beaten down before the Israel-Iran war too, are seeing some massive gains as well. But let me welcome in Avinash Gorakshankar at this point of time of the show. He is, of course, the fundamental analyst for the day, founder and head research analyst at Avinash Mentor Research Services, as well as Ruchit Jain, the vice president equity technical research at Motilal Oswal. The gentlemen, both of you, thanks so much for joining in. Ruchit, a very quick check of where we are on the benchmark, because we seem to be not finding any kind of support at 23,800. Is it now building in over the last couple of days, gives you confidence that this could sustain in the near term?
Yeah, hi, very good afternoon to everyone. Well, the kind of support that the broader market is giving in this up move, I think that really encourages. And we have seen that last 2 months when the entire market corrected, the main factors behind this correction, one was the crude oil, which of course tracks the war as well, and second was the INR depreciation. So last 1 week or last 10 days, we have seen a complete reversal in the INR, so which turned positive. And last 3-4 trading sessions, the Brent oil, which was around 108, 109, that is also comfortably trading below 100 levels. Of course, from that average of 60, we are still high, but I think markets have somewhat factored in this price rise. So I think until we see any kind of reversal or any kind of sharp up move coming in crude oil again, I think markets have taken it positively. Also on the weekly charts, 22,000 was the weekly 200 EMA. And this low, if you see the recent low, is just around those levels itself. So I think overall market should do well. The 50% retracement of this entire downfall that we have seen is placed around 24,250, and 61.8% is around 24,750. So I think market should at least retrace towards that 61.8%. So in the near term, 24,750 should be expected.
Okay, all right. So that's the view coming in with regards to where the benchmarks go. But let's start taking your quiz. The first one is coming in from Bhaskar, who's writing us from Bengaluru, asking about Lupin. His buying price is 2178 and 42 shares is what he's bought. Wants to know whether to sell or hold from a short-term perspective. So Ruchit, I'll stick with you for this one. Lupin, what are the charts indicating?
Overall trend is positive for the stock, and also it has been a relative outperformer within the pharma basket. So continue to hold on your existing positions. If you're a trader, then keep a stop loss below 2220.
Got that view, Ruchit, and thanks so much for that. Let's go across, take our next query now. This one's coming in on MCX. Our target is what's the question here. Avinash, we've seen gold actually come off the highs, and now expectation is that so will oil. So how do you view MCX at this point in time? Because we saw in the Q3 as well as Q4, the expectation, of course, is of a very decent performance based on volumes. But is there any impact of commodities coming off from the top on MCX according to you?
See, I think, Puneet, my guess is that, as a platform, MCX is very strongly positioned. I don't think, there could be any kind of margin pressure. In fact, volumes saw a very strong increase in the last quarter. And I think, most importantly, as the volumes grow for a particular commodity, that actually helps the exchange make more money. So my sense is, I think numbers for Q4 should be decent. I think the growth momentum continues to be on track. And I think hopefully the current year also should be equally good for them. So I think, from a longer term perspective, if one were to buy the stock, it's better to buy it in a staggered manner. But definitely structurally, this is a very long term kind of good opportunity. But yes, I think one can always buy in bits and pieces and stay invested, for the next 12 to 15 months.
Okay. The next one is coming in on Shelly Engineering. Our viewer V. Murli has bought it at the levels of 1980 from a short-term perspective of 3 to 6 months. Wants to know as to what the charts are indicating. Ruchit, Shelly Engineering, what's the view on the charts?
So not that positive. 1800, 1770 is the next support zone for the stock, which could be tested. And you can see that last 7-8 trading sessions, in spite of such a move in the broader markets, the stock has corrected from 2400 to below 2009. So if it's trading better, then I'll advise to take an exit.
Okay, an exit that's Ruchit is recommending on Shelly Engineering. Let's go across, take our first caller for today. This one's from Andhra Pradesh, and Pramod has a stock query for us. Pramod, good morning. Welcome to the show. What's your query?
Good morning. Actually, I have shares of Gravita India. The quantity is 30.
Okay.
I bought it at 1540 rupees.
Okay.
The query is actually, I want to buy more actually. With the perspective of, I want to hold it for next 5 to 6 years.
Okay, 5 to 6 years. Got it.
Yeah, should I add I want to invest large sum of money into this stock. So what's the upside potential for this stock?
And any
for,
particular reason, Pramod, that you're very bullish on Gravita at this point of time?
Yeah, actually, I'm thinking recycling would be much more growth stock. It's not yet touched. It's still potential is not unleashed, I guess.
No, perfect, Pramod. That is one of the key spaces also that we are also watching out for. But most certainly a very logical step that you are taking in this direction. But how do you view this, Avinash? Because we've seen Gravita being one of the most preferred players. I think in the valuation metric also commands that valuation. But you have a couple of smaller players there. In this space, what's your preference?
No, I think clearly, I think the recycling space is gathering more and more momentum, and even the government is supporting it. As far as Gravita is concerned, I would say that, the fourth quarter should be a decent quarter. But I think, the investor wants to allocate a large sum of money. It's always better, Puneet, to deploy money in a staggered manner. And I think looking at the kind of market volatility, it's always better to, not put all your investments in one shot. So basically, maybe you could try and put, say, 20-25% of the funds now and wait for some more time. After the Q4, there could be better clarity. The stock is not going to run away because, we have seen the stock giving multiple returns in the last, 2 years. So growth momentum will continue, but at these levels, valuations are not cheap. They're fair to expensive. So the next 2 years are going to be interesting, much stronger. So I would suggest him that he should buy in a staggered manner and stay invested.
Okay, so that's the view coming in on Gravita India. The next one is coming in on IDFC First Bank. This is from Soumya, who's writing us from Bengaluru. She's saying that, by the way, she's sending us a query for the first time. So thank you so much, Soumya, for staying tuned. She's got 500 shares bought at the levels of 75. Currently sitting on a loss of around 400 odd rupees. Wants to know as to whether this is the right time to average sell or hold from a short-term perspective. Sorry, her loss is right now around 4,000 odd rupees. So Ruchit, what would you recommend for IDFC First on the charts?
So the stock has been an underperformer within the banking space itself. So when the pullback move that we are witnessing along with the volumes are not supported by along with the markets are not supported by high volumes. So take this such pullbacks as an exit opportunity. So I won't suggest averaging now. In fact, this pullback should be used to lighten up.
The next question actually is coming in from Anand from Bangalore. He's been waiting for his question to be picked. And Anand, we do try to take as many as possible. Sometimes we do miss a few because of the
traffic.
Sorry?
The traffic
coming in. Yes, you're right. But we finally managed to take a question, Anand. His question is on Karnataka Bank. He's bought it at 190 and asking what he should do in the present situation. Should he add more or sell or hold is something that he can consider. He's not mentioned if it's the time frame, but he's sitting on almost profits of 60,000 rupees. Avinash, what would you recommend on Karnataka Bank?
No, I think he should hold on. He's got in at a very attractive level, and I think the bank should come out with a decent set of numbers in Q4. My sense is, rather than looking at adding the stock immediately, it's better that he waits for the Q4 numbers. I think numbers should be good, but I think that would give him a more amount of conviction. And, we could come to know what the bank plans to propose in the next financial year. So I think fresh buying advisable only after the Q4 numbers. Until that time, continue to hold. I think structurally the story looks good, but I would prefer that he buys at a slightly lower level so his return gets better.
Okay, all right. The next one is coming in on Narayana Hrudalaya, and this is from Sijo, is writing us from Qatar. He's bought 5 shares at the levels of 1670. Wants to know if he can go ahead and add more on average at the current levels. His time horizon is the next 3 years, sorry. And he says that he wishes to add 45 more shares. Avinash, would you recommend that?
Yeah, I think Mahima, if the investor has at least a 12 to 18 month time frame, Narayana Hrudalaya is a well-established hospital play, and I think most importantly, the kind of management bandwidth, expertise which the hospital has delivered, I think that is something which is not reflected in the numbers. So definitely a good play on the hospital sector, but time frame needs to be at least 12 to 18 months.
Time frame needs to be 12 to 18 months is what Avinash recommends. But the next question, it's on Eicher Motors. Our viewer KK actually has sent us a query. He's holding shares at 4615. So sitting on a massive profit of 22 lakh rupees on this counter. He's holding 800 shares also. So he bought it at the right time, bought the quantity also necessitated. So KK, many congratulations to you. And hopefully you could give us a call, tell us what you saw in the stock at that time as well, because very interesting that you bought it at 4615, because the move had just started after pausing at 36,000, then 3,600 now post the bonus amongst and the split, but a massive gain there of 22 lakhs for KK. He wants to know, Avinash, if he should still continue to hold. Now we've seen today also the stock buzzing. They just announced the electric vehicle bike launch under Flying Flea. How are you seeing this counter now?
No, I think he should continue to hold, Puneet. He's gotten at the right entry level, and I think auto sector, the tailwinds are very strong. I would say that not only the Q4, but even the current financial year should be very solid for them. The Royal Enfield business is growing very rapidly, where they enjoy a market share of almost 80%. And this new vehicle, I think one will like to see what kind of response it gets on the road. But definitely, I think at these levels, if he's not requiring any emergency funding, then I think he should hold on for the next 12 to 15 months. Some further re-rating definitely looks possible.
Got the view. The other question also that's coming in now, it's on EMS Limited. Our viewers bought shares at 289 and 50 shares is what Varun is holding. He's asking what's the long-term perspective of Avinash, given for the water management sector as a whole. We've seen, bouts of outperformance here, Avinash. What's your view on the stock now?
No, I think he should hold on. Water projects have now again started in a very strong momentum after the government has allocated fresh funds to the Jal Jeevan kind of initiative. And I think you could see a lot of traction in the coming financial year. I think for the last 1 or 2 quarters, almost all the companies in the water segment were affected because disbursements had become extremely slow. But I think going forward, FY27 should be a lot better. So I think, keep the faith and hold on for the next 12 to 15 months. You could get a significant risk reward in the next, say, 12, 15 months. So continue to hold.
Okay, all right. So that's the view coming in on EMS Limited. I think we've got our next caller. Karthik is calling us from Bengaluru. Karthik, hi, a very good afternoon to you. What's your query about?
Good afternoon. My query is on MTAR Technologies.
Okay.
I just wanted to check, is it the right time to invest for a long time? I'm looking at 2 to 3 years.
Okay, sorry. Karthik, this is from a long-term perspective or did you see the charts?
Yes, it is for the long-term perspective, for 3 years.
Sure. Okay, 3 years. Okay. I'll take this up with Avinash then. Avinash, MTAR Tech, what's the view like?
Yeah, I think he can definitely look at accumulating the stock, considering that he's thinking of the next 2 to 3 years. But I think, rather than putting everything in one shot, try to allocate funds in a staggered manner. The stock is not cheap, but I think they operate in very niche areas of defense and nuclear energy and has a very strong order book. So I think clearly if you buy, say, 20-25% now, and obviously, then stagger the buying, that would give you a better alpha over the next, say, 2 to 3 years.
That view, Avinash, but continue to look at some more stocks, and viewers, if you haven't already, do start sending in your queries as well. The next question coming in is on IRFC, bought by Siva. He's holding shares at 200. What should we do with this now, Ruchir? Because, of course, much away from the buying price. Would you recommend averaging right now?
Yes, I think some averaging can be done. The momentum readings are oversold, and we have seen signs of bounce back from its monthly 50 EMA, which is there. Can expect an up move back towards this resistance of 110 to 112 zone. One should again take a review again around those levels.
Yeah, all right. So that's the view coming in on IRFC. The next one is an interesting one. I don't think we get a query on this very often. This is from K. Parthasarthi, who's writing us from Chennai. He's holding 100 shares of Balmer Lorry, bought at the levels of 218. Wants to know if he can hold, add or sell the target that he can expect in the next 6 to 12 months. Rujit, I'll stick with you for this one. Charts for Balmer Lorry?
Has been in a downtrend. Some pullback move has been there in last 4 or 5 days, but no volume pullback is there. So it doesn't seem that we would see any kind of significant run-up move. 180, 182 remains a very strong resistance, which was the previous swing high. So avoid any kind of bottom fishing over here. If you have existing positions, any pullback towards 180 could be an opportunity to exit.
180 to watch out for on this particular counter. But another question now, and caller from Bengaluru, actually, Nikhil has a stock query for us. Nikhil, good afternoon. Welcome to the show. What's your query?
Hi, everyone. So I think my query is a bit different. So I have my savings around 8 to 10 lakhs, and I missed the rally. I mean, the bearish market in the last few weeks.
Okay.
But now I have my watch list on few stocks specific to Eternal, KFin, CAMS, and Delivery. I just want to know where exactly I can deploy. If yes, then do I have to stagger my investment, or can I do a lump sum?
And Nikhil, do you have any other stocks apart from the ones on your watch list? Any other stocks do you have currently in your portfolio?
No.
No,
I most into mutual fund, not into
Okay, mutual fund. All right, got it. Avinash is a very interesting one. Eternal has been down in the dumps and not yet participated in what we've seen in this rally from 20 to 500 odd levels. But on Eternal, KFintech, CAMS, and Delivery, any view on either of the stocks if it's good for Nikhil to add in a staggered manner?
Yeah, I think Eternal or maybe CAMS can be added, but again in a SIP approach, I think he has 10 lakhs. He said, I think there's no need to invest all the money at one shot. Maybe 20-25% allocation. I think CAMS or for that reason, Eternal, both are good companies if you are taking the next 2 to 3 years kind of time frame. So you can start with these companies. I would say that even look at some public sector banks, private sector banks, some consumption names like Varun Beverages. These are names which are expected to post a very strong fourth quarter number. And I think the long-term trajectory in these companies is pretty solid. So probably, it could be a mix of all this.
Okay, all right. So that's the view coming in from Avinash. But Avinash, as well as Ruchit, it's time for a rapid fire round. Try to keep your answers as short as possible. The first one is coming on Clean Science. Our viewers bought 800 shares. Wants to know if this is a good time to average from a 3 months perspective. Enough data on the charts, Ruchit, for this one?
Trend is still negative, so avoid.
Coal India, we've seen cost being escalated in the near term as one of the reasons why the stock is down today. But a 1 to 2 year view is what Ravi is asking Avinash.
No, I think she should hold on. No fresh buying advisable. I think, because this news is negative, but that doesn't mean that's the end of the road.
Okay, so Sundaram Fasteners is the next one. 300 shares bought at levels of 930. Hold or sell, Ruchit, on the charts?
Can continue to hold at current level.
Keynes Technologies bought at 5,600 by Subramaniam. Avinash, should he average down right now?
No, I think better to wait for Q4 numbers.
Shriram Finance, from a long-term perspective, can I buy at this rate? Avinash, your view?
Yeah, definitely. I think longer term should add a lot of value.
The next question coming in now, it's from on TCS actually. A viewer, Anup Mishra, holds shares at 1,500, so he's walled way back. Stocks trading at 2,500 now. Now, Avinash, should he still continue to hold this counter?
No, I think you should hold and even average. I think keep a time frame of 2 years.
Okay, between EIH and Indian hotels, what would your pick be, Avinash, in the hotel space?
I think we would prefer Indian hotels.
Shri Renuka Sugar bought at 28 by our viewer Ismail. He's holding 600 shares. Any view here, Avinash, from the long-term perspective?
No, I think avoidable.
Okay, the next one is from Sikumar Nair, who's asking about Heritage Foods. 50 shares bought at the levels of 412. He's sitting on a loss of 35%. Should he exit or wait, Ruchit, for recovery of his losses?
Keep a sell on rise approach around 380, take an exit.
Federal Mogal also, Ruchit, I know it's a stock we don't discuss too much, but V. Murli wants to know about his shares bought at 461.
Again, keep a strategy to exit on pullback moves. 480 is the resistance.
Codium IVF, Ramesh from Bengaluru wants to know if this is the right time to enter this counter. Avinash, any view?
Yeah, I think if the investor can wait for the next 12 to 18 months, it's a good opportunity to invest money here.
TVS Supply Chain bought by Shankar at 102. He's holding 250 shares. And Avinash, it's been in a corrective phase, right, since its listing. Any view on the stock now?
So I think again, stock should be held on. I think keep a time frame of at least 12 to 18 months.
Okay, the next one is coming in on, this is on CC Avenue. This is from Ashraf, who's writing us from Chennai. Wants to know whether from a long-term perspective, can you continue to hold this one or not? Avinash, any view?
Yeah, I think one can hold on.
Next one's from Lalita. She's holding Motherson Sumi wiring at 45. Should she average down now, Avinash?
Yeah, I think one can average at the current level, but keep a time frame of at least 12 to 18 months.
Pearl Global bought at the levels of 15.99. 100 shares is what Supriya has been holding. Should she continue to hold? Ruchit, your view on charts?
Exit on pullback moves.
Okay, that brings us to the end of this rapid fire round and Ask Profit for this week as well. Avinash, Ruchit, thank you so much for helping us answer all those stock related queries. But viewers, like I said, completely out of time with this edition of Ask Profit. Do stay tuned. India Market Close up next.
केसरिया से मन जोगी हुआ रे दिल झूमे देखो मतवारा हुआ रे केसरिया से मन जोगी हुआ
हर पल मनाओ केसरी त्योहार विमल बोलो जुबान केसरी
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversations.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices.
And here's where you can watch us.
If you really want to see environmental action in India, we will have to revive community action.
How convenient you make it for somebody to choose a greener option, or how inconvenient you make it for them to choose a browner option makes a difference.
So we have eradicated road transport. Where we cannot replace it with the slurry pipeline, we are using this LNG or electric trucks.
कुछ बड़ा होने वाला है।
Presenting the all-knowing, all-powerful Tech Guru.
Whoa. Guru? I'm no guru.
Okay.
I'm just a guy who loves his tech.
A show where the mysteries of megabytes and motherboards shall be unraveled.
Bro, nobody talks like that anymore. This is all about connected ecosystems, EVs and AI that you can use in your daily life. That's what we do on Tech 360. Real talk, real reviews, tech that you can actually use.
Tech has changed. So should your tech show.
To understand the Tamil Nadu twist, join me in the midst of people, language and politics. Vanakkam Tamil Nadu, here we come.
When others are warming up, I'm raring to go. The stories that matter, the stories that shape your life.
Hello and welcome to watching Prime 5 with me, Raisha Sehgal. What's happening? How to
The show that sets the prime time agenda.
We'll be deep diving into this topic to tell you what's at stake.
Join me, Raisha Sehgal, on Prime 5 only on NDTV 24/7.
Very good afternoon. You're watching India Market Close, and the screen is just telling you one thing, that investors in their mind have moved on. Unless you're going to go back to a very, very escalatory kind of situation, the screen stays green. Alex, I just find it astonishing how we've stayed put through the day. Despite IT being a bit of a drag, the rest of the market clearly rejoicing, isn't it?
It's looking good. Let's pull up the intraday chart because we've actually come off just a tad bit in the last 5 to 7 minutes or so, but we still trade with 3/4 of gains, and you will take that at the end of the week. It's a positive screen. Pull up the Nifty 50 heat map because, and before we go to the broader markets, because this is a pretty good screen. It is nearly all of the constituents, about 39 of the constituents in the green, and you have Asian Paints that's up about 4%, the Flying Flea helping Eicher Motors go up by as much as 3%, 3.3%, and the private banks are actually doing reasonably well. ICICI Bank is up and about, you have Axis Bank that's up and about, HDFC Bank with gains of about 1.5%. So it's not looking like a bad screen, Tamanna.
Not at all. Just the losses are deepening. Sun Pharma, because of that acquisition, not being treated too well right now. Coal India sliding down is also reflecting some of the worries easing from the Middle East crisis, because Coal India was seeing a run-up because of the scarcity premium it would command. Infosys is sulking along with TCS. It's interesting that TCS's numbers are out, but Infosys is getting hit even harder. So is Tech Mahindra, so is HCL Tech. I mean, what really is the story there? The quarterly numbers were good enough, but the overhang and the worries about AI and all of these new updates like Mythos, etc. from cloud are clearly overtaking anything that you would see on their balance sheet or from the management commentary. I mean, that's the story over there. Just want to look at the Nifty contributors very quickly, and then we'll get you some of the highlights of what's been happening today. And it's all your IT pack which is coming down. If Infosys and TCS were also firing, this would be a complete rock and roll kind of a market today. Banks are making a comeback.
We should look at the broader markets as well and just pull up the intraday charts for the mid-cap index and the small-cap index before we look. And so you're seeing a little bit of a cool-off at the end of the session. I wonder if that accelerates a tad bit towards the end of the day, and also pull up the contributors for the Nifty 500 to see if anything stands out. You will see some pretty hefty gainers. New India Assurance on the back of pretty decent premium numbers that have come through. Cohance Life is seeing significant volume action as well. Avanti Feeds, Orient Electric, Adani Energy, a few big gainers from the broader markets, and not too much in the bay of big losers. These are all, a bunch of these are actually names that you saw for the Nifty 50. So CIL, Sun Pharma, Infosys, TCS, practically half the list is from the Nifty 50.
Correct. So, which is why the broader markets are doing better. So, here's what's happening. Of course, the upward trend crossing 24,000 continues for the Nifty, led by private banks. Sustaining above this will open the path to 24,300. The India VIX has slid below 19 for the first time since the 18th of March. That's important. The Nifty has gained nearly 6% this week and snapped a 6-week losing streak. It's the best weekly gain since January 2021. So it's quite an achievement of what we've seen in the last 3 trading sessions. The Bank Nifty has seen a structural uptrend continue, but 56,000 is a heavy resistance zone. It's a result-heavy week next week. BFSI names will dominate. There's ICICI Bank, HDFC Bank over the weekend, ICICI Pru Life, Lombard, ICICI Lombard, HDFC AMC, and of course Wipro thrown in there on the mix, which will report on the 16th. So all of that to watch out for very closely. But let's get on to our conversations. Nilesh Jain with us this afternoon, Head AVP Technical and Derivatives Research. G. Chokhalingam, Founder and MD of Economics Research, also with us this afternoon. Welcome to both of you. Nilesh, let me start with how you're seeing the upward trend of the Nifty. Is there still time to buy?
Very good afternoon to you, Tamanna. Good afternoon, everyone. Well, absolutely. See, first of all, if you see the volatility index in the weeks where we have seen a sharp cool off and it has corrected close to 6% today and it has slipped below 20 marks. So that is giving more comfort now. So whatever dip you'll get from here, that should be used as a buying opportunity. Nifty has already surpassed its short-term 21 DMA and it is facing immediate hurdle at 24,000. On the closing basis, if we get a close above 24,000 today, then it will be considered as a very strong close. And then probably we can expect a strong round of short covering, which will open upside towards 24,300 to 24,500. So overall, there are high possibility that Nifty will break 24,000 barrier decisively and move towards 24,500 kind of level in the coming week. So we remain constructive on the market, and buy and decline should be the strategy. Similarly, in the Bank Nifty as well, 56,000 is the immediate hurdle, and that's the strike on derivative front where we have seen huge amount of call writing. So call writers might run for the cover if it breaks above 56,000 decisively. So these are the two important levels we are keeping an eye on. But having said that, the overall broader structure remain bullish. Buy and decline should be the strategy.
Okay, buy on decline. So therefore, from that perspective, and that's the index level, Nilesh. What about stocks, individual stocks that you're looking at that are looking attractive at this moment on the charts?
Well, Alex, I have both the buy recommendation. First of all, Polycab, this particular counter is looking very strong on the chart. We have already seen a good double bottom formation, and now it has given a good breakout as well on the chart. So we expect a follow-up move to continue. On derivative front, we have seen a fresh OI addition of close to 5% today. So good setup on derivative front as well. So we expect a follow-up move towards 8,000 to 8,200. So these are the two targets on the upside. Keeping a stop loss below 7,550. Polycab can be added at current level and on declines. And apart from that, another counter we are liking, that's HDFC AMC. So overall, across all AMC space, all AMC stocks, we remain bullish. And HDFC AMC continues to remain our preferred bet for upside target of 2,800. One can keep a stop loss below 2,520, and it's a buy. So HDFC AMC will be another pick that can be added at current level.
Got it. Okay. Mr. Chokhalingam, I'm coming to you on IT because this is a big talking point today. And just a holistic view on the space, because it seems to be taking a bit of a battering, not just because of the TCS numbers, which the street is looking at maybe with a little bit of trepidation heading into FY27, but also from the perspective of the latest Mythos announcement. What do you make of it?
I think this is on expected line because AI threat is real. Only the magnitude of the AI threat, there is some difference of opinion, but threat is real, and instead of growing at 2 to 4% in dollar term, the revenue of IT sector is going to grow anywhere from 0 to 2%. That's what I believe firmly. So second, the short-term worry now for the stocks to fall is the reversal in the rupee exchange rate. We saw last couple of days it's improving exchange rate. There is a room for further significant improvement because I have been consistently saying that in the last 6 weeks, the war cannot continue for very long. There will be a lot of global pressure. A lot of small economies will collapse. So there will be a pressure to find a resolution. So I think worst is behind. There could be little volatility on any individual development news front from Iran or Lebanon, but the worst is behind us largely, and oil will further fall very badly, and rupee will improve, and that also would be negatively perceived for IT stocks. So I continue to maintain that the wealth creation story in IT stock is over. Even beating us, Sensex Nifty would be very difficult for IT stocks. So investors should look for some other sector to make decent equity wealth.
Come back to you on which sector you think that is, Mr. Chokkalingam. But let's go to the stock of the day, which is not Tata Consultancy Services. It is in fact Sun Pharmaceuticals, which is sulking in trade today because maybe it's gotten the prescription wrong. We've got Varsha joining in to tell you about why that is. Varsha, just perspective on this acquisition that seems to have spooked the street. What's it about?
Well, yes, absolutely. As you said, the stock is under pressure because of the wrong prescription, though. Well, this is down because on large acquisition news, well, market is cautious on $12 billion deal size, which concern about the debt integration and execution risk. Let's deep dive. The mega acquisition plan. Now, Sun Pharma Industries is planning $12 billion bid to acquire Organon and Company. Now, this would be largest global M&A by Indian pharmaceutical company. Now, the bidding offer is expected in coming weeks as per the media reports. Now, talking about why market is worried, what's the key risk? One is, of course, this is a very large deal versus size of Sun Pharma, and Organon, if you see, has a huge debt on its balance sheet, and also there are some weak growth in some of their segments. There are also integration challenges if I were to speak about globally, and of course the competitive pressure is seen in the generics and biosimilars portfolio. Also, the key factor over here is company CEO was resigned in October 2025 following an internal investigation related to sales malpractices, and acquisition also does not bring any strong pipeline of products for Sun Pharma, neither does it enhance the Sun Pharma's R&D portfolio. Now, but why Sun Pharma wants to buy it? What's the strategic intent? Of course, they want to move beyond generics and innovative pharma. They want to build global scale and branded portfolio which will strengthen present in women's health and biosimilar. But let's talk about the financial position. Is Sun Pharma capable enough of to buy Organon? So if I were to talk about net cash flow, stand at around $3.2 billion. Revenue of Sun Pharma is around 52,000 crore, but Organon has a high debt of around $8 billion and also facing competitive pressure. Lastly, if I were to talk about the business snapshot of Organon, they are into women's health, biosimilars, and of course some of the established drug, but the sales were impacted because of lower US government funding and of course the pricing and competition that the company is going through. So overall, the investor are not actually happy with the plans of Sun Pharma of buying this company.
Okay. All right. Mr. Chokkalingam, a quick view on Sun Pharmaceuticals. What's the view? Varsha has put it, I think, quite succinctly to talk about all of the headwinds that the company might face if it heads into this acquisition as is planned.
Yeah, if this materializes, becomes true, I would suggest, cut down the exposure to Sun Pharma. But one thing is very clear, the company has done phenomenally well. All of us know, ROC is too good, Profitability is very high compared to many companies, but no doubt about it. But the only concern is that, this $12 billion, when you convert in a rupee term, it is slightly above its whole total balance sheet of the company at present. So whether, by swallowing such a big assets along with the liability is going to suppress the ROCE, the chances are quite high. And second, Mr. Trump keeps saying that US consumers should get drugs at lower prices. And third, biosimilars have been under pressure in terms of realization over the last 3-4 years in a very big manner. So there are a lot of uncertainties suddenly emerge. Otherwise, this company is known for steady performer. So these uncertainties are giving cause of worry. And with a little bit of uncertainty about the pharma business in US, so I would be cautious. I would not exit the stock, but I would, reduce the exposure. That's my view on Sun Pharma.
Okay. Sun Pharma having a bad day. So are some of the IT companies, but it's not the overall story of the market. The market's fairly positive. And one company that has seen interesting news coming in is Anthony Waste. I'm speaking now with the chairman and MD, Jose Jacob. Mr. Jacob, thank you so much for speaking with us. Your company in the news because of this 750 million yen deal with JFE Engineering. Start by telling us a bit about it.
Yeah, so we won 2 contracts in Andhra Pradesh, one in Kurnool and one in Kadapa. And we'll be managing around 1,000 tons per day, generating around 15 megawatts power. And for which we need the state-of-the-art technology, and we chose to go with JFE, who will be not only an investor, but they will come as an EPC company. They have built around 250 such waste-to-energy projects worldwide, and they have been in the waste-to-energy industry for last 60 years. And that is one of the reasons we decided to go with JFE, and we believe that they can build one of the 2 latest technology plant in Andhra Pradesh.
Okay. What is the strategic importance of this deal for you? Because here you have JFE will take that 25%. How are you funding the 75% balance of investment?
So both the waste-to-energy project will have a total capex around 650 crores. Okay. And out of which the equity 25% will come from JFE and 75% from our company, and balance will come as debt.
Okay. What is the timeline like for this entire deal to go through?
So the deal is done. We have signed off, and the construction work will start somewhere in May 15th. And in 2 years, we'll complete the project. We'll start. Usually, it takes 22 to 24 months to complete, and thereafter we will start generating electricity and exporting. And the contract is for 20 years.
Okay. Hi, Mr. Jacob. Alex here. I'm reading that there is an extended timeline or wait for the generation of power to start. I'm reading it as 12 quarters. When you're saying 24 months, therefore, it's not 12 quarters, right?
Yeah, see, the construction phase is around 24 months.
Okay.
So the total plan to complete construction will be 24 months. Thereafter, we'll be generating power.
Okay, so it's not 12 quarters. I'm just wondering, why does it take so long? Why does it take 2 years?
So it's a power plant, it's like a power. So instead of having the power plant with coal, we'll be incinerating the waste. So it's waste of high calorific value. And the construction, and it has a flue gas system, everything. So typically it takes maybe 22 months, but we keep 2 more months extra. So around 24 months we complete.
It's actually, I think it's important to put into perspective why this is so crucial. Is it one of the first of its kind, at least, that this Japanese company JFE is doing, where you're turning waste to energy in India? What is that landscape like so far, Mr. Jacob?
So JFE will be setting up the first time in India. And
how much of this is being done right now in India, where waste is being turned to energy? That's the premise of it. And apart from how important it is for your company, just as a nation, it's very interesting that we are able to do this. How much of this is happening right now?
So we already have one of the first plant in Maharashtra, in Pimpri-Chinchwad. We are generating 14 megawatts, and we are managing around 1,000 tons of waste per day. There are few plants, but the technology took time to get stabilized. And now we all understood what type of waste our country produce, and we know what is the best technology, what is the best system which can take care of the waste. So in India, we have many cities where the population is more than 10 million, and these cities, all the cities have to manage their municipal solid waste in the scientific method. And the best part of waste to energy is you don't require large amount of land, typical thumb rule is a 15 megawatt plant to manage 1,000 ton requires not more than 15 acres. So that's the best part of this technology.
Mr. Jacob, just trying to understand, at the end of this 2-year period, when you will have these plants ready, what is the total generation capacity that you will end up with?
So each plant will generate around 15 megawatts, out of which 2 megawatt will be used internally and remaining 13 will be exported.
Okay.
And both the plant will generate, will export around 26 megawatt.
26 megawatts. And you said that you already have one plant in Pimpri-Chinchwad. So cumulative production capacity of power of how much?
So 26 plus another 12, you can consider that. So it will be 38 megawatts roughly.
Okay. And so the feedstock, so to speak, for these power plants, you're getting paid for this anyway, right? Because these are part of your waste management contract.
So we get, it depends on certain contracts. In Andhra, we are getting paid on per megawatt per unit. And also we are getting some VGF funding. And so certain municipalities, they give more VGF funding, some give us twin fee. And it's how they want to make the contract.
And this power that you are going to be selling, is it going to be through PPAs or is it going to be on the market?
In Andhra, it will be through PPA.
Okay. And so therefore, what is the revenue generation potential of these power plants?
So around 8 rupees 10 paise per unit, we'll be selling the power.
Okay. And if you were to map out, therefore, starting from the 25th month, and so therefore we're talking about 2 financial years from now, we're talking about FY29, right?
Yeah.
Right? So in FY29, what is the revenue generation potential? Where will that take your top line in a blue sky scenario?
So what we have calculated is for next, once the plant starts, the contract is 20 years. And it will generate a revenue of around 3,200 crores in 20 years.
Got it. Okay. Got it. All right. So obviously we're at the end of the financial year, Mr. Jacob, and so I'm not going to be asking you too many questions about the quarter gone by, but I'm hopeful that when we speak again, we'll get more insights and look forward to speaking to you then. Thank you so much for taking the time.
Thank you. Thank you. Thank you very
Appreciate it. Interesting update there. And it's not something that's going to turn into gold or power, so to speak, within the next few months. But
I think waste to energy is like waste to gold right now.
It is, absolutely. Especially in the context of the energy requirement that India has.
Correct. If this actually gets off ground and on a larger scale, think about it. First of all, our energy requirements, our cities create so much waste and garbage. If that can be used and recycled in a big way, so it's a huge story that is turning around. Nilesh Jain Chokalingam with us this afternoon as well. Choka, is Anthony Waste a company that you look at or you track in any fashion?
Yeah, I studied it. It's a good theme, as you discussed. It's a good theme to use waste to generate energy. The only concern is last 3-4 quarters, the margins have come down as much as from 21% to 16%. But otherwise, steady growth in revenue and profit, and capex also, fixed assets also gone up substantially in the last 4 or 5 years. Now with this development, I am sure it should be able to do well. So one can hold it. In case it falls, even 5%, one can accumulate because it's fairly priced now at around 21 PE. So therefore, I would give a hold rating, buy on declines.
Okay, buy on declines. That seems to be the trend for the market as well. Let's go across to Soumit Sarkar now, just to get you a sense of what he is hearing in the dealing room. This is our regular feature heard on the street. Soumit, good afternoon, and what are you picking up?
A host of stocks that dealers have highlighted in trade today. Firstly, when it comes to emphasis, the stock is down in trade because of the overall pressure that we are seeing when it comes to the IT sector. But dealers are indicating that there are some buy flows on the large HNI desk at the lower levels that emphasis is seeing. And this is because they expect that the constant currency growth for emphasis will be much better compared to what the street has been anticipating. Second is Titan. There are buy flows on institutional desk. Delivery volumes could be on the higher side for this counter. And for Reliance Industries, dealers indicate that there are buy flows on the DI desk. There was selling pressure from the FI desk, which is now over, and hence the stock could bounce from the current level. So keep an eye out for Reliance Industries as well. When it comes to Lind India, there are some buy flows on the PMS and the large HNI desk. Some positive news flow is expected largely here. And lastly, when it comes to IIFL Finance, there are buy flows on the large HNI desk. Dealers are expecting some positive news flow regarding the external tax audit that just got over last week. So some positive news flow regarding this. Now do remember when this news was out there was a tax audit that IT department had asked for. The stock had fallen more than 10 to 15% in trade. So keep an eye out for IIFL Finance as well.
IIFL Finance. All right. So interesting stocks right there. Just want to go across very quickly to Nilesh. Nilesh, any of these that stand out to you? Would you trade any of them?
Well, Alex, out of all the names that just mentioned, IIFL Finance could be a bet. We may see a follow-up on the back of a pullback trade because seems like it has formed a very good base formation. So we may see a follow-up more towards 460 to 465 on the upside. And apart from that, within IT space, I think emphasis and persistent system. So we may see some bit of a rebound going forward. So the broader setup has already turned positive. So any dip from here can be used as a buying opportunity.
Thank you so much, Nilesh, for joining us today. Choka, thank you so much for speaking with us. Pleasure to have you on NDTV Profit as always. All right, Rahul Arora, CEO of Ashika Institutional Equities, joining in on the conversation this afternoon. Rahul, this has been a week that's feeling like a month in terms of how many ups and downs have taken place, isn't it? The news flow going from extremely disappointing to extremely euphoric. How do you think we're ending off? Do you think right now the street doesn't quite care if there's a bit of skirmish here and there? The ceasefire holds as far as we're concerned?
Good afternoon, Tamanna. Thank you for having me on the show. A week that feels like a month, but a month that's moving a lot faster than March is for sure, which is a good thing, I think, in many ways. But I think that being said, Tamanna, the focus obviously is going to move to the result season. I think hopefully we've seen the worst of the war behind us. The resultant impact of what's happened over the last 40 odd days will linger. I think that effect will stay on for both the Q4 and the Q1 results. So it's a question of, how much results or earnings get downgraded by for FY27. And on that, what growth are you projecting for FY28? Because I think if you look at most of the sell side in India today, they're already valuing companies on FY28. There is value emerging. There's no question about that. Am I sitting here confidently saying that the worst is behind? I'm not so sure yet. But one thing is for sure, Tamanna, I think if we were having this conversation, say 45 days back, the street was probably working with a 16 to 18% earnings growth for FY27, predominantly driven by BFSI. I think that number now probably comes down to about 12-13%. So and this is another one of those fiscal years and this has probably been consistent over the last 10-12 years, ever since demonetization happened, where you start off the year expecting a certain growth rate for earnings and they get revised down. I think FY27 is not going to be a different year from that perspective. There has been a certain amount of rationalization and valuations, that's for sure. But I think that this is going to be a year where I would would say even if you go as far as allocating 25-30% of your portfolio to fixed income, debt, government securities, it may not be the most imprudent wealth allocation decision to make. So even if the worst is behind, I'm not expecting a runaway. I'm not expecting the market to make a new high this year. You may well have a situation where the Nifty retests 26, 27,000, but I think those levels are going to be very, very hard to kind of sustain. So probably looking at a broad range of 22 to 26,000 for the rest of the remainder of this calendar year.
Pretty broad range. Rahul, good afternoon. And so I just want to get a perspective on a couple of pockets that stand out today. And even if I'm asking about today's move, I'm asking in the context of a slightly longer term, right? TCS results coming through yesterday, a lot of discourse about that, but also the whole update on Mythos and what it means for the sector. Were you convinced with the conversation or the communication from the management of TCS on the path ahead in the face of artificial intelligence and the challenge that it poses?
So the counter to that, Alex, is when was the last time you had a situation where TCS, Infosys, HCL Tech, Wipro actually moved into a situation where you got them at 10, 11 PE? That was, you'd have to go back to GFC. Now, these stocks are trading at about 50% higher valuations than that, at about 16, 17 times. There is still a very large portion of cash on their books. If you look at the operating cash flow, if you look at the free cash flow, the dividend yield of these companies, they're very strong. Now, obviously, the one thing that's missing is growth, which has been there for quite some time. My counter to this is, what if IT companies in India start using their cash balances to buy growth, thereby reducing the cash balances on their balance sheet, or rather than, basically utilizing their cash flows to buy growth? That is going to have a positive impact on the return on equity, right? So effectively, if you go and say something like what Coforge has done not too long back, and I think that may well turn out to be a jack in the box. HCL Tech did that in the IMS space a few years back. So I'm not in that space where I think things are going to, collapse for Indian IT services. I mean, 2-3 months back, these stocks were trading at 23 to 26 times on a 1 year forward. You did have Anthropic, you did have some commentary come out from, leading AI players in the world. Now at 15, 16, 70 times, I don't think there is much to lose in these companies, honestly. I think that, we're underestimating the potential of how nimble the Indian IT companies can be. See, Accenture did this. Accenture was a very cash-rich company. They went and started, affecting their working capital by making inorganic moves. But the stock market eventually did reward Accenture for what they did. So I think valuations are in favor. I think the next 2 years are pretty much going to be acquisitive rather than having Indian IT companies rediscover or reskill themselves. And in that backdrop, I think, could these companies fall another 10, 15, 20%? For sure they can. But could they be the best contra trade from a 2-year perspective? I think valuations are reaching that stage where, I would look at them very seriously. Now, a 1.2% quarter-on-quarter growth, I'm not, as you very correctly pointed out, Alex, these are just very short-term numbers. You're not looking at IT on QOQ numbers. The total contract value numbers were very, very strong for TCS, both for the quarter as well as for the year. All of this is going to translate into revenue. So if you have a situation where the frontline IT companies organically can grow between 8 to 10%, and then buy some growth and move that up to, say, 13, 14%, we may well be in a situation where these stocks are back to 23, 24 times multiples sooner than we actually know it.
So would you look among that pack, Rahul, an interesting take there where IT is a contra trade that you're identifying. Would you look at TCS as top of the heap or some of the mid-cap players?
No, I think from a capability standpoint, Tamanna, if I was to look at it today, I think the mid-cap guys like, say, a Coforge or a Persistent or a KPIT may be better placed. I think if even if you look at the growth rates that the sell side has for companies like Coforge and Persistent, these are companies likely to still continue growing in that 20 to 30% range. And you're seeing that in valuations. Even despite the correction, you have most of these companies trading, anywhere between 50 to 100% premium of what the large cap guys are. So, if large cap IT is coming to you at 15, 16 times, you do have these guys trading at 25, 30 times. So my inclination would still be towards a Coforge and a Persistent kind of company. But I think if you're looking at the large caps, I still think the biggest EBITDA margin delta will probably come into Tech Mahindra, which is probably going to be something that where you'll see earnings growth be the best of the frontline IT names. But I think if you're, and that is just a reversion to mean in some ways. But I think on a steady state basis, I think TCS and Infosys would still be the standout performers from the top 5 companies for me. So I think in terms of growth, like I said, I think that the 2 biggest companies are better positioned in terms of acquisitions as well, in terms of the cash balances. But I think if you're looking at it from a stock price perspective, I think something like a Coforge or a Persistent might be a better bet at this point.
Okay. How are you liking your financials right now, Rahul? Everyone's wish list has financials on top of it. Everyone says, okay, go for financials, safe, etc. Your big private banks topping that list. Are you leaning in the same direction?
So, Tamanna, to quote a line from McDonald's, I'm loving it. But, it's...
loving it sarcastically or loving it because you agree?
No. Actually, I mean, Tamanna, if you look at Axis Bank, State Bank of India, Kotak Mahindra Bank, HDFC Bank, ICICI Bank, they're all trading between 1.5 to 2.1, 2.2 times price to book on an FY28. Now, had this war not happened, you were at the bottom of the NIM cycle, GNPAs and net NPAs were under control. Credit growth had gone back to 14-15%. I mean, not too long back, a couple of years back, this was hovering around that 10-11% kind of number. And, there were reports that it was probably going to head to that 8-9% number. Now, when you had a situation where credit growth has moved back to 14-15%, vehicle loans are still growing at 17%, gold loans in the last, if you look at the data that has come out in the fortnightly, disclosures that the RBI makes, gold loans are up by about 127%. So, credit growth is back. If the initial disclosures that banks have made, deposit growths are anywhere between 13 to 15% for advances and deposits. CD ratios are under control. So, had this war not happened, I think there was a good case that the Nifty may have already been at 30,000. I think if you remember the last time we spoke, I had said that, as the market starts to price in FY28, this is obviously pre the war, I had said that by next Diwali, I would not be surprised if the Nifty was at 35,000. That was going to be driven by BFSI. Had this war not happened, banks could have begun that rally for the market because the fundamentals are very strong. Now, unfortunately, these are the largest holding for FPIs, and that's why they have taken the biggest brunt of the selling. But my sense is once sanity returns, IT and this will be the 2 biggest sectors of the block. And NBFCs are reporting even better numbers. I think if you look at the Ujjivans, Equitases of the world, on some of the other numbers that I've seen disclosed, those numbers are even in excess of 20-25%. So I think this is clearly top of the pack. If you're looking at a 2-year perspective or an 18-month perspective, I think the valuations in BFSI, both in banks as well as non-banking companies, are at very reasonable levels. And we could certainly look at starting to build a portfolio around them.
Very rare times when you have IT and banking both on a buy list together, and that too for Rahul Arora, isn't it? So I think it's an interesting time completely. Thank you so much, Rahul, for speaking with us and joining us on the show this afternoon, especially when we're looking like we're going to end the week pretty well. We'll take a very short break, but just pull up the Nifty as we go into that break, because that's the trick, right? We stay above the 24,000 mark. We're hanging in there right now, but the next half hour as well becomes crucial. We come back with the top buy today, sell Monday ideas after this break. Stay tuned.
केसरिया से मन जोगी हुआ रे दिल झूमे देखो मतवारा हुआ रे केसरिया से मन जोगी हुआ
हर पल मनाओ केसरी त्योहार विमल बोलो जुबान केसरी
Tamil Nadu votes decisive uniquely the way it does.
Politics, power and cinema and all of that in an unprecedented Dravidian script.
This is not an election easy to call. It never has been.
And unravel grassroots conversations with the voices that matter.
That's why we travel across Tamil Nadu to get you the real picture. From the OG of Indian elections comes the next big political blockbuster.
Because
Tamil Nadu votes only the way Tamil Nadu does. Tamil Nadu elections on India's original election voice.
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversations.
Welcome back. It's turning out to be a fantastic Friday after a long time, usually for the last few weeks. And this is the first time in 6 weeks, maybe we're going to close in the positive, Alex. Every Friday has been of fear and trepidation, not just because we think news will break, so then we'll all be here Saturday and Sunday, but also because the street just doesn't know what can happen in the next 48 hours. Having said that, I don't want to jinx it.
Yeah.
Even I don't know what's going to happen in the next 48 hours. Let's knock on wood. I hope this is wood. The fear of this all collapsing seems to have receded. And it's not happened in the last 24 to 48 hours. Maybe peace will hold or a ceasefire will hold for another 48.
One hopes for the sake of humanity that sense prevails and that we don't go back to violence and destruction and a lot of innocents losing their lives.
Yeah, and violent posts as well. The posts were also quite violent. All right, we're talking about the metals space because that is completely buzzing. Macquarie has an interesting note today, and this is their take on some of the top companies. I want to just run it through before we get to our conversation. They've maintained an outperform on Tata Steel and hiked the target price to 241 from 222. An outperform on JSW Steel as well, on Jindal Steel as well, and a neutral on Hindalco and Coal India. Why are they so bullish? Because they say in Q4, firm prices to boost EBITDA, and they prefer ferrous domestic steel prices remain firm, auguring well for FY27 estimate earnings. Hindalco benefits from aluminum price gradual uptick in Novelis EBITDA, but valuations cap upside potential. As far as Coal India is concerned, one of your top losers actually in trade today. Neutral rating reflects modest downside following recent stock outperformance. That's possibly why you're seeing Coal India down in trade. But Aditya Velekar is joining in. He's Senior Research Analyst, Metals at Axis Securities. Aditya, always great to have you on the show. Why do you think there is so much optimism about metals right now? Do you think it's warranted? Aditya, can you hear me?
Yeah, sorry, there was a disconnection in the line.
Okay. Do you want me to repeat my question? My question is, why do you think we have so much excitement about metals, and is it warranted?
Yeah, so the prices have stood strong. We have seen both in ferrous and non-ferrous, especially in steel, the prices which have bottomed out in the month of December and they started rallying post that almost 25%. The prices have increased from the level of 47,000 to almost 56,000, 57,000 rupees per ton. So that's quite a jump. And also aluminium prices, we have seen because of the disruptions in the Middle East, the prices are touching $3,500 per ton, which are a good level for all these companies to make good amount of cash. So the price actions justify the rally.
Having said that though, Aditya, how much of this is, in a sense, and I'm not necessarily likening this completely to the supply shocks post-COVID-19, but in a sense, it is supply shock driven. And there are dislocations that might just go back to some semblance of normalcy. So could you see a situation where there could be volatility for these companies as well as the underlying commodities see that volatility in pricing?
Yeah, not until these Q4 results means the prices could sustain at these elevated levels for quite a bit of a time. So just to take in case, for example, for aluminium, almost 9% of global aluminium comes from Gulf region. And some of the smelters have got hit because of the disruptions there. So 9% supply is gone. So that's why the prices are getting support. So even if in the most positive or optimistic case, if the supply comes in 6 to 9 months, the prices will still remain elevated at these levels. But in the medium to longer term, yes, the probability of prices coming down from these elevated levels, especially for aluminium, remains because one, the expansion of aluminium smelters in Indonesia that may come up, and then the restart of the smelters, the disrupted smelters, and largely from a macro basis, if the inflation in US increases and if the Fed rate tightening happens, if they do not cut the rates or if they increase the rates on the contrary, that would be a negative scenario for most of the metal pack. And in that case, we could see some price correction from these elevated levels.
Okay, among this entire pack, Aditya, how would you look at some of the updates that have come? We saw JSW Steel coming in today. We saw Tata Steel a few days ago. Do you think steel is looking set for a good quarter?
Yes, definitely. Quarter four is usually a seasonally strong quarter for both steel and non-ferrous. Construction activity has started picking up, and we have seen good production volumes, especially for Tata Steel in this quarter. So, from a results perspective, we expect the EBITDA and EBITDA per ton to increase for most of these companies. Only for Hindalco, there might be some contraction in EBITDA per ton at Novelis because of that Oswego fire impact. At Nalco, there might be some degrowth in alumina sales on year-on-year basis because of the geopolitical disruptions in the Middle East. But as I said, because of the higher aluminium prices, higher steel prices, and to a certain extent, not so high coking coal and key raw material prices, the Q4 may not be witnessing that amount of cost inflation, so that will lead to higher EBITDA per ton. But what we will going to monitor will be the commentaries emerging out of the Q4 results. What will be the impact of the cost inflation, especially from raw material sides like gas cost or other ancillary cost, other inflationary cost, and how it will impact the margins in Q1 FY27. So that will be the sustenance of prices at these elevated levels, and the increase in raw material cost, will it impact the spreads for these companies going ahead into Q1? That will be critical because the valuations have already caught up a bit.
All right, so quite a bit to look forward to for the metal pack as a whole. Aditya, thanks so much as always for taking the time, and look forward to speaking to you once we get more clarity on the earnings picture. All right, we've got Jay Bala, who's the founder and chief market technician at Cash the Chaos, as well as Neeraj Dewan, independent market expert, joining us on the program. Gentlemen, thanks so much for taking the time, and happy Friday to you. It is indeed turning out to be a happy Friday. Jay, as we wind down to what has been a pretty decent week in the larger context, what are the key levels that you're looking at, not just for the Nifty 50, but also for the Bank Nifty?
Yeah, see, the low registered for both these indices on the 2nd of April, I think it's likely to hold, and we are looking at fresh record highs to be reclaimed within a few weeks time frame. Maybe we'll be looking at both the indices well past the record highs registered. Recent the high for the Nifty, all-time high for the Nifty was about 26,375. That'll get taken out, and the markets will move well past that. There's just a small bit of short-term ambiguity coming from the price structure. So whether or not the markets make one more low below the April 2nd low, or the markets holds that low, the markets will be higher from a 3 months perspective. And by October, I'm anticipating the markets to be around about 29,000 to 30,000.
Okay. What about picks? This afternoon, actually, you're going to be doing picks and BTST in a span of a few minutes, so you might as well club it together, Jay.
Yeah, I have two short-term picks. One is Praj Industries. It's broken out of an inverse head and shoulders pattern. The stop loss is about 292. I make it a round number as 290, with an objective of about 440. The second one is Shriram Finance. We have a objective of about 1200 plus for the stock, and for a very short-term BTST call. It's Thermax. Thermax at about 36.38. I'm expecting the stock to hold 3,600, and tomorrow I'm expecting it to be trading at about closer to 3,900. Closer to 37.20 tomorrow.
Okay, Neeraj, I want to bring you into to the conversation, and financials have made a bit of a comeback, and private sector banks specifically, right? But in the run-up to this week, there were significant underperformers, I guess to a certain extent because of that frenetic selling activity by foreign institutions. As things stand right now, with the valuations that are currently on the screen, are they still buys, and which specific stocks stand out?
Yeah, good afternoon. Thanks for having me on the show. So we're talking about private sector banks specifically, like you asked me. So I think private sector banks, I feel even after the run-up that we've seen, stocks like HDFC Bank, ICICI Bank, I think they're both on the valuation point of view, on long-term valuation, they're still not expensive, though they've seen some decent moves from the bottom. So I think both these, with a little longer-term perspective, can be bought at these levels also. But then, the only thing is that FIs have been continuously selling into this market. So I think the only positive that I can take from the recent fall is that, they've seen a 16-17% correction for the first time in 2, 3, 4 years in our markets. So I think after this fall, there's the possibility that they find our market attractive. And if the selling stops and some buying comes back, normally these big private sector banks are the first one which they lap into. So keeping that in mind, I think one can have a positive view on these stocks for a 2 to 3 year perspective.
Okay, all right. Just allow us to now go to a special segment which we normally do on this program. It's called Bulls versus Bears, and we've chosen an apt one today. We're talking to Jasmeet about Tata Consultancy Services, and for good reason, Jasmeet, because yesterday when we were looking at the first flush of the numbers, it was a beat on several respects. But then today when we looked at the fine print and maybe some elements of that commentary got looked at, it's not all positive. So what is the scenario?
Well, as rightly put into, the first cut was really positive for the company. In the Q4, the company's beat in like almost all the aspect. But now when you look at a bigger picture, the entire year as a whole, and when you hear the comment from the management, we do have few bears that are coming in for this particular stock, and that's the reason the stock is tying in today's trade. Let's quickly understand the bull case. In the Q4, company reported their highest CC growth revenue in last 6 quarters at 1.2%, showing the overall recovery in the business sentiment. But on the other hand, the bear case, it's their first ever revenue downtick in terms of dollar terms since the time of listing. And there's a big one, downtick of 0.4% for the company like TCS marks a big impact. While the second bull case, we did make a note that overall deal wins surged at 12 billion, a soft quarter being the Q4, the second half of the company on the back of the furloughs. Still the deal wins at 12 billion was great for company estimates of 10 billion. But on the bear case, we did make a note that the overall commentary and the overall deal wins in BFSI remained flattish, and we saw a slight degrowth as well. Given BFSI being the major segment of the company, a degrowth in terms of revenue terms becomes a big thing to watch out for. The next bull case, the analyzed AI revenue jumped to 2.3 billion in this particular quarter, where we see a good uptick coming in. But on the other bear case, the AI pricing pressure still remains, though management confirmed that they don't expect any AI deflation, but still the overall bear case of the AI and the new tools still persists. If we look at the next bull case, we do note that overall headcount saw uptick of 2,200 employees, and when you look at last 3 quarters, there was a downtick of 31,000 employees. So we see a complete healthy run of additions. That's a overall bull case. But the bear case, the margin remains rebound with the 25% range, where the management still aspires to reach 28% going ahead. If we look at the last analysis of what we understood from the bull cases, the company remains positive for FY27, and they also plans to sign a deal with Anthropic soon to boost the overall enterprise AI system. But on the bear case, the brokerages still remain bearish on this particular counter. And today we did see some brokerages come and cut down the target price of this particular counter, given on the weak commentary for FY27. And here is the analyst recommendation, that's the ANR. We see the buy at 36, while the overall return potential is at 19%. Well, this comes in the stock has already broken down almost 20% in the month of Feb. So all in all, we do see good Q4, but commentary and the FY26 as a whole remains weak for the counter.
All right. Thanks so much for that. Pull up the counter as we're speaking about it, right? Tata Consultancy Services.
off the low point of the day. At one point, it was seeing cuts of over 3%, but now down just about 2.5% or so. Neeraj, the valuations are, according to a lot of people, compelling. But the argument against it is also something that is pretty strong. What is your call specifically on Tata Consultancy Services? Should it be bought at the current level?
Yeah, I think that, not specifically TCS, but I think I like Infosys also. So I feel that these stocks can be bought at these levels. One, valuation is attractive, and they're trading at multi-year low valuation they used to trade at. And second thing is that the results were not bad. So they were not, and though the commentary for 2027 is not so bullish, they have a little bit of cautious tone. But I think looking at the valuation and looking at the correction damage which has already happened, there's nothing alarming in these numbers to so that we should not invest in the stock. But I think this is a good entry point as far as valuation is concerned. So I would be an investor in these stocks.
All right. I'm just looking at the broader markets and seeing what's moving. And there's one in particular that is doing particularly well. And this is from the insurance pack, New India Assurance. It's at upper circuit right now. And it's quite the reaction. By the way, Cohance Life Sciences also on the back of pretty significant volumes, multiples of the last 20-day volumes, is very close to that 20% uptick level as well. Jay, if I were to ask you whether you would trade and how you would trade these two counters, what would your answer be?
Yeah, see, Cohance has been a beaten down stock. It's fallen from 1100, 1200 to about 267. So I would be a bit cautious and treat this as a counter trend bounce and not as an investment bet. So I would expect some kind of counter trend bounce to stretch this stock to about 505. So stop below 311 will make a lot of sense. When it comes to the New India Insurance stock, I would say it's an avoid. But from a long-term perspective, LIC India has got a very interesting structure. So I would like to keep a focus. If your investment bet is on the insurance space, I would keep my eyes on LIC India and avoid New India Insurance for the moment.
Okay, Life Insurance Corporation of India currently trading at 797, which is a lot of people would argue a very attractive level if you think about long term. But let's talk about Coal India, which is seeing a little bit of a whack-in trade and quite a sharp one at that. Rising diesel and explosive prices are set to create margin headwinds for Coal India. Parth is joining in to tell you more. Parth, in the run-up to today, of course, the argument has been about the requirement for energy and thereby the requirement for coal. So what has changed today?
Thanks a lot, Alex. So in a recent report by Nuvama, they have maintained a reduced rating on Coal India with a target price of 384 rupees per share. This means that they are expecting the stock to see a further downside of around 10 to 15%. Nuvama says that the current risk to reward ratio is highly unfavorable and they are expecting the return ratios of Coal India to half in the range of around 22 to 24%. Now, the main reason behind this is the cost inflation that the company is facing right now. The rising diesel and explosive prices have created margin headwinds for the company. And due to these reasons, the annual costs for Coal India are expected to jump by around 3,000 crores. Now, this is because the industrial diesel prices have jumped from 92 rupees per litre earlier to around 142 rupees per litre right now. And also the cost of explosives have shot up as well by around 26% by the end of March. Now, these rising costs will hit Coal India and will increase their EBITDA per ton by around 40 rupees. With e-auction prices also remaining below 2,500 rupees per ton and the non-executive wage revision coming in later this year in July, the Nuvama is expecting the overall earnings to remain muted and grow at a slower rate of around 4% CAGR. About valuations, Nuvama says that the current multiple of 5.9 times EV to EBITDA appears to be slightly on the higher side and they expect it to reverse to the 10-year average of around 4.8 times.
Right, all right. Thanks, Parth, for that. Neeraj, any comments on Coal India? It's beaten down today, down 4%. Is it in the price what my colleague Parth was just highlighting?
See, I can understand what Nuama also said, that there can be some near-term or short-term impact on the margins because of the cost pressure. But I think that would be an opportunity. If the stock is correcting because of that, if it corrects to 400, 410 levels also, I think that would be a good level to enter. Because I think from a long-term perspective, Coal India demand is going to go up. There will not be any dearth of demand for them. So, short term, one quarter or 2 quarters will not matter if you're investing for 2 to 3 years. I think that would be an opportunity one should look into.
Okay. I wonder if you're looking at any of the IT stocks as well as an opportunity ahead of Wipro results next week, Neeraj. Is Wipro kind of bucked the trend and was favorably seen because of the buyback? Is it increasing your interest in Wipro? And I don't know if you've already talked about your take on TCS, but how would you look at Wipro specifically?
See, as far as IT pack is concerned, my favorite stocks there are Infosys and HCL Tech. So both of them, I think at these levels look attractive to me for long-term investing. Wipro, definitely because of the meeting, they've announced a buyback. For a trading point of view, one can look at Wipro also because valuation there are also compelling. So for a trade point of view, maybe Wipro, but for long-term investment, I prefer Infosys and HCL Tech.
Okay, let's talk about Eicher Motors. Earlier in the day, it was among the top 5 gainers in the Nifty 50. It continues to do so. Actually, it is at the high point of the day, and this is likely on the back of certain positivity around their latest bike. And this is not the regular sounding motorcycle. It is actually relatively quiet if you think about an Enfield. It's called the Flying Flea. And Puneet joining in to tell us why it's called that and why there is so much interest in the Flying Flea.
Well, thank you for that. Definitely not sounding like a bullet, most certainly. But in terms of performance, Eicher is aiming to give that and continue that momentum. Priced at 2.79 lakhs is not the cheapest in the same, but the first mainstream company in the listed space essentially to offer you an electric vehicle bike. Barring someone like Ola Electric who has the Roadster, of course, but within the 4 players, Eicher, Bajaj Auto, TVS and Hero, Eicher is the first one, and they've modeled this under the Flying Flea brand and a 3.91 kilowatt hour battery and much higher than the electric vehicle scooters between 2 to 2.5. So it gives you a range of 153 kilometers, gives you that perspective as well for which target segment is what they're targeting. Also for, they've already commenced bookings from today, which is April 10th, and the deliveries are expected to start between May of 2026. One key aspect is that this could speed in the launches in the electric vehicle motorcycle space. Ather, a recent listing, has said that 2027 is when they'll come out with the EV bike, but could be a new consumer base that they are addressing. There is something which they did with the Hunter at the lower end. So you had the premium motorcycles. They now have an ICE motorcycle at the lower end. And now with the Flying Flea could address new consumer which are coming in the market. So could be a game changer, a lot to watch out for from this space.
I think what's interesting is how the stock has reacted as far as Eicher Motors is concerned, about 4% up right now. Neeraj, Devan, you like this company?
Yeah, I like this company, definitely. Eicher Motor has been a very good performer. But I think at this price, I think it's nearly covered all the losses it did because of the Middle East war. I think maybe I'll wait for better opportunities to get into it. If one is a long-term investor, if we're looking at opportunities, maybe one should look at better prices to get into this. But if this is part of the portfolio, then definitely you should stay invested in the stock.
Should stay invested. On that note, Jay Bala, Neeraj Devan, thank you so much for joining in today. Pleasure having you. There's nothing flea-like in the stock performance for Eicher Motors. It is ending very close to the high point of the day. And so too is the benchmark Nifty 50. As Tamanna joins in to talk about this, 24,000 being held very comfortably. You called it the trick. I think that trick has been managed today.
Absolutely. 6 weeks of losses now being broken, that losing streak has been broken, because we're going to be ending with gains this week. I think that becomes very crucial. The advanced decline ratio looking fantastic. The bank nifty robust, nearly 2% up, and this is really, in a sense, the star of the day. I'm going to pull up the sectoral indices very quickly, and just let's take a look at those before we get to the nifty heat map, because that's really the story. Auto, realty, all of them zooming today as well. MNC, the whole clutch of it doing well. Banks are up 2% as well. Nifty rural, I've never seen this sector bounce like that. It's only IT that's sulking, and it can be forgiven. Everyone doesn't need to join the party. Some can sit on the sidelines, and maybe this will participate next week as well. I mean, the kind of positive reinforcements we've heard for IT as a contrarian bet today are definitely telling. Let's pull up the Nifty heat map as well. And Alex, what really stands out here is the kind of breadth that we're seeing, and autos making a comeback in the last bit of trade.
Yeah, absolutely. And Asian Paints as well, making a big comeback today. I wonder if it's going to hold, but Eicher Motors, Bajaj Auto, Mahindra and Mahindra, Tata Motors PV in that top 10 should tell you something. Mahindra and Mahindra up as much as 3%. HDFC Life, by the way, the life insurance company is also coming back somewhat. Bajaj Finance making a comeback. So NBFCs, financials, State Bank of India, Axis Bank, all in the top line. ICICI Bank going home with gains of 3% today.
Oh, wow. Yes, ICICI Bank definitely is seeing a big boost over there, and that's actually pulled the bank nifty up. Coal India, Sun Pharma happen to be the ones losing there. But, when we close, apart from the weekly charts, we should pull up the India VIX, 7% down. I mean, all of that question about whether the ceasefire will hold or not hold is a bit of, khalli walli. Don't really worrying about it right now. Jo hoga dekha jayega. 7% down on the India VIX. Bulls firmly in charge. Fantastic advanced decline ratio. We can go on and on, but we're not going to do that, because we have up next our Friday special that we bring you, the editor's cut. And this time we have a very special guest in the studio. Who is it? To stick around to watch after break. We'll be right back.
केसरिया से मन जोगी हुआ रे, दिल झूमे देखो मतवारा हुआ रे, केसरिया से मन जोगी हुआ।
हर पल मनाओ केसरी त्योहार। विमल, बोलो जुबान केसरी।
Tamil Nadu votes decisive, uniquely the way it does.
Politics, power and cinema and all of that in an unprecedented Dravidian script.
This is not an election easy to call. It never has been.
And unravel grassroots conversations with the voices that matter.
That's why we travel across Tamil Nadu to get you the real picture. From the OG of Indian elections comes the next big political blockbuster.
Because
Tamil Nadu votes only the way Tamil Nadu does. Tamil Nadu elections on India's original election voice.
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversations.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
कुछ खास होने वाला है।
If you really want to see environmental action in India, we will have to revive community action.
How convenient you make it for somebody to choose a greener option, or how inconvenient you make it for them to choose a browner option makes a difference.
So we have eradicated road transport. Where we cannot replace it with the slurry pipeline, we are using this LNG or electric trucks.
Presenting the all-knowing, all-powerful Tech Guru.
Whoa. Guru? I'm no guru.
Okay.
I'm just a guy who loves his tech.
A show where the mysteries of megabytes and motherboards shall be unraveled.
Bro, nobody talks like that anymore. This is all about connected ecosystems, EVs and AI that you can use in your daily life. That's what we do on Tech 360. Real talk, real reviews, tech that you can actually use.
Tech has changed. So should your tech show.
To understand the Tamil Nadu twist, join me in the midst of people, language and politics. Vanakkam Tamil Nadu, here we come.
When others are warming up, I'm raring to go. The stories that matter, the stories that shape your life.
Hello and welcome to watching Prime 5 with me, Aisha Saeed. What's happening? How
The show that Welcome to the Editor's Cut. This is a special show where we huddle together at the end of the week and try to make sense of the week gone by, give you an idea of what we're thinking in the newsroom, and sort of a forecast of what you could see in the next week. We love inviting in a guest editor on the show, and today we have Gautam Chacharya of UBS with us. Gautam, thank you so much for coming in, and welcome to the Editor's Cut. So the way we do it is we start by sort of going around and talking about what each of us think. So would you like to start off? What has the week been like for you?
Like last few weeks has been another interesting week with a lot of turns, but with a lot more optimism this week than the last few weeks. Investors are still trying to find their feet. Hopes are alive, clearly, but with a lot more caution also. One of the things which one of the investors told me, and which I keep repeating, is that one of the consistent things coming from the US administration in a lot of these ups and downs is that they don't want to stay around for long. Unlike past US such events in other countries. So that's one of the key things to remember, that come what may, it's unlikely they will prolong this war for long. Forget the ceasefire hopes right now. So that also is the reason why I think the markets never panicked. Markets corrected, but markets were never pricing in a prolonged scenario of war and oil going through the roof. $150, $200, oil never moved to those levels despite what was happening in the Strait of Hormuz.
We went up as high as 119, 120.
For a brief while, But markets never priced that this is going to be a prolonged war. And one of the reasons is that at least one consistent message coming out from US all these weeks has been that this will not be a prolonged. Having learned from their own history, this presidency, they have made a comment that they will not like to be prolonged.
So you know, in terms of what I've seen this week, I think the world has swung from, it's a week of mood swings, if I had to put it that way. It's swung from a fear of nuclear war to now an uneasy ceasefire. It's happened just in a matter of hours in the middle of this week. And that ceasefire announcement has actually given buyers chance to get off the fence. People who were wondering, should I come in, should I not, I think the last couple of days has really seen people take a call. This will continue even if there is a bit of rhetoric here and there, some new Lego video. It's not going to matter unless you go back to pre-ceasefire levels of escalation. So the focus now maybe is going to be more on business updates and other things. I don't know how you guys really saw it, and whether you think we're being too hasty to say the worst is behind us as far as at least the Iran war is concerned.
Well, on actually on the point that you were making earlier about people, investors finding their feet, and I'll come to this and I'll come to that in just a bit, which is that mutual fund investors seem to have already done that in the month of March. And so those numbers that I saw today are actually the highlight of the week for me. But on this point, very quickly, I don't think that we've seen the end of this story, but I don't think that we'll see the blaring headlines that we saw in the month of March. We won't go back to that level of rhetoric. So there is a little bit of calm that will prevail, in my opinion. I hope I'm not speaking too early.
Yeah. You know, I mean, to add to this, when you're talking about the ceasefire, I was just looking at data with regards to the Iran-Israel war, which is ongoing from, 2024. There was a 12-day war in 2025, after which Trump was the one who brokered the ceasefire then, which went on for several months. Hope again for me is, again, you'll see a deja vu of the same, where the ceasefire probably will prolong. Not sure if there will be a decisive conclusion that comes in on that front, but that's my hope, taking cues from what happened back then in 2025. Coming back to markets, I think taking cues from what Alex is saying, you know, your retail investors and your DIIs have been an absolute pillar of support for our markets, is what I read, because the kind of buying that has come in for this cycle, or in the last 2 years when FIs have been sellers, they have kept pumping in money, and that SIP number gave you that details, because after seeing that 29,000 mark previous month, I think everyone was expecting it'll go below this. Yeah. And it's come way above that. So
can I take the numbers, because this is for me the biggest talking point, right? So if you look at active equity as a category, and this is everything from flexi caps, large caps, etc. This is where a fund manager takes an active call. Over 40,000 crore rupees on a net basis has come through in the month of March. If you look back through the entire financial year, the only month in which the number was higher was in the month of July of 2025, when the number was around 42,000 crore rupees. But if you look down into the details of that, nearly 9,000 crore rupees of that, or over 8,000 crore rupees of that entire 42,000 has come through new fund offers.
Okay.
And so if you net off, or you remove the new fund offers from both that number and this number is by far and away the biggest inflow into actively managed equity mutual funds in FY26.
It's a tenga to all the money that's been fleeing out.
It's huge.
Acha, you are selling, please go ahead. We're standing to buy.
And that does not even count. It does not even count. If you look at passive flows, index funds and other ETFs put together have gotten inflows of 28,000 crore rupees in the month of March. Just 1 month. And I'm pretty sure that it's not silver ETFs, as was the case a few months back. It is likely equity ETFs that have gotten inflows in the month of March.
Have you seen that kind of sort of thinking? What are the conversations that you've been having? Today, our big newsroom chatter is about whether we'll see an FII buy figure at the end of the day, even if it's a tiny one. Have those selling figures started petering out?
So I don't want to guess today's numbers, but look, FII selling, petering out is the first stage, obviously. I don't think they come in to buy as such in a hurry. Because look, the India market was beaten down into the last few weeks, went touch almost 22,000 levels Nifty. That level kind of looked interesting, but the reality still goes back to what was pre-war, etc., which is the risk reward in terms of growth and valuations versus other markets is still not exciting enough for global investors to jump into India. Like this, our conversation suggests they'll still go back to the big AI trades and opportunities in North Asia, then come back to India in a big way.
Does the rupee help? Because from the low, because of the RBI intervention and the measures that have been taken, I just pulled out the numbers, we're off as much as 2.64% from the all-time low. And so therefore, we're hopefully not going to see it plumb those depths in the near term.
But look, from a foreign investor perspective, it's still hurting, right?
It is.
It's appreciated from that low, but for them to actually, at the back of the mind, they have been hurt in the last few months by the rupee move. So they will still be thinking that, okay, my actual returns might be lower in India. So that's on top of what's happened in the last couple of years around growth and valuation. So rupee at this stage helping now. If for whatever reason rupee goes back to 90 or below 90, then it provides some comfort to foreign investors. Okay, what we saw in the last couple of months was a one-off. It's still a more steady 3%, 3.5% annual depreciation currency, which will give them comfort. But I think fundamental thing is still growth and valuations. They need to get comfortable about India becoming again a absolute and relative growth market, which they still are looking for signals.
Interesting.
Okay, a point I have to make over here is you're talking about FIs who might just go and get onto the AI play. Last couple of days, we've been just looking at the FY26 FI inflows in terms of sectors, and we've had a discussion about it. They've been investors in the capital goods sector.
In FY26?
In FY26, and the bunch of that money has come in the month of February and March. So what is it that is actually making them positive? Is it the domestic growth story that the FIs are looking at and not really just restricting sectors which could have risks, say from an AI perspective, risks from an export market perspective, and they're just looking at India from a domestic growth story perspective? Because only capital goods to be as a sector seeing FI buying is very unusual.
So look, again, when we look at sectors, they're much more dispersed. Capital goods are much more dispersed sector per se, rather than one.
Yeah, I'm sure it's more of a semiconductor data center play is what they're looking at.
So
maybe policy push, maybe moving into policy push.
I'll give you some flavor of that, like applies globally also, but in India for sure, is that, look, globally, when you talk about AI, etc., it also flows through the entire ecosystem of capital goods, energy, power. That also is a big beneficiary of that. Similarly, in India, there is an element of that. Secondly, irrespective of what's happening in business cycle, I think one cycle for the next foreseeable few years, which looks very promising even in India, is the power sector. Okay. And the entire industrial supply chain around that looks very, very good. And that is least likely to be impacted by the macro. Because the demand-supply gap is so much there. That's possibly reflecting what you just mentioned, that they see that opportunity, and when you see stock price is correct because of whatever reason, that's an opportunity to get back in.
Yeah, I think one thing that we should focus on if you're looking at what's going to happen next week and where this is going to go next, my sense would be that a big talking point is going to be how the Strait of Hormuz is actually managed. Right now, you've managed to still have Brent at the 96, 97 level, sub 100, even though the traffic in the Strait of Hormuz is a trickle. For 48 hours into a ceasefire, we haven't really seen much movement coming in. Is the world preparing, my question is the world preparing for a scenario where Iran, along with Oman, and maybe a smattering of others, starts charging a premium to pass through the Strait of Hormuz? I mean, call it a toll tax collection or call it whatever you want. That is the reality right now, and then that kind of grows.
So look, is the world preparing? Is too early. The question is, even if theoretically they charge a premium or a toll tax, the question is how much?
Yeah, is it going to be a big downer? Not really.
Not really. Like again, unless they start charging, because ultimately that's not the only available oil supply.
$1 per barrel is
that doesn't change the equation at a global level, right?
Yeah.
And there are alternate supplies.
Because everybody then pays.
No, but
it has to be competitive also.
But if they take it in yuan and cryptocurrency, as the reports are suggesting, we don't know if that's happening.
That becomes more a geopolitical game also, not just a cost issue. So ultimately, look for businesses. If you look at companies in India or anywhere else looking at buying that crude or gas for their inputs for their processes, they will look at that versus alternate supplies. Like whatever crude is coming there plus the toll versus, okay, can we get it from US or Venezuela or from somewhere else? And that's how markets will play out. I don't think in itself that's going to be a big factor. Geopolitical, obviously.
I find that very interesting because what that tells me is at the end of the day, deals will be struck and an additional cost will just be swallowed in and absorbed along with everything
in a competitive way. Compared to alternates.
No, of course. I mean, they can't overprice it to the extent where then nobody wants to go through the Strait of Hormuz. We'll go all the way around but not come here. And so maybe that's what will end up happening, and there will have to be some kind of acceptability to that as well.
But I would, so just from the perspective of a buyer of products that depend on crude oil, I would take that. I'm just saying, look, just finish this conflict off. If you're saying, okay,
it's going to cost a little more.
Yeah, give $1. I'll pay $1 a barrel. Just let the crude go through.
But is it going to be only crude? The question is it going to be across supplies,
It'll probably be across. It'll probably be a system in place. There'll probably be a lot of... So the next leg of conflict, if I were to think about it, apart from what Israel and Lebanon are doing, and that's become sort of a... I don't want to say a side story because people die and it's very real, but if suppose that's not center stage, the next leg of conflict is going to be control on the Strait. Does America, along with NATO, want to have some say? Does Iran, Oman come in? So that's going to be... But we don't go back to the world 6 weeks before now.
I don't foresee a situation, and I keep saying this on these conversations, the tendency is to sound like a geopolitical expert. I'm nowhere close, but I do not see a situation where Iran will let go of control of that is their primary bargaining chip.
Who stops charging taxes once you start? I mean, nobody. But having said that, big focus for next week. Do you think results now take center stage? Have you been enthused by what you've seen so far vis-a-vis business updates? Of course, the big IT one. What have you made of it?
So look, it's not been disappointing, which is a good start. But I don't think markets will overly focus on results. They will look at it and they will react if there are extremes, not the usual course. Okay, the earnings missed by 2% and stocks reacted. That may not happen much.
But the outlook is because
the broader macro will drive much more rather than the 2% miss.
Is that because FY27 could have a completely different story than what panned out in Q4?
Absolutely. But if there are big misses or big beats, then yes, stocks will react.
But do you think it'll be more in terms of the commentary, the guidance, what the street is watching out for now versus...
So the commentary guidance will be much more tracked closely in terms of what's happening, supply chains and actual demand today rather than what happened in 4Q. Because again, everyone is looking for those inputs as to where are the shortages, if at all, how are the prices moving, how are the supply chain bottlenecks changing or not changing. So those commentary will be looked at very closely, and also how that's resolving. Because I think the worry is all the dislocations at a margin which we saw, is it a 1 quarter issue at most or a 3 quarter issue?
My worry though,
or a 1 week issue. That's what they will track.
I think the damage has been done to some extent. I mean, at least my conversations with those in the banking sector seem to suggest that some damage, even though it was for a few weeks, but the LPG squeeze that we saw to smaller businesses has been done. In the banking sector, there may be stress if this continues. You might not see it even till Q1, maybe Q2 onwards if it goes on. And the appeal will be to come in with some relief, at least on payments being made for MSME, because the fact is, a nice example was being given, even for ceramics. There is commercial liquid natural gas available, LNG available, but even the commercial LPG is still cheaper. And everyone's already moved to that system. So that they've not accounted to move back whole hog. So those pain points will be there and they'll still show.
And a lot of companies who we've spoken to have been of the opinion that don't be surprised where you will see the full impact come in the first half of FY27 completely. And that's where the worry is, because even they are not able to forecast.
So by Q2 of next year, of this year?
1 and 2. And because they've been looking at the situation on a fortnightly basis, because they don't know what's happening, right? So it's a 15-day view, and that's when they look at what's happening next. So they are worried of the first half of FY27.
My worry is that and to your point of how much do you get in the way of guidance, because the companies themselves at this point don't know timeline, and so there will likely be hesitation by company managements to put out any sort of guidance on how this is impacting their numbers.
That's quite likely.
And so from the perspective and the lens of an investor then, how do you take those decisions? Do you take it purely on the basis of looking at, for example, the IT pack, and it's not related to this subject, but just as an argument, you're looking at it with the lens of historical valuations and how it compares to that and saying it looks attractive right now. But can you make the same argument to other sectors that have seen supply shocks? I don't think so.
And it's a tricky one. It's a tricky one, very tricky one. And it'll be interesting how markets navigate this because it's a tricky one.
What are you focusing on in terms of key areas, Gautam? I'd like to know your thinking going into result season because you're right. Right now, the data you're getting is probably feeling like a huge lag because it was in a very different world. But what are the key sort of indicators that you're focusing on?
So look, one indicator is get granular details about the dislocations they are seeing on the ground today and how long does it take to unwind that. That will help in some way frame the outlook for the next couple of quarters and try to quantify the first half impact. But in terms of sectors as all, look, again, at a broad macro level, we are still underweight India in EM context. That's our strategist view. Our strategist still underweight India. Again, same growth valuation perspective on a relative basis. There are still other interesting...
Haven't valuations come off enough now?
No, not really.
Really?
Not really. So
where would you be comfortable with?
I think at 22,000, our EM strategy doesn't have a level where he'll be comfortable with. I think 22,000 level is a level where Indian markets have bottomed out twice, like last year also and this year. Okay. Now at 22,000 levels, is it a level where the valuations are screaming levels, okay, attractive? Maybe not. But at least it's clearly bottomed out twice. That's one way to look at it psychologically. Ultimately, more than the level, it's also about the visibility of growth. So when do we start seeing growth recovery actually happen? And surprising also, like I think 2-3 months back, there was some hope building up in the markets that growth will not just come back, but there's a possibility growth surprises when we saw credit growth numbers. Okay, like maybe it's turning, not just turning because of a low base effect, that because of a low base, you'll anyway have growth in FY27, but actually going back to the earlier periods of higher growth. So once markets start seeing that, then in India's case, look, many investors look at India, great bottom-up companies, stories, great long-term growth opportunity, but the interim has been tough. So the moment they start getting comfortable that it's still is going to be a high double-digit earnings growth market.
Just to the point that Tamanna was making, I want to drill down a little bit in that, which is haven't valuations come off? Maybe at the index level, and even if you look at the broader markets, the argument is that no, you are still relatively expensive. But the point has been made by money managers here in India that at individual company levels, the destruction has been so dramatic in certain pockets that it does become attractive, does it not? You don't buy that?
So individual stocks always happen, even at the peak of the, even in bubble markets, there are always individual stocks which can always be attractive. But again, to the generic comment about market correction and individual stock correction, it's a question of what time frame you're looking at from a relative valuation perspective. Like if you compare to last 5 years, 6 years, yes, there have been corrections a lot more. I'll give you a simple way to look at a market Nifty level. If you look at headline, consensus-based, Bloomberg-based forecast, and they look at multiples, 16 times is where India has been bottoming out in the last 10, 12 years. That's where 22,000 levels would be. That's where. But if you go 10, 12 years before, and go to long history, 16 times where it used to peak. Okay.
Yeah, but you also didn't have this wall of money coming from domestic investors.
That's a technical argument, not a fundamental argument.
A lot has changed. A lot has changed in this time as well. So the technical support is
definitely there. And that's why depending on where if you are comfortable, the local wall of liquidity will keep on continuing. And 16 times is a good level to have a good support.
March is decent to give you a supposition that will continue.
Correct. And I think a few of the things that will pan out even as we wrap up, one is that inflation in input prices across the board for companies are beginning to be seen and will continue to be seen. The fact is crude is still at 96, 97, not at 80, 85. So that continues to be seen. All of their derivatives, all of this doesn't go away in a way. So I think that's all of Q1 is going to be a little painful.
I think that markets might see through.
Yeah.
That market might see through. Again, if the overall thing stabilizes and there's visibility on supply chain normalizing, I think that market will see through.
All
That's a hope of pessimism or optimism is what we should look at from here on.
Yeah, no, I think that's pretty optimistic. I think it's nice that we're ending this week on an optimistic note after everything that we've seen. That's pretty much time that we have on the Editor's Cut this week. Thank you so much for joining us, and we'll hope to see you back again next Friday with much more to unpack. But for now, it's seeming like we may have a decent start next Monday as well.
केसरिया से मन जोगी हुआ रे दिल झूमे देखो मतवारा हुआ रे केसरिया से मन जोगी हुआ
हर पल मनाओ केसरी त्योहार विमल बोलो जुबान केसरी
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversations.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices.
And here's where you can watch us.
Tamil Nadu votes decisive, uniquely the way it does.
Politics, power and cinema and all of that in an unprecedented Dravidian script.
This is not an election easy to call. It never has been.
And unravel grassroots conversations with the voices that matter.
That's why we travel across Tamil Nadu to get you the real picture. From the OG of Indian elections comes the next big political blockbuster. Because
Tamil Nadu
votes only the way Tamil Nadu does. Tamil Nadu elections on India's original election voice.
The government has a very focused, very intelligent, very smartly devised policy for renewable energy. We combine that with the Indian talent for innovation. With these faculties that we have, I believe that anybody can follow to success.
As we say in the climate word, we need all hands on the deck for any sustainability solution. And NDTV joining this robust voice makes all the more difference to India.
Presenting the all-knowing, all-powerful Tech Guru.
Whoa. Guru? I'm no guru.
Okay.
I'm just a guy who loves his tech.
A show where the mysteries of megabytes and motherboards shall be unraveled.
Bro, nobody talks like that anymore. This is all about connected ecosystems, EVs and AI that you can use in your daily life. That's what we do on Tech 360. Real talk, real reviews, tech that you can actually use.
Tech has changed. So should your tech show.
Nifty rebound in trade and closes above 24,000 level for the first time in a month. Benchmark indices post highest weekly gains in 5 years. Almost all sectoral indices show significant recovery. Dalal Street is disappointed with TCS results. Stock falls about 3%. Brokerages are bearish as TCS posts first ever yearly drop in dollar revenues. Most of the IT companies fall in trade. The only outlier in the IT pack is Wipro, which surges after announcing that the company is mulling a buyback. Sun Pharma shares down over 3% after reports of a proposed mega acquisition. The company is said to be planning a $12 billion bid for Organon and Company, which would mark the largest overseas acquisition by an Indian pharma firm. March AMFI data shows strong momentum with active equity mutual fund inflows recorded highest since July, marking a 56% surge than the previous month. SIPs at record highs in March, standing at 32,000 crore rupees. Oil climbs but stays below $100 a barrel as Strait of Hormuz tanker traffic remains under strain despite US-Iran ceasefire. Saudi supplies risks add pressure on crude elevation. Iran and US face deep division over Lebanon ahead of the ceasefire talks in Islamabad tomorrow. Strikes in Lebanon continue. Iran media says that talks in Pakistan are suspended till Israel stops attacks on Lebanon. After over 4 years of war, Ukraine sees progress towards a potential peace deal with the Kremlin. Ukraine's top negotiator with Russia says that a resolution to the war may not take long to achieve. Bihar Chief Minister Nitish Kumar takes oath as Rajya Sabha MP, marking an end to Nitish Kumar's era in Bihar politics as the Chief Minister. Now eyes remain on who will succeed him as Bihar Chief Minister. NASA's Artemis 2 mission enters its final phase after a 10-day expedition with the crew on their return journey to Earth after a historic lunar flyby. NASA says crew is halfway home. Hello and welcome to Profit 360 on this Friday afternoon. Let's take you through the top story that we are tracking today. The stock markets, they end the week on a strong note, recording the highest weekly gain in 5 years that both Nifty and Sensex, our benchmark indices, have seen. Now that is since February 2021 that we are talking about. It rose almost 6% and closed above 24,000 is what we are talking about, Nifty 50 after 4 weeks. And this was the first green week for Nifty after 6 straight weeks in the red. Now, the broader markets performed even better with the mid and small cap indices really gaining over 7%. Let's take you through all the market action with my colleague Jasmeet joining in with the Roundup. Jasmeet, tell us.
It has been a roller coaster time for Nifty, but Nifty ends in green in today's trade. The top gainers in Nifty 50 includes Asian Paints and Eicher Motor, both gaining over 3.5%, while Nifty in today's trade managed to cross the 24,000 mark and end at 24,050 by gaining 1%. If you look at the weekly performance, this has been the best performance of Nifty since Feb 2021 in terms of the weekly gain it has received. Now, while Nifty closes above 24,000 mark after almost 4 weeks of underperformance and gaining slowly post the degrowth which it has seen. Now, in terms of the overall performance, the Nifty in this particular week gained almost 6%, while Nifty ends in green after 6 consecutive weeks in red. Now, in terms of the top gainers in this particular week, we have stocks like Shriram Finance, Adani Enterprise, both gained over 13.5% over the week. While broader market outperforms the benchmark in today's trade and as well as the week, what we see is Nifty Midcap 150 and Small Cap 250 end in green for the week, both about 7%. In terms of the top gainers in Midcap 150, we have stock like New India Assurance as well as Ashok Leyland, both gaining well in mid-cap 150 space. Ashok Leyland almost gained 26%, while the New India gained over 19% in Nifty mid-cap 150. If you look at the small cap, we have stocks like Ola and Cohance Life Sciences, both top gainers during the week, while Ola, interesting one, gained almost 45% during this particular week, while Cohance Life Sciences gained over 23%. If we look at the sectoral image, we do note that all sectors end in green for the week, while Nifty Realty is the top gaining sector for this week. It gained over 12.5%. The top gainers are Lodha as well as Phoenix Mills gaining over 15.5% in this week. In terms of the other key sectors, what other trends we are noticing is Nifty Auto snaps a 2 week of losing streak, while Nifty Financial Services snaps its 6 week of losing streak. Nifty Realty, Media, Energy as around other stocks as well for the second consecutive week they saw the gain. In terms of stocks like Nifty Oil and Gas and Nifty Metals, they gained for the second consecutive week, while lastly Nifty Bank and FMCG snaps its 6 week of losing streak and saw an uptake. So all all in all, a good week for the markets.
All right. All in all, a very good week for the markets as ceasefire really kicks in and the markets really respond very positively. Thanks, Jasmeet, for all those details. Now, the shares of TCS, they fell about 3% in trade despite the Q4 numbers beating the street estimates. The pressure primarily was due to the specific reason, like the company posting its first ever dollar revenue decline for the year since the year 2004 when it was first listed. Now, the margins being range bound is also another concern. Competitive intensity rising and brokerages remaining bearish on this particular counter. But the management sounds secure despite the dent seen in the stock prices. Our managing editor Tamanna Inamdar sat down with the top management of TCS to clearly understand the reasons behind their confidence about a strong financial performance going ahead. Listen in.
We had one of the best order books this quarter.
Yeah.
With this 12 billion, and for the year we closed 40 billion order book. We signed 3 mega deals. Okay. And our number of $100 million clients, it went up by 4 this quarter. If you look all these lead indicators, it gives us a lot of optimism about the year to come by. So we are quite positive. While there could be some macroeconomic overhang for a short period of time, we are very positive about the future.
If you see our AI revenues from last quarter to this quarter annualized has increased from 1.8 billion to 2.3 billion, which is a huge positive.
You see that trajectory continuing?
Yes, yes. And the other thing I would say is the kind of progress we have made on the Hypervault initiative, which is a key component of our end-to-end play, which we call it infrastructure to intelligence. I think excellent progress made by our teams, and you have heard some of the announcements that we made with OpenAI and AMD, and we see that going very well. So the whole AI ecosystem thinking that we are bringing into this is starting to play out extremely well.
Right, AI focus for the tech majors in the country. Now let's shift focus to the pharma space. Sun Pharma shares fell over 3% today due to the reports of a massive $12 billion all-cash acquisition of a US-based pharma firm called Organon. Now, this would be Sun Pharma's largest ever overseas deal by far, but the huge deal size as well as financing concerns have really caused some caution around this particular stock today. In fact, my colleague Varsha joins in with all the details on what really ails the stock movement today after this deal report really came out. Varsha.
You know, the stock is down because, of course, on the large acquisition deal, this is as per media reports. So Sun Pharma plans $12 billion bid to acquire Organon and company. This would be largest global M&A by Indian pharma, and the binding offer is expected in coming weeks. Now, there's a no single bidder situation. Sun Pharma will be competing with Global P Consortium. Now, the important point over here is why market is worried and why the stock is down almost 3%. This is the largest deal versus Sun's size, and the Organon's, the company which Sun Pharma is expected to acquire, they have a huge debt on their balance sheet, and also there are some weak, they have a weak growth in some of their segments. Also, they do have competitive pressure when it comes to their generics and biosimilar portfolio. And Organon's CEO, if you see, resigned in October 25 following an internal investigation related to sales malpractices. Also, acquisition does not bring a strong pipeline of products for Sun, neither does it enhance Sun's R&D portfolio. But why Sun is buying? According to them, this will move beyond generics, will cater to innovative pharma, will build global scale and branded portfolio for them. If I were to talk about the financial position of Sun Pharma, they have $3.2 billion of cash on their balance sheet, but Organon has a high debt of almost $8 billion and also is facing competitive pressure. Organon, they are into women's health, biosimilar, established drugs, but their sales were impacted by lower US government funding and pricing and competition. So a lot of issues are actually there for the target company, and hence market is not liking the proposed deal for Sun.
All right, market not too enthused about such a large transaction by Sun Pharma. Now, according to the latest mutual fund data, investors showed strong confidence in Indian equity funds in the month of March, while the inflows in flexi, mid and small as well as large cap funds really improved, well, the gold and multi-asset funds took a backseat. In fact, let's bring in my colleague Alex, who is going to give us all the details of the internals of the AMFI data that was released. Alex.
Strong flows into the mutual fund space in the month of March. In fact, when I look at the active equity component, which is essentially where a fund manager takes active calls to manage your money, the inflows in the month of March have stood at over 40,000 crore rupees, and that's the highest net inflow into that category of mutual funds in FY26. That's the full financial year. Of course, in July of last year, you had a little over 42,000 crore rupees that came through, and that was because of new fund offers. So if I remove new fund offers from the picture, you had 9,000 crore rupees of inflows through new fund offers in that month in July, and about 1,600 or 700 crore or thereabouts in the month of March. So net of that, or X of NFOs, this is actually a very robust inflow, and it's across the board. You have inflows into the flexi cap funds, which have crossed that 10,000 crore mark. In both small cap and mid cap categories, you've seen inflows of over 6,000 crore rupees. And even in your large and mid cap, in your large cap funds, a lot of money has come in. The SIP number actually is at an all-time high in the month of March. That stands at 32,087 crore rupees, and it comes on the heels of a lull in the month of February where it fell to around 29,800 crore rupees. Now, what you have to also bear in mind is that money has come through into index funds and other ETFs, which is primarily equity ETFs, and that is to the extent of close to 27,000 crore rupees. So that's very, very sizable. Gold ETFs have also gotten inflows, but much lower than they have received in previous months. In fact, in 1 month, over the last 4 or 5 months, you've had 1 month of inflows that came through at 24,000 crore rupees. This is maybe a tenth of that, but it's still pretty strong. All told, very strong inflows into equity as a category, but as you normally see at the end of the quarter, you've seen outflows from fixed income mutual funds of about 2.9 lakh crore rupees, and as a result, the total inflows or rather outflows from the mutual fund industry as a whole have stood at over 2 lakh crore rupees. But the takeaway is that Indian investors are pouring money into the mutual fund space because they feel it is an opportunity, the volatility that we've seen in the recent past, and that is coming through in both SIPs as well as lump sums.
All right, that was about markets, but remember, crude is the one which has really played around with the Indian markets as well. So MCX crude oil prices are heading for a weekly loss this week due to a fragile ceasefire between the US and Iran. In fact, both Brent as well as WTI crude are down about 11% for this particular week, and this is the biggest weekly drop since June 2025 that we have seen. Now today, Brent crude rose 1% to over $96 per barrel, while WTI climbed to $99 per barrel. And the main reason for oil simmering down below $100 is the 2-week US-Iran ceasefire. And this has reduced the supply worries, even though, remember, the tanker traffic through the Strait of Hormuz remains very low, but they have baked in the ceasefire and that the blockages for crude oil movement coming through. All right, I spoke to Peter Maguire, the CEO of AustraliaTrading.com, about the current situation of energy prices globally. And he said if the ceasefire sustains, oil prices could really hold firm, not just below 100, but could also drop to around $90 per barrel. Listen in.
I would say that if this ceasefire is going to materialise and there are no breaks in that, Nisha, then I'm very confident that oil will be sub 100 and probably even very close to 90 or less. But as we know, there's a lot of water to pass under the bridge between now and when that expires. And there's talk in the town as far as whether there's going to be breaks in it, how it all structures. So one would be hopeful that crude prices can stay at these levels or lower, but there's a lot of uncertainty when you come to warfare and geopolitical risk.
All right, so that was all about crude. Now, IT services major Wipro has announced that it would be considering a buyback of shares along with its fourth quarter results on April 16th. My colleague Jasmeet is back with more details on that. And of course, remember, this was the only big IT company which was positive in trade in the IT pack, which was dragged down after the TCS numbers. Jasmeet.
As rightly said, this being the only sector that's seeing a lot of pressure at this point in time. But given that Nifty IT had already rallied 10% in the month of April, and we see some kind of correction in the overall stocks. Now we talk about Wipro per se trading in green currently, while the stock remains on focus as the board to consider buyback from the Q4 earnings that's on 16th of April. Now what board expects is this will be the third buyback first buyback they're doing in the last 3 years, and altogether fifth buyback for the company in the history. Now currently the cash balances of the company are roughly at 41,000 crore. And analysts are expecting company to deploy nearly 18,000 odd crore for this particular buyback. If we look at the past data, the premium which generally the board gives for the overall buyback is between 18 to 20%. Keeping the same premium, we can expect the buyback to be anywhere between 240 to 245 rupees based on the current price. So all in all, we do expect positive up move in the stock going ahead. But currently the stock rallied 3% but right now has cooled off the trade.
All right, thanks so much, Jasmeet, for that. All right, moving on to the war situation. Middle East remains on a knife's edge. With the fragile ceasefire hanging by a thread, Iran has issued a sharp warning, vowing no aggressor will go unpunished, even as US President Donald Trump really ramps up the pressure, slamming Tehran over blocking oil flows through the Strait of Hormuz. Now, amid escalating tensions, high-stakes diplomacy is now in motion. US Vice President J.D. Vance is headed to Islamabad, remember, for a crucial talk with Iran. Pakistan's Interior Minister has led a top-level security review, ordering foolproof arrangements for visiting delegations. Meanwhile, Israel has opened another diplomatic track with Prime Minister Benjamin Netanyahu, clearing direct talks with Lebanon and also focused on disarming Hezbollah. Now, the big question is, can talks really cool tempers, or is the ceasefire ready to collapse? That will be the big question that everybody is asking, as fragile is the word that is attached. And now let's take it across to my colleague Pradeep Datta, consulting editor at NDTV, reporting from Ground Zero, where an incoming projectile has just exploded nearby. And this is a zone where there's absolutely no sign of a ceasefire, only the deafening sound of blasts, relentless gunfire, and continuous military movement all around. Let's take a look at this ground report.
तो अभी आप देख सकते हैं कि रॉकेट की आवाज आपको सुनाई दी होगी, क्योंकि रॉकेट चलता रहता है। यहाँ कभी भी किसी भी वक्त यहाँ पे रॉकेट फायर हो जाता है। और वो देख सकते हैं आप, ये देख सकते हैं, ये आप देख सकते हैं कि किस तरीके से लगातार रॉकेट फायर किए जा रहे हैं। आसमान में आपको धुआं उड़ता हुआ नजर आएगा। ये लॉन्चिंग साइट है जहाँ से रॉकेट फायर किए जा रहे हैं। और अब देखिए, मालूम नहीं जाके ये रॉकेट कहाँ गिरेंगे, किसका आशना गिरा देंगे, क्योंकि उम्र लगती है आशना बनाने में। लेकिन एक पल में एक धमाके की आवाज आप देख सकते हैं कि धमाके की आवाज की वजह से ये आपको आवाजें जो सुनाई दे रही है, धमाके की आवाज सुनाई दे रही है। ये रॉकेट फायर किए जा रहे हैं, ये मिसाइल फायर किए जा रहे हैं। मुझे लगता है कि हमें किसी सेफ शेल्टर की ओर जाना होगा, क्योंकि यही एक बेस्ट ऑप्शन रहता है। या तो जमीन पे लेट जाइए, या तो आप किसी सेफ शेल्टर में चले जाइए, क्योंकि यही एक ऑप्शन जो है आपके पास बेहतर ऑप्शन रहता है ऐसी सिचुएशन में, जब कभी भी, क्योंकि हम जिस एरिया में है वो बहुत ही मुश्किल एरिया है। ये सरहद का एरिया है। ये इस समय आप बताऊंगा, ये मैं आपको बताना चाहता हूँ, ये इजराइल और लेबनान का बॉर्डर है। और ये जो जमीन का टुकड़ा है, ये डिसाइड करेगा कि सीज फायर का फेट क्या होने वाला है। आप देख सकते हैं वहां पे, यहाँ पे या तो आपको टैंक की मूवमेंट सुनाई देगी, यहाँ ऐसे धमाके सुनाई देंगे, या तो रॉकेट चलते हुए आसमान में नजर आएंगे, या वो इमारतें जो पूरी तरह से ढह चुकी है। आप देख सकते हैं खंडर वहां जो बने हुए हैं, वो खंडर डिसाइड करते हैं, भी बताते दर्शाते हैं कि इस इलाके में क्या हुआ है। लगातार यहाँ पे IDF टारगेट कर रहा है और ये जो खूबसूरत मकान है बिल्कुल खाली है, यहाँ रहने वाला कोई नहीं है क्योंकि लगातार हिजबुल्लाह की तरफ से फायरिंग हो रही है और हिजबुल्लाह लगातार टारगेट करता जा रहा है और यहाँ पे परेशानी का सबब है बहुत सारे परिवार यहाँ से घर बार छोड़ के चले गए। अब ये देखना है कि जो बातचीत इस्लामाबाद में हुई उसके बाद क्या रिजल्ट आते हैं, क्या लेबनान को लेकर कोई समझौता हो पाएगा, जबकि ईरान ने साफ कर दिया, वाज़ेह कर दिया कि लेबनान अगर सीज़फायर नहीं होता है, वहां पे धमाके बंद नहीं होते, वहां पे IDF का अटैक बंद नहीं होता है, तो वो इस समझौते में शामिल नहीं होंगे।
All right, that's our colleague really reporting from ground zero, from the place of the war. And remember, Lebanon has become a point of contention there in the whole ceasefire between US and Iran in the Middle Eastern tensions. All right, India is stepping up energy diplomacy amid global tensions. Petroleum Minister Hardeep Singh Puri is in Doha on a two-day visit holding key talks with Qatar's energy minister. Now, he also conveyed Prime Minister Narendra Modi's message of solidarity with both the sides pushing for peace and stability in West Asia. Now, backing this, MEA spokesperson Randhir Jaiswal says that Qatar remains a key energy partner for India, with Doha reaffirming the strong cooperation and its role as a reliable supplier to India. Both the nations have also welcomed the ceasefire, stressing the need to keep global energy flows uninterrupted. Let's listen in to what the MEA spokesperson had to say on these key developments.
Our Minister of Petroleum is visiting, as you know, Qatar on 9th and 10th April. Presently, he is in Qatar. Qatar is an important supplier of energy to India. He has had engagements with his Qatari counterpart. A press release has also been issued on the visit, so you can look up for details there. Our Minister conveyed greetings and message of solidarity and support on behalf of Prime Minister to His Highness the Amir of Qatar and to the Prime Minister and Foreign Minister of Qatar. Qatar Energy Minister reaffirmed Qatar's commitment to remain a reliable energy supplier and looked forward to continuing and strengthening energy relations and cooperation with India.
All right, to an important development that's breaking right here on Profit 360. Sources tell NDTV Profit that government is prepping for 30 to 40% demand spike for induction cookers, 27 gigawatt additional power as more households expected to move towards clean cooking amid gas supply shortage. For more on this, I'm joined by my colleague Rishabh Bhatnagar on the phone line with all the details. Tell us, Rishabh.
Absolutely, a very important development that has come out post today's interministerial briefing on the West Asia conflict. What we're picking up from sources is that the government is expecting a big uptick, about a 30 to 40% uptick in the sale for induction cookers and electric cooktops. And this becomes important as the government is looking at more and more people transitioning to cleaner forms of cooking. As gas supply shortages continue to hit the common man, what we're picking up is that currently India is seeing sales of roughly 1 crore electric cooktops annually, and the government is hoping that there will be some sort of a boost coming up to those sales. The government is in active talks with these companies that make these products as well, and and they've spoken to these companies on issues around boosting production for these electric cooktops. What the Power Ministry is also expecting is a 13 to 27 uptick in demand, additional power demand that will come as more and more people shift to this form of cooking on a daily basis. What we're seeing is that the Bureau of Energy Efficiency, which is a part of the Ministry of Power, they have already deferred the mandatory star labeling for induction cooktops from July 1st this year to January 1st next year, keeping this expected uptick in mind. So a lot of action on that front, and we can expect more developments on that very soon.
All right. Thanks so much, Rishabh, for getting us all those crucial details, of course, about the energy security and a short supply. Very, very critical details. Thanks for that. Now, the Adani Group has emerged as a successful bidder for Jaiprakash Associates, with the Committee of Creditors really approving its resolution plan. Now, the founder of the company Jaiprakash Associates, Jaiprakash Gaur, said the process was fair and transparent and that he respects the outcome. He also acknowledged the participation of both Adani and Vedanta in the bidding process. Gaur noted that the company, which has a long history in infrastructure, cement and real estate, had faced severe financial stress leading to insolvency. This is one of the largest deals through the IBC process in the recent times, remember. Now on to some political news of the day. Nitish Kumar has taken oath as a Rajya Sabha member from Bihar. And Kumar, who recently resigned from the Bihar Legislative Council after being elected to the Rajya Sabha, is now set to become the new Chief Minister of Bihar. He is expected to take oath as the Chief Minister in the coming days. And this marks his return to the post after a brief period of political flux in the state. So that's a big development coming in from political arena. With that, completely out of time on this edition of Profit 360, but do keep it with NDTV Profit. Thank you so much.
Presenting the all-knowing, all-powerful Tech Guru.
Whoa. Guru? I'm no guru.
Okay.
I'm just a guy who loves his tech.
A show where the mysteries of megabytes and motherboards shall be unraveled.
Bro, nobody talks like that anymore. This is all about connected ecosystems, EVs and AI that you can use in your daily life. That's what we do on Tech 360. Real talk, real reviews, tech that you can actually use.
Tech has changed. So should your tech show.
If you really want to see environmental action in India, we will have to revive community action.
How convenient you make it for somebody to choose a greener option, or how inconvenient you make it for them to choose a browner option makes a difference.
So we have eradicated road transport. Where we cannot replace it with the slurry pipeline, we are using this LNG or electric trucks.
Tamil Nadu votes decisive, uniquely the way it does.
Politics, power and cinema and all of that in an unprecedented Dravidian script.
This is not an election easy to call. It never has been.
And unravel grassroots conversations with the voices that matter.
That's why we travel across Tamil Nadu to get you the real picture. From the OG of Indian elections comes the next big political blockbuster.
Because
Tamil Nadu votes only the way Tamil Nadu does. Tamil Nadu elections on
Presented by Canara Bank. Together we can.
Hello and welcome back to NDTV Profit. You're watching KYC or Know Your Company. My name is Puneet Zaveri, and over the next half an hour or so, we'll try and put that focus on that one company that should be on your focus today. Today, we're focusing on a smaller name. Paka Limited is what the company is. Into the packaging space, operates into a niche business, but there is a lot to look out for this company. Now, of course, they are building a very complete as well as compostable packaging portfolio, and it's very important for the company to do it in a sustainable way. And you will get to hear from the management very soon on why that is the case as well. Now, when you look at the three segments, wrap and carry, food services as well as flexible packaging are the three categories. Roughly wrap and carry, which is effectively that if you go to a store like Subway, you can get a sub, wrap it, carry it and take it home. So all of that packaging is what Paka Limited does. That's almost majority of its revenue, and it is entering into flexible packaging. More of that in just a bit. But the other aspect has been that sugarcane bagasse, which is the company's raw material, puts into focus the sustainability part that I just spoke about. So that is about the company, what they do, and where is the raw material also. Now, since largely it is a B2B company, because wrap and carry is a B2B business, the food business, which for example they might go to a restaurant or one mom and pop store, they are a B2C client, so a business to a consumer client, but that is just 13% of the company's revenue. So hence a B2C portfolio, while being there, it's limited to that extent as of now. They are of course getting into new launches, also looking to double their product portfolio in the second half, which is already underway. So we'll talk to the management about that as well. But overall, we have seen that the clientele includes the likes of Haldiram, Baskin Robbins, Borosil, Cafe Coffee Day, and amongst others also. You will see the packaging part of it is all taken care of by Paka Limited at this point of time. When you look at the three key things that you will have to watch out from the management's conversation as well, that they are investing roughly between 100 to 140 crores via convertible warrants. Now what this will do is increase promoter holding, of course, but this is also used for the second key thing to watch, which is the new plant of almost 750 odd crores. Now that is for an expansion in Ayodhya for the new vertical which we spoke about, that's flexible packaging, and hence there is skin in the game, of course, and some of the capex has been taken care of from there. There's also 100 crore investment done by SBI Mutual Fund for this venture too. So you are seeing diversity come in funding apart from internal accruals. Apart from that, the big talking point has been the inventory days. Now sugar season, which is one of the sugar bagasse which I told you was the raw material, has a season between somewhere around October to November till April. So effectively H2 is where this company takes the inventory for the full year. But they haven't been very quickly been able to manage this, and hence you see the inventory days at over 450 days and a lot of capital being locked in because of that, and that puts pressure on ROCE. So that's the three key things to watch about. But let's look at the parameters now. Now there are 8 key parameters that we are focusing on. Income statement, of course, balance sheet and cash flow take the 3 key verticals. You also look at return ratios, where I just told you could see an impact because of a higher inventory. Apart from that, shareholding, street cred, return ratios as well as outlook is something that we focus on for this company. In terms of income statement though, let's go across and put that into perspective first. You see a 3-year CAGR of about 12% isn't the greatest for a company growing at 300 to 400 crores in terms of revenue. So hence in terms of the EBITDA, it's been flat for the last 3 years. So have the profits been, and hence we've given this a thumbs down for now. A lot to watch out for the company's new vertical flexible packaging, which will come into FY27, and of course for FY26 also numbers seem to be on a similar flattish trajectory for now, what we've seen in the first 3 quarters. When you look at the balance sheet, and of course the margin trajectory has been on a downward trend for FY25, and hence a thumbs down for now for the company. Looking at the balance sheet though, it tells you a perspective that while it has been a tough performance over the last 3 years, we've seen the other equity also increase materially because the company's 140 crore tranche of convertible warrants, half of that has already come. So you can see an increase there. From 240 crores to 445 crores, you've also seen the money come in from SBI Mutual Fund for the investment already. So you're seeing the equity largely being stable. Apart from that, the borrowing number has increased from 100 crores to 200 crores going into FY25. So this does have an impact on the interest cost too, which we saw in the previous slide. And hence, we've given this for now a thumbs down as well, because there has to be some improvements done in all of these key aspects. Cash flow also has been very, very weak in terms of the company, Actually, for balance sheet, we had given the company a neutral rating because there has been improvement in the equity portion of the company. So hence, we've given it a neutral. We'll come back to that in just a bit. Cash flow from operations, this is a thumbs down. Because the cash flow from operations has been constrained over the last 3 years. So from 51 crore, it's down to 11 crore, and hence the cash flow from operations to PAT ratio is also very depressed, down from 64 to 18%. So hence, we've given this thumbs down as well, as we continue to monitor this as well. In terms of the fourth parameter, which is return ratios, we continue to look at how the company has been able to withstand the capital advances, because the new capacity is almost 400 to 500 crores. So return ratios trends has been on a downward trajectory because a lot of capital gets stuck in the inventory, as I spoke to you about. Hence, we've given this a neutral rating because there is a change that is expected from FY27. FY26 might be the same, but the new plant will come in H2 of FY27. So somewhere around October of this year, and hence from quarter 3, start to see capacity utilization go up as well. In terms of shareholding, that's the fifth key parameter. We look at the promoter holding, has been down to 42% because of the investment coming in from SBI amongst others. But the company plans to increase this back to the 48 to 49%. Now there's a limit of increasing the shareholding by 5% in every year. So you will see this in Q1 of FY27 getting increased as well, which will be almost in the next 2 quarters. In terms of ownership, public do own roughly a majority of almost 52% of the company, which is a diversified shareholder base, and hence you've seen the individual shareholder number also increase materially as the company has underperformed in the last 2 years, something that retail investors keep a keen eye on. Street cred is the other one. Has been a tough period for the company. Stocks down in the 1 month performance, 6 months, 1 year, as well as the 5-year period. Given that we've seen that the last 3-year performance has been subdued in terms of the financial, that is visible in both the year-to-date performance as well as what you've seen in the 1 and 5-year period. So hence, this one is also a thumbs down from that aspect. A lot to improve for the company post FY27. When you look at the last couple of key parameters, let's pull those up very quickly as well, because we've seen consistently that valuations come into perspective yet again as well, but let's pull those up as well as the outlook for what the company expects. First, in terms of valuations, now very interestingly, now when you look at all of these players, Paka, of course, trading at around 62 times because the earnings and the profitability has just waned away. So you've seen the price to earnings ratio, the denominator has squeezed, and hence the price largely remaining stable to a downward momentum, hence the PE has increased. But in terms of a direct sustainable player, there's not a direct competitor there as of now. So when we've included the paper names now, a lot of them are into packaging, a lot of them are not. So you have to look at it from both perspectives, that while the stock is expensive on this metric, there won't be a direct comparison with West Coast, but we have to put in some peers to compare it with the paper players also, because they are also into packaging at this point of time. So this is also a very interesting one, a neutral rating here, because yet again, you will see that come in from FY27. But in terms of outlook, and let's give you that perspective very quickly as well, because we've seen the new paper machine to double capacity from to almost 9,000 tons by 2026. This is largely going to be something to watch. Strategic decisions will be to slow down into US as well as Guatemala will help company conserve cash. So ROC will improve going forward. B2C is an important vertical because it has better gross margins. We spoke to you about the food business being 13% of revenue, and they are looking to launch compostable solutions as well with the new flexible packaging vertical. So when you look at all of these key aspects, there is of course quite a bit to talk about with the company to cover the challenges that we've highlighted as well as what is the outlook for FY27. Before we do that, a quick look at the final ratings, because a lot of the parameters we look at are historical. Hence, you will see that income statement and cash flow are negative. Neutral rating or return ratios as well as balance sheet, which has been maintained because of the equity infusion. Shareholding continues to be a positive, so is the outlook. But there is a lot to look at the street cred, and this should be valuations, but we've spoken to you already about it. Finally, the ratings for the company out of the 8 parameters, we've given it a 3.5 because there is a lot to talk about and a lot to be visible, not in FY26, but in FY27. But let me welcome in Mr. Ved Krishna. At this point of time, I had a chance to speak to him about what are some of the key aspects that are the challenges part, what the company actually does to give you a perspective as well, and also on the return ratios and growth outlook. Let's listen in to what Mr. Ved Krishna had to say. Largely, there has been a lot to talk about, especially in the packaging business, with the growth that we've seen across verticals, across foods, across restaurants, across what we've seen also in e-commerce. So this is a very key aspect and a key conversation, because the listed peer gives investors a lot of access to Paka Limited now. Just how we start now. So you have two main verticals in revenue. You are investing for a third one as well. But and wrap and carry is one, foods is one. But just within packaging, if you can start us off with what are some of the key segments that you cater to, and who would you be competing with, both in the listed and the unlisted space? If we can start off with that.
Absolutely. Thank you so much for having me. So like you mentioned, two and the third coming up, we have three broad segments. We are totally focused on how do we make packaging regenerative. So for first and foremost, wrap and carry. So wrap and carry is everything we use for food, where you wrap a burger or you wrap a sandwich and then you carry it. So broadly, that's the focus. And how do you create value there? By creating products that are stronger, better printability, etc., so that people stay with a compostable substrate. The second one that you mentioned is food services. There again, it's all about how do you create value for the customer by having a very different eating experience. So if you go to a Haldiram or to an airport today, you'll get these brown colored plates and bowls, which have a very different experience from a styrofoam or a poly-based product. So those are typically manufactured by us. The third one where we've been kind of focusing on and building on is the flexible packaging domain, which is multi-layered substrates. All of us consume potato chips and chocolates and crackers. So they come in this structure where, no air goes in and no water goes in. And if you taste a bag of chips after 6 months of manufacturing, you still feel it's fresh, mainly because of that. So it's very difficult to crack in a natural substrate, but that's what we've been working on for a few years. And the base substrate is a very dense paper. It's something like a release paper, which is what comes out of the sticker. So when you see it, you'll find that it's a very dense paper. So that's what we are trying to create. So the new investment is all about flexible packaging. How do you transform that segment and create, we were talking just before you hit record, was that, how do you reduce that garbage pile that we are creating as human beings?
Got it. And in terms of, and thanks so much for the comprehensive view on the company. How are you, selling to its clients? Is this largely a business that's B2B, or have you also started a B2C vertical where you're seeing these mom and pop stores, these individual one-store outlets, which are of course expanding as well? Because we've seen an advent of those as well, especially in the foods businesses, especially when you see coffee verticals come up. If you can give us some perspective of how do you actually sell the products that you manufacture? Is it B2B, B2C? What's the strategy?
Yeah, so the wrap and carry and flexible segments are typically B2B because they are not a finished product. They typically go into another round of conversion. So in a wrap and carry, it'll convert into a bag or a wrapper and have some printing on it. In a flexible, it'll be similar. It'll go to a converter who will print on it, pouch it, etc., etc. And we want to do things at scale. So doing the conversion is not really something that we are focusing on. On the food services, you're absolutely right. It has been actually surprising how it's grown in the B2C segment. We thought, the B2C segment would remain like a 5 to 8% kind of revenue for us. But it's gone over 20% now, which is mainly because of quick commerce, which we never expected. And that's been a welcome change for us. And we did work closely with restaurants, like you mentioned. But in the end, they're also B2B. So it's a B2B2C. So, but in this case, now it's a direct to customer where the customers order directly from a Blinkit or a Zepto or a Flipkart or an Amazon and get their disposables at home. So we are actually learning, how do you do a D2C business? Because we've typically been in B2B segments traditionally.
Got it, sir. And we've largely seen that, before I come to the financials of each vertical and the growth and the expectation, the one key aspect has been that you've invested almost 100 crores to convertible warrants and almost 100 to 140 crores of convertible warrants. Just wanted to understand how much has already been deployed in the company and how much of it is remaining in terms of timeline, and what will your stake be after the full 140 crores is invested?
Absolutely. So this is all part of a large project we are betting on. And like I mentioned, flexible packaging. So it's a 750 odd crore project where there's a state-of-the-art line that is being created, specially designed to build these products. We are very excited because it should start in the next 3 to 4 months. So of course, these are long capital kind of outlay projects. So it's taken us a couple of years to build this. So the capital structure is such where there is about 240 odd crores that came as equity or warrants, and the remainder came as internal accruals and loans. What we have done is that 100 crore was taken by one entity, 140 crores was taken by another entity, and part of that was convertible warrants, which falls due in April now. The remainder is being deployed. The total spent now is already over 500 crores because again, it's on the verge of startup now. So we are hopefully going to see this project see the sunlight of the day later this year.
So your project in Ayodhya, which required an investment of 750 crores, almost 140 from these convertible warrants as well as another 100 crores have been deployed by the promoter for this project. Is that a correct understanding?
Oh no, sorry. I'm glad you repeated that question. So there were two external parties. The board in front of you, SBI Mutual, came in with 100. Carnelian Capital took partially warrants, partially equity. We diluted ourselves down to about 38%. But we are also buying in now. So we are buying in about around 100 crores. So my equity will go to about 49% again by next year, because I can only buy in 5%. So 5% comes in now and 5% will come in by April next year.
So I think as per the filing, I can see that promoters hold roughly around 41.6% stake as of the end of December. And you are saying that will go to 49 probably when both of these 5% comes in. So around 40 to 49% maybe by FY27 end. Would that be a safe assessment?
Yeah, FY27 beginning, because FY26, 27, we buy in 5%, which is in the next month or so.
Right.
And then, of course, I can only creep another 5%. I can creep 5% more next year. So the money will probably come in before, but it'll be converted to equity by next year, April.
Perfect. I got that clarification. So, and also a project in Ayodhya of 750 crores. When is the likely timeline? Is it that the end of the year, probably by Q4 is when you start production, at least in phase 1 for that? Is that, and then of course the capacity utilization will include gradually through FY27. Would that be correct?
So we are working towards Q3. We start production in Q3, and then yes, we stabilize Q4, and hopefully by FY27-28 we are up to about 70 to 80% capacity.
And in terms of the potential of revenue basically from this plant, what is the expectation on a full scale basis, if I can add without any timelines, once your capacity utilization is over 75 to 80%, what could be the revenue potential from this plant? And then any specifics that you can highlight for maybe for FY28, because you're saying that you will start only in Q3. So a couple of quarters to understand the nuances of that plan. So maybe in FY28, what's the expectation of revenue?
So yeah, starting from your first part of your question. So once we come to a steady state, if we just look at the base paper itself, which is the base for creating flexibles, the revenue potential is about a little over 500 crores alone from this plant. We're not talking about the revenue that will increase from our current operations. And then, of course, if we go into flexibles, that over doubles the revenue because you get into more barriers, and the quality and the value also rises. So we're talking upwards of 1,000 crores from the new plant once the coating also comes in, but that's planned a little bit later once the base paper is stabilized. In terms of the current year, yes, we will get some revenue from the operations of the new machine, but the real kicker will come in by next year to kind of add to our current revenue and the increase in revenue that we'll make from the current operations.
Mr. Krishna, what we've seen actually in the last 3 years is that the revenue has largely been actually kind of flat, kind of stable at almost 400 odd crores. Now, for this year as well, it seems to be that you're on trajectory to do that. But the margins, so firstly on revenue growth, before I come to margins, what is the expectation that, is it largely built on this new plant in Ayodhya that will drive the revenue growth while the current business motors on? Is that the assessment? And what has been the reason why the revenue has been largely in this 400 crore range for the last, since FY23, 24 and 25?
Yes, of course, we've been on the drawing board for these couple of years, but that doesn't take away the possibilities that we should have capitalized on. Mainly, we are a very innovation-led organization. Everything we kind of do is to do with how do you make the earth more regenerative, and that basically for us it's packaging. How do you make packaging more regenerative? So there are a couple of things we were betting very heavily on. One is how do you build more in the delivery space? And the other is how do you build more in the flexible space? So nothing stops us from going asset light, outsourcing, building partnerships for manufacturing, etc. But we have not been able to capitalize those. Those were expected in the last couple of years. But the great thing is that we have started getting into gear for those as well. So it will not be steady state from the current operations either. We will build on the current operations. We are trying to transform our food services division, where we are trying to bring in more revenue through outsourcing. We are also trying to bring in new ranges of products. Like I mentioned, the delivery range is something we've been again on the drawing board for a couple of years, and that's seeing the light of the day now. And again, it's a transformational product, and we will hope that that will take the fancy of the market and people will shift from petroleum substrates to renewable substrates. So that's the effort that will be there. And hence, so the steady state is because of, I would say a mix of working on the new project and not being able to deliver on the targets that we had set. But those are delays and not defaults. So the idea is that those will start kicking in as well, and the company will show a very different performance going forward.
Mr. Krishna, in terms of what you mentioned, right, that these are just delays and not revenue loss. So any particular reason why the revenue has been delayed? Is it largely because of capacity being increased? Is that the reason, or how do you see the traditional business growth? Because your new plant will of course address a new vertical, but for the other two, your wrap and carry as well as your food business, the growth has been a key contentious point, right? So how are you viewing this? What has been the reason for those delays essentially?
Yeah, so like I said before, we are a deeply innovations-led business. So everything we do has to be focused on how do you create materials that are regenerative, that don't harm any other species in terms of animals, fishes, as well as the ecology. So when you do that, you're kind of always in a learning trajectory. So when we look at, say, the delivery space, we want to transform the entire experience of the customer and not just make it regenerative. So that sometimes takes longer than our kind of optimistic thinking. But that said, those are kicking into gear, and we will get both. We'll get the new capacity and revenue from those. We'll get revenue from new products. We'll also get revenue from outsource side. So we have now got a couple of tie-ups in both food services and wrap and carry, where we are doing ancillary products to what we do through outsource means. So those will be more asset-light models.
The other question, because of paucity of time, has been the key aspect on cash flows, right? Because a lot has been invested, especially in the inventory. So inventory days are over 400 days now. Is there any plan? What is the, and that was for FY25, what has been the number for FY26 and the eventual reduction of the same? Is it something that because of raw material insourcing, that you are doing, it will largely be something that you have to continue to maintain, and what is the reason for the inventory specific to be so high? What can be a steady state from here?
Yeah, you identified it absolutely right. It's the raw materials. So we are based totally on sugarcane residue. You know, the fiber that is left from sugarcane, it's called bagasse.
Yeah.
And that's what because again, we want to use materials that are regenerative. So that's a waste for the sugar industry. The sugar season typically runs between November and April. We have to stock that inventory for the entire year. So what you see is basically a heavy inventory when we end on March 31st, because that's almost the end of the season. So that's our peak inventory. So that's just because it's a seasonal kind of business that we are in. So every year you'll see a higher inventory when we close. That said, this year it's even higher because we are stocking for the new plant. So you know, the new plant gets into gear, which means there'll be a higher capacity, which means higher pulping will be needed, and hence there is an overstocking on purpose. So it's still for the new plant, and again, you know, like inventory for us. And again, the second part of that inventory is fuel. We make our own energy. We are totally based on biomass. We are usually off grid. Only temporarily are we a little bit off on the grid right now. So we use biomass, which is mainly rice husk. And interestingly, the rice season is also the same. It's from November to April. So the inventory for that also is very high. So typically when we end on March 31st, the inventories are at a peak level, and hence you see a higher inventory days.
That's a wrap on this edition of KYC. Thanks so much for watching. A lot more action on the other side.
क्या सर्च इंजन के चक्कर में पड़े हो दोनों? अब कोई कंफ्यूजन नहीं. कॉल 9300
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversations.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices.
And here's where you can watch us.
The government has a very focused, very intelligent, very smartly devised policy for renewable energy. We combine that with the Indian talent for innovation. With these faculties that we have, I believe that anybody can follow to success.
As we say in the climate word, we need all hands on the deck for any sustainability solution. And NDTV joining this robust voice makes all the more difference to India.
Presented by Canara Bank. Together we can.
"2026 has been a turbulent year, more so than recent years. And depending on the way that you've invested, your portfolio will be in various stages of deterioration. But if you zoom out and look at decades, then weeks and months tend to look like flashes in the pan and nothing more. Actually, these are opportunities that can build the foundation for multi-year growth. In fact, my guest today on MoneyWise has said that bear markets excite him. I'm going to ask him how he's feeling at this juncture. I'm not in studio today. I'm actually out and about. In fact, at the office of Nippon AMC, and I'm in conversation with Sailesh Rajbhan, who is President and CIO Equities of Nippon India Mutual Fund. Sailesh, thanks so much for taking the time.
Thank you so much for having me.
So let me start with that question, which is, how are you feeling? And I must say that we're playing out this interview today. It's a safe harbor because things can happen very rapidly. How are you seeing things right now?
See, what's really interesting in investing is that the prices are right. Over the last 2 years, I think all the excesses are being given away because of large events. You had tariff challenges, you had significant FII selling, you had the war-related issues which were there, right? All of these have created kind of a sell-off in the market, which is making valuations very, very interesting. So for long-term investors, you can't get much better news or much better prices. And all of this always comes on bad news. So the real idea is to take advantage of the bad news which is there and create portfolios for the rolling next 3-year period. I think that is what is the best we can do. And you're today getting high quality, good businesses at fairly sensible prices. In fact, in a lot of cases, very, very sensibly priced, because everything that could go wrong is going wrong. Maybe 1.5 lakh crore of FII selling, oil prices at substantially higher levels. Then you had tariff challenges in the interim, right? So all of this has created an environment where prices are getting better while the news remains to be a little weaker than what one would anticipate. So I think good times.
So you're excited?
Certainly, boss. I think this is what is allowing us to do some work, find relatively better opportunities, think through differently. In elevated markets, you don't get those chances because it becomes only one game, relative attractive valuations, that's it. But here you get chances to look at business from a 3-5 year angle, buy them at sensible prices, which itself lowers the risk. So I think extremely good times from a investor point of view.
If you look at the way that markets have behaved in 2026, it comes on the back of an underperformance in 2025. So for the Indian investor, it has been practically 2 years of an unfortunate situation. But look, it comes again on the heels of 3 years of fantastic performance. So therefore, when you put all of that into context and you look at things right now, you talked about, in a sense, margin of safety. What do you feel when you think about margin of safety right now?
So, like you said, it's been 2 years of consolidation or lower prices. And after that, this kind of a 10-15% kind of a sell-off, right? Only these kind of events will take away the excesses of extreme bull markets, which happened from 2020, 21 till 2024, right? Till September 2024. So they have normalized valuation. See, the only real success for anybody is buying business at right prices. Rest of it, you have to leave for businesses to deliver, outcomes to come, markets to value them differently. So I think the current environment allows you to do that, which I think is the single biggest advantage of being in these markets, right? And for investors, typically getting these kind of prices has been rare for a last 3-year period. And people have to choose that, when you're getting prices right, you'll always get them on bad news.
So let me ask you this, because if I look at the schemes that you personally manage as well, and I'm looking primarily at the large cap fund and the multi-cap fund, I see that the turnover ratio is not very high. It's actually pretty low. So does that indicate that you have doubled down on investments that you already have done, and you've used these opportunities to add more weightage in certain cases than adding new ideas? How are you hunting and using these opportunities?
Sure. It's exactly the way you have mentioned. For example, you have seen very good quality businesses also correct sharply because of significant FI sell-off. That has given opportunities in those pockets. Normally, these don't come. Normally, these businesses remain at elevated valuations. Today, you're finding world-class businesses at 5-6 year flat prices. Plus, they are still growing and the opportunity to grow remains for them. So a lot of businesses like that are coming in, which were sensibly valued even before, but have become extremely more attractive because of the fall in the markets in the March period, especially from last November onwards till March. So we are continuously looking at those areas where solid businesses, sensible prices is the first thing. And second, there's also a segment where, we have seen good companies, right, which were obscenely valued because of the flow of money in mid and small cap and the euphoria. Those businesses have now given up 60, 70%. Those are the new ideas which are coming up where good companies with sensible prices there also, they may not be the greatest of the businesses, but their valuation corrections are 60, 70%. The P multiples have fallen from 50 to 20, 15, 12, right? And they have longevity of growth. So without compromising on longevity and quality of businesses, today you're getting a plethora of businesses across where you can deploy capital to, right? So in our portfolios, we have, in fact, the turnover has moved up in the last 6 months. So prior to that, it was much lesser because we were clear that markets were not offering much opportunity. So we've used that advantage to add on to these two segments of the market, which I mentioned.
The tendency, Sailesh, is to use broad brush when you're talking about Indian equities or any equities per se. And so therefore, you look at a benchmark Nifty 50 and you assign up a blended price to earnings. You look at the broader markets, you look at small caps as a whole, and you look at it as a contiguous whole. But as you've pointed out, there are a few pockets where there was froth and where the correction has been much steeper. Having said that, before we get into individual ideas or sectors, I want to ask about your opinion, right? Because one of the narratives that has been created over the last year and a half is that foreign institutions have been selling, domestic institutions have been lapping up. And so the dunce in the room is the Indian retail investor that has kept pouring money into the equity markets. Do you have a counter argument here?
See, when prices are getting better, it's always good to have it. It's a question of time frame. See, a lot of foreign investors have capital, though long-term capital, they're evaluated annually versus multiple choices they have. They have to invest in China, they have to invest in other markets, maybe they have to invest in US, they have to protect themselves for currency risk because that takes away the return which is there. So India didn't have any great opportunities from a global investor point of view in the last 2 or 3 years because there was no AI trade possible. Right. And there was no, I would say we had a tariff situation for some time, which was extremely unfavorable. And now you have this extended oil related shock, which has been there because of the war. So we were not in a situation where foreign investors were allocating. It's not because they don't think India is a 10-15 year story. They do believe India is a 10-15 year story, but relatively China had done terribly and was very cheap at that point of time. So they are choosing relative opportunities to reach their goal, right? And for Indian investors' point of view, the good part is people here have some time frame. You have a 3 year, 5 year, 7 year time frame to build it. And you get these opportunities only after that kind of a time frame because you get, say, these corrections provide those kind of opportunities to do it. So, and it's not a zero-sum game. I mean, I hear these FIs are selling, so they are possibly smarter than domestic retail participants. I think
that is the narrative.
These are little too
simplistic
narratives which are there, right? If Indian investors stay invested for a 5-7 year period, the outcomes can look very, very different.
I understand that you manage equity in India, but ultimately the owner is Japanese, and I'm just wondering what your philosophy is, whether it extends in diversification as well into global equities, because one of the other strong cases that people have made over the last year is, and usually it is, Sailesh, when you look at data that is last 1 year, 1.5 years, when there is a significant underperformance of Indian equities, hey, look, we told you, you should have diversified beyond just Indian shores. Is that a strong argument?
Yeah. See, over a longer period of time, yes, you need allocations to most markets. But if you look at those markets also, those 2 years have been phenomenal for them. India was virtually the only bright spot in the first 3 years of COVID. And then those markets caught up and did substantially well. So you'll have phases where different markets deliver returns, right? End of the day, do global companies offer a value add in terms of participation for long-term capital? Yes, there is no doubt about it, right? I mean, it should be a part of the portfolio. But it's a journey, it's not like you can time every market, move from one market to the other and generate alpha every year. I think that's a very, very, I would say an easy argument that, you can do this, you could have done that, I think this doesn't work, I think. But long-term allocation to global markets also is an important part of the allocation strategy which investors should do, in addition to participating in domestic market. Look at it like that. This narrative just a few years back was India is the only place for growth. India would be growing at double the growth of US or double the growth of other markets. Just because it's not done well for a 1-2 year period, it suddenly become why are you not in other markets? I think these decisions cannot be based on 1 or 2 years of outperformance of different markets. They have to be based on your allocation, what kind of diversification you really need from a 5-10 year angle, and then leave it like that, because that's how it will function.
First, I want to talk top, and then we can go to the rest. But there is a tendency in every crisis to say this time it is different. But Shailesh, over the last 25 years, you've seen several of these crises play out. Is it different this time around?
See, most crises depend on what is the starting point of it, right? You had a 2007-8 crisis where, we had a bull market, and then suddenly that big collapse happened of 2007 and 8, right? So the starting points were very high. Here we have already seen 2 years of correction. And then on top of it, we had a derating which was there because of significant FI sell-off. I think the only cushion, is that your starting point of valuations get better. And that, I think, has been happening now for the last 2.5 years. And that creates you reasonable, or possibly allows you for much better outcomes over a rolling 3-year period, right? To your point, whether it is very different from the past and things like that, I think your balance sheets are good generally in India, right? It's not a problem that, there is a crisis of balance sheet. This oil spike also, $20, $30 oil spike, we could normally manage. This was a $50, $60 oil spike, which is extreme, which nobody in the world can manage, right? So I think our fragility, which was there 10, 15 years back, is much lesser today, right? It doesn't mean that we will not suffer these kind of shocks, right? But I think if you look at it, had this $100, $115 oil happened, say a few years back, our reaction of markets would have been 25-30% down, right? So I think we are getting better. I think our sustainability is far better than what it was before. And it keeps on improving if we keep managing our financials and the fiscal side fairly okay.
I want to talk about portfolio strategy now. And we began, in a sense, talking about your philosophy and how this is an opportune time for you because it fits right into your philosophy, buying at a reasonable price. But I want to talk about your allocations and the way that you fit in. These might be incidental based on how you're seeing things, right? But you have been overweight on financials. And there are a few pockets which have emerged over the course of the last 1 year in terms of attractive valuations. My perspective, you please correct me if I'm wrong. Financials and, in a sense, IT has emerged because of the way that it's been beaten down, and a couple of other pockets as well. Why have you chosen to go so aggressive in financials?
See, you look at the financial construct, especially the private sector banks there today, their valuations are possibly 10-year lows in a lot of cases, right? Unless somewhere in a bad cycle that was different. But generally, the longevity of these businesses there, the right to win for these businesses there. And after consolidating for a period of time, you have an extended compression in valuations because of significant foreign ownership sell-off. So when you put all of this in perspective, it creates value. And the value is very interesting. I mean, valuations being for that kind of high quality businesses with reasonable certainty of growth over a 5-year, 7-year period, you're getting them at maybe 12, 13 multiples, right? Price to books are also very sensible. Each of these businesses also have underlying extensions. A lot of these businesses have significantly high value subsidiaries which have done well. And they are growing and they are less linked to the cyclicality of the banking sector itself. So you have many options coming in these businesses. And the most important thing is solid balance sheets, sensible managements, attractive valuations.
Okay, so that's the picture on the banking side. Will a change in inflation scenario and the possibility of interest rate hikes change the dynamic, or will it make that call stronger? Because one would assume that profitability of banks will improve as a deposit franchise becomes more attractive and they're able to get more deposits.
So it's a question of what kind of an inflation challenge we are looking at. Suppose we are looking at oil remaining at $110 or something like $100 for a 12-month period. It's a very different challenge. A protracted thing, it's a very different challenge. It will start hurting balance sheets then. But if you see a kind of a reduction in oil and, associated inflationary challenges which are manageable. See, the good part of India is our starting point of inflation is low. So in fact, last 2 years have been very sensibly managed versus how the world has been. So maybe we are in a better position to handle this shock also because of that factor. So if we normalize in a 6-month period because of all this, right, and our inflation is within our range at the point of time, I think we are in a good run for a lot of things to happen positively. So it will change only if you have extreme construct of the macros which go against, right? But still, I think valuations factor a lot of that as well.
Speaking of valuations factoring in negatives, the IT pack as a whole, right? The arguments have been made about terminal value and about changing the lens on how you look at these IT companies. But the reality is that they have been pummeled. Pummeled how, right? You don't have a very sizable allocation. You have a few of the frontline companies. But is there a reason why you've not necessarily partaken in what seemingly is an attractive valuation?
So the starting point was, the growth rates were slowing, right? In addition to that, you had this AI problem, which would, actually be, if people work hard, can be an opportunity as well, and companies can do that. But I think it definitely puts the difficulty to grow faster has only increased for them, right? Now coming to this price correction also has been fairly substantial now, right? So if you look at companies with 10, 15,000, 20,000 crore of cash generation in a year available at, say, sensible prices, about 15 multiples and all that, they start getting extremely attractive from a valuation construct. Also, a lot of this, when the first wave of narrative happens, right, you get compressed valuations, then the reality generally is slightly different from what you assume, because it's like a long range forecast people are trying to make. So we are looking for opportunities in this area also. Valuations for IT services are one of the cheapest you can find for this kind of cash flow generation, right? And if you look at, you talked about terminal value. Out of 5,000 companies listed in India, there are a lot of companies where you can doubt terminal value even today, and not just IT services companies, because the world is changing. And if AI changes so rapidly, it will also impact other sectors. It's not going to just be limited to IT.
When you talk about the small cap fund, right, there has been a certain alpha generation and outperformance despite the fact that it is the largest in the industry. The question that I have for you is to perhaps explain why there is a tail and how that relates to, not necessarily, but in a sense, the way that you manage your multi-cap fund and the allocation towards small and mid-cap, whether there are parallels that you can draw or similarities in the way that you approach picking of stocks.
Yeah. See, our basic strength as a fund house is that we look at bottom up as a very important driver for alpha generation. So it's stock selection. Stock selection is what derives, right? Buy the right businesses, hopefully get them at sensible prices and stay longer till they deliver. And that works across. So that is a philosophy for the whole fund house, right? Whether it's small cap you're picking up, whether it's mid cap you're picking up, I think the construct is similar, right? Now, when you look at buying ideas, our idea is to not have unnecessary concentration. In a bull market, it's very easy to keep buying your stocks and the prices keep moving up, right? Our idea is, are you finding relatively better value in some other pockets of the market which are there? Even within the small cap fund, we have about 30% generally in non-small cap, whether it's large cap, mid cap, and cash component, right? That also allows us to use that capital and convert that to keep buying in these kind of market conditions, switch to or add to more small caps when valuations get interesting. So we use these strategies to make sure that, we are kind of giving the right risk-adjusted return to investors. And you keep creating better quality portfolios or keep improving portfolios continuously, right? With better research and I would say better sizing also for positions at different points of time.
If you were to look at, and there are obviously two ways in which you can consistently beat the market. It is by falling less and gaining more. So therefore, low beta when the market is falling and generation of alpha when you're on the way up. If you were to choose one out of the two, which would that be?
See, first, I think normally when you look at returns over a cycle, right, both matter.
Yeah.
Right. If you're able to do that, you will not be able to do, you can't play one strategy only, right?
Sure.
But that's where, this 25-30% large and mid cap helps in the cycles in terms of allowing us to change the beta of the portfolio if need be, mix of the portfolio need be, because you generally can't move or change portfolios in small cap very frequently. So we generally do very long-term investing in these segments, and the other segment allows you to change it. Rightly said, I think if you have extremely expensive markets, the first strategy where you're kind of managing risk is where you have much better outcomes, because throwing money at markets and stocks actually lead to inferior outcomes, as we see, right? There are times like it's starting to happen and you have difficult conditions when you really get extremely attractive businesses at throwaway prices. Outcomes may take a lot more time, but that is where you attempt to get alpha. So it's about there has to be enough and more compensation paid for the risk you're taking. If that is not there, it won't work. So hence both situations matter. In the first situation, if there is too much of risk you're taking to get the same return, it doesn't work out. So there you have to lower the risk, and here you have to actually increase the risk of possibility. And that's where outcomes improve. So you have to use both of them in a sensible manner.
I want to ask you about what has changed perhaps since COVID-19. Because if I look at your own track record, then the 3 years prior to COVID-19, you relatively underperformed. But every year since COVID-19, you have outperformed. And that is, if I look at the last 5 years, both in a booming market scenario and in a relatively quiet market scenario. What has changed? Is it, so fund casing is something that Nippon is doing. Is that what is working?
Yeah. So see, there are multiple parts to the strategy which works, right? In addition to the framework, the fund casing you have talked about. If you look at markets prior to COVID, they were extremely narrow markets with just two sectors doing well. We as a fund house have a philosophy of growth at sensible prices. There were no sensible prices in consumer stocks. So we had zero or very little ownership in consumer stocks. It was private sector banks, that to select few private sector banks, and rest of them were at all public sector, and all these stocks were at extremely low valuation. So we chose sensible value at all points of time in those markets. So you will have phases where outcomes are not there, but when you look at what you did in those 3 years is determined outcomes post-COVID. So I think what you do in difficult markets gives you the returns. Returns never come in what you start doing it in a bull market or a good market, right? Look at the largest PSU bank, right? It's up 7-8 times from lows, right? Where you had private sector bank during that period given only 5% return. So now the opportunity shifted more towards private sector banks, which have underperformed for 6-7 years, and they can possibly have better outcomes. So it's about consciously choosing every rolling 2-3 year basis where to bet, where to stay invested, where is there sensible value available in the market. And that will come only in dislocated markets. 2017-18 were completely dislocated with 3 sectors, 2 sectors doing well, which provided enormous opportunity in the whole engineering, whole manufacturing, whole PSU banking pack, right? Hotels, other cyclicals, everything was at distress valuations and bankruptcy valuations. So our idea is to take advantage of these conditions, right? Take the right risk is what we internally call, take risk, but take the right risk which pays you in terms of long-term returns or better alpha for the portfolios.
Just to close out, and this is something that I try and provide as an opportunity to all money managers that speak to me on this program, which is a message that you can send out to people that potentially invest with you or existing investors, right? Which is setting expectations. You've had 2 troubling years, and we began the conversation with this. As you look out into 2026 with the caveat that this is unprecedented turbulence and volatility, how do you set those expectations?
Yeah. See, clearly it's a consolidating market as we see today, right? Prices are better, but news still doesn't remain the best. I mean, it's improving a bit, but it's not that oil is at $70 and it's not that the news is still the best, right? So I think this is a market where you accumulate for 27, 28, 29. This is a market you don't run away from, because this is what will give you outcomes which are better. So typically people are investing in SIPs, right? They have a 3-year, 5-year horizon. Maybe these are times to double up your SIPs. I mean, for this particular 12-month period where you are getting this bad news, which is giving you interesting prices. So it's staying the course, right, is extremely important, because in these 2 years where markets where, say, India has not delivered so much in terms of equity returns, the size of the population has gone up by 25 million. Right, so you've got significant increase in market opportunity also, right? Plus a lot of businesses today are world-class businesses, prices are in your favor. So accumulate, use this period to accumulate and be there.
You've already talked about financial services as one of the primary legs of the growth for you that you're looking at. What else looks extremely attractive in your opinion right now?
See, good part is high quality businesses across sectors are starting to derate or have derated massively. I can give you a whole list of companies which are 6-7 years have given zero return. And these were the companies where the world owned as if they are the kind of companies for the next 50 years. If you remember in that era of low or zero interest rates, people used to talk that these are businesses to own forever. They'll trade at 60 multiples, 70. They have all normalized now. The private sector bank, the most hated, like why I'm highlighting that is, that was a reverse situation where people only wanted to own private sector banks about 2 years back, right? Or say 5-7 years back, right? There have been flattish returns for that particular period of time. So wherever you're finding high quality companies where 6-7 years of consolidation happen, prices are becoming normal, and the quality of those businesses are not deteriorated, is a very, very large opportunity across sectors.
They exist in consumption and pharma?
They exist across category. Pharma, consumption, IT services, right? Today people have difficulty in talking about companies which are making 20,000 crore of cash. So I think all of this is expectations versus reality is shifting. And if you're able to get that right, these kind of businesses pay you off with the least. There's a classic case of quick commerce saying it'll destroy retail in India and all that. You see what happened in the last 7 days, right? So India is much, much larger than what we are able to put in our Excel sheets and try to do it. I think the idea is to catch these shifts because this is free alpha lying down because people are disconnected from where the reality is.
Fantastic. On that note, Shaleshwan, thank you so much for taking the time.
Thank you so much, Alex. Thank you.
Well, that was an interesting conversation, wasn't it? Let us know what you think in the comment section and stay tuned. This is NDTV Profit.
Tamil Nadu votes decisive, uniquely the way it does.
Politics, power and cinema and all of that in an unprecedented Dravidian script.
This is not an election easy to call. It never has been.
And unravel grassroots conversations with the voices that matter.
That's why we travel across Tamil Nadu to get you the real picture. From the OG of Indian elections comes the next big political blockbuster.
Because
Tamil Nadu
votes only the way Tamil Nadu does. Tamil Nadu elections on India's original election voice.
Presenting the all-knowing, all-powerful Tech Guru.
Whoa. Guru? I'm no guru.
Okay.
I'm just a guy who loves his tech.
A show where the mysteries of megabytes and motherboards shall be unraveled.
Bro, nobody talks like that anymore. This is all about connected ecosystems, EVs and AI that you can use in your daily life. That's what we do on Tech 360. Real talk, real reviews, tech that you can actually use.
Tech has changed. So should your tech show.
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversations.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices.
And here's where you can watch us.
if you really
क्या सर्च इंजन के चक्कर में पड़े हो दोनों? अब कोई कंफ्यूजन नहीं। कॉल 9300
We're talking to the top team at TCS at a time when the biggest question about this entire space and India's largest IT company is what the future holds. And we have the opportunity in a quarter where their numbers have looked, I think, better than most expected, to ask some of those questions. K. Krithivasan and Aarthi Subramaniam with us. Thank you so much to the two of you to give us time on NDTV Profit.
Thank you.
Let me begin. Of course, the numbers have been, I think, better than most estimates of the street. But let me start with the elephant in the room and the conversation which has gone on through this quarter, apart from the numbers, which is what is going to be the revenue model, the survival, the outlook for IT services companies with AI in the picture. Let me begin by directing that first at you, Krithi.
I find the revenue model in the future is very bright. Okay, I say this for a few reasons. One, the system integrators have, what is the main role of system integrators? We make the technology work, deliver the outcome for the business. And we do it because we know the context in which the technology has to be implemented. So the fundamental nature of what we do doesn't change with AI. And now coming into the, moving from philosophy into the specifics. We'll take the first concern some of you would have on the, will AI remove the jobs? What AI, currently what you are seeing, it probably brings in maybe 20, 25, 30% productivity. Now, based on the discussions we have with most of our customers, what we find is just the productivity gain comes in, but that productivity gain is flowed back into other transformation engagements or other backlog they have. This is point number one. In my view, point number two is for any enterprise to even leverage AI, there is so much of groundwork needs to be done. Like you have to get your data estate right. You need to get your model architecture right. You need to get your agent architecture right. You may have to train your SLMs. Okay, you may have to fine tune them. So there's so much of work that has to happen. Third is even if you have all these things, you still need someone to work with you in reimagining your business process so that AI delivers a true value for you. AI's value is not in reducing 15-10% on the IT budget. AI's value comes when you are able to improve your customer's experience, bring new product, new service. And that's where we've been helping our customers. So if you look all these things together, I believe actually our opportunity space is increasing and not under threat.
I will come to the bit on employees in just a couple of questions, if that's okay, because I think 30,000 employees have been, the headcount has been reduced over the last 3 quarters, 2,500 odd increased. So how does that math work up? But the question is not so much as of the opportunity for AI or the number of employees.
It's an opportunity for system integrators is what I said.
How will you bill clients? How will you charge clients? Will you have to charge them differently with AI in the picture now that you need less people to actually provide those services?
No, that's
very simply
put. I said, the first thing I said, we may need less people for doing what you are doing today, but you are going to be much more than what you are doing today. So when you are going to be the whole space is expanding significantly. I said, what you are doing today, you may get 20% productivity, you may probably do 20% less. But there's so much of additional work that needs to happen. Who is going to do it? So I'm not expecting that we will need much less people than what we have today.
So the revenue model does not change significantly.
Revenue model in terms of how you price your services can change. Right. But I'm not expecting a shrinkage in the overall revenue on the trajectory of revenue as well.
Okay, so there's no AI discount or AI deflation that can come into place? Overall.
Yes.
Okay. How you charge your services or bill your services, how do you think that changes?
It can proceed, like eventually AI has to deliver the business outcome or and because of that, we will be signing up to programs where there's an outcome is also guaranteed. But like we have seen always, this needle will move slowly. Currently, we do programs more in a fixed output model.
Yes.
Where you deliver, that probably will continue, or where you commit. If you are doing a migration program, or where I say technology modernization. The technology modernization you will deliver based on, if I'm moving from technology A to technology B, I can charge a fixed price. These are all models that exist even today. Okay, where we move to outcome-based model, the needle will move slowly, but it will happen. I don't expect that to happen dramatically overnight.
What is the timeline you expect that outcome-based model to come in?
It can be 2-3 years. I don't want to put a timeline to it, and it doesn't really matter as much as whether the model is T&M based or outcome based. I don't think it matters as much.
I think the big takeaway that you don't expect revenues to get impacted in any significant fashion in the foreseeable future. If I may come to you, ma'am, on the employee bit of it, and you've had a plus on the headcount point, at least this quarter. Do you expect the quality and nature of people that you add on to now change in line with new outcomes that are expected or new demands from clients vis-a-vis AI?
See, if you really look at demand, right, I think first it's important to understand where customers are spending money, right? Like Kriti said earlier, there is, run optimization which is happening, which is where it's all about productivity and efficiency. Then there is, transformation. There are 3 types of transformations our customers are embarking on. One is, transformations which are enterprise transformations, things that we have been doing for a decade, whether it's the cloud modernization, data modernization, implementation of enterprise systems like SAP, Salesforce, right? So those things are continuing and there is demand for those services, right? So we continue to build those niche skills. The next one is modernization that Kriti touched upon. That's again a huge opportunity because with AI, you can actually solve for tech debt faster, better, and also cheaper. So those programs are coming up. And again, there is, a lot of AI. You need the knowledge of the legacy technologies, plus you need the AI talent. That's coming together. The third type of transformation are what we call the pure play AI transformation programs, which are the business impacting programs that Kriti alluded to earlier, where again, there are different skills. So with the rapid change in technology, there are new skills coming into play, but a large part of the new services, whether it's cyber, cloud, and everything that I talked about, we're continuing to build skills in-house and also hire for niche skills. The other color to this is that we are also investing in more advisory talent, right? More consulting and advisory type of skills, because you want to shift more to the right in terms of how you engage, because with AI, you need to really help them reimagine what they do, their workflows, the process. So we're bringing the higher, experts with consulting and advisory skills as well. So that's how we are approaching.
In terms of net numbers of headcount, and I think I laid out a few of them before. If I look at the last 4 quarters, the cuts that have come in versus the increments, what direction are you heading in? What is the kind of headcount outlook you're seeing?
See, we are continuing to, 2 cadres of talent intake. One is on the fresh campus hires. We hired more than 44,000 last year, and we already have 25,000 offers which are already given out for this year. That's on the entry level, campus hires. On the experienced professionals, again, we hired a significant number last year, and on the based on client demands, we'll continue to onboard the experienced professionals.
Has the right sizing process now ended, which you needed to do a few quarters ago?
Yes.
That restructuring is done?
Yes, that's restructuring is done.
Only point I want to add, we never called it right sizing.
Okay, fair enough. That's a
we said
term
we wanted to be a future ready organization. Our talent model has to be future ready. We only said there are certain people who are in a senior management or middle management who will not be able to adapt to the new future ready or the new ways of working, who will be respectfully outplacing or later releasing from the organization. So it is nothing, we didn't have a size. When I say small, we didn't have a size in mind saying that I need to cut down my organization by this much. And to be again to correct, it was not AI induced. It was essentially getting ready for a future ready model. It's not because of the productivity we gain, we did not let go anybody.
That process is now done.
Yes.
Yes. Okay, I think that's just important to note. The other point that I wanted to talk to you about, and I know we have limited time, so I'm just putting in, I would say, the major FAQs into this interview. All of these new models that get released every few weeks by a company that you are partnering with, and latest is Mythos. You have all of these new models come in, and every time the comment is, will you need traditional IT service companies less and less if there's a new cloud model which does the work of, say, a legal team more easily or an HR team more easily? Mythos is the latest. How do you look at all of these updates?
You want to take it, Ashley?
Sure. See, if you really look at it, all
answering this question since morning. So
see, I think if you look
maybe you should then both of you swap.
No, I think if you really look at the model capabilities, ever since the Gen AI moment in November, December 2022, model capabilities are rapidly developing. And every time a new, if you look at, let me give you an example, right? You take software engineering, coding, right? Coding assistance, and if you look at last year, compared to FY25, we were looking at 10 to 15% productivity with the coding assistants, which were of that generation. Last year, that number moved to 20 to 30. So I think the improvements are definitely coming, and with the newer versions, we are the first ones. As soon, for example,
it's not a threat to you. It's not a threat.
It is an opportunity to be more productive, more efficient. And if you look at coding assistants as an example, using coding assistants for doing the engineering work we do is mainstream in FY26. And the adoption will continue to increase. And like I said, there's so much of latent demand in enterprises. So the optimization that you bring, you want to do more work. So it's an opportunity.
It helps in productivity. It doesn't eliminate.
Okay. I must ask some questions about what your quarter has been like, so let me do that as well. The numbers, of course, are looking robust. What is the sense you're getting in terms of demand at a time when it was first tariffs, now there is a Middle East crisis, there's war? Is that impacting appetite or continuing to impact appetite?
See, while the macro or geopolitical overhang could be there, but you also see we had one of the best order books this quarter.
Yeah.
This 12 billion, and for the year we closed 40 billion order book. We signed 3 mega deals. Okay. And our number of $100 million clients, it went up by 4 this quarter. If you look all these lead indicators, it gives us a lot of optimism about the year to come by. So we are quite positive. While there could be some macroeconomic overhang for a short period of time, we are very positive about the future.
The revenues are also looking robust.
Yes, 3 consecutive quarters of growth.
Correct. Some of it powered by the newer acquisitions?
There is in this quarter, about 40 bips of revenue came through the acquisition.
Okay. And do you see more acquisitions on the anvil? Because a lot, and what you put out...
We continue to look for the right opportunities, right assets, where if you're based on the acquisition, if there is a synergy, where we can grow faster, definitely we look at it. We always said we will be doing it for getting competency at the scale and speed. So it will be for the capabilities, right? If we find it's the right capability and it will help us grow faster, we will look at that.
One last point I will touch upon, and this is also because, when we spoke last, you talked about how you aim to be the world's largest AI tech services company. How close are you to that goal?
Oh, we see we are progressing very well. We have laid out, I think last time also, we said we have got a very well-defined 5-pillar strategy. And we are executing on the pillars. We are very happy with the way we are progressing, like be it training our own associates, adopting AI within TCS, and Aarti and her team have come up with a model where how do we reimagine the services we deliver to our customers? How do you mature them? she calls it autonomy scale 0, 1 to 5. So we have defined it for almost all service lines, and how we are making AI real for our customers. Again, we have come up with number of rapid builds, and we've got making our contextual knowledge come to play life for our customers. And last is what we did in terms of acquisitions and what we did in terms of Hypervault. We're quite happy with the progress you're making.
And if I may just add, I think if you see our AI revenues from last quarter to this quarter annualized has increased from 1.8 billion to 2.3 billion, which is a huge positive.
You see that trajectory continuing?
Yes. And the other thing I would say is the kind of progress we have made on the Hypervault initiative, which is a key component of our end-to-end play, which we call it infrastructure to intelligence. I think excellent progress made by our teams, and you have heard some of the announcements that we made with OpenAI and AMD, and we see that going very well. So the whole AI ecosystem thinking that we are bringing into this is starting to play out extremely well.
Truly, it's front and center. If I just may ask about the 1 gigawatt data center, that's the other huge one. And one of the reactions to that, at least from analysts, was, is this going to be margin accretive? Is this where TCS should be really spending the money? Will revenues come in? If you could just address that bit.
She just said, right? After the announcement, the number of partnerships that we've been able to sign, and the number of other players in the industry, be it hyperscalers or be it model providers or power gear makers or cooling, so many other people are interested in talking to us, and we are in very interesting discussions with many of them. So I believe overall, it could drive our revenue. We maybe start seeing the revenue from sometime in CY28, because when it becomes operational. But the discussions are very robust, and we're very happy with the way things are progressing.
And this adds a very unique dimension to building strategic partnerships with our customers and also with our partners.
Well, Anand Rathi Wealth has come out with a strong set of numbers, and they have also announced a bonus issue of 1:1 as well. But to get in more perspective about the earnings and the outlook ahead for the company and the industry, we are joined in by Feroz Aziz. He's the joint CEO at Anand Rathi Wealth. It's always a pleasure to have you, Feroz, with us, and congratulations on the good set of numbers. But just want to understand the overall sentiment in that HNI category which you are catering to. Has that actually, the growth rates which we are expecting maybe 2 years ago when the IPO had come of the company, and now seeing the market conditions, is the asset allocation playing a bit differently? And if yes, is it hitting the equity segment, at least for the segment which you are catering to?
Yes, Sharad, but I think this is my 18th quarter as a company result. So we got listed in December 2021. This is our 18th quarter. We've always been telling our shareholders what to expect out of us, and because we understand our client segment and we filter our clients on certain basis. So to answer your first question, whether the asset allocation has changed, the answer is no. When markets are down is when we get our clients to buy more. Are they inherently very positive at these times? The answer is not at all. That's when me and my colleagues, 393, 400 of us, go into the market and tell them that market always goes up. That's the reality. There have been 12 wars. Market has gone back up once the war has finished. But that data is too difficult for one to notice by himself or herself. So we as advisors handhold them, is why you would see a large portion of equity allocations happened in this quarter when the market sentiment was bad. Left to themselves, I as an HNI will also be very depressed. There has to be some Sathi who comes and brings in rationality rather than the heart aspect of wealth management. That's why you see net mobilizations have been good for the quarter. Asset allocation has not changed though.
Okay, so the asset allocation hasn't changed, but the growth rates which was there, I think you have given a growth rate of that 20 to 25% growth rate. Will that continue? Will you stick with that guidance going ahead also in the long term, or is there something there for the medium term which is different?
No, it's not very different, because we've created a very uncomplicated business. Our pitch to the client is also uncomplicated. To the shareholder also, we have a very uncomplicated business. We don't sell agile things. We sell to our clients what is actually needed, not something so innovative that money becomes experimental. So coming back to your question of what's the growth guidance, we have guided 1,415 crores of revenue on a base of 1,198, which is what we finished last year. We had again projected 1,175. We did 23 crores more of revenue than projected, owing to the principles which our elders in the company have laid down. Don't overcommit, always undercommit and over-deliver. With the same principle, we are committing a revenue of 1,415, a profit or a PAT guidance of 460 crores. And an assets under management guidance of 1,20,000 crores. We ended at 93,000 crores. These again have to be seen with a conservative bent of mind when we guide, and that's where you see last 4 years we've always given a guidance and have met it. And there has been not any quarter less than 20% growth, and we are one of the few companies which have been able to do that for 18 consecutive quarters.
Right, definitely the guidance everything takes in. I just wanted to understand a little bit more, especially on your operational parameters. The active clients, that's how much current levels is there. The growth was around 14% which I checked on a year-on-year basis. And how does this client addition is panning out? Is there any change happening in the constituent of the client, or is it going towards a larger client bases, or the smaller ones are also getting included? How's the change happening in the client setup right now, if any?
Sharath sir, your question has 2-3 questions intertwined. Let me first break it down. How do we acquire clients, and what is the segment of the clients we acquire? When we acquire client families, we are very selective of whom we want to bring in. We don't bring short-term clients. We don't want to add assets from people who are not investing for a lifetime. We want intergenerational wealth. Largely, that's how it works. That's why our client attrition numbers are point in decimals, if not in second decimals. On a quarterly basis, they are in second decimal. So coming back, we have a very, very tight, clear mandate of what is our target segment. Having said which, we acquire using references, cold calls, website leads, people coming to us, or maybe LinkedIn and all these social media platforms where you reach out to people. What we have seen as a complete change over the last 5 years, of course, not over the last 1 year, is our reference is almost gone up to almost about 56 to 60% of our new clients are coming out of word of mouth.
Right.
Our number of cold calls have come down significantly. Now, a lot of clients have now realized that Anand Rathi Wealth is a serious player, and people reach out to us. And that is also one of the important trends of a pull strategy, which has started working, and there are green shoots of it. In the next 3-4 years, I think most of our clients prospects will walk up to us, is the assumption.
Exactly. And Feroz, in current market situation, of course, there is domestic exposure also. But is there any other instruments which you are giving your current or your prospective clients, something new, which, the way the world has changed, the equity has changed? Is there something more being offered, or is there anything on the anvil?
No, new is very overrated. When it comes to money, we have to see whether my objectives are being met. Most of the clients' returns over the last 4 years, 3 years, even 11 years when we started running a full model portfolio has delivered about 14% even after this war on a compounded basis. If one were to have given me 10 crores, December numbers I remember, on 1st of April 2014, and he said, do what your model portfolio says, I would execute it as you say. Then he would be at 57 crores in little over 11 years. And of course, don't remember the numbers of the March. That's why I'm giving you little dated numbers. So coming back to your question, new is overrated, point one. You only do new stuff if your objectives are not being met. Our clients' objectives between 13 and 15% over long term are being met because you're using lower risk platforms. That's why you've become the largest mutual fund distributor other than banks and aggregators. Anand Rathi Wealth has used mutual funds, which is the lowest risk and tax efficient platform. So not so much innovation. If a client, and like you rightly said, clients love innovation, prospects certainly do. We tell them we are not here for entertainment. We are here to do the same boring stuff as long as it works. Wow. And that's how it is.
Well, thanks a lot, Feroz, for that. And a lot of our viewers must be seeing how the business is actually run in private wealth and how you sustain. So this is very much important. Thanks a lot, Feroz, for giving your views, and best of luck for the future.
Thank you, sir.
A consumer eats by his eyes first and then by his tongue. Your fruit is ugly in the way it looks. Market is trending at 10 bucks a kg and you have got 4 rupees a kg.
It's unusual for those who come from farming families and break away to come back to it.
Our parents, being farmers, put us in a boarding school in Pune with the hope that we never come back to farming and the village life. I think 4 years into a banking job, we realized we were not cut out for this world.
What was the reaction from the family?
Dad was really uncomfortable seeing us both back. Farming has become socially unacceptable. If you're a farmer's son or a farmer by profession, no one even wants to marry their daughter to you.
It's almost like a movie script that you come back, but then there's this very tough part when you realize you have to actually make a living.
The practices over the last 50 years, conventional farming practices, have ruined soil fertility, and that concerned us.
So initially when we got back to farming, there was never an idea of forming a brand or marketing or a business around it. It was purely for the love of it. We had no credentials in agriculture. We understood farming from the people on the farm who were doing it.
How does this dynamic work in running a business? Oh, you're obviously the quiet one.
I take care of the back end, which is all the manufacturing, accounts, finance, the supply chain.
And I take care of the front end, which is more growth focused, marketing, branding, fundraising. Yeah, it's been easy because apart from being siblings, we were in hostel together.
Yeah.
From literally from KG till PG.
Tamil Nadu votes decisive, uniquely the way it does.
Politics, power and cinema and all of that in an unprecedented Dravidian script.
This is not an election easy to call. It never has been.
And unravel grassroots conversations with the voices that matter.
That's why we travel across Tamil Nadu to get you the real picture. From the OG of Indian elections comes the next big political blockbuster.
Because
Tamil Nadu
votes
only the way Tamil Nadu does. Tamil Nadu elections on India's original election voice.
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversations.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices.
And here's where you can watch us.
The government has a very focused, very intelligent, very smartly devised policy for renewable energy. We combine that with the Indian talent for innovation. With these faculties that we have, I believe that anybody can follow to success.
As we say in the climate word, we need all hands on the deck for any sustainability solution. And NDTV joining this robust voice makes all the more difference.
क्या सर्च इंजन के चक्कर में पड़े हो दोनों? अब कोई कंफ्यूजन नहीं. कॉल 9300
A consumer eats by his eyes first and then by his tongue. Your fruit is ugly in the way it looks. Market is trending at 10 bucks a kg and you have got 4 rupees a kg.
It's unusual for those who come from farming families and break away to come back to it.
Our parents, being farmers, put us in a boarding school in Pune with the hope that we never come back to farming and the village life. I think 4 years into a banking job, we realized We were not cut out for this world.
What was the reaction from the family?
Dad was really uncomfortable seeing us both back. Farming has become socially unacceptable. If you're a farmer's son, if you're a farmer by profession, no one even wants to marry their daughter to you.
It's almost like a movie script that you come back, but then there's this very tough part when you realize you have to actually make a living.
The practices over the last 50 years, conventional farming practices, have ruined soil fertility, and that concerned us.
So initially when we got back to farming, there was never an idea of forming a brand or marketing or a business around it. It was purely for the love of it. We had no credentials in agriculture. We understood farming from the people on the farm who were doing it.
How does this dynamic work in running a business? Oh, you're obviously the quiet one.
I take care of the back end, which is all the manufacturing, accounts, finance, the supply chain.
And I take care of the front end, which is more growth focused, marketing, branding, fundraising. Yeah, it's been easy because apart from being siblings, we were in hostel together.
Yeah.
From literally from KG till PG.
Welcome to this very special episode of The Disruptors. A huge aspiration for families when they educate their kids or even for youngsters is, what do you want to be when you grow up? Doctor, engineer used to be a thing of the past. That's also still very exciting. I want to be in tech, or maybe I want to be an entrepreneur. But it's quite rare that you hear someone who wants to be a farmer. And that is part of the story that we're talking about today when we cover the founders of a brand called Two Brothers. These are two brothers who are with us today, Satyajit and Ajinkya. Thank you so much for coming in and joining us on The Disruptors as we talk about your story. Satyajit, let me start by asking you to explain what your story is, what your company is, and what your journey has been.
Super. Thank you, Tamanna, for inviting us over. It's a pleasure to be, like you said, in some light after the farm. So, well, we both are farmers' sons, and we come from the small village called Bhodni, which is south of Pune, 2-hour drive. And our parents, being farmers, put us in a boarding school in Pune with the hope that we never come back to farming and the village life. And I think, we did what they wanted us to do, did an MBA, and then got working with banks. I was working with Citibank, and he was working with HSBC. I think 4 years into a banking job, we realized we were not cut out for this world. And so I think, 12 years back, we decided to go back to the farm and the village to live that life, to be amongst livestock and growing food. Once out there, like they say, the grass is always greener on the other side. When we landed up out there, we realized the grass is green, but it is not sustainably green. The practices over the last 50 years, conventional farming practices, have ruined soil fertility. They have reduced biodiversity both above and below the soil, and they have made food which is bereft of any nutrition. And that concerned us because we wanted to pass on our farm to the next generation and give them that choice of doing farming. And so, our journey of discovering sustainable farming practices started 10 years back. And then we, switched our farm from a chemical-based farm to a natural farm.
So we'll go through the journey of the story, but I have to start right at the beginning because it's unusual for those who come from farming families and break away to come back to it. It is, and in fact, it's a crisis of sorts because next generation of farming families don't want to farm. They want to do anything else. That's the dream. What has been your reason for coming back? I know you're the younger brother, you're the elder brother. I know he took the plunge first. Why did you have to follow?
In fact, I took the plunge.
You took the plunge first. Okay.
So I think it's purely for the interest of farming. As children, we had grown up on the farms. We had seen the life on the farms, the cows, the cattle, the kharif, rabi crops. And when we started working in Pune, Mumbai, Delhi, I think somewhere we always kept bouncing ideas, and it was always, we feel more comfortable at the farms. One life, let's do what you like. And that's how we came to the conclusion of let's get back to farming and let's go and explore.
So years of boarding school and then, life in the corporate world did not take out the farmer from you.
No, in fact, I think it instilled that will to get back to farming even stronger.
What was the reaction from the family? Because I know this is aspirational as well for a lot of farming families that our kids should have more opportunities. So what was the reaction when you went and said, okay, I want to come back and be a farmer?
No, so, Dad was really uncomfortable seeing us both back because, like I said, at age 4, he put us outside the village. And he said, never come back, go to a larger city, a larger country. And when we decided to come back, after ticking off all those boxes, he was very uncomfortable, and rightly so, because over the last 50 years, farming has become financially unsustainable. Farming has become socially unacceptable. If you're a farmer's son or a farmer by profession, no one even wants to marry the daughter to you. It's become such a situation back. So I think both our mom and dad were not very comfortable.
I think the idea of progress was, you move to a better city or you move to a Western country. That's progress.
Did you have that opportunity to work outside India?
Very briefly, while working with the banks, we did go outside and see the outside world, so as to say. And, like he said, it made our desire to go back to the farm even more stronger.
Yeah. Now, you come back to the farm, it sounds like such a romantic notion on paper, right? It's almost like a movie script that you come back, but then there's this very tough part when you realize you have to actually make a living, and then you create a business which is doing now a 300 crore ARR. So how does that first plunge happen, and what was the initial phase like?
So initially when we got back to farming, there was never an idea of forming a brand or marketing or a business around it. It was purely for the love of it. I think back in 2012 is when we quit our jobs, went back to the farm. What was being farmed out there was sugarcane. We come from the western side of Maharashtra. The commercial crop of the sugarcane. We took to it. Now, we had no credentials in agriculture. We were not BSc, MSc Agri students. We came from a different educational background. So we went out there, we understood farming from the people on the farm who were doing it, and very quickly understood that a couple of decades back, with very little input, we used to get 80, 90 tons of sugarcane output. And now, with so much of input going in terms of fertilizers, the output has dropped to 65, 60 tons an acre. So I think that was the starting point.
Having said that, there's one point about making your own farm or your own land sustainable, because luckily you had enough land to come back to. And then to build it into a viable business is a different ballgame altogether.
Yeah, it's a very different ballgame because it involves people and capital when you want to scale up. Doing our own farm was very exciting. We were experimenting with newer models. Very personally satisfying also. When farmers started looking at us and they were seeing that we're needing less and less inputs on the farm, and our yield is better in terms of quality, not quantity per se, and we were needing lesser water and stuff. And so they plugged into our system and we started hand-holding them also. And then we realized we'll have to put up teams for hand-holding them from seed stage to harvest stage, which we have now. What started off as a small little processing center in our own homes in the village slowly grew into a garage and then to a larger mega kitchen, and now it spreads over 2 lakh square feet. So I think the things, when they start growing, you have to manage more people, you have to manage more capital. That is a different skill set altogether. But, fortunately, we've been managing it till date with the support of our consumers because they love the stuff.
Yeah, but talking about the consumers, one of the big challenges that agriculturists and farmers face is when they have to go and sell their produce. And most of the time, what we hear and what they say is you don't even get the cost of what you put into cultivation. You've had that first-hand experience as well with your first crops.
Oh, yes. So that's a very interesting experience we had. We were growing papaya. And normally a farmer gets 40 tons an acre as yield. We grew it the natural way without fertilizers, and we got a yield of 20 tons an acre, which is half.
Yeah.
Which is half. But the fruit tasted like jaggery. It was so sweet from inside. Lately, if you have had papaya, it is tepid. It doesn't have any taste. Actually, any fruit, you bite into an apple with your eyes closed, a guava, a pear, you won't get to know what it is actually, without seeing it. And similar with the papaya, it tasted different. And we thought, when we take it to the market, they will give us a right value for it. And we took it to the Pune Mandi. And we experienced that process early in the morning at 3:30 a.m. You get your fruit, it gets auctioned, in a system where you don't understand what's happening. And then he came back and told us the market is trending at 10 bucks a kg and you have got 4 rupees a kg. And after asking him why, he said, and I told him, the fruit tastes way better. But he said, a consumer eats by his eyes first and then by his tongue. Your fruit is ugly in the way it looks. And organic is ugly because you're not spraying any kind of pesticides on it to make it shine and look even and right-sized. It's various forms and shapes and it has blemishes on them. And he said, then the consumer eats by his tongue and your fruit doesn't appeal to the eye. That's when we felt like a big setback, because we thought that people would appreciate the fact that it is better in nutrition, it is better in taste, and they would give us a higher value. And we realized that we'll have to put up a system or a platform that is independent and that will allow us to get the right value for good food.
So cut out the middleman.
Cut out the middleman and directly talk to a consumer and spread awareness and get the right value for what we're doing.
But you're talking about a time, and I assume this started when your journey started, about 10 years ago.
Back.
You're talking about a time when organic was exciting, but not such a buzzword. You now have consumers willing to pay a premium for organic. My question, a lot of the organic food that we all buy at a higher cost, it costs more. Is it truly organic?
So, like I said, you'll have to put in systems and processes where you'll have to show seed to harvest traceability. You'll have to show the certifications that you are taking for whatever you're growing. You'll have to open up the farms and processing facility for people to come and visit and see it by their own eyes. And then, of course, ultimately when they consume it and they feel the difference in taste and what it does in their system, then that's a final validation. So it takes time. It's taken us 10 years to develop trust among consumers. It's taken us benchmarking ourselves against the best certifications in the world. So we just got our entire farm and our product certified glyphosate free from the Detox Project, which is in the US. So I think all these processes combined develop trust with consumers.
No, it does for branded stuff out there. But there is no central certification which comes and checks whether someone who's claiming to sell organic food, whether it's actually organic or not.
I think there is a lack of...
Does that exist is my question. Because you're talking about, okay, I will show you my farm. Everyone's not coming to someone's farm to see if they're buying a papaya or a mango or an apple.
I think that system is not existing today, and I think some central body will have to play a role where they become, auditors of sort to see whether that produce is really organic or chemical-free and stuff. And I think that will come with time.
Let's understand the difference about why organic and the traditional way of farming is so out of reach right now. And you can talk about this, Ajinkya, through your own experience. Why did you have to come and change the way, for example, that your father was farming? And was it very difficult to do? How much more did it cost you?
I think it's been a systemic change over the past 40, 50 years. If you look at the up to 1950s, 1960s, the only way farming was being done was organic. It was after the introduction of a lot of the green revolution and a lot of chemicals coming in, is when the hybrid seeds, the modern seeds, with emphasis more on production, and then a different way of farming set in from 1960s onwards. When we came back to farming, like I mentioned, we understood that this gives you more production, which is what all the universities, research, seed companies have been doing. But then, is it sustainable? That's the question. And then, somewhere down the line, we understood that the common denominator in farming is actually the soil. While a lot of emphasis and studies has gone into seeds and crops and production, there's very less attention in the past 40 years that's gone into the soil sciences. So developing the soil biology, the different kinds of bacteria, protozoa, nematodes, earthworms, centipedes, millipedes that get into the soil, how do you increase their population? How do you make the soil more fertile? And then automatically whatever grows on it is bound to be of a good nutrition value, but most of a good medicinal value. So that change of focus is what we got back into the farming. But like I mentioned, the last 40, 50 years...
How much more does it cost you to grow anything organic compared to a regular way?
Cost in terms of monies and time. So I think the curve with organic farming is a little longer. You're using organic manure, which is mostly cow dung, cow urine, or other organic alternatives. It takes time for the soil biology to set in. So it will take you 3 to 4 years to get back to the normal production that a chemical farm gave you. So you lose that 2-3 years of production in that sense to make some sense out of it. And then the good thing is then lesser inputs are required. So if you look at it at a long term, it makes more sense. But if it's a very short term, 3 years, 5 years, then probably it wouldn't make much sense economically.
No, so the reason I asked this because that's a challenge that the sector is facing, right? The reason that we need the kind of mass production is because if everyone went organic, would there be enough food to feed the country? I know it's a philosophical question I'm asking, but it's an important one. I think it's a fundamentally important one, and one that needs to be considered if what you are doing at Two Brothers becomes mass.
No, I'll tell you, this we are often asked that, can we feed the 8 billion mouths with, this kind of production techniques where yields are lower. If you see, and if you analyze data, 70% of farmers worldwide do not grow real food. They grow commodities that are traded. Only 30% farmers grow real food, which you consume daily. And by real food, I mean is fruits, veggies, legume, lentil, pulses, grains and stuff. Now, if we make the other 20-30% farmers grow real food, then I think you'll have enough supply, though if yields drop. So instead of growing commodities, if majority of farmers are made to grow real food, you'll have enough supply. And why don't they grow real food is the next question, because the value that they get for real food is far less than commodities. So if you start paying the farmer more for real food, many more will start growing real food, and you'll have nutrient-rich real food that can feed the billions of mouths.
Yeah, but it has to be packaged and presented. For example, your company is doing well, you've grown, and you have big investors. Nitin Kamath is one of your early investors. You're exporting and present in 50 countries because you're packaged and presented as a premium organic product. My question would be, if your product is truly better in quality, why should everyone not have access to it?
So, ideally, we are working towards that. So, like if you ask us 8 years back, we had a couple of 100 customers. Today, we are being able to serve over 8 lakh consumers across many cities and some countries also. So, I think with time, once you get economies of scale, once you set up, proof of concepts that are scalable, you will be able to service more and more consumers. And also, us becoming successful to an extent has inspired, I think, more than 100 other brands to get into the same business. There's so much of scope for putting up so many brands in the agri space. Very few talented people actually go back to a village and, find out about what opportunity exists out there, what problem can I solve out there. So, us being successful, I think, has inspired so many people. Collectively, many more farmers are practicing sustainable farming. Many more consumers are getting access to this kind of food. You can't change a system that's been there since the last 60 years over 10, 15, 20 years. It'll take at least 20, 25, 30 years to reach the tipping point, after which everybody demands and gets access at a lower, more affordable price to good food. Also, another data point I would like to tell you is that in the US, 30, 40 years back, an average household spent 14% of its income on food. Today, that is approximately 8-9%. So it's also a mindset. You have, as a consumer, you're spending less and less on food. You want food to become cheap and cheaper, whereas your expense on other stuff has increased gradually over time.
Yeah. Tell me what the fundraising journey has been like, because this is an unusual idea, an unusual business to take to VCs or investors who are used to looking at, maybe, are you selling something online? Do you have a platform? Are you delivering it in 10 minutes? None of the above in your case.
So, since we wanted this to scale up economically and sustainably, the model that we established was also making a lot of sense financially. So if you see our growth over the last 5 years, we have been growing at 85-90% year on year. We have been managed to attract talent from pedigree institutions who finds purpose in the way what we're trying to solve for also. So this attracted many people. Like Nitin, you rightly mentioned, who runs a fund called Rain Matter, whose priority is to invest in solutions that solve for climate issues, that solve for nutrition issues, that solve for health issues. So Nitin has been one of our investors. And we were just checking, at the last count, nearly every investor, 90% of our investors are all consumers. So I think somewhere when they want assurance to the food that they're consuming, and many of our initial consumers have invested across the world in our startup.
Was it difficult to convince some of your investors?
There was inbound interest, and yet there is a very strong inbound interest. I think somewhere, even from an investor's mindset, they know the world is changing. After what happened, after COVID, people focusing on the food has become, more and more evident. And I think they're seeing those trends change where brands that are helping solve for that will eventually make commercial sense. And we have had that kind of interest. So it's not been hard. We don't have a banker also. In the last 2 rounds that we raised, it was without a banker.
So you just pick up the call and you tell Nitin that, come on, I have another fund.
No, I mean, they've connected, they've
Or
come
they
to the
call
farm.
you.
I mean, we've had that interest inbound where they have heard about the brand, the work, and they express interest to come and see at the back end, and they've come and seen everything. And then it has materialized into an investment.
Yeah.
I think a lot of investors, especially like Rainmatter, they're also very social impact oriented. So it's not just the commercials. Of course, that forms a big discussion. But that intent, the right money going to the right place, it's coming up.
Are you a profitable business? Can you be a profitable business farming? Or can you be a profitable business if you're a food company? Because you're also now, from the point of view of the consumer, you're a food company, right? You're selling ghee and you're selling pickles and you're selling oils and etc. Atta. You're a food company. So you're competing with, say, the large MNCs of the world who are also food companies. Can you be profitable in this business, in the farming community?
Yes, you can be profitable. And like I was telling you, for the 10 years of existence, we have been profitable for 6 years. It's now only that we are growing and we're investing in capex and processing facilities and farmer trainings and growth at the front end, hiring teams is where we're investing. I think with a little more scale, we'll turn profitable. I think in the next 2 quarters, we'll be turning profitable as such. But if you look at our CM1, CM2, they're double digit. So that itself gives you an idea that such businesses can be profitable because you are seeing it from a lens of sustainable farming. But for a consumer, it is an FMCG product.
Yeah.
It is a consumer product. So on that front, there's a lot of demand for such stuff.
And do you see the competition from the big players? Because now everyone's going organic.
Yeah, the narrative has changed. I've seen, just yesterday I saw a front page ad from a very large food company saying that our stuff doesn't contains lesser sugar and more fiber. So the narrative has started changing. Very large grocery brands have started speaking the same language that we are speaking. They never prioritized consumer health. They prioritized their margins and scalability and stuff. When we came up to consumers with a different value proposition, and that is ringing bells, they're seeing the tides change, and I'm glad that even they're trying to make that shift.
How does this dynamic work in running a business? Oh, you're obviously the quiet one. You're the one who
I think
puts the message
when we started
out.
off, we've been doing everything possible. Wherever there is work, we've been jumping in and doing it. But over a period of time, as the business has expanded, and very early on in the journey, we decided we will do the entire back and the front end, which means the farming, the manufacturing. We have our own dairy, own atta plants, own cold-pressed oil plant, a sister concern that does ketchup, chawanprash, laddus. So it's while it looks like a very FMCG or a D2C brand, we are very manufacturing heavy. So I take care of the back end, which is all the manufacturing, accounts, finance, the supply chain. We are now shipping to the US, to Dubai. We have an entity in both the places. So a lot of operations, supply chain that gets into this, the quick comms, our own website, Amazon's. I take care of all the back end and
yeah, and I take care of the front end, which is more growth-focused, marketing, branding, fundraising. And both of us have an interest in farming because that's been our passion. This business started off, by pursuing our passion. And so we try to spend as much as time on the farm with farmers.
Yeah. Is it easy to work together as your company grows? And clearly you want to see more growth. I believe you've thought about an IPO at some time as well. Do you see, as you scale up, continuing in the same way of work, you'll bring in professionals. How do you go to the next level as a company?
I would say it's been easy because apart from being siblings, we were in hostel together.
Yeah.
From literally from KG till PG. And so, we have stayed in environments where we had to be together. So that has helped. And that has remained till date. For the largest part of our life, we were left, to be with ourselves, and parents are not there in the picture. And that dynamic has continued. And I think the interests are common. Both of us have a very strong feeling towards the duty of being, coming from a farming background. When we were in school and college, we saw people from various other backgrounds who were living a very high quality of life. And when we look back and we see, what is it wrong in doing farming? Why isn't a farmer earning? Those common interests have kept us together, I think.
Yeah. For those who are watching this and maybe have farm land in their family, there's agricultural land in the family and wondering what to do, whether we should sell it off and maybe one high-rise comes there and then, make money. And they're watching this and they're thinking at the back of their mind, is this something that I should do? What should you tell them? What would be your message to them?
I think this has great scope. Family-run farms, even forget a scale business, but even small businesses that can keep you and your family sustainable. There's a great scope. People, due to social media, they can identify brands, they can follow your work, they can develop a loyalty towards your products and your farm. And I think with increasing, AI and stuff growing in other regions where they are predicting a lot of unemployment because of all this, I think farming is one area which will remain viable because it requires people working on the farm, manual work and stuff. And farming is also highly rewarding. You're physically working. Your mind is where you are. It's not in the past and the future. And I think being disconnected from such work environments is also causing a lot of stress in people who are just sitting and working throughout the day. Farming, I would recommend people who have land, like you said, near cities, to opt for farming. You live a better quality of life. There are opportunities to create small brands that give you economic sustainability. And I think you'll grow food for your family also.
The one trend with D2C brands, and the moment they get popular, is that some of the big fish come in and gobble them up and start acquiring them. If you have an offer tomorrow from a large company or a large conglomerate, which is in the food business, is that something you would look at?
I wouldn't comment on any speculation, but we
I
are
think
building.
I've touched a nerve.
I mean, when you build for, irrespective of all of this coming in, you build to become a solid entity. We have not copied any model, any brand. It's a unique solution that we're giving and that we're putting up. And I think it has merit of becoming a strong brand business in itself. And we're building for that.
Okay, wish you the very best of luck. And one thing I think everyone can agree on is that we need to eat better quality, cleaner food, which is grown with care and grown responsibly and with care and love. Thank you so much to both of you.
Thank you.
Tamil Nadu votes decisive, uniquely the way it does.
Politics, power and cinema and all of that in an unprecedented Dravidian script.
This is not an election easy to call. It never has been.
And unravel grassroots conversations with the voices that matter.
That's why we travel across Tamil Nadu to get you the real picture. From the OG of Indian elections comes the next big political blockbuster.
Because
Tamil Nadu
votes
only the way Tamil Nadu does. Tamil Nadu elections on India's original election voice.
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversation.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise.
Presented by Canara Bank. Together we can.
Welcome to the Editor's Cut. This is a special show where we huddle together at the end of the week and try to make sense of the week gone by, give you an idea of what we're thinking in the newsroom, and sort of a forecast of what you could see in the next week. We love inviting in a guest editor on the show, and today we have Gautam Sacharya of UBS with us. Gautam, thank you so much for coming in, and welcome to the Editor's Cut. So the way we do it is we start by sort of going around and talking about what each of us think. So would you like to start off? What has the week been like for you?
Like last few weeks has been another interesting week with a lot of turns, but with a lot more optimism this week than the last few weeks. Investors are still trying to find their feet. Hopes are alive, clearly, but with a lot more caution also. One of the things which one of the investors told me, and which I keep repeating, is that one of the consistent things coming from the US administration in a lot of these ups and downs is that they don't want to stay around for long. Unlike past US such events in other countries. So that's one of the key things to remember, that come what may, it's unlikely they will prolong this war for long. Forget the ceasefire hopes right now. So that also is the reason why I think the markets never panicked. Markets corrected, but markets were never pricing in a prolonged scenario of war and oil going through the roof. $150, $200, oil never moved to those levels despite what was happening in the Strait of Hormuz.
We went up as high as 119, 120.
For a brief while, But markets never priced that this is going to be a prolonged war. And one of the reasons is that at least one consistent message coming out from US all these weeks has been that this will not be a prolonged. Having learned from their own history, this presidency, they have made a comment that they will not like to be prolonged.
So you know, in terms of what I've seen this week, I think the world has swung from, it's a week of mood swings, if I had to put it that way. We've swung from a fear of nuclear war to now an uneasy ceasefire. It's happened just in a matter of hours in the middle of this week. And that ceasefire announcement has actually given buyers chance to get off the fence. People who were wondering, should I come in, should I not? I think the last couple of days has really seen people take a call. This will continue even if there is a bit of rhetoric here and there, some new Lego video. It's not going to matter unless you go back to pre-ceasefire levels of escalation. So the focus now maybe is going to be more on business updates and other things. I don't know how you guys really saw it, and whether you think we're being too hasty to say the worst is behind us as far as at least the Iran war is concerned.
Well, actually on the point that you were making earlier about people, investors finding their feet, and I'll come to this and I'll come to that in just a bit, which is that mutual fund investors seem to have already done that in the month of March. And so those numbers that I saw today are actually the highlight of the week for me. But on this point, very quickly, I don't think that we've seen the end of this story, but I don't think that we'll see the blaring headlines that we saw in the month of March. We won't go back to that level of rhetoric. So there is a little bit of calm that will prevail, in my opinion. I hope I'm not speaking too early.
You know, I mean, to add to this, when you're talking about the ceasefire, I was just looking at data with regards to the Iran-Israel war, which is ongoing from 2024. There was a 12-day war in 2025, after which Trump was the one who brokered the ceasefire then, which went on for several months. Hope again for me is, again, you'll see a deja vu of the same, where the ceasefire probably will prolong. Not sure if there will be a decisive conclusion that comes in on that front, but that's my hope, taking cues from what happened back then in 2025. Coming back to markets, I think taking cues from what Alex is saying, you know, your retail investors and your DIIs have been an absolute pillar of support for our markets, is what I read, because the kind of buying that has come in for this cycle, or in the last 2 years when FIs have been sellers, they have kept pumping in money, and that SIP number gave you that details, because after seeing the 29,000 mark previous month, I think everyone was expecting it'll go below this. Yeah. And it's come way above that. So
can I take the numbers, because this is for me the biggest talking point, right? So if you look at active equity as a category, and this is everything from flexi caps, large caps, etc. This is where a fund manager takes an active call. Over 40,000 crore rupees on a net basis has come through in the month of March. If you look back through the entire financial year, the only month in which the number was higher was in the month of July of 2025, when the number was around 42,000 crore rupees. But if you look down into the details of that, nearly 9,000 crore rupees of that, or over 8,000 crore rupees of that entire 42,000 has come through new fund offers.
Okay.
And so if you net off or you remove the new fund offers from both that number and this number is by far and away the biggest inflow into actively managed equity mutual funds in FY26.
It's a tenga to all the money that's been fleeing out.
It's huge.
Acha, you are selling, please go ahead. We're standing to buy.
And that does not even count. It does not even count. If you look at passive flows, index funds and other ETFs put together have gotten inflows of 28,000 crore rupees in the month of March. Just 1 month. And I'm pretty sure that it's not silver ETFs, as was the case a few months back. It is likely equity ETFs that have gotten inflows in the month of March.
Have you seen that kind of sort of thinking? What are the conversations that you've been having? Today, our big newsroom chatter is about whether we'll see an FII buy figure at the end of the day, even if it's a tiny one. Have those selling figures started petering out?
So I don't want to guess today's numbers per se, but look, FII selling petering out is the first stage, obviously. I don't think they come in to buy as such in a hurry. Because look, the India market was beaten down into the last few weeks, when touch almost 22,000 levels Nifty. That level kind of looked interesting, but the reality still goes back to what was pre-war, etc., which is the risk reward in terms of growth and valuations versus other markets is still not exciting enough for global investors to jump into India. Like this, our conversation suggests they'll still go back to the big AI trades and opportunities in North Asia, then come back to India in a big way.
Does the rupee help? Because from the low, because of the RBI intervention and the measures that have been taken, I just pulled out the numbers, we're off as much as 2.64% from the all-time low. And so therefore, we're hopefully not going to see it plumb those depths in the near term.
But look, from a foreign investor perspective, it's still hurting, right?
It is.
It's appreciated from that low. But for them to actually, at the back of the mind, they have been hurt in the last few months by the rupee move. So they will still be thinking that, okay, my actual returns might be lower in India. So that's on top of what's happened in the last couple of years around growth and valuation. So rupee at this stage helping now. If for whatever reason rupee goes back to 90 or below 90, then it provides some comfort to foreign investors. Okay, what we saw in the last couple of months was a one-off. It's still a more steady 3%, 3.5% annual depreciation currency, which will give them comfort. But I think the fundamental thing is still growth and valuations. They need to get comfortable about India becoming again an absolute and relative growth market, which they still are looking for signals.
Interesting.
Okay, a point I have to make over here is you're talking about FIs who might just go and get onto the AI play. Last couple of days, we've been just looking at the FY26 FI inflows in terms of sectors, and we've had a discussion about it. They've been investors in the capital goods sector.
In FY26?
In FY26, and the bunch of that money has come in the month of February and March. So what is it that is actually making them positive? Is it the domestic growth story that the FIs are looking at and not really just restricting sectors which could have risks, say from an AI perspective, risks from an export market perspective, and they're just looking at India from a domestic growth story perspective? Because only capital goods to be as a sector seeing FI buying is very unusual.
So look, again, when we look at sectors, they're much more dispersed. Capital goods are much more dispersed sector per se, rather than one.
Yeah, I'm sure it's more of a semiconductor data center play is what they're looking at.
So
maybe policy push, maybe moving into policy
I'll
push.
give you some flavor of that, like applies globally also, but in India for sure, is that, look, globally, when you talk about AI, etc., it also flows through the entire ecosystem of capital goods, energy, power. That also is a big beneficiary of that. Similarly, in India, there is an element of that. Secondly, irrespective of what's happening in business cycle, I think one cycle for the next foreseeable few years, which looks very promising even in India, is the power sector. Okay? And the entire industrial supply chain around that looks very, very good. And that is least likely to be impacted by the macro.
Yeah.
The demand supply gap is so much there. That's possibly reflecting what you just mentioned, that they see that opportunity and when you see stock prices correct because of whatever reason, that's an opportunity to get back in.
Yeah, I think one thing that we should focus on if we're looking at what's going to happen next week and where this is going to go next, my sense would be that a big talking point is going to be how the Strait of Hormuz is actually managed. Right now, you've managed to still have Brent at the 96, 97 level, sub even though the traffic in the Strait of Hormuz is a trickle. For 48 hours into a ceasefire, we haven't really seen much movement coming in. Is the world preparing, my question is the world preparing for a scenario where Iran, along with Oman, and maybe a smattering of others, starts charging a premium to pass through the Strait of Hormuz? I mean, call it a toll tax collection or call it whatever you want. That is the reality right now, and then that kind of grows.
So look, is the world preparing? Is too early. The question is, even if theoretically they charge a premium or a toll tax, the question is how much?
Yeah, is it going to be a big downer? Not really.
Not really. Like again, unless they start charging, because ultimately that's not the only
$1 per barrel is
that
the
doesn't change the
rate
equation
going
at a
on.
global level, right?
Yeah.
And there are alternate supplies.
Yeah, because everybody then pays.
No, but,
it has to be competitive also.
But if they take it in yuan and cryptocurrency, as the reports are suggesting, we don't know if that's happening.
That becomes more a geopolitical game also, not just a cost issue. So ultimately, look for businesses. If you look at companies in India or anywhere else looking at buying that crude or gas for their inputs for their processes, they will look at that versus alternate supplies. Like whatever crude is coming there plus the toll versus, okay, can we get it from US or Venezuela or from somewhere else? And that's how markets will play out. I don't think in itself that's going to be a big factor. Geopolitical, obviously.
I find that very interesting because what that tells me is at the end of the day, deals will be struck and an additional cost will just be swallowed in and absorbed along with everything
in a competitive way. Compared to alternates.
No, of course. I mean, they can't overprice it to the extent where then nobody wants to go through the Strait of Hormuz. We'll go all the way around but not come here. And so maybe that's what will end up happening and there will have to be some kind of acceptability to that as well.
But I would, so just from the perspective of a buyer of products that depend on crude oil, I would take that. I'm just saying, look, just finish this conflict off. If you're saying, okay,
it's going to cost a little more.
Yeah, give $1, I'll pay $1 a barrel, just let the crude go through.
But is it going to be only crude? The question is,
Even
is it going to be across supplies,
It'll probably be across, it'll probably be a system in place, it'll probably be a lot of, so the next leg of conflict, if I were to think about it, apart from what Israel and Lebanon are doing, and that's become sort of a, I don't want to say a side story because people die and it's very real, but if suppose that's not center stage, the next leg of conflict is going to be control on the Strait. Does America along with NATO want to have some say? Does Iran, Oman come in? So that's going to be, but we don't go back to the world 6 weeks before now.
I don't foresee a situation, and I keep saying this on these conversations, the tendency is to sound like a geopolitical expert. I'm nowhere close, but I do not see a situation where Iran will let go of control of that is their primary bargaining chip.
Who stops charging taxes once you start? I mean, nobody. But, having said that, big focus for next week. Do you think results now take center stage? Have you been enthused by what you've seen so far vis-a-vis business updates? Of course, the big IT one. What have you made of it?
So look, it's not been disappointing, which is a good start. I don't think markets will overly focus on results. They will look at it and they will react if there are extremes, not the usual course. Okay, the earnings missed by 2% and stocks reacted. That may not happen much.
So the outlook is
the broader macro will drive much more rather than the 2% miss.
Is that because FY27 could have a completely different story than what panned out in Q4?
Absolutely. But if there are big misses or big beats, then yes, stocks will react.
But do you think it will be more in terms of the commentary, the guidance, what the street is watching out for now versus...
So the commentary guidance will be much more tracked closely in terms of what's happening, supply chains and actual demand today rather than what happened in 4Q. Because again, everyone is looking for those inputs as to where the shortages, if at all, how are the prices moving, how are the supply chain bottlenecks changing or not changing. So those commentary will be looked at very closely, and also how that's resolving. Because I think the worry is all the dislocations at a margin which we saw, is it a 1 quarter issue at most or a 3 quarter issue?
My worry though,
or a 1 week issue. That's what they will track.
I think the damage has been done to some extent. I mean, at least my conversations with those in the banking sector seem to suggest that some damage, even though it was for a few weeks, but the LPG squeeze that we saw to smaller businesses has been done. In the banking sector, there may be stress if this continues. You might not see it even till Q1, maybe Q2 onwards if it goes on. And the appeal will be to come in with some relief, at least on payments being made for MSME, because the fact is, a nice example was being given, even for ceramics. There is commercial liquid natural gas available, LNG available, but even the commercial LPG is still cheaper. And everyone's already moved to that system. So that they've not accounted to move back whole hog. So those pain points will be there and they'll still show.
And a lot of companies we've spoken to have been of the opinion that don't be surprised where you will see the full impact come in the first half of FY27 completely. And that's where the worry is, because even they are not able to forecast.
So by Q2 of next year, of this year.
1 and 2. And because they've been looking at the situation on a fortnightly basis, because they don't know what's happening, right? So it's a 15-day view, and that's when they look at what's happening next. So they are worried of the first half of FY27.
My worry is that even, and to your point of how much do you get in the way of guidance, because the companies themselves at this point don't know timelines, and so there will likely be hesitation by company managements to put out any sort of guidance on how this is impacting their numbers.
That's quite likely.
And so from the perspective and the lens of an investor then, how do you take those decisions? Do you take it purely on the basis of looking at, for example, the IT pack, and it's not related to this subject, but just as an argument, you're looking at it with the lens of historical valuations and how it compares to that and saying it looks attractive right now, but can you make the same argument to other sectors that have seen supply shocks? I don't think so.
And it's a tricky one. It's a tricky one, very tricky one. And it'll be interesting how markets navigate this, because it's a tricky one.
What are you focusing on in terms of key areas, Gautam? I'd like to know your thinking going into result season, because you're right now the data you're getting is probably feeling like a huge lag because it was in a very different world. But what are the key sort of indicators that you're focusing on?
So look, one indicator is get granular details about the dislocations they are seeing on the ground today, and how long does it take to unwind that. That will help in some way frame the outlook for the next couple of quarters and try to quantify the first half impact. But in terms of sectors, there's all, look, again, at a broad macro level, we are still underweight India in EM context. That's our strategist view. Our strategist still underweight India. Again, same growth valuation perspective on a relative basis. There are still other interesting...
Haven't valuations come off enough now?
No, not really.
Really?
Not really. So
where would you be comfortable with?
I think at 22,000, our EM strategy doesn't have a level where he'll be comfortable with. I think 22,000 level is a level where Indian markets have bottomed out twice, like last year also and this year. Okay. Now at 22,000 levels, is it a level where the valuations are screaming levels, attractive? Maybe not. But at least it's clearly bottomed out twice. That's one way to look at it psychologically. Ultimately, more than the level, it's also about the visibility of growth. So when do we start seeing growth recovery actually happen? And surprising also, like I think 2-3 months back, there was some hope building up in the markets that growth will not just come back, but there's a possibility growth surprises when we saw credit growth numbers. Okay, like maybe it's turning, not just turning because of a low base effect, that because of a low base you'll anyway have growth in FY27, but actually going back to the earlier periods of higher growth. So once markets start seeing that, then in India's case, look, many investors look at India, great bottom-up companies, stories, great long-term growth opportunity, but the interim has been tough. So So the moment they start getting comfortable that it's still is going to be a high double-digit earnings growth market.
Just to the point that Tamanna was making, I want to drill down a little bit in that, which is haven't valuations come off? Maybe at the index level, and even if you look at the broader markets, the argument is that no, you are still relatively expensive. But the point has been made by money managers here in India that at individual company levels, the destruction has been so dramatic in certain pockets that it does become attractive, does it not? You don't buy that?
So individual stocks always happen, even at the peak of even in bubble markets, there are always individual stocks which can always be attractive. But again, to the generic comment about market correction and individual stock correction, it's a question of what time frame you're looking at from a relative valuation perspective. Like if you compare to last 5 years, 6 years, yes, there have been corrections has been a lot more. I'll give you a simple way to look at a market Nifty level. If you look at headline, consensus-based, Bloomberg-based forecast, and they look at multiples, 16 times is where India has been bottoming out in the last 10, 12 years. That's where 22,000 levels would be. That's where. But if you go 10, 12 years before and go to long history, 16 times is where it used to peak. Okay.
Yeah, but you also didn't have this wall of money coming from domestic investors.
That's a technical argument, not a fundamental argument.
A lot has changed. A lot has changed in this time as well.
So the technical support is definitely there, and that's why depending on where if you are comfortable, the local wall of liquidity will keep on continuing. And 16 times is a good level to have a good support.
March is decent to give you a supposition that will continue.
Correct. And I think a few of the things that will pan out even as we wrap up, one is that inflation in input prices across the board for companies are beginning to be seen and will continue to be seen. The fact is crude is still at 96, 97, not at 80, 85. So that continues to be seen. All of their derivatives, all of this doesn't go away in a way. So I think that's all of Q1 is going to be a little painful.
I think that markets might see through.
Yeah.
That market might see through. Again, if the overall thing stabilizes and there's visibility on supply chain normalizing, I think that market will see through.
All
That's a hope of pessimism or optimism is what we should look at from here on.
No, I think that's pretty optimistic. I think it's nice that we're ending this week on an optimistic note after everything that we've seen. That's pretty much time that we have on the Editor's Cut this week. Thank you so much for joining us, and we'll hope to see you back again next Friday with much more to unpack. But for now, it's seeming like we may have a decent start next Monday as well.
Well, Anand Rathi Wealth has come out with a strong set of numbers, and they have also announced a bonus issue of 1:1 as well. But to get in more perspective about the earnings and the outlook ahead for the company and the industry, we are joined in by Feroz Aziz. He's the joint CEO at Anand Rathi Wealth. It's always a pleasure to have you, Feroz, with us, and congratulations on the good set of numbers. But just want to understand the overall sentiment in that HNI category which you are catering to. Has that actually, the growth rates which we are expecting maybe 2 years ago when the IPO had come of the company, and now seeing the market conditions, is the asset allocation playing a bit differently? And if yes, is it hitting the equity segment, at least for the segment which you are catering to?
Yes, Sharad, but I think this is my 18th quarter as a company result. So we got listed in December 2021. This is our 18th quarter. We've always been telling our shareholders what to expect out of us. And because we understand our client segment and we filter our clients on certain basis. So to answer your first question, whether the asset allocation has changed, the answer is no. When markets are down is when we get our clients to buy more. Are they inherently very positive at these times? The answer is not at all. That's when me and my colleagues, 393, 400 of us, go into the market and tell them that market always goes up. That's the reality. There have been 12 wars. Market has gone back up once the war has finished. But that data is too difficult for one to notice by himself or herself. So we as advisors handhold them, is why you would see a large portion of equity allocations happened in this quarter when the market sentiment was bad. Left to themselves, I as an HNI will also be very depressed. There has to be some Sathi who comes and brings in rationality rather than the heart aspect of wealth management. That's why you see net mobilizations have been good for the quarter. Asset allocation has not changed though.
Okay, so the asset allocation hasn't changed, but the growth rates which was there, I think you have given a growth rate of that 20 to 25% growth rate. Will that continue? Will you stick with that guidance going ahead also in the long term, or is there something there for the medium term which is different?
No, it's not very different because we've created a very uncomplicated business. Our pitch to the client is also uncomplicated. To the shareholder also, we have a very uncomplicated business. We don't sell agile things. We sell to our clients what is actually needed, not something so innovative that money becomes experimental. So coming back to your question of what's the growth guidance, we have guided 1,415 crores of revenue on a base of 1,198, which is what we finished last year. We had again projected 1,175. We did 23 crores more of revenue than projected, owing to the principles which our elders in the company have laid down. Don't overcommit, always undercommit and over-deliver. With the same principle, we are committing a revenue of 1,415, a profit or a PAT guidance of 460 crores, and an assets under management guidance of 1,20,000 crores. We ended at 93,000 crores. These again have to be seen with a conservative bent of mind when we guide, and that's where you see last 4 years we've always given a guidance and have met it, and there has been not any quarter less than 20% growth, and we are one of the few companies which have been able to do that for 18 consecutive quarters.
Well, thanks a lot, Feroz, for that, and a lot of our viewers must be seeing how the business is actually run in private wealth and how you sustain. So this is very much important. Thanks a lot, Feroz, for giving your views, and best of luck for the future.
Thank you, sir.
I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversations.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
कुछ खास होने वाला है.
Tamil Nadu votes decisive, uniquely in the way it does.
Politics, power and cinema and all of that in an unprecedented Dravidian script.
This is not an election easy to call. It never has been.
And unravel grassroots conversations with the voices that matter.
That's why we travel across Tamil Nadu to get you the real picture. From the OG of Indian elections comes the next big political blockbuster. Because
Tamil Nadu
votes only the way Tamil Nadu does. Tamil Nadu elections on India's original election voice.
The government has a very focused, very intelligent, very smartly devised policy for renewable energy. We combine that with the Indian talent for innovation. With these faculties that we have, I believe that anybody can follow.
क्या सर्च इंजन के चक्कर में पड़े हो दोनों? अब कोई कंफ्यूजन नहीं। कॉल 9300
Swiggy co-founder Nandan Reddy steps down to pursue personal projects. The food delivery platform will induct 2 senior insiders onto its board as executive directors. In a bid to manage surging power demand amid gas shortages, the government has postponed the annual shutdown of nearly 10,000 megawatts of thermal capacity while ensuring coal stocks stay comfortable. As demand for induction cookers jump, sources tell NDTV Profit that the Power Ministry is engaging with electric cooktop manufacturers to iron out hurdles in scaling up production. Amid strikes in Lebanon, US Vice President J.D. Vance leaves for Pakistan for peace talks. J.D. Vance remains firm, says US won't be receptive if Iran tries to play with them. After over 4 years of war, Ukraine sees progress towards a potential peace deal with the Kremlin. Ukraine's top negotiator with Russia says that a resolution to the war may not take long to achieve. US Secretary of State Marco Rubio is set to visit India in May after meeting with Foreign Secretary Vikram Misri on trade defense in Washington. RBI proposes new measures to prevent cyber frauds. RBI proposes 1-hour delay for transactions above 10,000 rupees. March AMFI data shows strong momentum with active equity mutual fund inflows recorded highest since the month of July, marking a 56% surge than the previous month. SIP is at a record high in March, standing at 32,087 crore rupees. Nifty rebounds in trade and closes about 24,000 odd levels. First time in a month, benchmark indices post highest weekly gains in 5 years. Almost all sectoral indices show significant recovery. Hello and welcome viewers. This is Profit 360 on NDTV Profit and I'm your host Malika Mishra. Along the next half an hour, we'll bring you the latest on markets and national as well as international news. On to our top story of this evening. The Reserve Bank of India, in a very significant move, has proposed important changes for non-banking financial companies or NBFCs. NBFCs with assets over 1 lakh crore rupees may now be placed in the strict upper layer list, which brings tougher rules on capital and governance. The RBI's current list of upper layer NBFCs include about 15 entities or so, and Tata Sons is also present in that list and applied for deregistration as upper layer NBFCs to the RBI a couple of months ago. My colleague Piyush Shukla joins in with more details. Piyush, give us more information on this.
Yeah, Malika, that's absolutely right. The RBI has proposed to bring in 3 amendments to the master direction, which is for classification of upper layer NBFCs. Now, what are the key amendments that the RBI has proposed? Like the first one, like you mentioned, is that they have now set aside the earlier qualitative and quantitative rating criteria for NBFCs to be eligible to enter upper layer list. Rather, they have said that NBFCs with asset size of over rupees 1 lakh crore will now be eligible to enter the upper layer list of NBFCs. The RBI has also today said that proposed to bring government-backed NBFCs in the upper layer list. Till now, they were not a part of this list and were exempted from the classification. We also have reported today that RBI the upper layer NBFC list will be periodically reviewed, and the ceiling of this 1 lakh crore will be reviewed every 5 years. So over the next 5 years, we can expect it. After next 5 years, we can expect it to rise further. Now, what do experts tell us? Who are these NBFCs? First of all, it is important to know that among the 15 current upper layer NBFCs, Sammaan Capital and PNB Housing Finance do not have 1 lakh crore in overall assets, in their AUM. So that is point number 1. The point number 2 is government-backed NBFCs like Hutco, IRFC, IREDA, PFC, REC. These are some of the government-backed NBFCs which have over 1 lakh crore rupees of AUM. And we can expect these entities to fall under the upper layer category going ahead. And this is a very important development in this particular, the amendments that RBI has brought in. These 5 will be the next entrants in the upper layer NBFC list. Back to you, Malika.
Okay, all right. Thank you so much for that update. Of course, viewers, we have Gurmeet Chadda, Managing Partner and CIO at Complete Circle, joining us to further understand the story. Thank you so much, Mr. Chadda, for joining us on the phone line. So this is a very important development as far as scrutiny on upper layer NBFCs is concerned. I'd like to understand from your perspective, what is RBI trying to achieve from this particular proposal?
So, thank you for having me. I think this is another series of steps in terms of, more reforms and strengthening the BFSI sector. See, the earlier metric of upper layer was 70% quantitative and 30% qualitative with multiple scoring options. This makes it very simple, which is 1 lakh crore. The asset base becomes the only criteria. So that's one, makes it clear without any ambiguity. Second, includes state-run NBFCs. So, as your colleague pointed out, they become part of it. And third, it also allows you to use the state-backed guarantee and state bonds as an instrument of credit risk. Now, this is important, and probably I would want to hear more details on this because this will have implications on both risk management and excess capital or whatever is available. So I think it's a welcome step. Reduces risk in the system for large NBFCs, which are systematically important. The capital requirements accordingly would change, and some of the current ones in the list will move out. Some of the new ones will join in. But overall, makes the system robust and makes the process very simple.
Mr. Chadda, you pinpointed that some of them may move in and move out, and from that perspective, we also know that Tata Sons had applied for a deregistration as an upper layer NBFC, and if that were to go through, what kind of implications do you see, and would that also in a way inspire others to follow suit?
Yeah, I mean, currently it would be very speculative to comment on it because the SP group obviously wants Tata Sons to list. Now, whether RBI makes an exception and allows it to deregister, we'll have to probably see. And this is a discussion paper. The changes will take time to come in. So, but if Tata Sons were to list, obviously leads to a lot of value unlocking. In that entity. But let's see. As I said, very early to comment and too speculative.
Mr. Chadda, just one last question. How does this move really affect the end consumer? Is there something important that we must take away from this news?
Not really. It doesn't. So the larger ones, anyways, are well capitalized, and but it's important from as I said, state-run NBFCs. They come under this the PFCs and RSCs of the world. I'm sure that there's a broader guideline they have in mind because the energy security focus will further go up. The financing requirements will change as India builds now on its energy security, and especially the power lenders and the infra lenders. I think would become more robust. So nothing from an end consumer. I think entities which become part of this. I think once more clarity comes, we'll have to see whether they'll have to, raise more capital, or from a risk management point of view, what all needs to be done. I think that's something we'll have to then take a call stock-wise.
Right. Thank you so much, Mr. Chadda, for helping us make sense of this news. Viewers, as RBI tightens its screws on upper layer NBFCs in a significant corporate leadership rejig, Swiggy co-founder Nandan Reddy is stepping down from the company. His resignation became effective immediately on April 10th, 2026, that is today. Nandan said he is moving on to pursue his own independent personal projects. In a related board change, Swiggy will bring 2 key insiders as executive directors. Co-founder and Chief Growth Officer Fani Kishan will join the board, and Group CFO Rahul Bothra will also get a seat on the board. Now, this marks another leadership shift at the food delivery giant after its public listing, and therefore, from that perspective, it becomes even more significant. But on to another important update. For money transfers above 10,000 rupees from one account to another, there will be a 1-hour delay before the money reaches the receiver. And this isn't a final rule, but the Reserve Bank of India has proposed this measure for UPI and other digital payments. In fact, my colleague Piyush Shukla sent us a report earlier for all the details around this news. Let's take a look at that report first.
The RBI yesterday came out with a discussion paper to explore additional ways, additional measures that can be imposed to curb the menace of rising digital frauds. The RBI has particularly proposed 4 additional measures which can be taken and are accepted globally to curb frauds. The first one being that for certain high value transaction of say over rupees 10,000, RBI has proposed this limit, it is not final. But they have said that for over 10,000 rupees of transaction, digital transaction, they will introduce a 1-hour window wherein there will be a lag credit in the creditor's account. So when you do a push transaction, whether it be UPI, MPS, NEFT, RTGS, the debitor's account, it will receive money after 1 hour. And the UK, Singapore, Sweden, they have already announced such measures earlier. As per the information with National Cybercrime Reporting Portal, transaction above 10,000 rupees, the fraud, while the value is, the volume is very low, in terms of value-wise, over 98% are transactions which are over 10,000 rupees. So this is very important measure that the RBI has proposed.
So it's now time to get an expert opinion on how exactly will the RBI's 1-hour delay proposal for UPI transfers above 10,000 affect everyday users. Joining me now is Amit Das, co-founder and CEO at Think360.ai, pardon me. Sir, thank you so much for giving us your time. Welcome to the show. As a regular UPI user, how much of a hassle will this 1-hour delay be for genuine high-value transfers like rent or school fees or medical bills? Will it slow down daily life too much?
I think the intent is right. That's something that we can all agree with, because it gives you the window of about an hour to kind of deal with a potentially fraudulent transaction. Now, when we think about the recurring transactions, they are not a part of this design that is being proposed. But in certain cases, when you think about you're standing at a hospital, you are in the middle of an accident or a crisis scenario, and the other party is not going to really move forward till the time they see the proof of payment in their account. I think those are scenarios that will kind of be under scrutiny for a while. But there's a lot of detailing around this draft guideline that is yet to happen. I'm hoping that some of those scenarios will be clarified. And more importantly, I think there is sort of a risk-graded response rather than this blanket response saying 10,000 and I want a 1-hour freeze. Additionally, I would like to believe that we should introduce some sort of a way to notify the receiver that the sender has done the transaction, but the account is going to hit in an hour. So you're kind of covering for all the parties in that transaction, and that I think should take care of things.
Okay. I think one important clarification that we must highlight is when you said this does not apply to recurring transactions, and recurring transactions can differ from one person to the other. For example, I could buy a shopping bag for, I could buy a bag for about 20,000. And would this kind of purchase also be applicable for this proposal?
I think by the time we see the final guidelines, the merchant transactions, point of sale transactions, some of those things will start to be kept out of this scenario. So we are really not saying that I'm swiping my credit card at a mall shop, one of those branded outlets, and I still am going to have a 1-hour hold on the transaction. This is sort of in that realm where P2P transactions or there's sort of merchant risk assessment that has to be brought in. Otherwise, many people, and that's why the 98% sort of a number that Piyush was referring to becomes relevant. There are a lot of high-value transactions where you do not have the freedom to be kind of stuck for an hour.
Right. That is exactly why there's a lot of curiosity around, executing this particular proposal. The RBI has extra safeguards in mind for people aged 70 plus and differently abled users. Yeah. From an AI perspective, do you think a trusted person approval system will actually work on the ground, or could it create new problems for families?
Again, right intent, very not fully thought through design. Three problems, right? So one, you're moving the control from the senior citizen to, let's say, what you believe is a more able person or a more aware sort of person. So the issue is awareness. The issue is not your age, really, right? So to speak. But because we know that the segment that has been targeted the most, I believe 90% plus of the fraud is happening in the senior citizens and differently able people segment. So the intent again is not something that I'm going to question today, but it does add several friction points, right? So you are waiting for, let's say my mother is waiting for me to confirm a transaction before it goes through. In certain cases, it will lead to some second, the hill of good intention. There will be newer sort of frauds coming in because of this. But most importantly, and I think it's one of those social elements also, that you are taking the agency away from these senior citizens, which I don't think is, with the increasing longevity, I don't think that's a perfect solution, so to speak. So a lot of design element issues. I think you got to look at the core issue as being awareness and knowledge, more than saying that your age is kind of the issue here. So that's where I think the friction will be a problem.
Right. Thank you so much, Mr. Amit Das, for joining us on this important conversation. As you said, the intent is right, but it is not well thought through yet. But of course, once it comes in and we read the rules in under the blanket, I hope that it is easily executable. Thank you so much for joining.
Thank you so much for having me.
And viewers, the government is taking urgent steps to manage power demand amid gas shortages, deferring the annual shutdown of nearly 10,000 megawatts of thermal capacity to keep supply steady. Power Ministry officials say this move will help offset the shortfall from gas-based plants, even as plans are underway to add 3,500 megawatts of additional thermal capacity. Coal stocks remain comfortable for now, but the situation is being closely monitored. Let's listen in to exactly what Piyush Singh, Additional Secretary, Ministry of Power, said on the same lines.
Considering the requirement and because of certain loss of gas-based capacity during this period, we have deferred our plant maintenance for the next 3 months, and this has ensured availability of around 10,000 megawatt again for this period. Besides this, because of our strong coordination with Ministry of Coal and Indian Railways, we are able to maintain a very good stock in all our thermal power plants. Currently, the stock is around 55 million tons, which is sufficient for the next 19 days. And the supplies are very robust and continuous, and we are regularly monitoring through all the 3 ministries jointly. In addition to that, in next 3 months, we have targeted some capacities to be added. Around 22,000 megawatt capacity we are planning to add in next 3 months, of which thermal is around 3,500 megawatt, solar is around 10,000 megawatt, wind is around 2,500, and hydro is around 750. With the addition of these capacities, our availability will also go up.
And as the government tweaks its power strategy, concerns over energy supplies do remain, and there's assurance coming in from the country's top refiners. Speaking to NDTV, IOCL Chairman A.S. Sane says India has taken adequate steps to mitigate any crisis, with crude oil and LNG supplies remaining ample to meet both commercial and household demand. Let's listen in to what exactly he said.
So I will take you through the mitigation measures that we have taken. We have concerns we have the dependence, I will say, on 3 particular issues: crude, LNG and LPG. These are the 3 areas wherein we are dependent on foreign supplies. For crude, we have taken enough efforts to source crude from various geographies of the world. And today, I can tell you very confidently that crude oil is amply available with us to meet the requirements of petrol, of diesel, of kerosene, of aviation fuel. All these things are very much taken care of. We are not facing any trouble whatsoever anywhere in the country. The LNG, the second part, the liquefied natural gas, is also available amply all across the world, and it is very less affected by this conflict. So that's why we are sourcing LNG from wherever it is available, and we are making it available to the industry, to the households, and the government and the OMCs. We are encouraging people more and more to convert from LPG to LNG side, so that the industries are converting more and more towards CNG, the compressed natural gas, and the households are converting to piped natural gas, that is PNG, which is a cleaner fluid, which is a cheaper fluid, and which is amply available all across the world.
Viewers, in an impressive move, FIIs have bought Indian equities after 44 days of continuous selling. FIIs have net bought shares worth about 672 crore rupees, while the domestic institutional investors have also bought shares worth 410 crore rupees. So that means overseas investors are coming back while DIIs continue to show confidence in Indian equities. We have my colleague Parth joining us at this moment from the newsroom. Parth, can you give us some statistical picture on this?
Yeah, sure. So both FIIs and DIIs have acted as net buyers on 10th of April. FIIs have net bought shares worth 672 crore today, and DIIs have net bought shares worth 410 crore rupees. Now this is a big relief for investors because FII have turned net buyers after a long selling streak. Their last time FIIs net bought shares was on 25th of February, which was worth 2,991 crores. March actually witnessed the highest ever FII monthly sell-off, which was in which FIIs dumped shares worth almost 1,22,540 crores. Now the possible reasons behind this shift could be the recent ceasefire announcement that has been between US and Iran. Also, the RBI's recent policy might have provided some macroeconomic and rate cut stability, and also the large cap valuations have become much attractive after we have seen the recent sell-off in March.
All right, thank you so much, Parth, for giving us that picture. Of course, FII is buying Indian equities after 44 long days of selling is an important update, and it shows investor confidence from abroad in Indian equities. But on another positive movement, especially as far as India-US trade deal is concerned, viewers, US Secretary of State Marco Rubio is scheduled to visit our country in the month of May. The visit aims to reset and improve ties between New Delhi and Washington, which were strained by US tariff policies. US Ambassador to India Sergio Gore said Secretary Rubio looks forward to the trip next month. Rubio recently met India's Foreign Secretary Vikram Misri in Washington to discuss bilateral relations, and this comes as both countries work to strengthen their partnership after recent trade tensions. But let's give you some updates on the Middle East war. Middle East remains on a knife's edge, viewers, with a fragile ceasefire hanging by a thread. Iran has issued a sharp warning, vowing no aggressor will go unpunished, even as US President Donald Trump ramps up pressure, slamming Tehran over blocking oil flows through the Strait of Hormuz. Adding to the global chorus, the UK Foreign Secretary has reiterated that the Strait of Hormuz must remain free, calling for uninterrupted navigation and zero restrictions. Amid escalating tensions, high-stakes diplomacy is now in motion. US Vice President J.D. Vance is headed to Islamabad for crucial talks with Iran. In fact, Pakistan's Interior Minister Mohsin Naqvi has led a top-level security review, ordering foolproof arrangements for visiting delegations. Meanwhile, Israel has opened another diplomatic track with Prime Minister Benjamin Netanyahu, clearing direct talks with Lebanon focused on disarming Hezbollah. The big question is, however, can talks really cool tempers, or will the ceasefire in fact collapse? So that is something that we're tracking as far as the Middle East war is concerned. But another fallout of this war, viewers, is the impact that it has had on crude oil prices. And if you speak of the movement today, MCX crude oil prices are heading for a weekly loss this week due to a fragile ceasefire between the US and Iran. In fact, both Brent and WTI are down about 11% for the week, and this is the biggest weekly drop since June 2025. Today, Brent crude rose about 1% to over $96 per barrel, while WTI climbed to nearly $99 per barrel. They've relaxed furthermore through the course of the day. And the main reason for oil simmering down below $100 mark is the 2-week US-Iran ceasefire, because that is really being taken into investor stride. And this has also reduced supply worries, even though tanker traffic through the Strait of Hormuz remains low. US kicking off, in fact, with an important another update as far as this war is concerned. Sources tell NDTV Profit that the government